announces 30% tariffs on goods from the European Union and Mexico, which will take effect from August 1st. The European Commission President said the EU will take necessary steps to safeguard the interests of the European Union. Oil prices edge higher, adding to Friday's gains as investors eye further US sanctions on Russia. Meanwhile, gold prices remain steady amid trade worries. IT major HCL Tech will come out with its first quarter numbers today. The company is set to report weakest growth amongst peers, while margin is expected to dip despite no wage hike. And CNBC-TV18 Newsbreak confirmed as multiples PE and Mithun Sancheti come together to acquire 32% stake in VIP Industries held by promoters. The buyers will also make a mandatory open offer for an additional 26% stake in the company. Well, good morning from the Mumbai News Center. I am Vamakshi Thoria and you're watching Power Breakfast on CNBC TV18. First up, let's take a look at what the Asian markets are doing. Well, to begin with, the handover that came in from the US markets was not all that great, and we'll talk about that in a little bit more detail. But for now, there are jitters across some Asian markets like Japan, which have experienced, which have received rather some tariff letters from the US administration. The Japanese markets for now are down almost 0.4%. But what's leading the declines is the Taiwanese market. Take a look. That index is also down and out in trade today. Apart from that, the Hang Seng is rather flat but trading with a negative bias. Shanghai, on the other hand, is trading with a gain of almost 0.5%. The Kospi, though, the South Korean index, doing quite well despite receiving the tariff letter from President Donald Trump. Now, let's also take a look at what happened in the US markets then. Wall Street ended Friday's trading session lower after US President Donald Trump announced a 35% tariff on Canada and threatened higher tariffs across the board. The Dow loses more than 270 points, while the S&P 500 shed 20 points. The tech-heavy index, the Nasdaq, also lost 45 points. Friday's losses pushed the major averages into the red for the week. CNBC's Angelica Peebles gets us a wrap of all the action on Wall Street.
U.S. markets were down across the major indexes in Friday trading, a day after President Trump escalated trade battles with new tariff threats. The Dow lost 279, the S&P 500 down 21, and the tech-heavy Nasdaq tumbling 45. Bitcoin reached all-time highs overnight into Friday, crossing 118,000, thanks to institutions buying into Bitcoin ETFs. According to crypto investment research firm SoSo Bitcoin ETFs had their best day of inflows of the year Thursday at nearly $1.2 billion. Investors have been expecting Bitcoin to break records in the second half of the year as corporate treasuries accelerate their buying spree and Congress gets closer to passing crypto regulation. And the Treasury Department on Friday posted an unexpected surplus in June as tariff receipts surged. The surplus of more than $27 billion followed a $316 billion deficit in May. The June receipts bring the fiscal year-to-date deficit to $1.34 trillion, up 5% from a year ago. But with calendar adjustments, the deficit actually edged lower by 1%. That's what's happening here in the U.S. Back to you in Mumbai.
Well, thank you so much for that, Angelica. And the U.S. equity futures continue to slide as Wall Street contends with continued tariff risk and second quarter earnings on deck. On Saturday, President Donald Trump said the U.S. will impose 30% tariffs on the European Union and Mexico starting August 1st. Leaders of the EU and Mexico indicated that they intend to keep talking with the Trump administration this month in an attempt to agree on a lower rate. As of 7:15 a.m., S&P futures fell 30 points, while Nasdaq 100 futures dropped 0.5%. Futures for the Dow Jones Industrial Average were down 207 points. Well, as investors assess Trump's tariff threats, the U.S. President Donald Trump told reporters that revenue from tariffs will reach extremely strong levels in about a month. Let's listen in.
Our country made $25 billion last month, $25 billion. It hasn't done that in a long time, and a lot of that's done because of good management, and number one, and maybe even more importantly, the tariffs that are pouring in. We have tariffs pouring in at levels that we have never seen before, and they've only just started. That's really a small portion. It's mostly from cars and aluminum and steel, a little bit of lumber. But they'll really start in about another week. And then in about a month, they'll come in at levels that are extremely strong. We're dealing with other countries, and certain countries that would rather have a deal than a regular tariff. And we're willing, if they're willing to open up. These are countries that have been shut to us, but we've been open to them. In other words, they wouldn't let us do business there, but they would do business in our country. Not a fair deal. So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent.
While staying with the Wall Street, then let's also listen to what Urian Timmer of Fidelity Investments had to say on the US market impact from Trump's tariff salvo.
I think the markets are taking a wait-and-see attitude after the back and forth lurching of the headlines back in April. We got earnings season, of course, coming up next week. So I think there's a good chance that the earnings numbers will actually start to come back up again. And I think the market is pricing that in at a 23 multiple. So I think the market's in good shape. The breadth numbers are good, above the 200-day moving average, about 65%. So I think the overall health of the market is pretty good, and industrials and financials and consumer stocks are joining in with tech and communication services. Even global markets are at a new high, so it's a good situation. The downside, of course, is that if we do actually get the tariffs that were warned back in April and then were taken off the table a few weeks later, that could depress profit margins or increase consumer prices to some degree. I think this is why the Fed is on hold, which in my view is the right thing to do.
Well, that's all the global market action we have now. But how will all of these overnight cues impact our Indian market? We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. Let me first start off with how the trade setup looks like. Well, the markets in India continue to slip for the second straight week. Both the Sensex as well as the Nifty are down almost 1% each last week. Keep in mind that the previous week started off with hopes on a mini trade deal between the India and the US, but there has been no clarity yet. That does reflect on the kind of caution we're seeing in the Indian markets. IT has been the biggest drag on Nifty last week. Take a look at HCL Tech, TCS and Wipro. They were among the top losers. On the flip side, what did well was the FMCG index. It was in fact the only sectoral index which was in the green. Now, when we look at the broader markets, they continue to underperform the benchmark indices. The Nifty mid cap as well as Nifty small cap fell somewhere around 1.5% last week. And the losses were actually led by some capital market plays, which included BSE and MCX, which were the top mid cap losers. Now, as far as this week's session and today's session is concerned, as far as economic cues are concerned, we'll be watching out for India's WPI and CPI data, which will come today. Later this week, we'll also be keeping an eye out on China's GDP, India's trade balance data, as well as the US core CPI and PPI data. Now, today's news flow will largely be dominated by numbers. Results, we're keeping an eye out on HCL Tech, Tata Technologies, Ola Electric, Rallis India, as well as Tejas Networks. There's also a new listing lined up today. Travel Food Services will make it to the Lal Street, so we'll be watching out for that. And a new IPO opens. Anthem Biosciences will be launching its 3,395 crore IPO. Important levels on the downside, the support comes in at 25,000. On the upside, 25,350 could be a resistance. Let's take a look at what the GIFT Nifty is indicating. It'll come up for you on the screen in just a bit. It's indicating a negative start, down almost 43 points. But then let's also focus in on the stocks that will be in focus today. Ria is here to take us through that. Ria.
Good morning, Vamakshi. Let's take a look at the stocks that are going to be in focus today. First up, VIP Industries to be in focus since the promoters are set to sell a 32% stake in the company at a price of rupees 388 per share. Apart from this, going on to the Q1 numbers and the business updates. For Avenue Supermarts, the net profit has been largely stable at 773 crores in this quarter, and the revenue has been seen going up by around 16.3% compared to the previous year. For Sula Vineyards, they've come out with their Q1 business update. Net revenue has been seen going down by around 7.9% over the previous year. For all cargo terminals, the June CFS volumes are down about 4.5% month on month. Going on to Ajmera Realty for the Q1 update as well. The sales value has declined by around 65% on a year-on-year basis, but if you look at the collections, those have gone up by around 42%. For Kolte Patil Developers as well, the collections have been seen going up by around 10% compared on a year-on-year basis. And for IRB Infra, the June toll collections have gone up by around 5% compared to the previous year. Moving on from these three pharma stocks will be in focus today. First up is Gland Pharma. They've received the GMP compliance certificate from the Danish medicines agency. For Wockhardt, they have exited the US generics business, which had been loss-making for the past several years, and the focus will now shift to the innovative portfolio of the company. For Glenmark Pharma, they have received a warning letter from the US FDA for its Indore facility. So all three of these stocks will be in focus. Two other stocks to keep on your radar. NCC has bagged a contract from MMRDA worth about rupees 2,269 crores for the Mumbai Metro Line 6. And the last one is Akzo Nobel. JSW Paints has launched a 3,929 crore open offer to acquire up to 25.2% stake in the company.
Thanks for that, Ria. And finally, we now have Mangalam joining in with cues from the FNO space. Monday blues for the market, Mangalam?
Monday blues for the market, but it was more of an extension of the Friday blues that we saw. If you look at it, on Friday, we saw a sharp gash on the frontline indices, and this despite the Nifty Bank not falling as much. In fact, the Nifty Bank was an outperformer on that trading session. It was led lower by the IT stocks. The broader markets, while the mid-cap index fell in line with the frontline, the advanced decline tells you that there were way more number of stocks which were lower than the number of stocks which were higher, so the portfolios would be bleeding. We did see a small spike in the India VIX, which is a positive because the India VIX has been so contained that it may have been pricing in some sort of complacency, and that's something that I'd be watching out for today as well. There was a big sell-off by the FIs in cash market, in stock futures, in index futures, and in index options. So cash market sell was close to 5,100 crores. In index futures, they've been net short, but they've only increased their shorts a lot more. They sold almost 3,500 crores, unwound 6,000 longs, and added 12,000 shorts. So as a result of which, the net short contract for the FIIs this time around has crossed that 1 lakh mark. So in the last 4 trading sessions itself, longs have come down from 29% to 20%, while the net short exposure has increased to 1 lakh contracts. And they've also sold 1665 crores in stock futures, like I pointed earlier. And in index options, they sold almost 3,200 crores, and they added twice the number of calls on the short side as the number of puts, telling you that on the way up, there will be a lot of supply coming in, much more than the support that we are likely to see. What is that supply likely to be at? Around 25,300 call. That's been extremely active. 25,200 call. That's been equally active as well. So between 25,300 to 25,400, we might see some sort of supply. But at lower levels, the 25,000, psychologically important, put writers are fairly active out there as well. From a technical level standpoint, the Nifty 20-day moving average will be the resistance. For the Nifty Bank, the 20-day moving average will be a support because that's where it bounced from. And for the Nifty IT index, 100-day moving average will be a support. Just watch out for Glenmark, who was one of the stocks of the day on Friday, but has entered FNO ban.
Thanks for that, Mangalam. But let's slip into a very short break. Up next, we get you details on VIP Industries stake sale. Stay tuned. Welcome back. You're watching Power Breakfast on CNBC-TV18. Well, it's a CNBC-TV18 news break confirmed as multiple PE and Mithun Sancheti come together to acquire stake in VIP Industries. Mangalam joins in with more on this. Mangalam, well, you were reporting on this on Friday. What are the details?
Well, it has actually indeed come true. It's been a deal which has been in the making for so long that it's important that it has finally happened for VIP, where the promoters have gone ahead and sold the stake to a private equity firm. Remember, in the past, promoters have alluded to them looking to sell this business because of lack of succession. But more importantly, it's one of those brands started in 1971, synonymous with the luggage industry in India, and had been struggling for the last few years. And now a deal has happened. Multiples Private Equity has gone ahead and bought 32% of the promoter's stake at around 388 rupees per share. Additionally, they've gone ahead and made an open offer as well for 26%. This is a mandatory open offer at 388 rupees per share as well. Partnering with Multiples is Mithun Sacheti as well as a clutch of other investors. But more importantly, the promoters held 51.7% stake. The private equity owners have just gone ahead and bought 32%, leaving the Dilip Piramal family to have 17% stake in the company post this deal as well. For today, we expect the stock to be in the red for a couple of reasons. One, it has already rallied 75% from its 52-week low in hope of a deal. And secondly, the price itself is a lot lower than the closing price that we saw on Friday's trading session. But more importantly, once those excesses are out, maybe the street starts to ascribe a better valuation to VIP Industries given its recent underperformance and the possibility that maybe new owners could infuse a fresh lease of life in an industry which has been buzzing around ever since we had a bunch of new players come in. So for today, we expect the stock to be in the red, but thereafter, does it get re-rated or not is the question we need an answer to.
Thanks for that, Mangalam. So some red on VIP Industries today. But moving on then, HCL Tech is expected to report its Q1 earnings and the market is expecting a muted quarter. Rima is joining us with more details. Rima?
Well, after TCS sorely disappointed the street with its performance, for HCL Tech as well, we're expecting a muted quarter. Dollar revenue growth, while it's seen up 0.9%, the key number is always the constant currency revenue growth. And in the case of TCS, on account of seasonal weakness in their software business, revenues are likely to fall by a little more than 1%. Margins too, consequently, because of the revenue weakness, are likely to drop to 17.3%. That is a 60 basis points decline in margins. Profits down nearly 3%. Now, the key will be the guidance. Now, the current guidance for HCL Tech stands at 2 to 5% on revenues and 18 to 19% on margins. Some on the street believe that the company will be able to raise the lower end of the guidance, which means 2 to 5% could become 3 to 5%. But unless the upper end of the guidance is touched, that 5% mark, it's unlikely to signal, it's unlikely to be a positive signal. Margins are likely to remain healthy. Margin guidance is likely to remain unchanged. Deal wins are going to be steady, $2 to $2.5 billion. Deal wins is not the problem, but for the industry, there has been a bit of a disconnect between the deal wins and that translating into revenues. So let's see what HCL Tech throws up this time.
Thanks for that, Rima. So soft quarter is what we're expecting from HCL Tech. But let's slip into a very short break. Up next, we get you cues from the commodities market. So don't go anywhere. Welcome back. You're watching Power Breakfast on CNBC TV18. Well, the preliminary report of the Air India crash in Ahmedabad has been made public with important highlights. Madhya is here to take us through the key points from the report. Madhya?
Well, the preliminary report has been the most awaited communication from the AIB, not just in India, but around the world. The report doesn't have the transcript of the cockpit voice recording, but it does talk about what happened in the final moments of the crash. So on the afternoon of 12th June, which is 13:38:39 seconds Indian Standard Time, the aircraft lifts off. 4 seconds later at 13:38:42 Indian Standard Time, the aircraft achieves maximum airspeed and shortly after becoming airborne, and then something catastrophic happens inside the cockpit. Within 1 second of each other, the fuel switches for both engines, engine 1 and engine 2, move from run to cut off. Now, this transition cuts off fuel supply to both engines, causing both to lose thrust. One of the pilots is heard asking the other why did he cut off. The other pilot responded that he did not do so. At 13:38:47, the ram air turbine deploys and its hydraulic pump engines supplying emergency power. At 13:38:52, which is 10 seconds after cutoff, the fuel switch for engine 1 was moved to run, and 4 seconds later at 13:38:56, engine seconds fuel switch is also reset to run. Engine 1 begins recovery while engine 2 fails to recover its core speed despite relighting at 13:39:05, which is 9 seconds after turning on the second engine. One of the pilot issues a mayday distress call. The ATC inquired about the call sign but did not get any response and observed that the aircraft crashed outside the airport boundary into the hostel building of the BJ Medical College. This sequence of events from liftoff to crash lasted just 26 seconds. That's how quickly the aircraft went from airborne to disaster.
Well, thanks for all of those details, Madhya. But moving on then, we now have Manisha Gupta joining us with all the updates from the commodity space. Good morning, Manisha. What are you watching out for today?
Morning, Mama. Thank you for that. Well, I'll start with the crude oil prices because we're looking at $70 a barrel holding. Remember, it was 2% of gains on Friday. A second weekly gain. The previous week, the crude oil prices gained up by 1.6%. So we're looking at further gains continuing into this space. Well, remember, there is an immediate supply tightness. We are into summer driving demand season. It also is about higher refinery rates. So all of that really seems to be supporting crude prices. The other thing that I'm looking at is the silver prices. Well, we have seen an all-time high in the previous week in case of silver at almost $38.50 an ounce. This is a new 13-year high that the international markets are trading at. And while on Friday we saw 4% of gains come in for silver, today in the Indian markets you might be looking at an all-time high yet again coming back. So silver and crude oil prices both buzzing in the Asian markets right now.
So silver and crude oil both doing quite well in Asian markets. But thank you so much for that, Manisha. Now moving on to the world of sports then. Italian professional tennis player Jannik Sinner beat Spain's Carlos Alcaraz in a high-octane final to capture his maiden Wimbledon trophy and 4th Grand Slam, avenging his loss to the Spaniard in last month's French Open. 5 weeks earlier, Sinner lost one of the all-time Grand Slam showpieces in the French Open, seeing the title wrenched from his grasp after leading by 2 sets and holding 3 championship points. Sinner's Wimbledon triumph ends a 5-match losing streak against his main rival in the process. Well, that's all we have on this edition of Power Breakfast. We're leaving you with the GIFT Nifty still indicating a 42-point down tick for our own Indian markets. Don't go anywhere because Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, good morning.
Hi, good morning, folks. Everybody, welcome back. Welcome back to our viewers as well after the weekend. So plenty of sporting action and plenty of tariff action. Basically an action-packed weekend.
Indeed, and Monday is not going to be short of action on the sporting front at least, because India needs to chase down 135 runs, and it's the test match is quite interestingly poised. So let's see how that goes. But I'm sure, Prashant, you enjoyed the Wimbledon final last night. The best in class tennis we saw last night.
Yeah, but it was a four-setter, but I only found out who won this morning.
Oh, really?
Guys, I must go to sleep, get some sleep.
Oh, very good.
But I think 2.5 sets in, I kind of sort of, and it was looking like Alcaraz was playing better, just playing better.
Yeah.
But of course, I mean,
he had his chances.
But it's Sinner.
But speaking of chances, that's what Mr. Trump is saying. The EU had its chance. Mexico had its chance, but they didn't play ball. So he decided to do what he thinks is right.
Yeah, 30%.
30%.
Right? So, let's just take it from the top, straight up in terms of the action, the news flow, and of course the market reaction as well. So over the weekend, President Trump declared a 30% tariff on EU and Mexico effective the 1st of August. So this is the new thing which markets have woken up to. On Friday and over the weekend before this news, I think this was one of the top things markets were expecting to come through during the course of the weekday, but it's come over the weekend. But he's left the door open for adjustments. That's the important bit. He's left room open for adjustments. There are, by the way, comments from EU's top officials saying that they will continue to negotiate. There is the the president of Mexico, who's also on record to say that he hopes that they'll be able to avert these 30% tariffs, etc. By the way, the U.S.-Mexico bilateral deal is still effective. So any trade which takes place under that UCMA, that's still valid. These tariffs will not apply to that. That's very important, especially for the auto sector. But this 30%, why does this matter? These are significantly higher than the 10 to 20%, which was the expected outcome for these countries. Now, the market reaction is quite muted. You look at the euro, which is down, but down small. You look at the dollar index, which is up, but up very small. US futures this morning, about 2 hours back when I looked, they were down about 0.4%, S&P, NASDAQ, etc. And gold prices were up about 0.4% or so. So, they're largely holding. But these are very muted reactions. EU is by far, after China, the biggest trading partner for US. And US is saying, well, here's 30%. Well, the market's not reacting in that sense, right? And I'll just get to that in just a bit. Just to finish that point off on precious metals and gold and silver, this was the Friday move on gold and silver. 1% on gold, silver prices were up nearly 4%. And by the way, market reaction on Friday is largely been muted. Actually, there was just two things. One, precious metals, which was strong, and then it was oil, which went up about 2% or so. But focus squarely is back on tariff policy. And there's no doubt about it. So just to go back last week, before this weekend tariff announcement, Trump issued 22 letters last week. And most of it was to Asian countries. And guess what? Market reaction once again was muted. So Asian currencies were lower. If you look at a range of currencies, including the Thai baht, Indonesian rupiah, etc. But they were not dramatically lower. It was a muted reaction. So what the market is expecting is that Trump will back down once again, or he will further extend the 1st of August deadline. And that is the reason why they're not reacting, not to the weekend announcement, if you can move it along, not to the weekend announcement or to what happened last week as well, as the August date approaches. So this is the point. The question, though, is this a big risk, right? The fact that the market is once again expecting Trump to fold in a sense, right? Essentially saying that he's going to back down or extend. Is this a big risk, and does it kind of smell now of complacency as far as the markets are concerned? Will 1st of August really be, in that sense, the day of reckoning? Because Trump is on record to say, well, we're not going to change it. It's the final deadline, although there is room for negotiations. So I think that is broadly the bent of mind that I'm going with, that maybe with 15 days to go to the 1st of August, with the market not reacting once again to what is being said, there perhaps is a little bit of complacency, global market-wise, which is kind of setting in. The other bit last week, of course, was the 50% tariff on Brazil. And you've got to ask the question, does that also set a dangerous precedent? The reason I'm asking that, the reason I'm saying that is because, if the letter to Brazil was not about matters related to economy. He widened the scope to what the prior president has done, etc., etc. So could that, tariff policy was used to fix the deficit, but could it now be used for other things as well? So that's the sort of other bit in that sense. Of course, the question still remains up in the air. What will be the end state effective tariff rate? After all is said and done, will it be 10%, 15%, 20%? Consensus was somewhere between 10 and 15, but I think after last week and over the weekend, that number perhaps should be repriced higher. Will markets do it, or will they wait for it to actually go through? Just to tie in the levels here, Friday was a disappointing day because early on the market hit the 20-day moving average. There was a bit of a bounce, and then we kind of sort of sold off in an aggressive fashion. We ended about 200 points lower. The break of the 20-day on the Nifty on a closing basis opens up the risk of correction to the 40-day exponential moving average, which is 25,018. That's the level for the Nifty. Upside levels, of course, we'll continue to put out the previous highs, etc. Bank Nifty, by the way, has not yet closed below the 20-day moving average. If the Nifty Bank also has a close below the 20-day moving average, which is 56,692, the index can head to the 40-day exponential moving average, which is 56,097, 56,100 broadly. Just go with that number, just over 1% away from where we are on the Nifty Bank. GIFT Nifty will give you a quick sense of how we are likely to start, 35 points lower. Surabhi.
Prashant, complacency is a word that Jamie Dimon used last week as well. Describing the market's reaction to all these tariff headlines, because the headlines are big. When you have 25%, which came in, of course, last week on South Korea, on Japan, these are large trading partners. And now the EU and Mexico are the top 2 trading partners of the US. And the number has been set at 30%. The market perhaps still believes that it will be negotiated lower at some point. So the market is not too perturbed from the looks of it. If you look at Asia this morning, and it's not like there's a major slide or anything. Japan is showing a little bit of red, 0.3% lower on the Japanese Nikkei. Other markets like Hong Kong are actually flat to largely range bound. So no major cuts coming in. The EU and Mexico put together, by the way, contribute to a third of US's imports, total imports. So these are large blocks that we're talking about. Now, why is the market perhaps not too worried right now? It could be in the kind of statements that are coming in from both Mexico and from the EU. I just want to quote here the European Commission President, Ursula von der Leyen. She says imposing 30% tariffs on EU exports would disrupt essential transatlantic supply chains to the detriment of business, consumers and patients on both sides of the Atlantic. And then she goes on to say the EU remains ready to continue working towards an agreement by August. This is what the market seems to be focusing on. But then she does end by saying that we will take all necessary steps to safeguard EU interests, including the adoption of proportionate countermeasures if required. So let's see. Markets still thinking that this will be sorted over the next 2-3 weeks, and the ultimate number will not be as high as 30%. We'll see if the market gets it right or not. On gold, by the way, just to add to Prashant's point, that 1% rally that happened on Friday and almost 1.5%, depending on whether you're looking at futures prices or spot prices, there is an add-on that's been built in because gold is up this morning as well, marginally higher in Asian trade. For us, it's been a week of consolidation, and consolidation that started giving way to downside bias, and that's showing up in the flows as well. Look at the cash market flows, quite weak actually, especially the FPI numbers on Friday. Over 5,100 crores of selling. Domestic institutions were offsetting it to the extent of about 3,500 crores, but that FPI number was a big one. Today, in terms of our macros, the CPI number is going to be in focus, and the estimate is that consumer inflation in India will fall even further. Remember, the last print we had was 2.8%. After years, our inflation number had fallen to sub 3%. Well, guess what? It should fall to about 2.5%. That's what some of the polls on the street are indicating. As always, earnings season has started. There's going to be a lot of stock-specific action. So I'll just leave you with some samplers. Remember, we were telling you this on Friday that there could be a deal brewing with the VIP, and it's finally come through. Promoters are exiting the company. There is an open offer that's going to come in at 388 rupees a share. So watch out for this stock. Divi's, there's a negative development for Divi's. And that's because they were supplying APIs to Novartis for an important drug, Entresto. But now Novartis has lost a patent case. And the other company, MSN, is going to be launching a generic in the market. So could this, skew the pitch for Divi's? That's what some of the broker notes today are indicating. And more news from Pharma, Wockhardt. Wockhardt is finally looking to close down and sell off its US generics business, which was loss-making. So maybe people see this as a positive sign that finally there's restructuring and you look ahead. So as always, lots of individual stocks and, of course, Q1 earnings that will be in focus. Nigel?
Well, that's right. If I look at the setup, it's quite interesting. And the sense you get is maybe we're nearing to the near-term bottom after the pullback from around 26,000 to around 25,000. So a technical bounce may not be ruled out. To be fair, even in Friday's trading session, after starting off with a cut of around 150 points lower, we pulled back to minus 30, 40 points or thereabouts. And then we gave it away. And the reason I say that is because the FI net short positions are now at 1 lakh contracts. The PCR has come down. It was more than 1. It's come down to around 0.76. And now in the near term, the Nifty resistance will come in at around the 20 DMA. So that's the way trade is set up. Let's focus on what the FIs did first. You already told us what they did in the cash market. Well, in the futures space, both on the index futures as well as on stock futures, they added short positions. So if you look at the index futures, there was some long unwinding, short addition out there. And even on the stock futures, well, there could be some arbitrage at play out here. But there were shorts that were added. As I always say, shorts in the system, not such a bad thing. That could give you the reason to see a bit of a bounce. So FIs have been adding the shorts on. How are they positioned right now? Well, if you look at the way the contracts have moved up, when we started the series, well, the net short positions were only around 30,000 contracts or thereabouts. That number's moved up to around 1 lakh contracts. So that's the trajectory. And the clients, they were mildly net long. Now, in fact, the long positions have moved up to close to around 70,000 contracts. So both those two data points, actually, this combination hasn't been so bad. In percentage terms, the FI net short positions have moved to around 80%. And normally at around this 80-85% or thereabouts, that's where you see a bit of a bounce. The 1 lakh contract mark, that's normally the mark where you see some kind of bottoming out just in the near term. It's a technical level from where we see a bit of a bounce. Moving to the options data then, we had the VIX, first of all, that, though the Nifty has pulled back, the VIX is still at multi-month record lows. So just keep an eye out on that, and that's actually a good sign. As promised, let's go to the options data then. The 25,300 call, 25,200 call, both of them saw aggressive writing. And that's the reason why the PCR has come down, because the call writers, they feel that they are in the game. However, the 25,200 put as well did see some kind of addition out there, and there was a mix of activity at that particular level. There were writers at play as well, which tells you that 25,050 odd mark should be a level that the bulls would like to defend. The PCR as well has come down a little bit. So let's get down to the levels then. The Nifty, two important levels that we will be looking at. But in today's trading session, you'll first want the Nifty to make a higher high, because in the last few sessions, we're making lower highs, lower lows as well. So 25,322. However, the 20 DMA comes in first at around the 25,260 odd mark. So that's the first technical level that you'll want to get past. That's important. And on the downside, the 25,000 mark or thereabouts, that will be the line in the sand for the bulls on the downside. The bears, well, they will want the Nifty to break past this level. The Nifty Bank as well, that's saw a bit of profit taking last week itself, but that will have to lead the way from here on. So we're still defending the 20 DMA, still defending the 50 DMA. You wanted to continue to do more of the same on that front. The big deal that was announced yesterday, as CNBC-TV18 had broken, is VIP. Well, the stock actually has relatively outperformed Safari, in the recent past. But I'll be watching VIP because, the price has been done at a deal which is much low. So maybe that stock is under pressure. However, Safari could continue its outperformance from here on, because the promoter changing hands will tell you that price rationalization will come about. Some of those discounts as well will go away, and it could be good for the industry on the whole. So Safari is the stock that I'll be keeping on my radar.
All right. Well, Safari and VIP, all about luggage and travel. Rahul Chadha is with us, Founder and Chief Investment Officer at Shikara Investment. Rahul, good to have you with us here. Good morning. Thanks very much for your time. So the question is, the market's being a little complacent with tariff policy and what the end state tariffs could be like. Could they be higher, a little sort of steeply higher than what everyone is assuming, that it'll be just 10%? What's your sense, Rahul?
Yeah. So our beliefs mean tariffs are going to settle somewhere between 15 to 20%. There is going to be a lot of rhetoric around it, a lot of noise around it. The idea here is to induce, from a US perspective, other trading partners to agree to some of these conditions of better access for US companies and US products, etc. So markets seen this in the past, and which is why they're very calm about it. I think there may be a correction or a significant pullback in markets if actually such high levels, 30-35% of tariffs get implemented and US starts collecting it. Why I say that is, look, in China's case also tariffs are implemented but never really collected for a while, and then we saw eventually a trade framework pulled out. So our base case view remains that similar to what US has done with TikTok, it kept on getting 3 months extension rather than a ban. Same thing is going to happen with the trade deals. I think the most difficult ones with China, Vietnam, US has broadly agreed to a framework. Same thing plays out with Europe, Japan, and Korea.
So Rahul, morning. You don't sound too concerned about these numbers, 30%, 25%, 50% in the case of Brazil. So, I mean, you're saying we don't need to keep any sort of tariff risk on the horizon?
Again, there's a lot of noise which is going to hit you. I think our view has been always to look at the intent rather than the noise. Look, what matters also for US is that inflation comes down, and so that you can have lower rates. And inflation comes down only when tariffs are reasonable. So which is why one would not go by these headline noises, these tweets which come almost every other day, and look at the whole thing from a holistic perspective. And that's where the sense is that, look, what US wants is to encourage domestic manufacturing. What they want is the goods which are sold in the market, at least 25-30% of them are kind of produced locally. US builds control of some of these strategic materials, etc. So I think that's the intent. And look, it's not going to be a straight path. It's going to be a bumpy road. After what we've seen from early April, markets are up nearly 25-30%. Some pullback is but natural. So you'll see 5 to 7% correction here. But what is happening is most central banks are cutting rate. Come September, Fed is going to cut rates. Growth should improve from here on. So which is why overall we would buy the dips here, basically.
All right. Hi, Rahul. Good morning. Good to see you, Ben. From the Indian market perspective, you have mentioned that large cap is what you prefer, and banks and financials is something that you like. So run us through the thesis out there. You would stick to the larger banking names because there are deals happening on the smaller banks. I wanted to review out there. And all of a sudden, suddenly we're seeing that the street is becoming a little bit more optimistic on consumption. And maybe some part of the street wants to look at staples. But you believe discretionary is the way? Run us through both those two, banks and consumer discretionary stocks.
Absolutely. So again, as the economy kind of bottoms and grows from here, banks are the best proxies. We've played it through the large cap banks, which are steady compounding machines. At the same time, we'd like something like a AU Bank, etc., which has done well over last 6 months. So select mid cap banks. So we're not against cap banks. So it's select mid cap banks, which are good franchises, good risk management, etc. Something one has liked. This quarter may be a bit soft for banks as some of these rate cuts impact the NIMs on the, more importantly, impacting the asset yields, etc. But from a medium-term perspective, look, banks are the best way to play the economic recovery. Outside that, consumer discretionary is something one would like to buy at pullbacks, and you're going to see pullbacks. We've seen from some of the results which came through. Basically, it's guidance of soft numbers this quarter. The recovery will take 1 or 2 quarters to play out, but look, the medium-term story is very strong for some of these travel and consumer discretionary names. Why discretionary over staples? I think staples are fairly valued. You may get a bit of a recovery here, but the competitive intensity is much higher in that space because of these new brands which have come in. And you will get a bigger kind of a bang for your buck in terms of growth recovery from a 3-year perspective in the consumer discretionary in select categories. Hotels are something we've liked for a while. We mentioned about travel. Outside that, some of these quick commerce name would be also interesting from a medium-term perspective.
Got that. But just one, just going back to the global bit, Rahul, sort of US yields were up sharply on Friday. I mean, 6-7% long end, etc. as well. Do you think, personally, do you think that we will see, some change in the Fed or a shadow Fed? I mean, how will markets take it? It's never happened. That's why I'm asking.
Okay, so I think that is the risk, if you ask me, that the yields kind of go out of control and touch 5%. If you ask me the risk for the markets, that's the risk of the market. See, right now what we've had is we've had the Treasury Secretary Scott Bessent, who's played the role of a mature adult here and calmed the markets on that. But look, if the government or the administration here takes a whimsical way to change the guard or the chairman at Fed, I think that would be taken negatively by the bond markets, and obviously equity markets would also react to that.
Okay. All right, Rahul, we'll leave it there. Thank you very much for joining us. Appreciate you coming on with that quick perspective on a bunch of issues. That is the risk. So, you know, as Rahul points out, otherwise he's pretty sanguine that eventually things will work out with regards to tariffs. But 15 to 20% end state tariffs is what Rahul is kind of working with. We'll take a quick commercial break here. We'll tell you what interactions are lined up here on the program. So at 8:35, we'll have Hetal Dalal of Institutional Advisory Services and Karan Thorani, Velara Capital. Zee's special resolution to approve issue of convertible warrants to promoters failed to get requisite votes. At 9 o'clock, Prashant Biani Velara will be with us to talk about trends in the hotel space. 9:20, Vetri Subramaniam is our market master. 9:30, you'll have the management of an IPO, Anthem Biosciences, with their 3,400 crore IPO. And of course, we'll have Vivek Gupta after that. Another new listing, Oswald Pumps, to talk about their fourth quarter earnings. 9:50, Ajit Kumar of JM Financial Institutional Securities will be with us to talk about the banking sector ahead of the first quarter, which is going to kick off. And of course, it's the economy, Lata in conversation with Ashish Gupta of Axis AMC coming up.
Well, time for a quick break. We've got a lot of stock-specific action to track for you in our special Top 10 segment. For the time being, I'll give you a sneak peek into the list. We're looking at Wockhardt, Global Health, NCC, IRB Infra, 4 stocks reacting to good news. However, Avenue Supermarts will be under some pressure post its numbers. We'll also have Divi's Laboratory, VIP Industries, Glenmark Pharma, Sula, and Kolte Patel Developers that will be reacting to negative news flow. Take that break, come back. We'll get into further detail on all of these names.
Welcome back. So the cues across Asia are fairly mixed. Some of the markets like the Hang Seng are flat. There's a little bit of red in Japan. Let's pull up the implied open. Remember, all of last week, it was a downward slide, slow grind down for the market. Yeah, that's the Asian picture. Let's get the implied open up as well, 34 points lower. So, well, the indication is that maybe there could be little downside, little more downside as we start off trade. But there are plenty of stocks to watch. So let's straight away get to the CNBC-TV18 list of top stocks to watch. Starting first with some of the Q1 numbers that have been coming in. Mangalam morning, Avenue Supermarts. I mean, you already told us about the update, but we now have the final numbers as well. So fill us in.
Well, a couple of things that we were looking for post the update, the margins, that would be extremely crucial to track. And there the pressure continues. So expect the stock to, continue to see some bit of pressure in today's trading session. What we know from the update is that the revenues grew 16%, but the gross margins actually came off 30 basis points. The EBITDA grew just 6.4%, which means the EBITDA margins also came back by about 60 basis points, and the net profit absolutely flat. Foods as a percentage of sales have increased, which implies the margin accretive businesses like non-food FMCG general merchandise and apparel, all of them have reduced as a proportion of sales versus the same time last quarter. And in that, the company said the revenue impact of almost 100 to 150 basis points has been because of the deflation that we've seen in staples and non-food products. So it's price-led. The same-store sales growth is closer around 7%. Gross margins are lower due to continued competitive intensity, and operating costs are higher because of higher service level costs, capacity building costs, and inflation in wages. So all said and done, while there is a pressure on revenue and that's growing late teens, the important part is operationally the street does not believe that the margins will recover anytime in the very near future, which is why growing with red for Avenue Supermarts.
All right, Mangala, I'm going to come back to you for that big exclusive that you broke on Friday. But for the time being, let's hop across to Ekta. She's here to tell us about Divi's laboratory, which could be under some pressure today. Morning, Ekta.
Morning. Well, yes, Divi's Labs could probably be in the red today because MSN, pharma company, has won a patent litigation with regards to Novartis's blockbuster cardiac drug Entresto, which is basically cleared the launch for this particular generic version of this drug as soon as July 15th. So the impact is going to be negative for Divi's because Entresto's API is expected to be the largest product in Divi's custom synthesis business. It's estimated to contribute as much as 40% of their CS business and is estimated to account as much as 20% in terms of overall revenue. Over the next year, according to IIFL, the Divi's could see a potential 12 to 13% decline in the annual EBITDA. So that's the reason why you're probably going to see Divi's in the red. But remember that there are other opportunities for Divi's, and this has been a story which has been back and forth for Divi's. So maybe some part of the negative news is already also factored in.
Okay, all right. So Divi's on our radar. Thank you for that, Ekta. But now back to Mangalam for that big break on VIP Industries. Mangalam was alerting us about this on Friday. And Mangalam, after how many months, finally it's a reality, right? Promoters checking out of VIP?
Promoters checking out of VIP. It's like one of those travel plans which never materialized for very long and then eventually it did. I picked up some of the clues from Nimesh's D Street chatter, then worked my phones, figured out that this deal is likely happening, and that's exactly what has taken place. The promoters of the company which is synonymous with luggage in India, VIP, has gone ahead and sold 32% stake to multiples private equity and a clutch of other investors, including the likes of Mithun Sacheti, etc. But importantly, the deal has been done for 32% of the promoter's stake as against the entire stake. And it is done at 388 rupees per share, which is a steep discount to what we've seen on Friday's close. But remember, the stock has already rallied about 75% from the low. So large part of the street was sussing this deal out. Despite poor numbers, the stock continued to move higher. The open offer for 26% also is made at 388 rupees per share. So what does the stock do today? My sense is two reasons why it falls. One, the price is at a much lower price to the current price of the stock. Secondly, there would be some sort of sell-on news that will take place. But remember, once that is adjusted, the question is, can they revive the fortunes of VIP? The stock has done virtually nothing for the last many years, especially compared to its peers. So does 388 become the new base for VIP? And from there, we see re-rating. That's something we'll be watching out for going forward.
All right, Mangalam, good on you and congratulations on that big break. I recall when they delivered their Q4 numbers, they were a horrid one. The stock opened 5% lower. And from there, that dip got bought into. So the last couple of months, the street has been anticipating this particular deal. Let's go back to Ekta. Ekta, you have some stocks in news?
Well, yes, I'll start with Wockhardt, which is exiting its US generics business. It will now shift focus to its antibiotic as well as biologics portfolio and insulin. Remember, the FY25 US generics business already posted a loss of around $8 million. So they filed for Chapter 7 US bankruptcy code, and effective 11th July, this enables a structured, clean exit from the US generic space. Glenmark is in focus because they've received a warning letter for their Indore facility. It was inspected in Feb. It already had an official action indicated status, which was issued in May. Global Health, or Medanta, will be in focus because a writ petition was filed before the Delhi High Court by the Greater Kailash Residents Associations, and this was a stay on the was to put a stay on the construction of a proposed 400-bed multi-speciality hospital, which was a joint venture between Medanta as well as DLF. The court, however, has not granted any stay or interim relief with respect to the construction activities.
Okay, so we'll watch out for all of these stocks. Ekta, thanks very much for that. Now let's head to Vivek, who's looking out for NCC and IRB Infra. Vivek, morning. I think NCC has got a huge Mumbai Metro order, right?
That's right. So traveling from Lokhandwala to the rest of or to central Mumbai could get easier once this particular project comes on track. So NCC, what's transpired, the company has received a contract from the MMRDA. The total size of the contract is close to 2,270 crore. Now, this is for the Mumbai Metro Line 6. What does NCC have to do? Number one, they get the contract for manufacturing rolling stock, telecommunication systems, along with a whole host of other services. Construction period is for 24 months. The defect liability maintenance period is for 2 years. And comprehensive maintenance after that is for another 5 years. So YTD, how does NCC's order book or order inflow stack up? Close to 5,620 crore. Remember, the order intake guidance for FY26 stands in the range of 22,000 to 25,000 crore rupees. Now, coming to IRB Infra, the company has given the June toll collection update. It's up 5%. The company says that there was a moderation as far as traffic growth was concerned due to the monsoon. So it's just up 5%. But Q1 FY26 toll collection is up 8% on a year-on-year basis. So some positive toll collection update as far as IRB is concerned.
Okay, all right. Thanks, Vivek, for that. Let's go to Ria. She's here to tell us about Sula and Kolte Patil. Morning, Ria.
Morning, Nigel. First, coming to Solar Vineyards for their Q1 update. The weakness has continued for Solar Vineyards. The revenue has gone down by around 7.9% on a year-on-year basis, but adjusted for a one-off, the revenue has gone up by just about 0.2%. Coming to the revenue breakup for Solar Vineyards, the own brand sales have gone down by around 10.8%, and the company has said that these have remained subdued due to the continued slowdown that we've seen in urban consumption recently. But the wine tourism sales, these have remained strong, going up by around 21% on a year-on-year basis, and these have continued the strong momentum that we've seen in the recent quarters. Moving on to Kolte Patil for their Q1 business update, the sales have gone down by around 13.3% on a year-on-year basis. The sales volume on a sequential basis has gone up by around 5.2%, but down about 12% compared on a year-on-year basis. Even the collections have seen a decline of around 10% compared to the previous year. Realizations are down just about 0.9% over the previous year as well. And going forward, the company has said that they have a robust pipeline of launches across Pune and Mumbai in the coming quarters, which is expected to drive healthy growth in FY26.
Okay, all right, Ria, thank you very much for all the details there. So let's quickly recap our list of stocks to watch today. The ones that have positive news are Wockhardt, Global Health, NCC and IRB Infra. Stocks with negative news flow would be Avenue Supermarts, Divi's Laboratories, VIP Industries, Glenmark Pharma, Sula and Kolte Patil Developers. More red than green on the list today. Well, with that, let's now shift our attention to the commodity markets. We have Manisha Gupta joining in with a quick morning wrap. Manisha, good morning.
Morning, Survi. Thank you for that. I'll start with the crude oil prices because we've seen this one holding gain. There was 2% of a surge in Friday. It was a second weekly gain. The near-term supply tightness because of summer demand, high refinery runs seems to be supporting the crude oil prices. Add to that the fact that the U.S. could be putting additional sanctions on Russia. Even the European Union could announce an 18th package of sanctions against Russia is what is supporting the crude oil prices. The other thing that I will want to watch is the silver prices at a new 13-year highs globally, and it's trading at all-time highs in the Indian markets. That is something that should be on your radar.
Okay, all right, Manisha, will watch out for how crude behaves and, of course, how precious metals do. Thank you for that. We'll take a quick break on that. We'll come up on the other side, and we'll have Prakash Diwan joining in for some fundamental stock ideas.
Welcome back. Well, as promised, we have Prakash, the one market expert who joins us on the show. Hi, Prakash. Good morning. Good to see you, Ben. Well, let's go full throttle first on the big deal. VIP, finally, Mr. Piramal has agreed to go ahead and do a deal, and they have sold stake to PE. The problem is that the stock has rallied close to 70%. And if you look at it, the deal as well as price at a discount. What's your view on the stock from here on VIP? We have discussed this numerous times. I was lucky to have the management on my show as well a year or so ago, where they were saying that things will revive from here on. I also tried to push them on the stake sale. But that time, they didn't comment. Ms. Neetu was the one who we were interviewing. What's your view on the stock from here on? If it opens lower, will you be looking to get in? And also, if you could comment on Safari, because that's borne the brunt of this pricing pressure and pricing discounts. Now, this deal could be a positive for the luggage industry on the whole. Your take.
Good morning, Nigel. So, you're right. The VIP stock has had a very, very elongated anticipation built around it. And finally, the deals happened. But I'm not surprised at the discount at which it's happened. Promoter exits are usually, they come with a little bit of illiquidity discounts. And the fact that it has rallied was in anticipation that, it could be a deal that will be like it's not a fire sale, but it's probably something where somebody would want to pay premium. Given the situation of the business and the promoter's own context, I think the deal's pretty well priced. If the market gives you a negative reaction to it, it could be an opportunity for some sort of nibbling to start. But the real change will happen once the private equity owners settle in and the plans to professionalize the business completely get underway. And that's exactly what's required out here. So that could take a couple of quarters. But as soon as those things are much more visible, it becomes a stronger bet, because consumption, particularly around travel, is something which all of us are very positive on. It should impact. The Safari, this thing is, impact is the second order impact is going to be that Safari will probably be more positive after this, because it gives them time to restore market share, get into some of the segments while VIP kind of resets itself to this new reality. So yeah, from that perspective, it could be a faster tactical play, but I think VIP will give you a far better solid foundation over the next 6 months.
Okay, so that's VIP, and how Prakash is reading what is a transition now that the company is in. Prakash, hi, good to have you on. Lots of pharma news over the last couple of days, right? Glenmark, of course, is a blockbuster opportunity that they've grabbed. But then they have some outstanding FDA issues as well with a couple of their plans. Those were the reports over the weekend. In addition, we now have news on Divi's, one of their major cancer drugs that they're in partnership with Novartis. There's a legal challenge. Any thoughts on these two stocks, Glenmark and Divi's?
Good morning, Shobhi. So let me take Glenmark first, because I think it's positive. The fact that they have a 1.2 billion, hold coming through over the next few years. This is the first time that a company in India, a pharma company in India, is actually getting to monetize R&D effort of this scale. There are companies which have been dedicatedly doing that, but nobody's kind of been able to monetize it and reach fruition. So I think, of course, the stock has reacted very positively. You saw what it did on Friday. But if you get a chance to get in, remember the deal is still on. The money that they're going to make from this research initiative is very much there. There's nothing taking that away. These kind of US FDA inspection related speed breakers are just speed breakers. They are not road closures for any sort. So I think they'll get over that. So this is an opportunity where people who have missed out on Glenmark's brilliant run could probably do that. We spoke about this at about 1,000 levels. So you can see how well, how smoothly and gradually it's kind of, made its way to the 2,000 mark. So my sense is these are opportunities to latch on to good names. Divi's will, of course, get impacted. I don't know, but the rough estimates are anywhere upwards of 10% is where the contribution is. So that could probably evaporate over a period of time. But then they have so many other things coming out for them. So you lose out on some big contracts. You probably, make compensate that with some other contracts. But that could take some time. Again, opportunity to get into a business that's been so resilient and so innovative in terms of its approach. So, people find divvies expensive, and these are opportunities where you probably, get that blink to get it.
No, absolutely. Prakash, hi, morning. IT services after TCS on Friday, more will come this week. But more downside in TCS and anything else you're doing?
Good morning, Prashant. So, essentially, we've been a bit wary of these large IT names because there's nothing in terms of a trigger that takes things to a different level. Especially if you look at, I have a big issue with these large companies because they have been just returning cash through buybacks and dividends and all. They've not made any inorganic acquisitions, any growth kind of impulse. Especially in Europe, there's brilliant businesses available, which could kind of, help them diversify, change their revenue streams. But, it's a regular ho-hum business which they keep trying to make the best out of. I mean, maybe they don't have much of a choice given the scale, but the situation in the US is not very conducive to any re-rating of sorts. And I would believe the TCVs will probably hover around this 10 billion kind of mark for the next quarter also. And once, that changes, and you have some sort of realization which help improve margin, I don't think there's going to be any re-rating down here. So it's best to stay away is the short answer. HCL Tech also, we're not having much of expectation. 2 to 5% is the guidance, and that's really not something which can do much to the stock. So let's see. But you always have some outlier. I don't know who will that be, whether it's Infosys, whether it's Wipro, but at this point in time, large cap IT doesn't look like very promising.
Okay. Got that point. Prakash, stay on. We want to get your take on Zee as well. But do listen into this conversation, then we'll, get your thoughts in as well. Now, we all know the development from last week. The company, that's Zee Entertainment, had plans of raising funds, but those plans hit a roadblock after the special resolution to approve the issue of convertible warrants to promoters failed to get the requisite number of votes from the shareholders of the company. We have Hetal Dalal, President and CEO at Institutional Investor Advisory Services, as well as Karan Taurani, EVP of Elara Capital, who tracks the space, the sector and the company quite closely. Thanks both very much for joining in. Hetal, let me start with you because, a lot of the shareholder advisory firms, including, I think, IIS, had anyway recommended that minority shareholders do not approve this resolution, which would have otherwise allowed the promoters to increase their stake from 4%. I think it would have gone up, well over 18% thereabouts. So what were the real issues? The company has cash. Is that why you didn't see the need for this sort of issue to promoters? And where does that leave Zee now?
Okay, so there were three reasons primarily because of which we recommended that minority shareholders not support the preferential warrants. One is, yes, the company is currently sitting on 2,400 crores of cash, and in raising another, and they've already done it, and they did a QIP last year, raising another 2,200 crores to a preferential warrants without a specific plan, which actually resulted in a 15% dilution, which is quite high, is something that we did not support. The second issue was just the nature of the instrument, right? If you look at warrants, 25% actually gets brought in upfront, and the remaining 75% comes in after an 18-month period. And essentially, promoters are the ultimate insiders. So by and large, we don't really favorably look at warrants to promoters, largely because it allows them to ride the stock price. The third issue is the promoters themselves, right? If you looked at last year's AGM, right, shareholders voted against the reappointment of Puneet Goenka on the board. The board is now board has protected Puneet Goenka in terms of still allowing him to run the company in a CEO position, not on the board. And to our mind, that is essentially disregarding the voice of shareholders. Given these three issues, we recommended that shareholders not support the preferential warrants, which is essentially what has happened.
Very sort of tightly put there, Hetal. Morning, Prashant here. Karan is also with us. Karan, as an analyst, how do you look at the development and what ahead for the stock?
Hi, good morning. So I think this is, slightly like a negative, for Zee in terms of share price performance. This was one of the first, positive corporate development that we saw in the last 2.5 years, since the Zee-Sony merger has been called on. This could have provided confidence in terms of increased stake, promoter stake for the company. and could have kind of had held things differently. But now I think the focus moves on operational performance, business performance. 2-3 parameters to track here. One is the growth in the Z5 business, the kind of innovation they're doing on content. Second, on lower losses for Z5. Z5 losses have become half of what they were until about 8-10 quarters back. And overall operating margins have also seen a significant improvement in the last 4 to 5 quarters. But I think if you look at the situation here, had the promoter kind of wanted to increase the stake at a premium valuation rather than a current market price of 132 rupees, this may not have seen a rejection, because if you look at the investor perspective, they have entered the stock at 250 level, 250 plus on an average basis. So this will also kind of dilute the investor in terms of their stake, this kind of a large move by the promoter at these low valuations. So maybe they could have done a premium price over the CMP, which could have kind of held up on the investor conference side.
Or maybe they should have just done a preference issue, and taken the shares up front instead of making the investors wait for those 18 months or thereabouts. Got that. Karan, what's the official rating on the stock that you have? And since it's pulled back a little bit, and since you highlighted some of those positives, do you think that it would be buy on dips?
So I think from a fundamental perspective, we have a buy rating on the stock with a target price of 200. 2-3 things to look here. One is the operational performance, as I said, in terms of both margins and lower losses of Z5. Second big thing to look here is the Zee Music business. If you look at the Zee Music business, they do about 200-300 crores of revenue in terms of top line, and they make reasonable amount of profit margins as well. So if you look at other music labels today, which are listed like the likes of Saregama and Tips, they had a market cap of anywhere between 6 to 8,000 crores. So I think Zee Music also could have these kind of valuations. And if you kind of move away in terms of the Zee Music valuations separately, and if you put that aside, and if you put the 2,000 crores of cash aside, you are getting the broadcasting business at very low valuations, sub 5 times P. So I think, definitely it's a value stock to buy, but we'll have to see operational performance improvement on a consistent basis. 2-3 things more to track here is the SEBI issue, with the promoter, which is still an overhang. The issue with, Disney in terms of the ICC rights, which they had dishonored in terms of, showcasing the cricket contract, which they had done about a year ago. These are 2-3 things which needs to be tracked. Otherwise, apart from that, I think internally execution has to be strong, for share price momentum to pick up from here on.
Okay, well, not for the faint-hearted, given the outstanding issues that you described, Karan. But Hetal, to come back to you, I mean, the whole Zee saga for shareholders who've been invested, it's just been a real test of nerves and patience, right? From the whole Sony merger that it fell through, and then, the role of promoters. What do you see ahead? Do you think promoters with their 4% stake can still nurse the company back to health, look at some monetization, some assets like, Karan described, Z5, etc. What do you see ahead for the company?
I think there needs to be a structural fix as far as the governance structures are concerned. The board has clearly lost the confidence of investors. Not only have the promoters been voted out of the board, even the preferential warrants also has been defeated. It's time the board stepped down and you have a set of investors who bring in an independent board. I think this is a company which tends to show performance as a contradiction, as a solution to the governance issues, and I don't think that really works. For longevity of this company, I think there needs to be changes at a structural level, and therefore we believe a complete shift as far as the board is, a complete change of the board is really what is required.
And how can that be forced, Hetal? I mean, I don't know, because shareholders have spoken, minority shareholders, by turning down this warrant issue, like you're saying, by turning down Mr. Puneet Goenka's, appointment on the board. But what are the options for shareholders now? The board continues.
So there are several options, right? But that requires for shareholders to get together and ask for an EGM. The options are, of course, to ask for the removal of the board members and to appoint a set of independent directors who will run the company through. You've seen this in Fortis, you can see this in Zee as well. This was an opportunity that the shareholders had even when the Sony merger failed, and they still have it at this point in time to actually take that action. More importantly, it's the board also which needs to understand that they've lost the confidence of shareholders and therefore needs to step down. To say that 60% of the shareholders have voted for and therefore we're looking at the glass half full, well, I'm all for the glass being half full, but it can't result in cognitive dissonance.
All right. Thanks a lot, Hetal, as well as Karan, for joining in and giving us your view on Zee. We would like to chat with you, Karan, on your Swiggy report, which you put out late on Friday evening, but that for another time, an aggressive buy report with target price of 450. Thanks a lot for joining in. For the time being, though, we'll slip into a short break. On the other side, we'll have our technical trades. Sudarshan as well as Mitesh will be joining in. Stay tuned.
Welcome back. 9 minutes to go for the market pre-open to kick off. Sudarshan Sukhani and Mitesh Thakkar are with us with what they want you to do. Gentlemen, good morning. Good to have both of you here. Mitesh, as you've been saying, I think most of last week that the range has been contracting, and but on Friday we saw a bit of a break on the downside. The 20-day went, and what's your sense? Where is the market likely to find support? Has the structure been voided a little bit? And what's the trade here?
Yeah. So, morning, Prashant. I have been saying that 25,200 broadly on the Nifty was the lower end, and we kind of closed below that. The hourly indicators have finally started turning down, which means that there could be some kind of more directional movement on the downside. Now, then we looked at the possible targets, which is, retracement levels, moving averages on a slightly bigger time frame. My sense is that 25,120 is a minor pivot. That would be important to, from a short-term trading perspective. But eventually, there's a strong chance that we might head towards 24,850, 900 zone. So I think that's the initial target zone which I'm carrying. Also is the fact that on Friday, we had a gap down. So till that gap doesn't get filled, which is 25,340, 350. I think till then, I think the possibility of a test of 24,850, 900 is very strong. And on the upside, in case you get a pullback around those levels, I would be even comfortable taking short on the index.
It's sounding a little bit cautious. A pullback to 24,800, 24,900 could be on the cards. Sudarshan, what about you? How are you feeling about the index?
Yeah, good morning. Well, last week I had said consistently, I'm not bullish, but you have to go short only if you want to. Because in this market, taking a short position always has some difficulties. This is a different day today. We've had a decent small correction. Now we are coming to a support level, which is around 25,000. Now, and naturally, it's not exact. In that approximate zone of 25,000, the Nifty finds technical support. We are reaching that level. So today, after a very decent 4-day correction, it is possible that we could be looking at a buying opportunity. There's no rush in the morning. But if markets stabilize, then consider taking a long position with a stop under 25,000.
Okay. All right. Got that. What about individual stocks? Sudarshan, you go first.
Well, it's, mainly mid caps, because for the Nifty, we still want it to stabilize. KPIT Tech is a buy with a stop under 1240. Prestige is a buying opportunity. Though these are stocks that actually went up on Friday. Prestige is a buying opportunity with a stop under 1660. REC is a buy with a stop under 390. And the only intraday short is, Minda with a stop above 1088.
Mitesh, what about you? What are your trades?
I have a mix of buys and sells and one stock pound suggestion. I have a sell on Adani Enterprises with a stop at 2592 for targets of 2480. Bharti is a sell with a stop at 1942 for targets of 1860. Buy on Dabur with a stop at 525, targets of 543. And REC is something which you and I like. I would want to buy it once it starts getting past 403, 404. Buy then with a stop at about 401 and look for targets of around 420.
If just a 30-second view on Religare, which went up sharply on Friday, Mitesh. There's news as well, which we will address separately, but technically, Religare?
Actually, the move started, Prashant, on Wednesday. The stock was up and then we saw two other large candles on the upside. Looks like something has changed over here and the weekly and the monthly charts have started looking up. So this could be a trend which could see the stock head towards 290 is the minimum short-term target which I'm looking at, but a good chance that we might retest levels of 310, which was done in December 24.
Okay, all right. Point taken. As I said, we will get to the news on Religare, the pref issue, etc., to the Burman family, outside investors in a bit from now. We'll take a quick commercial break here. We'll come back with the pre-open rates, which should be with us. We'll also talk about the hotels space. So we heard a little bit from Rahul Chadda of Mirai earlier, but Prashant Bayani Vilara will shine the spotlight at that space, what he likes. Stay tuned.
Welcome back. Well, in a few minutes from now, we'll be getting the pre-open rates, taking down to that one, and then we get the official rates as well. But till then, we have Prakash Diwan, who's still with us. Prakash, silver's given a big breakout. Global prices over the weekend went to around $39. That's the highest we've seen in more than 13 years. Yeah. And now that ratio, I've been talking about this ratio between gold as well as silver. And if you look at the last 2 months, actually silver has outperformed gold. Because that ratio went to around 100 odd, with gold moving to $3,400, while silver was $34 an ounce. Yeah. Now that it's moved up, so it's narrowing that gap. Given the kind of move that you've seen on silver, there's only one particular play, which is Hindustan Zinc. How would you trade this particular stock? Remember that overhang with regard to the OFS, part of that is out of the way. With regard to the promoter selling, that's out of the way. Now we'll keep an eye on the government of India's plans. But since it's the only play on silver, Your view on Hindustan Zinc?
So Nigel, while I completely am in sync with your view on the silver, the disparity between gold and silver prices coming down in favor of silver, it might make sense to play silver directly through some ETFs, if you will. But Hindustan Zinc, there's lots of regulatory issues, not regulatory, but decision-making issues which could defer the whole thing, and we're not sure whether silver would maintain that kind of an edge for that long. So that's the thing. The other problem with Hindustan Zinc is its core business. While silver is a byproduct, the core business expansion hasn't been very optimistic or very favorable. So till that happens, of course, I do understand on the overhang being out of the way, but the operational efficiency also needs to kind of bring that salience in, and that's still some time away. So I would, as I said, play directly through some ETFs rather than work on this, because there are lots of optionalities that bring that dilute the impact of silver prices firming up.
Got that. Markets are, the pre-open session is kicking off and they're blinking red and green, not very settled kind of rate. Maybe we'll look back at it about 2 minutes time. Prakash, the other area which saw a fair bit of pullback, right, was exchanges last week. BSE was down 10% last week. MCX was down over 10% as well last week, of course, with BSE. And the stock exchanges, there was that Jane issue. There are some reports at the margin which suggest that Jane has deposited money. Jane Street has deposited the money, in an escrow account. We don't know if they're going to be back in the market or not. We will put it out as we get confirmation. But any thoughts on BSE specifically? And I mean, if you have a view on MCX as well.
So, Prashant, while we have seen one order where Jane Street has been held responsible for some of the misdeeds of sorts, there could be a continuation of this investigation which will reveal some other names, and that will ensure that things take some time to look up. The volumes are never going to come back to what we've seen at the peak levels, and which is good for retail investors in that sense. But my sense is this is not out of the way yet. Jane Street could be probably not a topic anymore. They paid up the fine. They may not resume trading. But whoever does that, whoever has to trade will be doing it with a lot of caution, with much more guardrails. And that means volumes will not pick up. So if in the absence of that, probably, the PSE or all these exchanges have corrected because they were overvalued to a large extent. And that's happened. Now it's up back to organic growth, new IPOs, all other volumes picking up, demat accounts adding up. But I don't think the options volumes is going to bring any spark to any of these exchanges.
Got that. A little later, we'll be speaking with Prakash briefly. Oswal Pumps, recent listing on the numbers. I don't know if you looked at it in any detail. They reported numbers. Any thoughts on this one?
So I did look at those numbers, not in detail, but just out of curiosity. But the numbers seem to be far more disappointing than what the IPO outlook promised. And this is typical of IPOs where you don't get things right on day one. It takes time for people to understand the business as earnings get shared. And that's why I've never been a big IPO fan. I would believe this will take some time to understand and then the market. There's too much optimism built into some of the government contracts and orders, which could take much longer. We've seen that in all sectors, all subsectors. You really can't kind of pencil in perfect timelines and start pricing the stock for those favorable outcomes. I would believe it will go through a little bit of a consolidation before the real price equilibrium gets discovered.
All right, Prakash, thanks a lot for joining in. And you could tune in to our chat with the management in a few minutes from now at around 9:40 or thereabouts. So do tune into that. But wishing you a good Monday, and we'll catch up as the course of the week does progress. Well, let's turn our attention to the hotel space then. In a recent report, Elara Securities says that various unforeseen events have dented occupancy in the first quarter of FY26. But they believe that Q2 onwards, things will continue to look up. Prashant Biani, the Vice President, Institutional Equity Research at Elara, joins us on the show. Hi, Prashant. Good morning. Good to see you. Well, Q1 is going to be a little bit softish. What are you penciling in terms of occupancy, in terms of, average prices out there? And what kind of a recovery do you look at from there on?
So Q1 will be strong, but it will be the growth will be lower than expected. We have seen occupancies getting impacted due to geopolitical tensions as well as travel disruptions led by Air India flight crash. So that has dented some of the occupancy, but still on a YOY basis, we see growth both in occupancy as well as ADR front. So on a RevPAR basis, we are expecting 12 to 14% growth in Q1 for the industry. Q2 onwards, we would be on a normal base. On the occupancy front, we are expecting flattish kind of occupancy from Q2, but ARR trajectory continues to be strong. So I believe hoteliers will continue to clock RevPAR growth in double digits. The focus of the hoteliers now have shifted on RevPAR. Either it comes through occupancy or through ARR. That is not a matter for them right now. It is what RevPAR is on which they are focusing on.
So, Prashant, from what you say, it seems that the first quarters perhaps was just an outlier, just an aberration because of the unfortunate events with the crash and the cross-border tensions as well. Now, since you seem to be convinced about the overall growth trajectory, the longer-term narrative on the hotel space. So, from that perspective, for someone who wants to get in with at least a 1-2 year view, which company could perhaps offer the best growth and valuation comfort, synergy? There's obviously Indian hotels, but should you be looking at tier 2, tier 3, smaller hotel stocks if you've missed the big move on Indian hotels itself?
See, structurally, we like IHCL.
Oops. I think we've just lost that line with Prashant. We'll get him back, but that's the
brand base and chalet hotels in asset owner space.
Yeah, Prashant, we lost you in between. Can you start that answer again? Your favorite hotel stocks and why?
Yeah, so structurally, we like IHCL as well as chalet hotels. IHCL because of the fact
I think we have a bad line.
They have a leading pipeline. And then on chalet hotels, again, we are expecting asset addition every year from chalet hotels for the next 4 or 5 years. So these two are the preferred ones right now. And given the kind of run-up that we have seen in business for all hoteliers, valuations are not cheap as of now. So that is why it would be better to focus on stocks which are good from a structural perspective.
And you've listed those names, Prashant?
IHCL and chalet, just two, right?
Yes.
Right. So at the margin, valuations are not cheap, but at the margin, do you expect, the general broader expectation is that consumption will pick up, but I guess that is largely for mass market, which has been doing poorly. There's been no such problem at the higher end discretionary, right?
No, in hotels, actually, we are seeing demand across all segments, be it luxury, upper upscale, mid-scale. So it is not that only the luxury or the top-end segment is seeing demand growth. We are seeing it trickle down to even the mid-scale segments. So companies like Lemon Tree, Sami Hotels, right up to IHCL, all of them are seeing good occupancy as well as rate growth.
Yeah. There's no, I ask this question whenever we speak with a hotel company once in a while, but, what is worth doing is worth overdoing. That's the general maxim in markets. There's no risk of overbuilding, right? I mean, the last time you had a big boom in hotel construction, it was long ago, but it took 15 years for that capacity to be absorbed. No, is there a risk of that same repeating?
Right. See, the difference between asset addition in the last upcycle and right now and for this upcycle is that between 2008 and 2014, the expansion primarily was in business locations. But this time, the expansion is in your not only in business location, it is well distributed across business as well as leisure locations. It is not concentrated to tier 1 locations. It is spreading across tier 2, 3, 4 locations as well. And that is why therein lies a key difference. Rather in tier 1 location, actually the construction has been less because of the expensiveness of the asset of the hotel construction. And that is why we are seeing ADR growth in most of the metro locations in double digits. it is a classic demand supply mismatch which is playing out right now. So I don't think that there is a similarity between the last super cycle of asset addition vis-a-vis this time. Actually, by 2030, we should see ideally almost all prominent locations across tier 1, 2, 3, 4 having one or two branded hotels, which will be the key difference between this asset addition cycle versus the last one.
Okay, there's an interesting point there. Prashant, thank you very much for joining us. It's good speaking with you and getting that perspective. Patchy line, I wish the line was better, but interesting conversation nevertheless. Well, let's just quickly get in Sudarshan and Mitesh who are with us with what they want you to do as far as trades go. 9:10. Sudarshan, what do you have?
Well, it's Prestige. Buy Prestige with a stop under 1660.
Prestige, okay, and that's a long call. Mitesh, what about you?
I'll go with a short side call, and that's on Bharti Airtel, which I would recommend selling with a stop at 1942 for targets of around 1860, 1865.
Okay, all right. I've got that. I think we can now talk about the top stocks as well from a fundamental perspective, which should be in the news VIP industries. I think the pre-open is finished, so maybe the stock comes up as well. Let's revisit that story. Stock's down about 4.5%. Mangalam is here with the deal which came through, which Mangalam was telling us on Friday as well. Mangalam, take us through it.
Well, so the VIP promoters who own 51.7% stake, 32% of that stake will be sold to multiple and consortium at a 388 rupees per share valuation. The stock, the reason why it's lower in pre-open is because it's already seen a run-up, and the Friday close was a sharp premium to the price at which the deal has finally happened. But from here on, the companies, the acquiring companies have also gone ahead and made a mandatory open offer for up to 26% of stake at 388 rupees per share. So 32% from the promoters and possible 26% leads the overall deal size to be about 58%. So we'll keep an eye out on that. VIP Industries, remember, is a very strong brand, synonymous with the luggage industry in India itself. But the last few years, it's been struggling on all fronts when it comes to market share on account of competition. And at the same time, in terms of leadership as well, multiple CEO exits, etc. have taken place. The promoters themselves have alluded to, looking for strategic investors in the company due to lack of succession. And that exactly has happened. So from a business standpoint, how multiples and the consortium turn this around at a time when the industry is fairly dynamic, still promises a lot of growth runway from here on, is something I'll be tracking very, very closely. But from just an iconic brand selling out to an investor, it's a very nostalgic story.
Yeah, indeed it is, and it's been in the making for many, many quarters and months, I guess. Mangalam, thank you for that. Another important stock to focus on today would be Divi's, and Divi's is down 3% in the pre-open. That's because one of their major drugs to which they're, I think, suppliers, it's a cardiac drug with Novartis, it's running into some legal trouble. Let's go to Ekta to find out more. Ekta.
Well, yes, Divi's is in focus because MSN, the pharma company, has won a patent litigation regarding Novartis's blockbuster cardiac drug, Entresto. And remember, it's generated around $6 billion for Novartis. So that's how big the drug is. It basically now clears the pathway for the generic launch of this particular drug, Entresto, in July itself. So that means that there will be generic versions by MSN which will be launched in the US market of Entresto. How does this impact Divi's? Entresto's API is expected to be the largest product in Divi's innovator custom synthesis portfolio and is estimated to be contributing as much as 40% of their custom synthesis revenue and accounting for as much as 20% of their total overall sales. IIFL wrote on this. They said over the next year, Divi's could see a potential 12 to 13% decline in annual EBITDA. It's currently trading at around 58 times FY27 EPS and 40 times FY27 EBITDA, and hence pricing and probably a lot of optimism around GLP-1 CDMO space. And the Entresto patent cliff will probably pose a material risk to earnings, but they maintain a reduced rating on the stock. The reason the stock is down around 2.7% in opening or in early opening is indicative of the fact that possibly a large part of this bad news is probably factored in, considering there's been a lot of back and forth with regards to this particular litigation. So the street was probably expecting the worst already.
All right, Ikra, thanks very much for that. So Divi's down about 3.5% Let's just look at, we have 60 seconds. Religare, if we can pull it up as well. So we looked at VIP, Divi's, and let's just look at, not REI, Religare, if we have it. And maybe like a TCS, which was, of course, down 3.5% on Friday after earnings came through on Thursday. So yeah, I mean, 1.25% lower, some 45,000 shares in the pre-open. But trade is just about starting to pick up. I think on the indices, at least, we've left off absolutely flat, nothing very much going on. We'll just look at the rates on stocks in a bit from now. So 25,150 on the Nifty, 82,500 on the Sensex. These are the first sort of levels which are starting to come through. 25,130, 20 points lower. 56,700 on the Nifty Bank. So this is flattish kind of open. Mid-cap index is, again, almost unchanged. 20-point change. The small-cap index maybe also not very much at all. And advanced decline is almost 1:1. So it's not as if the broader market out of the gates is doing something very special, something very different. So it's a very flat kind of start. The Nifty heat map gives you a quick sense, as always, of how things are starting up. And then we will go into individual names, etc. So it is a very, very flattish kind of day. There you go. Evenly split. So I think about 25 up, 25 down. Almost, I mean, so neither here nor there. Surabhi.
Yeah, IT is still down. That's the one clear trend. TCS is another 0.5% lower. HCL Tech is approaching its numbers with nervousness. Remember, even for HCL Tech, the constant currency revenue is expected to fall by about 1%. So tech is on the lower side. Infosys is down more than 1% now. So that's one trend. What else? There is BEL lower by 1%. HDFC Life, Bajaj Finance, some of the financial stocks, even Bajaj Finserv, Shriram Finance, a lot of the NBFC names on the lower side. Not that banks are having a much better run. Axis Bank is lower by 0.3%. HDFC Bank is totally flat. And ICICI Bank is not even up 1 rupee. So it's completely flat. No sense of movement whatsoever. The weak side also includes names like Eternal, Hero Moto, L&T and Reliance, by the way, two big stocks, both down 0.5%. And that brings up a 50-point decline for the Nifty. So what is countering it? There's some pharma action on top. Sun Pharma, for instance, 1% higher. There's Lever, there's Titan, there's Apollo Hospitals. That's pretty much it. Don't have a big move on FMCG today. Just a few of these consumer stocks like Lever and Titan holding up. Otherwise, yeah, it's flat with a negative bias. Now 60 points lower on the Nifty. Nigel.
Well, that's right. A few stocks that deserve special mention. Enviro Infra, that's a newly listed company. That, in fact, is moving higher on decent volume. So that's a stock that's on the radar. You have Sona BLW. The stock actually in pre-open was much higher. Now it's holding with a gain of around 2%. Both of them on high volumes. Jane Street, they've gone ahead and they've put in that deposit with regard to the penalty. Now, the hope is that volumes pick up yet again. That's the hope. No confirmation, but BSE. That's the one that I'm talking about. That's up close to around 2.5%. So keep an eye out on that name as well, if in case volumes do start recovering. Because remember, the past week or so, couple of weeks actually, volumes on the exchanges have been far lower than averages. Moving to the other stocks, GE Power, that's falling on large volumes. So that one's coming for some big profit taking, as is the case with Religare. After the big bazooka move that we saw on Friday, Religare is actually lower. And Dream Folks, that downward spiral just continues. So that one as well is struggling this morning. So you have the Nifty, that's lower with a cut of close to around 50 points. The mid-cap index, though, is holding pretty much flattish, which is encouraging, actually. And, I was reading a note from Gautam Dugar this morning from Motilal Oswal. They believe that earnings will be much better in the mid and the small cap space. So that's why they're increasing weightage on the mid and small caps in comparison to the large caps. So the mid caps doing a bit of an outperformance.
BSE, as we were discussing before the pre-open as well, 3% is the biggest volume-led gainer. 10% knock last week. MCX was down 10, but exchanges generally took a bit of a hit. So that Jane news of the margin, will it help? Will it bring some people back? Is the question. MCX is up about 1.25% as well. Polycab is another one, right? 2.5% higher. It's the fourth, fifth largest volume-led name. But and then you look at Angel One as well. Angel One is up about 2%. So again, broker 27, 26 or so. Castrol is coming up with a 3% pop, 226. Silver Bees, look at silver. We were talking about silver earlier. Silver Bees, which are traded 2% higher. I remember silver on Friday was up 4, and this morning I think they're up a little bit as well, futures. But the big one, of course, came up on Friday's session. Advanced decline now is settling down, slightly down, about 1250 lower and about 1100. Actually, it's not very much different. Infi is the biggest volume-led loser. IT services is another space after TCS we were talking about. So it's down 1.5%. It's not much, but it is down. So I think TCS has reported a 3% constant currency decline is basically muted expectations a little further. And then, of course, I mean, you got VIP, etc. We will be discussing. Garden Reach and Mazgaon are the two shipbuilders, which are down 4% and 3% respectively. So another sort of area to keep an eye out for. Najib?
Just a couple of stocks, Polycab and KEI Industries, they are higher. Their case could be helped by the fact that we have a JM Financial note that's come in there. And they've initiated coverage on both these two names. On Polycab, the target price is around 7,900. And on KEI Industries, it's 4,500 rupees. So that's a note that's released today itself from JM Financial. So could be having some kind of impact in initiating coverage on both these two names.
All right, we'll keep an eye out on that one. We'll probably get you updates, the details of that note as well. 50 lower, 25,100 on the index. Vetri Subramaniam is Chief Investment Officer at UTI Asset Management Company. Is with us. Vetri, good morning. Great to have you on the program as always. Prashant this side. Are we heading up or are we heading lower, Vetri? Simple question. It doesn't get more simpler than that. From here, where we are, sort of, is it? And the question I asked that question is because even though last week markets lost a little bit of momentum, they've not really done badly at all, given all the noise around tariffs, etc., and all the other stuff, right? Earnings which have been poor, which continue to be. This quarter is going to be nothing special. So, which way are things weighted, in your opinion, Vetri?
Morning, Prashant. Well, I wish I knew. It's impossible to say what the market will do any given day or any given week. But I think, we as a mutual fund, are looking to deploy money for investors over the much longer term. And I think when you look at that, you have to look at, where you are in terms of the starting point, in terms of valuations. It's a little bit more of a mixed picture over there because, valuations are sort of in the fair value zone when it comes to, benchmark indices like the Nifty 50. But I also think this is a market in which it's more about getting the stock selection right rather than just a top-down focus on, market valuations or single stock valuations. So I think I would just describe it as challenging territory. And I would suggest that the main thing is for investors to have very moderate expectations from equities given the current starting point in terms of valuations.
That's an important point. Vetri, hi, good morning. And we'll talk about some of the micros in a bit. But on that point, where markets are and how markets have reacted to all the tariff news as well, right? And now the letters that are going out, at least the printed rates are 25%, 30%, 50%, depending on which country you are. But the market has remained completely unfazed. I mean, what would your observation be on this? Is this a sign of wisdom or is this a sign of overall market complacency, which then maybe could be a new risk?
But let's just slice and dice it a bit. I think clearly, all the factors that you're talking about has heightened the uncertainty in the marketplace. It's heightened the uncertainty in terms of corporate decision making. So, I think clearly we are seeing companies hold back on large capex announcements because of the fact that the global value chain is now splintering. And this is particularly true of, large investments in the tradable goods area. I think this is true not just of India, but even on a global basis. Any entrepreneur is doing the obvious thing when faced with uncertainty. It's a little bit like driving in heavy rain in Mumbai. You just slow down simply because your visibility is so much slower. And I think some of that will translate into slower decision making. It will show up in the earnings. And it's interesting since you mentioned, earnings, the market sort of back to where it was, 7, 8, 12 months ago. But in valuation terms, even though you've rolled forward a year, in valuation terms, it's not really cheapened very significantly. significantly. And I think, therefore, given the risk to earnings, I would still worry a little bit about that. In a global context, it's quite interesting because when you look at the US, the bond market is talking about 2 rate cuts through the rest of the year, which suggests the bond market is expecting softer data. But you look at the equity market, and the cyclical component of the equity market in the US is significantly outperforming the defensive part of the equity market, which is a little bit of a dichotomy, that you've got the bond market pointing one way and you've got the equity market pointing the other way. And sooner rather than later, only one of these theses is going to play out. Both can't play out.
Absolutely. I guess the equity market only wants to read one way, and that is up. Whether you talk about real wars or trade wars or currency situation, inflation, the equity market just wants to read up. By the way, our market is flashing down. I just wanted to, as I hand it over to Nigel, we're almost a 90-point drop now on the index. Watch out for a sharp fall in stocks like Bajaj Finance, and further cuts on big stocks like L&T as well. And IT anyway has been weak, so it's now turning out to be slightly lower after the start.
All right. Hi, Vetri. Good morning. Good to see you, Ben. You're sounding a little bit cautious on the headline index itself, so you wouldn't be in the camp that believes that mid and small caps are the way to go. I was reading a note from Motilal Oswal earlier this morning, and they have said that after a while, they are feeling a little better about mid and small caps because the earnings growth will be far better than what the large caps will do over the next 12 to around 18 months, or 18 to 24 months. How would you position yourself in terms of investments in the equity market?
So if you just roll that back, Nigel, look, all returns that you got out of equities are a function of where you are in terms of starting valuations and then what you get in terms of earnings growth. There is some evidence that, I would say certainly looking at the quarterly outlook, that the earnings prospects in the current quarter, or rather the quarter completed, are better for mid and small caps compared to large caps. But if I look at the FY26 numbers, I'm not able to see a very big gap. And therefore, given that the starting valuations are already a lot more elevated in the mid and small, I'm not sure that the superior earnings growth by itself will do enough to outweigh the pressure from the starting valuations being higher. So you've always got to look at it in a combination. The market is never driven by a single factor. It's always multi-factor. And I would say the two key elements that I as an investor have always learned to look at is where are you in terms of starting valuations, where are you in terms of earnings growth. So you've got to look at both together rather than only where is the best earnings growth. And history is replete with examples about, companies which have compounded earnings growth at, very healthy levels. But when their starting valuations are elevated, you don't get the benefit of that simply because, the stock derates over a period of time. So that's the complexity you need to keep in mind.
Yeah. The thing is, now the market seems to be grappling on both fronts. Trying to find pockets where valuations are reasonable and trying to find pockets where at least you'll get some half-decent earnings growth, right? So, Vetri, help us out over here. I remember our earlier conversation. Financials, for instance, is a space that you've always liked. There's a big debate on FMCG now because FMCG stocks have not moved. Many believe that earnings from that very low expectations era will at least be better than what they used to be. But do you believe so?
Sure. So just quickly on both, I think as far as financials are concerned, Surabhi, we spoke more than a year ago. I think two big changes that have happened since then. One is that the RBI's thought process in terms of interbank liquidity has changed dramatically. The other thing which has changed is their approach towards risk weights. The way I interpret that is that they are now a lot more comfortable that the system has been cleaned up, and therefore they would be a lot more amenable to actually see credit growth accelerate. And I think that would be a wonderful thing for the financials. It's not yet happened. Credit growth is actually barely running at about 9% in line with nominal GDP growth. I would say, in fact, it's quite weak. But I think the trend line from here is likely to be higher simply because you've got RBI now clearly indicating in terms of its actions that they are amenable to higher credit growth. And I think that is good for the banks along with the easy liquidity. As far as FMCG is concerned, I know the stocks haven't done much in recent years. The other reason to look at them is that they're a little bit distanced from all the stuff that's going out in the context of, value chains and global trade and tariffs and all of that. But I just feel that the starting valuations there are still not really at a level which gives me great comfort. If I were to look at a sector where I had more relative comfort, I would actually say the Indian healthcare sector in general. And you remember the Indian healthcare sector is very well diversified now across domestic drug producers looking at global markets, the CDMO type companies who are doing contract work. Then you've got diagnostics, you've got hospitals. So I think that's a sector which, to my mind, slightly removed from some of these other issues, and at the same time, very diversified set of companies which is reasonably well placed to do well over the next few years. So banking and finance followed by healthcare would be my preference.
I think absolutely, Surabhi, on that financial point, we've of course seen this big pivot from the RBI, which I think has been well acknowledged. I met a couple of bankers over the weekend, and the RBI regularly calls for feedback, right? I mean, they'll ask and say, what else can we do? Yes. I mean, sense I got is that they are really eager. Tell us what we can do to spur growth. So they really want to kickstart another credit cycle. That's the clear message.
Which bodes so well, right?
Which bodes well. I mean, they really want to push growth. And one person said, well, I've not seen this kind of an RBI.
Focused on growth.
Focused on growth in a while, So I think that existing regulations, can we repeal some of it? Some things you think are draconian, et cetera, et cetera. I mean, things like PSL. We've discussed some of this in the past, but I think... and I think that is one reason why many who we speak to regularly are quite kind of focused and bullish on financials as a space. But the point is, if credit growth picks up, I mean, it shows up everywhere. Yeah. It's just that banks are economy facing and kind of it shows up there first.
Yeah, I think we were talking a lot about the Fed pivot. Well, all eyes are on the RBI. The pivot came here.
That's what I said, right? We were joking about it. Remember that Mr. Trump, maybe he'd want to take a leaf out of our RBI governor's book and send some lessons to Mr. Powell. That's on a lighter note. But thank you very much, Vetri. Great conversation as always. So we'll keep our eyes very focused on financials to see how it starts playing out in numbers. The RBI is a new, far more supportive and accommodative stance with respect to growth. So thanks for that. The market continues to sort of grind along 70 points lower. So it's not kind of... The good thing is that the ground is not sinking in. It's not caving in. It's still fighting with about a 70-80 point sort of a cut. Now let's focus on a company that is all set to come to the street. We're talking about Bengaluru-based Anthem Biosciences. They're doing an IPO. It's an issue where they're looking to raise about 3,395 crore rupees. This is entirely an OFS. The price band has been set at 540 to 570 rupees per share. The company has raised a little over 1,000 crore rupees from anchor investors ahead of the public issue. So we have with us the chairman and managing director of the company, as well as CEO, Ajay Bharadwaj, and the CFO, Goyer Beg. Thank you, gentlemen, very much for joining in. Mr. Bharadwaj, let me start with you. So just explain to us, I mean, I was going through your business verticals as well. The growth has been very, very steady. You've managed over the last couple of years quite a steady run at the top line level. We're talking about, I think, over 35%, almost 35% growth coming through. Your margins are close to 36% as well as of FY25. So this space that you're in, CRDMO, just tell us about your pipeline, the big companies that you're operating with, and what makes you confident about growth prospects.
Yeah. First of all, thank you for having us. First, let me explain what the Contract Research Development Manufacturing organization is. It's a new age business, and it's a very knowledge-based business. We actually are partners to global innovator companies, helping them discover new drugs. So that, in a sense, it's very different from what we understand as the normal pharmaceutical business in India, which is largely generics based. We, on the other hand, are partners of choice for global innovators to help them discover new drugs. So we do end-to-end discovery. We start with discovery, development, and all the way up to manufacturing. So as the molecule or a potential drug candidate progresses from early development all the way to manufacturing, it has to go through many gates, right? This is a highly regulated business. Anthem is able to assist global companies at each step.
So, so help us understand what that model means in terms of how the revenue flows or the revenues accrue. I mean, I'll just give you an example of the latest big headline in the Indian pharma R&D space is coming in from Glenmark, right? Now, they have a very different model. They developed a drug and then they've sold it to an innovator, and then they get certain upfront payments and milestones, etc. So when it comes to generating revenue, how does your partnership with the global innovator giants work?
So actually, if you look at it, it's very similar to what's happened with Glenmark, as you said. There are companies which are, emerging biotechs. They are in these centers of excellence around the world. It could be Cambridge in Massachusetts, San Diego, San Francisco, these kind of places where there is a lot of talent, and there are brilliant universities there who generate a lot of knowledge, new knowledge. So people form companies in partnership with either professors or ex-employees of big pharma, and these companies get funding from the venture capital funding, which is available plenty in that area. Once these companies are set up, they're very small, head count. They have no labs. So we become their wet labs. In the sense, they give the development responsibility to us. Now, for them to do that, they have to have enormous amount of confidence both in your ability to do this, as well as the other parts, which is your credibility, your ability to keep it confidential and protect their intellectual property, as well as their name. Because that's when you ask, who are our customers? We're not at liberty to disclose them because our agreements forbid us to do that. Then if these companies start to succeed, let's say, and it takes 5 to 8 to 10 years sometimes before the molecule moves to phase 3 and is near commercialization, then almost always they get acquired by big pharma. Just like this molecule has been taken by AbbVie from Glen. So, we would do the development for these companies. And finally, we do go into supplying big pharmas, and that is also the big part of our story. So our revenue flows come from molecules that we helped discover and are now commercial.
So
Some of these
go ahead. Would it be correct to understand that there is, during the life cycle phase, which could be running into several years, you get, so to speak, a service fee for all the lab work and R&D you're doing. And if the molecule actually reaches the end point and commercialization happens, then you are open to what, additional milestone payments?
So, yeah, you're right. So we agree to what our model, as opposed to several other of our peers, which is their model is full-time equivalent. Ours is fee for service. So we agree on milestones. And when we deliver those milestones, we get paid. And then we move to the next, then we set the next milestone. So in the end, when the product goes commercial, because arguably we know most about it than anybody in the world, because these are all de novo molecules. These are new molecules. So it does stay with us. So whoever acquires it also would say, we want to keep it with these people because you know the most about it. If we have the ability to have the manufacturing capability, the scale, which we have, as well as the compliance track record. So because, again, this has to go through all the FDA approvals and all the rest.
Can I ask you a question about the
go ahead.
itself? So this is the OFS, complete OFS. And it's correct me if I'm wrong, I mean, compared to Divi's and others, I mean, priced a little aggressively. I mean, you want to take that? Question?
I'll take that. See, with respect to this OFS, with respect to the IPO, this is a complete OFS, and the price band that we have set has been in consultation with our BRLMs, and we've been on the roadshow for the last 3 months, and based on that, we have set on the price band. And even last Friday also, we've got our anchor book done, and a lot of marquee investors have come in this anchor book as well.
FY20, based on FY25 earnings, almost about 65, 70 times earnings, right?
Yes.
On a price to earnings multiple. That is, what kind of growth are you expecting? Anything you can tell us broadly?
See, what we have done is, we have built our facilities, which is highly compliant facilities from a US FDA point of view. Both our facilities have gone through US FDA audit 6 times. Now we are coming up with a third facility, which has also been commissioned over 2024 and 2025. Now we are starting work on our Unit 4, which is a large-scale expansion on a 30-acre land block. So the ingredients of the growth is something what we have put in.
Long-range forecast, Mr. Vik. Would you be able to put some numbers to it?
At this point of time, we won't put any numbers on the long-range forecast, but historically, we have grown at a CAGR of about 24%. Our margins have been quite steady. We've been at about 36 to 37% EBITDA margins and about 23 to 24% PAT margins. And you talked about the IPO being an offer for sale. The reason being it's an offer for sale is we are sitting on net cash of about 625 crores. Plus, there is cash generation in the business. It's a cash-generating business, so we are in a self-sustaining model to be able to sustain our manufacturing expansion by using the internal accruals and cash being generated. And that's the reason it's an offer for sale.
All right. Good to have you in the studio, gentlemen. I was looking at the numbers, and maybe one of the reasons that you all have priced it so aggressively is because you all have grown faster than competition and margins are relatively better as well. But just a quick word on the margins parameter. The margins that you mentioned, mid-30s on in terms of EBITDA, and PAT margins, I think mid-20s. You can hold on to that. Not asking for a concrete guidance, but that's the aspiration?
That's the aspiration.
Got it. All right, so that's out of the way. Also, a couple of more questions. Specialty ingredients, I think that's around 18% of the mix, right? Could you tell us how are margins different out there? And if you could tell us, where do you see that number scale from around 18%? So that's point number one. Point number two is, you have cash of 600 crores. How will you utilize this cash? Please go ahead.
Yeah. See, specialty ingredients is also a very niche business that we have. It's a fermentation-based business where we are selling a lot of nutritional-based products, mostly actives across probiotics, enzymes, nutritional actives, vitamin analogs. And it's a high-growth market because a lot of this products in this space is not something which is coming under price control. So most of our customers are looking at selling these products, and to whom we supply are the drug substance or the drug actives. Historically, specialty ingredients have been hovering for us in the range of about 20 to 25%. And I think broadly going forward also we would continue to be in that same range. This year it has been about 18.65%, but broadly it would be around the 20-odd percentage level.
All right. Have we got that out of the way? And cash utilization?
Yes. As on date, we have about 109 crores of working capital debt and about 735 crores of cash, mutual fund investments in bank and bank deposits. I think over the course of the next couple of years with cash generation, which could be about close to 300 crores a year, we'll be sitting with close to about 1,000 crores plus of cash, which we will use for our Unit 4 expansion. That's the large-scale expansion which you're looking at doing.
Just one last. I think 5 odd customers contribute 70-75% of your revenues, right?
54. Yes, 70%. Yes.
70%. And the model that you described was you get paid as you go, based on milestones, etc.
Right.
Right. Is there a risk because it's so highly concentrated? I mean, if something does not work out with one client, and 5 or 70% of your revenues, I mean, there is it kind of becomes lumpy in that sense?
No. So let me again explain. The commercial products that we have, those are very linear. They are continuously growing and they have very long extended patent life still. So
there are 13. Sorry, so I wanted to just understand. Right now, you have 13 products which are commercial, right? So that's steady state. There's no discovery or development risk over there.
So that becomes like a regular, very linear business.
It's like annuity, yeah.
And growing because those molecules are growing globally. And 4 of them are blockbuster drugs, which means they have crossed more than $1 billion in sales. And we support them as a major supplier. And on the milestone part is the discovery part. So that part is the part where we get paid as the molecule progresses. See, in our business, you want to ask something.
So just to go back to Prashant's question as well, the risks. Since you have a client concentration of 5 and the commercial molecules are 13, there are many which are early stage, some late stage, some discovery stage.
Right.
What about the risks when you don't meet the milestones and you're concentrated with 5 clients?
No, these are not the 5 clients are commercial.
Okay, those are 5 commercial clients.
We have 150, nearly 150. So that's why it's a little. It takes a little while to understand. There are 150 discovery companies that we are working with. So these molecules, and it's the nature of the business. Many of them fail, but neither do we. We get paid because it's still
R&D.
We still do development. And the good part is when a product fails, and these companies usually then go belly up, but the people who are working in these companies go and join or start another 3 new companies. So potentially you now have another 3 new more, because you never failed them, right? So actually this is why we've been in business 19 years now. So I mean, I can say very confidently that we have in that ecosystem of drug discovery a very good name. And in this, word of mouth is also really important, because people who have worked with you, they can vouch for you.
Matters for a lot. Thank you very much, gentlemen. Great speaking with both of you. And I hope you will come back and we can have a longer chat. We're constrained on time, but wish you all the best of luck.
Thank you so very much.
Well,
thank you.
All the best. We look forward to you speaking to you all on listing day yet again.
Thank you.
Well, let's get back then to a couple of listed companies. Then newly listed Oswald Pumps has reported its Q4 FY25 earnings. The revenue jumped 50%. The EBITDA margins as well expanded by 750 basis points. But it seems the street wanted a little bit more. And that's why we saw the stock see some profit taking in Friday's trading session. We have with us Mr. Vivek Gupta, the chairman and managing director at Oswald Pumps, who joins us on the show. Hi, Mr. Gupta. Good morning. Thanks a lot for joining in. Well, you've doubled your revenues approximately, every 2 years or so. For this year, FY26, what kind of growth expectations you're talking about, if you could help us out with the guidance? And also, though the numbers have been looking very good, last year your cash flow, in fact, went into the negative. How confident are you of returning back to cash flow positive in this year? If you could give us some color on that front. So revenue growth, margins, and cash flows turning positive. Please go ahead.
Okay. Very good morning. Basically, can I talk in Hindi?
Yes, sir.
Yeah. So if you see the last year company ने year on year एक बहुत अच्छी growth ली है, जो कि करीब आप देखेंगे तो 176.5% के करीब हम लोगों ने growth ली है प्रॉफिट और मार्जिन में, EBITDA मार्जिन में, एंड जो हमें इस पूरे आगे का सीन दिख रहा है ओसवाल में, बहुत अच्छी ग्रोथ दिख रही है, क्योंकि पीएम कुसुम 2 बहुत एग्रेसिवली गवर्नमेंट काम कर रही है, एंड पीएम कुसुम 1 के फिनिश होने से पहले ही कुसुम 2 बहुत तेजी से लॉन्च होने वाला है, और इनफैक्ट पीएम कुसुम 1 को भी फिनिश होने में एटलीस्ट कैलेंडर ईयर जून 26 तक का टाइम है, जून जुलाई तक का. सो वी आर क्वाइट वेरी सेफ एंड वी आर एक्सपेक्टिंग वेरी गुड प्रोग्रेस एंड गुड ग्रोथ. So definitely, as per planning of Oswald Pumps, still there is no doubt. And as per
Mr. Gupta, एक अगर मैं सवाल पूछ पाऊँ आपसे, एक तो कुसुम सेल्स जो हैं, कुसुम का जो प्रोपोर्शन है सेल्स मिक्स में, वो गिरा है इस बार, कुछ 11% नीचे है. मार्जिन्स भी काफी कम है कंपेयर टू द एनुअल एवरेज. तो आप कुछ एक गाइडेंस दे सकते हैं FY26 के बारे में, बोथ टॉप सेल्स ग्रोथ एंड टॉप लाइन ग्रोथ, कुसुम मिक्स एंड मार्जिन्स?
ओके, देखिए एक्चुअली हम लोग ईयर टू ईयर ग्रोथ को एक लेके चलते हैं, और क्वार्टर टू क्वार्टर हमारे सेल्स मिक्स का वेरिएशन हमेशा रहने वाला है, क्योंकि हमारे पास पैन इंडिया नेटवर्क जो हमारे अदर कस्टमर्स है वो भी हमें सस्टेन करने हैं. सो ये कंपनी एक बीच में स्ट्रेटजी कॉल लेती है ताकि अपने कस्टमर्स को सस्टेन कर सके, कि सारा टोटल सेल्स हम अगर प्रोजेक्ट की सेल करेंगे तो हमारे जो रिमेनिंग कस्टमर्स है वो सफर होंगे. सो वो रहेगा. बट ईयर ऑन ईयर अगर हम देखेंगे, सो हमारा जो प्रोजेक्ट सेल्स है वो भी इंक्रीज, बहुत अच्छी ग्रोथ लेने वाला है, और हमारी पैन इंडिया जो नेटवर्क सेल एक्सपोर्ट सेल्स है, सो अकॉर्डिंगली वो भी हम लोग बहुत फोकस कर रहे हैं. सो ये क्वार्टर टू क्वार्टर थोड़ा बहुत सेल्स मिक्स में डिफरेंस रहेगा, बट कंपनी का आउटलुक बिल्कुल क्लियर है. कंपनी ईयर ऑन ईयर बेसिस पे ही अपने मार्जिन्स लेके चल रही है, अपने प्रोस्पेक्ट्स लेके चल रही है.
तो क्या नंबर्स हैं वो FY26 के लिए गुप्ता जी?
देखिए FY26 में बेसिकली हम लोग साइलेंट पीरियड में चल रहे हैं. सो यहाँ पर हमारे कंसर्न है कि हम लोग बहुत क्लियर व्यू नहीं दे सकते.
नहीं सर, तो आप ये बता दीजिए मिस्टर गुप्ता, आप ये बता दीजिए कि लेट्स गो बाय योर मिक्स. जो आपकी रेवेन्यू FY25 जो जब खत्म हुई, तो वो जो मिक्स था आपका पीएम कुसुम से जो बिजनेस आ रहा है वर्सेस द नॉन पीएम कुसुम बिजनेस, वो मिक्स एक बार हमको दोबारा बता दीजिए एंड टेल अस वेदर इट विल स्टे द सेम या उसमें कुछ वेरिएशन होगा.
देखिए नॉर्मली कंपनी का मेजर फोकस प्रोजेक्ट सेल पे है. सो अभी तक की हिस्ट्री अगर हम देखते हैं, 70 to 75% का हमारा क्वार्टर 3 तक का मिक्स रहा है प्रोजेक्ट सेल में, और यही रेशोज, इसी के आसपास की रेशोज हम लोग आगे मेंटेन कर रहे हैं, और मे बी 2-4% ऊपर नीचे. बट प्रोजेक्ट सेल्स में बहुत अच्छी ग्रोथ दिख रही है, क्योंकि पीएम कुसुम 2 में गवर्नमेंट बहुत एग्रेसिव है, और चूंकि हम लोग एक लीडिंग मैन्युफैक्चरर है, सबसे बड़ी कैपेसिटीज, सबसे ज्यादा नंबर ऑफ पंप्स इंस्टॉल्ड अभी तक ओसवाल के पंप्स हुए हैं. So and eligibility criteria ओसवाल के पास हर एक स्टेट्स में अवेलेबल है. So ओसवाल यहाँ पर बहुत एग्रेसिव है और बहुत ऑप्टिमिस्टिक है कि इससे जो प्रोजेक्ट सेल्स मिक्स हमें पहले मिले हैं, शायद हम इससे भी अच्छे नंबर्स अचीव कर पाए.
अच्छा, एक चीज और मिस्टर गुप्ता, दैट योर रेवेन्यू हैज बीन ग्रोइंग at a very fast pace. Your profits are also higher. But this is not showing up. जो आपका cash flow है, उसमें इतनी जल्दी conversion नहीं हो रहा है. So why is the delay? In fact, आपका cash conversion cycle 135 days आ गया है. End of FY25, end of FY24 91 days था. तो कैश कन्वर्जन साइकिल क्यों बढ़ रहा है? Why is the profit not translating into better cash flow?
Okay, देखिए हमने गवर्नमेंट प्रोजेक्ट्स में पार्टिसिपेट करना शुरू किया एंड ऑफ द FY24 के क्वार्टर में, और चूंकि हम धीरे धीरे हर एक स्टेट्स में एक्टिव हो रहे हैं, सो गवर्नमेंट साइकिल्स करीबन हमारा 150 to 160 डेज का जो साइकिल था, पीछे आप देखेंगे तो वो साइकिल चल रहा था, जो कि इस साल में बहुत तेजी से धीरे धीरे रिड्यूस भी हो रहा है, क्योंकि गवर्नमेंट इसमें एक्टिवली हम सब के लिए काम कर रही है. वो चाहती है, गवर्नमेंट चाहती है कि हमारा जो साइकिल है, पेमेंट साइकिल है, बहुत रिड्यूस हो, और वी आर वेरी मच ऑप्टिमिस्टिक. ये जो साइकिल है बहुत तेजी से रिड्यूस होने वाला है इन कमिंग कपल ऑफ मंथ्स. वी आर वेरी मच ऑप्टिमिस्टिक कि अगर आप एंड ऑफ दिस फाइनेंशियल ईयर देखेंगे तो ये जो कैश कन्वर्जन साइकिल है ये बहुत अच्छा खासा रिड्यूस होगा. एंड सेकंड, चूंकि अभी हम लोग नए नए गवर्नमेंट प्रोजेक्ट्स में आए थे तो थोड़ा सा कैश फ्लो नेगेटिव था, बट इस साल वी आर वेरी मच ऑप्टिमिस्टिक कि हमारा कैश फ्लो पॉजिटिव होने वाला है.
ऑलराइट, कैश फ्लो पॉजिटिव होने वाला है, एंड मे बी जब आप साइलेंट पीरियड पे नहीं होंगे तो फिर बात करेंगे विद सम स्पेसिफिक नंबर्स फॉर FY26. थैंक यू वेरी मच.
थैंक यू वेरी मच
for joining us. We'll take a quick break here. We'll come back, and what we'll do is we'll put the focus on a sector, as always. Quarter se quarter tak is our segment, which is coming up. Vivek Gupta we'll have Gaurav, who will be joining us in just a bit from now to run us through what his expectations are for the first quarter from the banking space. That's coming up in just a bit.
Welcome back. Just a quick check at the market, and it's managed to cut its losses. The Nifty, which was at one point in time down almost 100 points, is now down only 40 points. This is good. There's some buying happening at lower levels, so bulls would be pleased with the way things are turning around. The mid-cap index is doing a lot better. Mid-cap index is up a whole 0.5%, nearly 0.5% in positive territory. Well, let's continue with our special series, Quarter Se Quarter Tak, as we prepare you for the upcoming earnings season. We've got Gaurav joining in. How the first quarter could be for the banking sector. Over to you, Gaurav.
Well, yes, investors' interest in the banking segment is rising, and the reason being that if you look at Bank Nifty, it recently reached its all-time high level. But when we look at Q1 numbers, can we expect the same numbers from Q1? So let's understand a few factors. RBI has now delivered rate cut in the range of around 100 basis points. On the other hand, when we look at system credit growth, that has come down to around 9.6%, which was as high as 20% just a year ago. And considering all these factors, now there are two concerns specifically for the bank. First is that slowdown in the loan book growth, and second is the slowdown in the interest margins. First, let's understand the loan book growth aspect. From what we have seen in the provisional update, we have already seen that banks, large sector banks like Kotak Mahindra Bank and some mid-sector banks like Bank of Maharashtra have delivered very strong growth. But on the other hand, we also have IndusInd Bank, Union Bank, who reported weak set of numbers when it comes to provisional updates. Now, considering this factor, if we look at the small finance bank, there the picture was actually even more bad, because excepting AU Small Finance Bank, there were some banks who reported very weak set of numbers if we compare it with its weekly previous average levels. And specifically when it comes to the asset quality also, there also we saw some concerns, because bank like Equitas actually reported very sharp spike in their retail slippages. Let's also not forget that there were also banks like CSB who outshined because of their gold portfolio. So that was another concern which was there from the market, but it was not seen in the CSB bank. But from the NIMS point of view, we may see some kind of pressure because of all these activities which are happening. NIMS are expected to go down almost by 8 to 30 basis points. In fact, we have got a list of banks. For example, when we look at some banks like SBI, Bank of Baroda, PNB, and a bank in the like of Axis, we may see NIMS going down in the range of around 10 basis points. For bigger banks like HDFC, ICICI, and for the banks like Federal Bank, the NIM drop down can be somewhere in the range of 15 to 20 basis points, and it will be higher for the banks like Bandhan, RBL, and even for the bank like the small finance bank, where we have seen unsecured portfolio which is higher, and now these banks are actually shifting their focus to the secured portfolio. Let's also not forget that for IndusInd Bank, we may see an uptick in the net interest margins on a sequential basis because there was a one-off in the last quarter. But let's also not forget about the asset quality concerns. When we talk about asset quality for slippages, Q1 is usually slower in terms of asset quality, and that is the reason we will be watching out on ICICI Bank, HDFC Bank, in fact in SBI as well, because we may see some uptick in slippages. On the credit cost front, there will be some pressure on the banks where we have seen asset quality was deteriorating, specifically in the likes of Bandhan Bank, RBL Bank, IndusInd Bank, where we may see slippages and credit cost remaining higher despite being a drop on a sequential basis. Now, let's not forget that for Axis Bank, they have actually tightened their norms, and that is the reason we will be watching out on slippages as well as credit costs for Axis Bank. Lastly, considering all these aspects, when it comes to the earnings, we may see some drop down in earnings as well. For PSUs, there may be some gain, but for the likes of HDFC Bank and ICICI Bank, we may see the momentum somewhere remaining around in the single digit when it comes to EPS growth. And for the banks like Axis Bank, SBI, and even for the bank like Kotak Mahindra Bank, we may see some drop. For the banks where we have unsecured exposure, we may see a bigger drop somewhere in the likes of around 20 to 30% for Bandhan Bank, RBL, and even higher for IndusInd Bank. Now, considering all these aspects, do we really are concerned about the overall outlook for banks? Well, it is unlikely, because when it comes to the outlook, many of the investors believe that this is going to be an event only for a quarter or two. In fact, Macquarie recently wrote a note where they believe that there will be some uptick in the bank's net interest margins. In fact, they believe that in FY27, we will see NIMS actually recovering to the full extent, and the private sector banks can also grow their EPS at around 15% over the next 3 years. So definitely, there are a few concerns in Q1. We may see some slowdown, but that does not mean that the banks are going to lose their shine. And on the back of that, we will be watching on the sector in coming days.
All right, Gaurav, thank you very much. Very comprehensive QT on banking. Ajit Kumar is lead BFSI research analyst at JM Financial Institutional Securities, is with us. Ajit, good to have you with us here. Thank you for your time. So across the board, I mean, I think as Gaurav comprehensively outlined, there is decline in margins, which is expected, some bump up in credit costs, etc. as well. How do you approach this season? It's going to be, of course, when we know, we'll know, but these are largely modeled in since NIMs will be lower because of course, rate cuts, etc. What's your sense?
Yeah. No, good morning, everyone. I think, Gaurav has summarized this, beautifully. Gaurav is absolutely right. We have the latest credit growth data till 27th of June, 2025. Now, the interesting point is YTD credit growth is roughly 1.3% versus, let's say, 2.8% last year. So credit growth definitely is lower as compared to last year. And on top of that, there is a margin compression which is going to happen across the board. Let's say, for the large banks, we are expecting roughly 10 to 20 basis point of margin decline in 1Q. Even in second quarter, there should be at least 10 to 15 basis point of margin decline in second quarter before recovering, let's say, by fourth quarter of this financial year. So net, because of this moderating loan growth and let's say margin compression, NII growth for our coverage banks, it's not more than 2 to 3% on a YOY basis. And, 1Q is normally seasonally weaker quarter. But even if we adjust for the seasonality, my sense is 1Q is going to be even more weaker quarter for the most of the financials name. On the asset quality side, yes, slippages are going to bump up because in the large bank, there is elevated agri slippages that come in first quarter. And on top of that, you have unsecured loan, which is a bit of pain still now. So net, your credit cost is going to be higher. So combining for all the banks that we cover, the PAT growth is going to moderate to roughly 8 to 9%. Versus, let's say, 6% decline that we had seen in fourth quarter. So this quarter as well, we are going to see, PAT declining by roughly 8% on a YOY basis in 1Q26.
All right, well, that's just hold on to that thought. Ajit, we have a newly listed company, Travel Food Services. It lists at a bit of a premium in comparison to what the IPO price is. And there's quite some ringing going on there with regard to that bell. So, management sounded optimistic about growth, profitability, and ROCE of, I think, 50% is what they were mentioning as well. The hugs are there, a green listing out there. I think the grey market premium had come down a little bit, but the stock opens up in the green. So I think, those smiles are quite bright and proud out there.
Yeah, I think
and the ring was
excited.
quite something.
Yeah, I'm sure there'll be some good food as well at that listing ceremony.
Better be.
Well, that's Travel Food Services. They offer, of course, food and beverage services at many, many airports. Big
All
airports.
the youngsters as well, quite happy to be part of that.
Yeah, it's one big happy family there at TFS as the company makes its listed market, public market debut today. We'll keep an eye out on how that share behaves as the day progresses. But just to get back to that conversation on financials with Ajit. Ajit, so, okay, let's just break it down in terms of, first of all, from an investor's perspective, should we be, when we're watching out for the biggest delta, should we be looking at the biggest growth outliers? And in which case, which could those banks be? I think the consensus is tier 2 banks will probably be tier 1 banks when it comes to growth. And when it comes to the margin delta, perhaps the best margin performance, the least drop in margins, etc., then which could be 2 or 3 of the banks which could surprise on the margin front? So tell us both.
Yeah. No, I think on the growth side, some of the smaller banks have done relatively well. Like, for example, AU Small Finance Bank, they have reported, good set of numbers, especially on the growth side. My sense is PSU banks, YOY growth is going to be higher as compared to private sector banks. And this has played out in last quarter as well. Even in this quarter, the banks who have reported their numbers till now. For PSU banks, YOY growth is roughly 11% versus, let's say, 6 to 7% growth for the private sector banks. So PSU banks are growing faster as compared to private sector bank on a YOY basis. And then even on, let's say, some of the smaller bank side, let's say, for example, AU Small Finance Bank, Karur Vysya banks, those guys are delivering, better on the growth side. Now, on the margin side, my sense is some of the mid-sized bank like City Union Bank, where most of the loans are fixed rate in nature, their, margin decline is going to be lower. Then some of the large banks, margin decline is going to be somewhere in the range of 10 to 15 basis point. But for the other banks, right, like, for example, all the other mid-tier banks and small finance bank, our sense is margin decline is going to be even more sharper. It's going to be somewhere in the range of 30 to 40 basis point. And the reason for this is there are two drivers of actually, this margin decline. One, obviously, the, policy rate cut that has happened, let's say in last, 2 to 3 months. The second issue here is mainly because of this stress in unsecured loan, most of these mid-sized banks and NBFCs are getting into secured loan all at the same time. So everybody wants to get into vehicle financing. Everybody wants to do affordable financing. So what is happening is there is a loan mix shift which is happening from unsecured to secured, and that is putting pressure on the yield side. So there is a mix shift which is happening from unsecured to secured, and as a result of that, there is elevated competition in the secured loan. So there is a pricing pressure as well in some of the secured segment. So yield is coming under pressure, and that is why we believe that for mid banks and NBFC, the margin outlook is even more muted. But coming to your question on the margin side, our sense is City Union Bank and large banks are going to surprise positively, or at least their numbers are actually baked into the expectation.
Okay, and very quickly your top picks then, just quick 30 seconds.
Yeah. So ICICI Bank continue to remain our top pick. ICICI Bank, SBI, even Axis Bank remains our top pick. In mid banks, City Union Bank and DCB continue to remain our top pick. In NBFCs, we like Bajaj Finance and PNB Housing Finance.
Okay. All right, Ajay, thanks a lot for joining in and giving us that view. We look forward to chatting up with you as the numbers keep trickling in. For the time being, let's get back to the markets, and we've seen a good recovery. As we pointed out earlier today, we're not ruling that out because the PCR had come down to the lower end of the range, and there are shorts in the system, 1 lakh contracts of FI net shorts. Midesh Thakkar is back with us. Midesh, would you be looking to sell into this sort of a bounce? We've recovered close to 80 points in the day's low, but I think we're still a little bit weakish till we get past at least the first hurdle, which will be at the 20 DMA. Tell us your trade on the Nifty and fill us in with a couple of stock trades.
So, Nigel, we have taken some put spreads. So basically, it's not a direct short, but it's an indirect short when the money will be made if the markets kind of decline a bit. So I think that could be a good strategy, given the fact that we have slightly tapered off from 25,600 to 25,050, which is today's low, without any kind of a pullback. We take a put spread, but as we get closer to 25,200, I think that's the area where you would want to be aggressively short. So another 100 points higher, you would want to explore shorting in the futures as well. The idea is that overall market, I think, could possibly decline to about 24,850, 860 zones, and that is the area where I'm looking stock support to come.
Okay. 24,850 eventually. That's what you're saying? Mitesh?
I'm working with that kind of a direction. That's right.
Okay. I mean, the 40-day exponential, which we put out in the morning, is 25,000, basically 25,000. 25,018 is the 40-day as on Friday exponential as on Friday's close. We'll see if that comes into view. The Nifty Bank, 56,800 so far. Yeah, it's still not. I mean, it's still 100 points away from its 20-day, which is about 56,700 or so. The Nifty Bank did not break the 20-day on Friday, unlike the Nifty, which actually did. We'll take a quick commercial break, and I think what we'll do is we'll look at some individual stocks, etc., which are going to be in focus. Stay tuned, coming up.
Welcome back. So, slightly choppy morning for the equity market, but let's figure out what's happening in the world of commodities. We have Manisha joining in, who's been telling us that, gold can move aside. It's silver that's been sparkling all the way through. So, which one is it, Manisha? What's catching your attention this morning?
Well, Bitcoin and silver both trading at an all-time highs, but I will take you through across precious metals on how the trades really have been. You know what? There's the safe haven buying which really has come back into many of these precious metal prices. One, for them, it's supply tightness. For the white metals, that is, there's an increase in demand as well. And to ship many of these metals, it is the freight trades which also have been trading on the higher side, supporting prices on the upwards there. I'll start with gold because that one is trading at a one-week highs. We're looking at more than 0.5% of gain in the Asian markets right now. It absolutely has to do with safe haven buying. And then we also are looking at US widening the global trade wars with the new tariffs, and that clearly has been supportive. So that's about gold. But take a look at the silver prices, 13-year highs onto that one. Platinum and palladium also trading at a multi-year highs into the trade right now. Silver clearly should be on your radar because we're trading at a 13-year highs in the international markets. We've seen 3 weeks of constant gains. For the Indian markets, we are trading at 1,14,000 rupees a kg, which is an all-time high. Add to that the GST and the making charges, and you'll take the prices much higher from here. The investment demand has been strong, and a lot of silver guys tell us that it is the physical buying in sense of jewelry as well, which really seems to be doing well with what gold is doing, and the silver prices clearly seem to be supported with that as well. If you look at the overall price movement, then we've seen 3.5% of gains on Friday. For the year until now, it is 34% of gains that we've seen in silver. It has been 6 consecutive weeks of gains that silver also has posted. It's trading at an all-time highs in India, with the markets telling us that 1,25,000 is what you can expect to see in silver by the time it's Diwali. But it doesn't end there, because take a look at the platinum prices. We've seen 30% of tariffs coming on Canada, Mexico, Japan, South Korea, and that really seems to be impacting palladium prices at this point in time. Safe haven demand is one part of it. The trade war is yet another, and that safe haven buying seems to be coming in case of platinum and palladium as well. I want to take you through a last final plate which tells you on what we've done in sense of price movements in this year until now. So there you have gold, which made an all-time high in the first quarter of this year itself, is holding with its 28% of gains. Silver has been doing a catch-up, all-time highs in the Indian markets, 33.5% of gains until now. But clearly, it is about platinum. Last quarter saw platinum prices gain up by 40%. And the month of July has seen yet another 15 to 20% of gains, giving you a 60% of a return there. And palladium, because of shortages, deficits, etc., also has been doing quite well. So it really has been about the white metals within the precious metals, which have given you very, very strong returns.
All right. Manisha, thank you very much for that. Precious metals and are getting more precious in that sense, as Manisha puts it. We'll take a quick commercial break here. It's our special segment. It's the economy. Lata in conversation with Ashish Gupta, Chief Investment Officer, Fixed Income at Axis Mutual Fund. We, of course, also will talk about the latest as far as SEBI versus Jane Street goes. Sit tuned.
Welcome to It's the Economy. Money Control has just reported that Jane Street has deposited 4,843 crore rupees with SEBI and can start trading. But this isn't acknowledgement of guilt. The Wall Street Trading Company will eventually challenge SEBI's order in SAT. What are its chances of winning? Well, SEBI has accused Jane Street of manipulating the constituent shares of a bank Nifty index by pumping up the share market prices and luring retail investors to go long in the option markets, and then by the end of the day dumping the shares in the cash market and thus making huge profits on their own sell options, put options taken in the options market on Bank Nifty index. Now, to understand SEBI's order over the weekend, I spoke to one of the best experts on the field of options trading, Ashish Gupta, the CIO at Axis Mutual Fund. Ashish was the first one to point out in a paper called Gamification of Equities the unusual rise in volumes in India's index options market. I began over the weekend, this interview was over the weekend, I began by asking him the central question. Jane Street claims it was doing standard index arbitrage trading. But SEBI has shown with a mountain of data that Jane Street pumped up share prices in the morning and dumped them in the last hours so that it could profit in the options market. Does SEBI have a solid case to prove manipulation? That's my first question to him. Here's the chat.
I would not like to comment on a particular entity's trading pattern, and frankly, that information is visible and available only to SEBI, right? And they have talked about it in their order. The concern we have had, and the paper you mentioned that we wrote, was just that how large and disconnected the options market was relative to the cash market, right? If we talk about options really as a derivative instrument, it means that it has to be connected with what is happening in the underlying market, which is the cash market. And therefore, there has to be some similarity in both the volumes and the pace of growth in the what you see in options, or more broadly in derivatives, and what we see in cash market.
Yeah.
Now, over the last 4 or 5 years, we had steadily seen the disconnect increasing, and as you mentioned, on a notional turnover basis, the option market notional became multiple times that of the cash market, right? If you, on the other hand, look at the other derivatives, right? If you look at the futures market, so the futures market is, of course, also larger than the cash market, but the future market notional is really 2 times that of the cash market, right? And this was at its peak nearly 400 times. Notional to cash has since then moderated. Now, one of the big drivers of this was what was happening on the expiry day, what was happening on the last day. And again, as option pricing goes, there are 2 elements to it, really. One is the amount of notional that you are taking exposure to. And the second is the time you are taking that exposure for, right? And on expiry day, the time factor is so low that the price of the option is much, much lower, right? And that is what was really attracting retail investors to come in, because with a small investment or with a small size bet, you could actually look to take exposure to a large market. And if you recollect, SEBI had published this data last year about what proportion of total option market volume was actually happening on the last day, right? And in some instances, 80-90% of the volume was actually happening just on the expiry day, right? And so that kind of begs the question that if someone is looking to hedge exposure, why is he looking to hedge the exposure only on one particular day, right?
And for half an hour.
Yes,
that's
right.
true.
So clearly, and we had seen in terms of the number of retail participants and the kind of retail participants that were coming into the market, that more and more younger people, more and more people from tier 2, tier 3 towns were getting attracted by really the leverage the options market offered.
Fair enough.
And that really led to the outside growth of the options market versus the cash market.
Yeah. No, all those points are taken. I'm sorry I'm dragging you back to the Jane Street order. I understand that you will not comment on another entity, especially when you don't know what they do actually. But the reply of the, we know we have the SEBI order, which is very, very detailed in terms of the number of shares purchased in the morning, number of futures options, futures purchased in Bank Nifty, and amount of options sold at the end of day. Those are very clear data given. Can that be explained as plain arbitrage, which is what some legal entities are saying? That this is just plain arbitrage. Is it arbitrage? But then, numbers are so different.
Yeah. So, frankly, arbitrage really is, and we in our mutual fund also run an arbitrage fund. Arbitrage really is when you take two positions of same, or if not same, similar size in two different markets, right? So theoretically, you can be doing arbitrage, taking a position on NSE and selling on BSE, or taking a position in the cash market and another position in the derivative market, right? Because in arbitrage, you are trying to play the spread between two different market or two different instruments, right? If the size is different, then clearly on one side you are taking a directional position, right? So then it is not really arbitrage, but it's a directional view that you are taking.
Yeah, that is the point perhaps that people are making. The other issue that some lawyers have made, or maybe some opinion makers have made, is that this may be unethical but not illegal. It may be aggressive but not illegal. Now, if you move the constituents of Bank Nifty in one way, and very clearly SEBI proves that in the morning when the prices are going up, they had 35%, 37% of the amount of trades, volume of trades, gross traded value. And likewise, even in the last half hour in the cash market, the positions taken by this entity was, 25 to 30%. Then can you really, isn't it very obvious, therefore, that they were driving the market?
No, so I think that comes out in SEBI's order. And actually, if you see it a bit more holistically over the last 9 months or so, SEBI has been trying to address some of these issues, right? One attempt, for example, has been to kind of tone down this over-exuberance of options trading by, I think, October last year, they came out with measures to increase the lot size, right? So really to dissuade.
No, 1 minute, Ashish. I perhaps didn't complete my question. When you look at the amount of shares with which that was sold in a particular segment, it does not give the sense of just unethical. It seems to give the sense of illegality. Do you want to comment on that? Because that seems to be the constant word. It is aggressive, it is not illegal. But then if you move with such intent, then it looks illegal. Your thoughts?
Yeah, see, frankly, intent is for the legal experts to kind of prove. What I'm saying is that why such strategies could work was the proportion between cash and the derivative market was very, very different, right? So cash market, as we discussed, is relatively smaller compared to the options market. The second part, and which is that in some of the indices, the index constitution is such that it is very concentrated in a few stocks, right? And in Bank Nifty, literally two banks account for more than 45% of the index weight, right? So then such strategies can kind of come out and really try to
Yeah, they will work. I agree. These strategies
right?
will work. So the answer, Ashish, is the answer, therefore, to not have weekly futures. I mean, what are you hedging in a week? If I buy Kotak Bank today, what is going to happen in 1 week that will change? I mean, it may happen once in a way when there is a monetary policy or something. But as a rule, do weekly futures serve any hedging purpose?
See, I think it's a question that one needs to look at. Like, market has several instruments, right? And they are important, and market liquidity is created by investors, by hedgers, by speculators, right? So you need a certain speculative element also in the market, right? So, maybe the proportion of a monthly future versus or monthly option versus a weekly option, the number of investors versus speculators is very different. But for the well-functioning market, you need all kind of participants. I think it is important that we have the regulatory framework which kind of prevents really abuse of the system. I think we have seen a fair bit of data consistently, and even last week, SEBI came out with the data that there were outside losses that were getting incurred, and again, not directly correlated to the other order, but it kind of emphasizes the need for it to act. And there have been several regulatory steps that have been taken. And on top of that, there is a supervisory or enforcement action that is actually coming in. And I think net, I don't disagree with SEBI that it needs to act on this. If you see the latest number, it is almost 1 lakh crores of losses.
But what would
put it in context?
Sorry, I'm interrupting because I'm running out of time. But what would your advice be? What more can SEBI do?
So I think there are various ways to control this further. I don't think necessarily you need to take out the index option, but I think having a broad-based index, having some degree of really limiting the retail participation, whether it is from lot size increase, whether it is from kind of having some side of accreditation of investors that is needed, because in really none of the large market options are available to all retailers to trade. And it is not just a market issue. I think it is a macroeconomic issue. Because the loss is so large, right? To put it in context, 1 lakh crore is about 6% of household financial savings in India, right? And remember, we have on a previous show talked about why household savings not growing and why bank deposits are not growing. So this is actually a large number in that context, 6% of household financial savings.
That's a fair point. Ashish, we're out of time, but thank you very much for joining me. Just one word, you don't think FPIs would be worried about this regulatory action, would they? This is not going to scare them.
So I think, frankly, there are various kind of FPIs, right? So there are these high-frequency traders, but there are also we have multiple long-only and hedge funds that have actually been investing for a long time in the Indian market, and some of them actually have also been concerned. So when I wrote that paper, several people were concerned that option market is so disproportionate in India.
Okay. Well, so this was a conversation I had to have over the weekend because Ashish was traveling today. But I think Ashish is making a couple of points. Whether it is manipulation or not is one issue. We cannot allow it is the other part, because it's taking away 6% of India's household financial savings. That's an important point. And meanwhile, when we were speaking, we got the clarification from SEBI. I had written to SEBI asking whether Jane Street had deposited the amount. Apparently, they have deposited the amount and they've asked for certain conditions placed on them to be removed so that they can start trading. SEBI had, in that order, not highlighted exactly what those conditions are. So we await more clarity on exactly what are the conditional restrictions imposed on them. But to be sure, Jane Street will be aware that given SEBI's order, SEBI's definition of manipulation is now very clear. If you account for 25 to 37% of the market, of the cash market, and are trading above the last traded price, so that the market goes up in the morning, and likewise in the last hour of trade, you are accounting for 37% of the cash market, and you are trading below the LTP, below the last traded price, you are deliberately pushing the index down. SEBI will look at it as manipulation. That is very clear. So even if they are allowed to trade, which looks like on the cards, perhaps the same will not be repeated, because now Jane Street knows SEBI's mind. Exactly what the conditional restrictions are, we will come back to you with those details. That's it on Bazaar. Chartbusters up.
CNBC-TV18 News Break confirmed. VIP promoters sell up to 32% stake to a consortium of multiples PE and Mithun Sacheti at 388 rupees per share, a discount to the current market price. A consortium will also make an open offer to acquire an additional 26% stake. The stock traded lower and now has recovered.
Divi's Laboratories under pressure on fears of competition as Novartis loses its bid to block MSN Pharma from launching a generic of its cardiac drug Entresto. Divi's is a key supplier of APIs for Entresto, and the drug contributes 25% of its EBITDA as per IIFL.
Avenue Supermarts trades lower, though off lows on the back of its earnings. The company's profit remains flat while the margins take a hit on higher competitive intensity.
Castrol shares trade higher as it receives a favourable order from the Tax Appellate Tribunal in a 4,130 crore rupee dispute with Maharashtra Sales Department.
It's a tepid listing for Travel Food Services. The stock lists at a 2% premium to its issue price and thereafter sees a bit of selling. The management will join us shortly to discuss their post-issue strategy.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, the Nifty is down closer around 50 points or thereabouts. But the good news is we have seen a big recovery in the mid-cap index. Number of stops advancing. Well, when we started off, we're only around 700 or thereabouts. So the crisscross lines will tell you the story. The breadth of the market has improved. The Nifty bank has moved into the green. So not as bad as what was feared in the initial trading minutes.
Nigel, you know the kind of selling that we saw on Friday with all-round selling from the FIs in cash market, index futures, stock futures, etc. At some point, the street thought maybe it may have been overdone. So there is a bounce that takes place. The question is whether the Nifty goes ahead and crosses past the 20-day moving average of 25,265 thereabouts or not. That's something we'll be watching out for. And what the Nifty bank does from here on as well. On Friday's trading session, it did not fall as much as the other indices and was supported. So the Nifty bank holding mildly in the green. The broader market's doing a lot better. And a lot of individual stocks actually which open lower are seeing a fair amount of recovery. And amidst all of that, there are a bunch of stocks which are surging right now as we speak. Vodafone Idea for one, up nearly 7%. We're seeing a big gain in names like J. Kumar Infra, something like a Shoppers Stop, or even HEG, which has seen a big spike in the last few minutes or so. But speaking about spikes and individual listed stocks, let's get action from the primary market. We have a new kid on the block. Travel Food Services made its debut on the bourses today. The stock listed at a 2% premium to its issue price. And thereafter, we saw a bit of a sell-off just in line with the market. We're currently seeing almost a 2% decline on that stock from its issue price of 1,100. To discuss the company's outlook, we're joined by Varun Kapoor, who's the CEO and Managing Director of Travel Food Services. Varun, thank you so much for joining in. Momentous day. Congratulations on the listing. Now, the question is, the last time you joined us, you said your revenue momentum will continue, your margin momentum will continue from here on because the travel in India continues. What we want to understand is how many new airports have you signed up with? And over the next few years, what are the kind of airports that are coming in terms of supply for you?
Right. No, thank you for having me on the show. It's a pleasure to be here on this day for us. Tremendous day for the business, getting listed on the stock exchanges. And last time I think you were kind enough to have me on your show, and we spoke about the business. And I think what has been truly tremendous over the last few years, I think the aviation story, right? We operate in aviation, F&B outlets and lounges as well. And the last few years have been tremendous growth. I think going forward, no doubt the same tailwinds which have been there in the business continue to be there. So talking about, we have outlets continuously opening at new airports coming in. We spoke about opportunities. We are opening shortly at the new Noida airport coming up. Navi Mumbai is opening up soon. We're opening there as well units. So there's a big amount of opportunities, no doubt, as new airports come, but also in existing airports where we run currently. We recently opened stores in Delhi airport as well. So you constantly have new outlets coming up across the country as new airports open, but in existing airports as well.
Let's get very specific. There is a Navi Mumbai airport which is coming in, and then there is one at Jewar which is coming in the north as well. Have you signed agreements with them already?
That's right. We've done agreements there. We have units opening up shortly, both expected, as you know, in the next few months, these to come live. So you'll see our units there, some of our in-house concepts, but you'll see some interesting, both leading international concepts and some of the strong national brands as well. So quite holistic outlets, as well as lounges as well in both of these airports.
Hi, Varun. Good morning and good to see you, Ben. Congratulations on listing. The journey has just begun with regard to being listed on the stock exchanges, and we look forward to having you more often. And quite a job in ringing that bell, going hammer and tongs at that one. And the younger generation as well were quite excited to be there. So all the best to you, the entire team, as well as the family. Well, that said, let's focus on growth. So much. As you said, that you're quite confident about growth. Given the new airports that you have signed, business as well, momentum is expected to continue. So for the coming year, a mid 20% growth is doable, if you could confirm that. And margins as well should be in the vicinity of 30-35%, or would you like to look at the PAT margins, which should hover around the 20-22%? Tell us.
Right. So I think for our business, yes, no doubt you see structurally the tailwinds continue to be there. While we are shortly will be coming out with the results and talking a bit specifically about how those are trading and going on. But yes, I think the general trend in terms of our business growth, and if you see in terms of margins particularly, I think PAT may be a relevant one with our business. We've been about 20% PAT margins, thereabouts over the last 3 years, quite stable on that. So those levels we see to be quite stable for our business and continuing forward. So you will see that robust nature of, I think, aviation growth is very much palatable across, I think, Indian markets. And I think our business will be reflected of that, as you'd see, I think, in a few weeks when we come out with our results as well.
Given what you've said to us earlier, and if that trend continues, then the street is factoring in close to 500 crores in terms of PAT for FY26. But we let your numbers speak about that once you can speak about those numbers once the first quarter numbers are out as well. You've historically done about 60 to 70 outlets in terms of openings every year over the last few years. Is that trend which is likely to continue? How many are you likely to open from the QSR space and how many lounges?
Right, so we're at currently about, in terms of our business, just to give you a reflection, we were at 380 outlets roughly, I mean, when we looked at our June numbers, on the travel QSR side, 380, 390 units then. What's happened, which at the time of listing, just to share with you, and we didn't get a chance to discuss these numbers, we've actually been at 442 travel QSR outlets as of March end. We've opened a few more actually over the last 2 or 3 months as well. We've had 37 lounges. This is up from 32 lounges which were there, which we had in June of last year in 24. So the business openings have been quite robust and strong. We've opened a few more stores in Delhi Airport, and including with Navi Mumbai and Noida Airport, when those come in, you'll see a significant jump up as well in the number of stores happening. So this is constantly happening in our business. As new terminals happen, new expansions happen, you'll constantly see over the next year as well that same momentum in terms of outlet openings as well.
Varun, a 500 crore net profit number looks gettable in FY26, going by the projections. Could that be the aspiration, 480 to 500 crores of net profit?
So I wouldn't comment. I think we're, possibly we're not really giving exact guidance because, I think just because we're so close to where our results will come in. But I think from a growth point of view, we've been historically, I think, over, if you see kind of the 20-25% growth rates have been there historically, and we did about 380 last year. So, from that point of view, I think it's probably more helpful to look at those trends over the last 2 years, which has been approximately a bit more than a 20% PAT growth consistently. So I think one maybe refer to that without probably giving exact numbers for the year ahead. Just
mathematically, you should be in the vicinity of 460 to 500 crores. But you don't want to comment on that. Hopefully, next time around, we'll get a concrete guidance. Final question from my end before Mangalam comes in again. There is this fear because of what happened with Dreamfolks, and the issue that the airport authorities will like to directly get into the space which you are currently dominating. What is your comment on that? Do you see it as a risk? Or do you see that as it is you're partnering with them, whether it's the Adanis, whether it's the GMR, company, so they're already getting their share of the pie. So you don't believe there's a risk to your business? Or, do you think that what happened to Dreamfolks could also happen to you all?
Right. So exactly as you say, we've got deep partnerships with airport operators. These are great things. We look at them ultimately in operating in these airports, the vision they have, and executing that, trust they have in us. And we actually take the real estate and build these units. We operate, we build these units. So maybe looking at a particular example of Dreamfolks, there. So we tie up, for example, our lounges there. We are actually the operators of the lounges. So we would go tie up, whether it's a Dreamfolks, we tie up with airlines directly, we tie up with banks, so we have multiple types. And therefore, when a middleman goes, like, recently at many of the Adani airports, there's quite a bit of technology coming in, the Adani Digital, for example, you leveraging that, getting a direct tie-up at those airports with, those
So Adani and GMR are not a
for us,
risk to your business, right?
That's right. They're partners with us, correct. So
what
we
we
would be
understand,
the partners who ultimately are running the operators.
What we understand is that the Adanis may be talking to other players as well, the likes of Premium Plaza, etc., for some of their marquee hotels, or rather airports. So just wanted to understand, how long is your relationship with them? When do those contracts come up for renewal?
Right, so these contracts we have generally are long-term in nature. These tend to be 8 to 9 years on average there, and actually going longer these days. So many of our contracts actually are there for the long term. So when we're doing it actually in terms of where you see we actually operate in a joint venture. with our airport partners, particularly talking about Adani and GMR, the examples you give. So actually, our real estate is run together with them. This is the best practice of both coming together. You have a strong operator with us and airport knowledge in terms of them. So I think that coming together is where our business actually works. It works through a joint venture with both investing.
Right. And a final question before we let you go, Varun. You've raised 2,000 crore rupees. The entire thing is an offer for sale from the promoters. Promoters still hold about 86% stake. So they'll have to bring it down to 75% over the next 3 years or so to meet the minimum public shareholding norms. So the other 11%, will that be an OFS as well? Because from the looks of it, you don't require cash. So just wanted to understand how that will go.
Right, no doubt. From a cash point of view, while the business doesn't need, we've got a little more than 600 crores of cash. We have no debt on the books. From that position, we're quite well capitalized for growth we're quite enough of cash for growth capital. But from a point of view, we've just done this journey. Our focus was getting this over the line. We've not had the chance to actually think in terms of that. We have a 3-year journey to get there and how we probably approach it. So that's where we are in terms of, obviously we'll have to get there from a 25%. And as promoters, we're committed to this business and have significant stakes still in the business to grow it.
All right, Varun, enjoy the day. We'll interact with you more often. As you say, you believe that the big names like Adani and GMRs, they're partners. So you don't believe it's much of a risk to your business. Congratulations on the listing. And Mangalam and me, we look forward to chatting up with you in the coming quarters as well.
Thank you, Nigel. Thank you, Mangalam.
All right. Well, time to slip into a short break. But remember to tune in to our all-new CNBC-TV18 Prime. Bring you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset. At 1 p.m., the Big C and Global Lens at 8:30 p.m.
Welcome back. You're watching us here on Chartbusters. Let's get in Shivangi Sarda for a quick technical check on the market. Shivangi, on Friday we saw a big decline. But this morning, it's not as bad as what the opening had indicated and what the fears were. We've seen some recovery from the low. So do you think 25,000 as an important psychological level holds for the Nifty?
Very good morning, Mangalam and Angela. Thank you for having me. So we've seen that, of course, Nifty has slipped most part of the week, in the previous session, in the previous week. And we've seen that the put call ratio has also sunk and sustaining below 1, which is, indication that call writers have made their position. Of course, 25,000 will be an important make or break zone here, quite a psychological level here. If it breaks these levels, then we could see 24,800, but we're expecting some range bound move because there is some support base buying at 25K levels, which is, making it a float at these levels. So we're looking at a range bound lackluster movement for Nifty with an upside cap of around 24,400 marks. And, a strategy based play could be played out for this one. Now, talking about Bank Nifty, of course, we've seen that the smaller PSU names are, still holding up, and which is why it is, outperforming the broader market. And Bank Nifty, we are looking to sustain at these levels at a support of 56,250 and the upside towards 57,350 levels.
All right. And individual stocks, what do you have on your list?
So individual stocks first up on my radar is from the banking space, which is CanBank. We've seen that, the PSU space specifically have been outperformers, and CanBank has given a consolidation breakout of the last 9 trading sessions, with RSI showing positive divergence here. Very good short covering move can be captured here, and we've seen that it is surpassing its previous hurdle zones, getting ready to hold above 115 levels. So this one is a buy at these levels, and the next target being 120 with a support of 111. And the second pick on my radar is PEL, which has been witnessing excellent short build-up. After a long consolidation, we've seen this one moving. From the last 2 trading sessions, the volumes have been quite significant, and the previous resistant levels of around about 1,200 levels is acting as a support level here. So clear role reversal can be seen here. And we are recommending a buy here with a target of 1320 levels and a stop of 1250.
Got it. Okay. All right, Shivangi, thanks a lot for giving us those views. Well, let's focus on our special segment where we get you a few ideas for profit from Money Control Pro. Lekha Badlani of moneycontrol.com joins us to talk about a stock that she's tracking closely. Lekha?
Yes, so we're positive on SGS Enterprises, which is a prominent player in the decorative aesthetics products for the automotive industry. Now, SGS is poised for significant growth by focusing on new generation, value-added products and strategic expansion. It's focusing on advanced high-margin products for the display market like that of optical plastics and cover glass. The company is also investing in in-mold labeling, in-mold decoration and in-molded electronic parts for the global markets as well as for the EV industry, all designed to boost the content per vehicle. Now, the management aims to increase the content per vehicle in four-wheelers to 10,000 rupees from the current 3,500 to 5,000 rupees. Now, to drive this expansion, SGS is actively onboarding new clients like Dixon Technologies, Hero MotoCorp and Stellantis. They also maintain strong relationships with consumer durable clients like Whirlpool and Samsung. SGS is also prioritizing export market expansion, targeting 14 to 15% of the consolidated revenues by FY28, up from current 7.5%. Now, to support these ambitions, SGS is undertaking significant capital investments with a capex of 150 crore in FY26 and around 220 crore in the next 2 to 3 years, mostly funded by internal accruals. The company's management is confident in achieving double the industry growth and maintaining an EBITDA margin of around 26%. Now, given the strong business outlook, the current valuation of around 23 times FY27 estimated earnings appear reasonable for long-term investments.
All right, thanks a lot for that, Lekha. Time to slip into a quick break. We'll be back with more market action. Stay tuned. Welcome back. Well, a bit of a wibbly-wobbly market is what we're seeing. Ola is the one, I think, that's bounced up considerably from the lows. Remember, the stock has seen a sharp pullback from the highs that we saw, more than 140 rupees to around 40 rupees. But the reason is because they're saying that the auto business will be positive from Q2. They're also saying that the FY26 gross margins will be around 35 to 40% with PLI benefits. And the commentary basically on the whole volumes as well, pretty healthy. So for the time being, the street is buying into this bounce. Sustainability and delivering these numbers is going to be most important on that one.
They've given the revenue guidance for this year as well, 4,200 to 4,700 crore rupees, again, with the volume guidance. But it is definitely, the management has to go ahead and walk this stock that they've been speaking about operational profitability. With that, we'll wrap up on this edition of Chartbusters. Thank you so much for watching. The team of Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Fatakia and Reema Tendulkar. Happy Monday to both of you. But looks like the fall that we've been seeing last week continues today as well so far. In fact, we are below that 25,100 mark. Nifty, it failed to hold on to those crucial levels through the week last week, and that continues today as well. So on the Nifty, we are looking at a 75-point cut as we speak. Bank Nifty is down, but not as much as Nifty is currently. The Sensex 2 is falling in line with the Nifty, but the mid-caps, that pocket is the one that is outperforming. So mid-cap index is up around 0.5% right now. And we do have reactions coming in from results over the weekend. There was that big deal in VIP as well. We'll, of course, discuss that in greater detail. But IT results coming in thick and fast, and you're just busy, Reema.
Indeed. I was reading, I think 32% of the IT companies will be reporting, not IT companies, of the Nifty companies will be reporting their numbers, and 10 of them are from the Nifty pack. So Reliance, big banks like HDFC Bank, ICICI Bank, Axis Bank. We're including the weekend also on the IT front. It's HCL Tech, Wipro, Tech Mahindra. All these companies will be reporting numbers this week. So it's going to be an important week which sets the tone for the earnings season. But I must say, looking at the global markets, Nikkei has recovered 300 points from the day's low. Kospi is up 0.75%. Anyway, it was in the green, but the Korean markets are higher. Hang Seng is up close to about 0.25%. So despite all this trade uncertainty, the big numbers in EU, Mexico, markets on the whole are very, very well behaved. They're absolutely shrugging off, at least the tariff news.
Yeah, it's for the US, it's for Wall Street to decide what priority it wants to lend to Donald Trump's tantrums, because he's done this before in April, he's done this again last month, now he's planning to do it on the 1st of August again, and then in the 1st of August he might just turn up and say, I'll do it on the 1st of September. Nobody's going to really challenge that. So it's still, the Dow futures are down 200. You mentioned Nikkei. It was also because of the Bank of Japan planning to raise their inflation forecast going forward. So that is what has sparked the recovery in the Nikkei. But the markets for now, well, 25,100 on the Nifty, where 25,041 is the intraday low. That's the level that the bulls would fight to protect over the course of the day. But as Sonal was highlighting, plenty of earnings reactions. Anand Rathi Wealth continues to build on Friday's gains, now 7.5% higher on that stock. And a lot of very, very heavy moves in pharma names. Look at Newland Laboratories, 11% higher on that stock. Laurus Labs is up 3.5%, and Laurus Labs, mind you, is now trading at a record high. So 820 on Laurus Labs, and some of the other pharma names as well are doing fairly okay for themselves. Mankind Pharma is up almost 3%, Lupin's up 2%. We'll get Ekta in just a bit to highlight some of the big movers within the pharma space. But the stock of the last few minutes has been Ola Electric, and that, of course, as the back of results that were reported just a few minutes earlier, the net loss widened on a year-on-year basis, but it was narrower on a sequential basis, and that is why the stock at one point was up almost 8%, is now cooled off slightly, but still holding on to gains of around 5%. Sudarshan is here to break the numbers down, what worked for the company this time around, and what it is expecting for FY26 as a whole, Sudarshan.
So what a move the stock has seen after company has announced earnings for Q1 of FY26. But ahead of the earnings, the stock was down more than 50% in 2025 and more than 75% from the record high that stock had hit in August of 2024. So how was the earnings in Q1 of FY26? In one line, if I can say, the earnings have improved on a sequential basis, but year-on-year earnings remain weak. Now talking about the main numbers, net loss has come in at rupees 428 crore against 870 crore that company had reported last quarter. So the losses have narrowed. But the same quarter last year, loss was of rupees 347 crore. So from that level, it has sharply increased. Similar trend is seen in revenue front as well. Revenue has come in at 828 crore versus rupees 611 crore on a sequential basis and versus rupees 1644 crore in the same quarter last year. Gross margin has seen a sharp improvement. It has come in at 25.8% versus 13.7% on a sequential basis and versus 18.4% in the same quarter last year. Now, what is management saying? It's saying that auto segment has delivered on Q1 FY26 guidance and it has turned EBITDA positive in the month of June. One concern, like all the other auto companies, when Ola Electric has raised, that is of rare earth magnet. It's saying that rare earth is a major long-term risk for the auto sector, but for the short term, company remains covered. Now, the reason the stock has seen a sharp recovery intraday after the earnings is mainly because of FY26 guidance. Company is saying that auto business will be EBITDA positive from Q2 and gross margin currently, which is around 25-26%. It's expecting that by the end of FY26, gross margin will improve and be in the range of 35 to 40%. Volumes are seen at 3.25 to 3.75 lakh units by the end of FY26. In FY25, company had reported volume of 3.59 lakh units. On revenue front, it's seeing a decline of 7% or growth of 4%. So revenue for FY26 is seen in the range of 4,200 to 4,700 crore. And full year EBITDA, company is expecting that it will be in the positive trend, and it's expecting to be above of 5%. And revenue growth, as I told you, minus 7% to plus 4%. So more than earnings for Q1 FY26, stock has seen a sharp recovery, mainly because of positive guidance that company has given for FY26.
Okay, all right. Thank you so much, Sudarshan, for joining us with those important details. The Ola Electric stock spiked. It's still up 5.5%, but has come off from the highs of the day. The other stock on our radar is Divi's Labs. That stock is under pressure. Ekta is joining us to tell us what's happening here, though the stock has recovered from the lows again. Ekta.
Well, yes, Divi's is in focus because pharma company MSN has won the patent litigation with regards to Novartis's blockbuster heart failure drug Entresto. Now, what this means is that basically the generic version of this particular drug, Entresto, can be launched in the US market by MSN in July itself. What is the impact on Divi's? Entresto's API is expected to be the largest product in Divi's innovator custom synthesis portfolio. So they are supplying the API to Novartis for their particular drug, which is now going to see generic competition. It is estimated to be contributing as much as 40% of their custom synthesis revenue and estimated to account for as much as 20% of the overall company revenue. Brokerages such as IIFL have said that over the next year, Divi's could see a potential 12 to 13% decline in the annual EBITDA. Remember that the stock is already trading at very heavy valuations. So IIFL points out it's currently trading at around 58 times FY27 and 40 times FY27 EBITDA. And hence, it is probably pricing in a lot of the optimism around GLP-1 and CDMO opportunities going forward. However, considering that this news has been going back and forth a lot, Divi's Labs, possibly a lot of the analysts say, has factored in a lot of the bad news when it comes to Entresto already.
Okay, but no doubt there is going to be an immediate earnings hit as cheaper generics enter the market, and the company will need new growth drivers. But not a big fall, as Ekta explained. Let's talk about the other pharma stocks which are in the news, Ekta.
Well, yes, I'm looking at Wockhardt, which is in focus because Wockhardt has exited its US generic business. It will now shift focus to the new antibiotic discovery and the biologicals portfolio in insulin. So the FY25 US generics posted a loss of around $8 million, and Wockhardt has now filed for voluntary liquidation. Glenmark is in focus because the Indore facility received a warning letter. And hence, it's in focus on account of that.
Okay, we take that point, Ekta. Thank you so much for joining in, and take care of yourself. But let's talk about the other big news. SEBI has confirmed Jane Street confirming depositing that big amount in an escrow account. Hormuz is telling us about all the details here. Hormuz.
You know, it was in line with what the SEBI had ordered on the 3rd of July in that interim order that they had put out, that these unlawful gains, what they had alleged them to be, were 4843 crore. Those have now been deposited into an escrow account, and the actions that have been taken by Jane Street are without any prejudice and, of course, in line with the rights and remedies that remain available to them. Now, of course, this is procedural, and now what Jane Street has appealed to the regulator is that there are certain conditions that were put on them. They should be lifted now that they have deposited these unlawful gains within an escrow account, and SEBI in response to that has mentioned that that request is currently under examination, and of course they will continue to follow due process when it comes to examining such requests. So it's, of course, a procedural step. Jane Street was asked to deposit that sum. They have deposited that sum, but will they immediately start trading? Well, no. The answer is no. They are only eligible to trade now that they have deposited that sum in the escrow account. Now, this entire saga, of course, the crux of the matter, which was reported a couple of weeks ago, was the fact that they had made profits to the tune of almost 36,000 crore rupees over the last 2 years within this index derivatives market, and as a result of which this this action was taken by the market regulator, and that had caused a bit of frenzy in these capital market names over the next couple of trading sessions. So, well, procedural, of course, SEBI has eventually confirmed that they have deposited it. Now we'll await the next steps as to what exactly transpires in this matter. But we take a short break here on Trading Hour. The Nifty currently down around 80 points. On things commodities on the other side with Manisha Gupta. Welcome back. Shifting focus to the commodity space, Manisha Gupta is joining in, and today we put the spotlight on crude prices, Manisha.
Well, yes, commodities across board are seeing some support, and so is the crude oil prices, holding around that $69, $70 a barrel mark. And we're holding gains, by the way, from the 2% of a surge that we saw on Friday itself. Well, the prices did gain 1.6% in the previous week, which was a second weekly gain coming in for the crude oil prices. For the year, though, we still are trading into the negative by 5%. That is because the markets believe that going forward, by the time it's the last quarter of this year or the first quarter of 2026, you could be looking at higher supplies. But the prices are in support right now, and that is because of immediate supply tightness. The other thing is also about summer demand in US, which now seems to be picking up. And then it also has to do with higher refinery runs. The crude oil prices also are taking support, as the US could be putting an additional restrictions or even sanctions on Russia, is what the US president has been saying. And it's not just about US. The European Union also has been saying that they could be announcing 18th package of sanctions on Russia, and that could happen as early as this week itself. That seems to be adding some premium to prices.
Take that point, Manisha. Thank you so much for joining us with all those details. With that, we'll slip into a break, but remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Mid-caps is still holding up pretty okay. So it's up more than about 0.5% on the mid-cap index. Castrol is a big mover. We discussed it in the morning how the company's got some relief in the tax case, whereby at least an amount of about 4,000 crore, 4,131 crore of a tax demand which was raised in the company has been dismissed. So that stock has surged nearly about 5.5%. You've got gains in Zee Entertainment. That continues to be a big mover. Ola Electric Smart. BSC is higher. DB Realty now 248, 3% up on that. Pharma and Adani Green are some of the big volume movers. Nagraj Shetty from HDFC Securities is now joining in for a quick technical check on the markets. Nagraj, morning. Thanks for joining in. The weakness continues. Now you can no longer call it consolidation. There appears to be a bearish bias. What's the advice and where are we headed?
Hi, good morning, Rima. The market has been a downward correction, healthy downward correction, in fact, from the higher levels. I'm not expecting any bigger free fall from here onwards. There is a support at lower levels. The damage has already been done slightly at the higher levels. And at the lower levels, around 24,900 to 24,800 is going to be a strong support for the market. And I'm expecting a possibility of upside bounce from the lower levels.
What about specific stocks, Nagraj, with the kind of fall that you've seen in the broader markets as well? Do you see that as a buying opportunity?
Of course, there is a buying opportunity for even broader market indices. Recently, we have seen some underperformance, and today's session showed some outperforming in today's session to the benchmark Nifty. I have two picks from the mid-cap segment. First one is a Graphite India. Graphite chartically has been in a larger consolidation phase over the last few weeks, and in today's session, it has made an attempt to break out of the range around the 585, 590 levels. Currently trading around 579.80, 580. One can look to buy at this point of time. The target would be around 620, and one can place a stop loss at 560. Second one is Five-Star business. The Five-Star has been in a consolidation phase. We have seen some dip in last few sessions back. Currently showing strength to move up. Trading around 775, one can look to buy Five-Star at the point of time, and the upside target would be around 625, and one can place a stop loss at 750.
Okay, all right, take that point. Thank you, Nagraj, for joining in. Those are some technical picks and the important levels to watch out for on the Nifty. Let's talk about individual stocks now. Avenue Supermarts, the company reported their Q1 numbers. Mangalam is joining us with the fine print. Mangalam.
Well, if you look at Avenue Supermarts numbers, the street was already apprised of their revenue growth. So the overall revenue growth of the company came in at around 16.3%. What the street wasn't happy with is the gross margin, but more importantly, it's also the EBITDA margin and the management commentary. So the gross margin, there was some compression year on year to the tune of 30 basis points. The EBITDA margin compressed a little more to about 70 basis points, and the net profit as a result of which was absolutely flat. What is it that led to this gross margin compression? If you look at the higher margin businesses of the company, which is non-food FMCG and general merchandise and apparel, all of them were lower in overall contribution, and the contribution from FMCG increased. The management attributed almost 100 to 150 basis points of sales to the deflation that they've seen in FMCG prices as well as the non-food products. But secondly, gross margins, they attribute the weakness to competitive pressures, and EBITDA margins on account of increased investments in store expansion, higher entry-level wages, and at the same time, them spending a little more on cost of service. So all these three factors which have impacted the EBITDA margins aren't going away in the very near future, which is why the stock has been a little subdued in trade today.
Thank you very much for that. Let's talk about AU Small Finance Bank. That's in focus on the back of a Kotak Institutional Equities note. Gaurav is here to share the details on that. Gaurav? Okay, we'll get back to Gaurav in just a bit. But let's talk about NCC because that's in focus on the back of a big order win. Vivek is here with us instead. Vivek?
That's right. So NCC is in focus. A very interesting order win that the company has got. This is for the Mumbai Metro Line 6. It starts from Lokhandwala Complex in Andheri, West Mumbai. So this particular project, the company has received it from the MMRDA, which is the Mumbai Metropolitan Region Development Authority. The total size of the project is close to 2,270 crore rupees. So what does the NCC have to do? Number one, it will manufacture the rolling stock, telecommunication services, and a whole host of other services. The construction period for this particular project is 24 months. The defect liability maintenance period is for 2 years, post which the company also has to provide for comprehensive maintenance for 5 years post the DLMP. So now where does the YTD order intake stand at? Close to 5,620 crore. So the company is well in line at the end of Q1 to meet the FY26 order inflow guidance in the range of 22 to 25,000 crore rupees.
Interesting, Vivek. Thanks a lot for that. NCC off the highs of the day as of now after that order win. But Gaurav is now joining in for that Kotak note on AU Small Finance Bank. A downgrade coming in, Gaurav, from Kotak.
Well, yes, AU Small Finance Bank is currently under pressure, and the reason being that Kotak Institutional Equities has downgraded the stock to sell while increasing the target price to 700 rupees. Now, what they have written is that it is actually constructive for the business. What they are saying is that in FY25, we have seen business suffered because of the unsecured segment, but in FY26, this picture will turn as per Kotak. In fact, what they are saying is that if the environment remains favorable, AU Small Finance Bank can actually outperform its peers, and that is the reason they have actually upgraded the target price. But what remains a pain point is that the valuations right now. What they have highlighted is that in the recent days, we have seen a sharp rally in AU, and that is the reason if you look at the risk reward, they believe that it is not favorable for investors, and that is the reason they have maintained, or rather give a rating of sell. In fact, what they're saying is that they actually prefer other cyclical plays. If we compare AU Small Finance Bank with other counters because of the valuations, let's also not forget that in the last 3 months itself, the stock has given more than 50% upside. So on the back of this, they have actually downgraded the rating to sell, and as a result, we are seeing stock is suffering today.
All right, we can see that in the stock price, 1.5% lower. Thank you so much, Gaurav, for joining us with all those details. With that, we'll slip into another break. Up next, we'll discuss the market fundamentals with Christy Mathai from Quantum AMC. Stay tuned for that conversation.
Welcome back. Nearing the lowest point of the day again now is the Nifty 25,048, and it's just 5 to 6 points away from that intraday low of 25,041 that the index had made. So almost there. 100-point cut again on the index, and the recovery that we saw in the early part of the session has been very swiftly sold into. Christy Mathai is joining in to take the market conversation forward. Christy, good morning. Thank you for joining in. You know, we've started off with the earnings season. A couple of IT earnings have been disappointing, to say the least. We have more IT results coming up as the week goes by, but do you expect any potential on-ground recovery, if not in the first half, at least in the second half of FY26 for these IT companies? And if so, how do you position yourself in a sector like this?
Yeah, thanks for having me. Good morning. So clearly, if you were to just go by the last couple of quarter results, things are not improving as people would have expected. There was earlier this year, there was a expectation of recovery, but that has not come through, thanks to what you have seen in the US and other geographies owing to, the Trump tariffs and so on and so forth, which is creating some bit of, uncertainty in the minds of the IT spenders, which is the large Fortune 500 companies as you see it. So, it is very difficult to call out when could be the recovery, because you see most of the IT companies themselves, faltering on that sort of analysis. But perhaps next year, what we can see is, it's been almost since, the COVID, boom that we have seen in IT spending has been almost about 2 years where the IT services spend has been pretty subdued. And if you were to really look at the fundamental factors, the on-site offshore proposition that, many of the Indian IT services enjoy, has that gone away? Clearly, the answer is no. Execution at scale, that also remains pretty relevant. Even now, we have seen fairly large deals, high ticket size deal signings also happening, in the past few quarters. So some of these propositions still remain very relevant. And at some point in time, that discretionary spend has to come up, and we wouldn't be able to pencil in whether it'll happen in the next 2 quarters or perhaps in the first half of next year. So we are pretty patient on this pocket because, if you were to look at the overall scheme of things, IT still looks, from most parameters, pretty reasonably valued in this environment.
So are you overweight or neutral on IT right now, and the distinction between large caps and mid caps?
Yeah, so our allocation versus the indices is on the higher side. Compared to whichever index that you look at. And mostly it would be in the large cap pockets that we would be deployed owing to liquidity considerations.
Do you think ER&D has bottomed out? The likes of Tata Elxsi, Tata Tech, LTTS, where we've seen the biggest valuation derating?
Right. So, see, some of these companies carry risk owing to concentration in specific sectors, be it auto, be it some other sectors. So when those sectors are going through some issues, as you would see it, if you are overtly exposed to that, you will see those companies suffering. And that we think is happening because they sort of have enjoyed the last 2-3 years of fairly good growth in the auto growth owing to EV shift or some other sectors. So broadly, if you're overexposed to certain themes, when that sector is going through a turmoil, you will have issues. So from our perspective, we still think these sectors, there is some downside left in that whole ER&D pack, and the valuation do not really capture that risk.
Okay. Christy, you want to tell us what is the portfolio positioning? So on IT, you're slightly overweight. Where else are you overweight and even your underweight positioning right now?
Right. So we are pretty positive on the financials pack. Clearly, on the private sector banks, that remains a fairly large holdings. In the past few years, what you have seen, they have not really participated in the market rally. But broadly now, with the environment becoming more conducive, owing to some of the RBI intervention, things are looking up. The credit growth, the deposit growth still is pretty stagnant, but we are hopeful towards the H2 there should be some recovery. That remains a large pocket. And also we are exposed to some of the saving themes. We have allocated large chunks in insurance, both general and life, and some of the capital markets play as well, though we are very careful on an exposure there. Apart from that, auto consumer discretionary, which is primarily the autos, also remains a fairly large overweight from that vantage point, because we expect volume recovery going to come through the next year. Places where we are clearly underweight on consumer staples. We have had no exposure for a fairly long time. And we think, the growth that it can potentially deliver against the valuation are not clearly stacked up in an investor's favor. So we are watchful on that. We like those companies, but we are watchful on that pocket.
Christy, we'll have to leave the conversation here for now. Thank you very much for joining in. That's Quantum AMC. We'll get into a break, but don't go anywhere, because on the other side is the big interview for the day. The management of VIP Industries will join in to talk about the promoter stake sale. Stay tuned. Welcome back. CNBC-TV18 News Break confirmed as multiples PE and Mithun Sancheti come together to acquire stake in VIP Industries. This deal has been long in the making, long speculated, but now there is going to be the change in ownership. Dilip Piramal, chairman of VIP Industries, joins in, and we've got Mangalam here with us in the studio too. Hi.
Hi, Rima. Thank you for that, and thanks a lot, sir, for joining in. It's an iconic deal that has taken place from a brand standpoint as well. VIP, was synonymous with luggage in India. The first obvious question, you've been alluding your interest to sell stake in the company in the past many years. The obvious question is, why now? And secondly, why multiples? What were the factors that went in for you to choose a particular partner? Because multiple times in the past, there have been a lot of buyers that came in and a lot of talks were being taken.
Yes, yes. Well, it has been 53 years since I acquired VIP, in 1973, 52 years. And ever since its existence, VIP has been the market leader in the luggage industry in India. And it is the only country in the entire world where Samsonite is the only multinational company in the luggage space. And it operates in 130 countries. And it is the market leader in all the countries, where the number 2 is not even 10% of Samsonite sales. India is the only country in the world where Samsonite is not a market leader, even today. So we've continued our market leadership. But in the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. So what do I do? And there is a theory of Peter Drucker, who used to be the father of scientific management, modern management in the 50s. I mean, the present generation, nowadays nobody talks about him, but he was the sort of master of management and the original mentor. So he had a very good theory that by the 4th generation of family businesses, they either degenerate or they lose interest. And that happens very often. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management.
But in the past, you've dabbled with professional CEOs who are non-family.
We have always done. Even with our family
What
management.
does multiples bring that,
I'll come to that. So let me talk a little bit about the change of management and all. Like you find in India, so many family managed companies, they still continue to have the ownership, like very eminent companies like, and especially in the consumer business like Pidilite, Marico, Dabur. They all are still family owned, but they have complete professional management. What happened in my case is that I've always had a professional managing director since 1984. It's not that I've been the managing director. I'm not a hands-on manager because I had 4 or 5 businesses. So I never headed till 1984. From 73 to 1984, I was the MD. And then we always had a professional manager, except for a few years when my daughter Radhika was for 5 years, she was the managing director and she was the full-time CEO. So then she decided she doesn't want to, she lives in England and she has a slightly different life, So she was happier there. And I always believe that, okay, I'm not against, like I was talking about the modern generation. Today you have science of such large, one of the most affluent families in India, someone is an artist, someone wants to be a sportsman, someone wants to run a small restaurant, which is nothing compared to the size of the business of the family. But there's nothing wrong in that, This is the modern trend when people want to do their own things. But in my case, I found that the professional management is not being able to run it well. My last year, 4 quarters I had losses, Just 2 minutes, I'll complete what I was saying. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value.
Got it.
Yeah. So that is they're dedicated to that and they're experts in that. And in the last 10 years, private equity take over the complete management. They take, in many cases, majority control also. So that is the best thing for us. Now, I've retained 20% stake.
Yeah.
Because I feel that the long-term future of this company is fantastic.
Got it.
And who will do it better than private equity? Because all their objective is to increase value.
Get that. So two-part question.
Yeah.
And one, what are the imminent changes that, immediate changes that multiples needs to make for the business to go back to its glory days? And secondly, the 20% stake that you've kept for yourself. Is there an exit for that? Is there a right of first refusal for multiples and the others for that? How long do you intend to hold on?
As far as, see, what are the management changes and all, I'm not going to suggest anything.
Got it.
Because that is multiples task.
Got it.
In fact, I'm not going to be on the board also.
Got it.
They've offered me a chairman emeritus position, which is an honorary position. And like, whenever they want my counsel, advice, I'm always there. but it is very clear that they have to run the company. So I'm not going to give any unsolicited advice.
And the 20% that you have?
That will be mine.
Yeah, but do you have any,
Yes, so I have one right to appoint one director, and most likely I will put my wife there so that there is somebody from the family, the Piramal family is represented. And I have full confidence that they will run a good show.
And is there a tenure for which
Yes.
you intend to hold this and for them?
There is a clause that as 20%, I am still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
Got it.
And after that, then under 10%, I am no longer a promoter, but they have put that figure at, we negotiated a figure of 8%. And then I am free to...
And have they committed that they will buy that stake, or you have been open to
I think there is some right of first refusal and all.
All right. And is there a price to that?
No, that will be at the market price, but the price to first refusal is, I'll try to sell obviously at the highest rate.
Right.
But they have a right of first refusal, you know.
You know, the VIP share price, if we look at it, at peak it has been over 700 rupees as well. And the business was doing extremely well. I'm sure you had a lot of buyers that time as well. What is it that prompted you to sell it at 388 as against the 700? Because the intent was there for a while.
When that is the sort of tragedy. 2 years ago, the share price was 700, market cap was 10,000 crores. And we got an offer for that price. But my management at that time felt that in 6 months or in 1 year, the share price will go up by 50%. If not, and in 2 years, even 100%. Unfortunately, that hasn't happened. So in the last 2 years, the share price has been going down. So now I was very, insecure that we are in a downward vertical spiral, you know. Then unless this rot is stopped last year, ending
What do you
March
think it will
25,
take for this rot to stop?
Good management, nothing else.
So the top brass,
we are very
everyone
strong.
changes?
Everything is up to multiples. I will not comment on that.
And,
And multiples will come in only after 3 months.
And in the last 5 years, the industry itself has changed. You know, you've had a lot of D2C players come in, a lot of newer players come in. VIP is no longer the only game in town with the brand, strength that you have. So what will it take for VIP to get its old mojo back?
Good management.
That's it?
Yeah, what else? Structurally, we're very good. We are the largest manufacturer of luggage in the world. My Bangladesh factory is such a great source of soft luggage, you know. And of course, the market for uprights, suitcases, has shifted drastically from soft luggage to hard luggage. So that has caused us problems. But I'm looking also at the international market. You know, we have terrific opportunities in the international market. And we have to explore that. But in the last 5 years, when I'm struggling in my domestic market, where I cannot talk about international market, you know, first let me douse the fires at home.
Just my final question to you. You know, you said that the job of a private equity is to increase value, but also the private equity firms intend to flip it over to some others at some point in time. So is there a timeline for that? Is there any IRR that they've calculated? And what if they sell to some of the adversaries?
I'm not going to answer any questions on behalf of multiples. You have to do a separate interview with them.
Got that.
Okay? But usually how private equity firms work, and why is that this model so suitable for me? Because they are there for 5 to 7 years. You know, usually 5 to 7 years is their term.
Got it.
And they have to increase the value in 2 or 3 times. They want to increase as much as possible, you know, usually 2x or 3x. And so there can be nothing better than that. I'm not so motivated to work so much that for me it's long term. It doesn't matter this year, we'll do it next year and all. Overall, we should be their market leadership. But for them, bottom line is everything, you know, and that is the only way the value goes up. So it's a very good fit for me. You know?
Take that point. Thank you so much for taking the time out and joining us in our studios, but also an important deal. We wish you good luck, your family good luck, and hope that multiples does bring multiples in terms of growth for the company itself from here on. Thanks a lot, Rima.
Thank you very much for this interaction. It was wonderful to listen to it. Get into a break. On the other side, we'll put the spotlight on tech. Today, HCL Tech and Tata Tech will be reporting their numbers. We'll get you the key expectations. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. We have spoken about that big exclusive conversation. It's now time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Gaurav is joining us now, going to tell us how will Q1 pan out for the banking sector. Over to you, Gaurav.
Well, yes, investors' interest in the banking segment is rising, and if you look at Bank Nifty also, it has reached its all-time high level just recently. But does that mean that Q1 is also going to be a big bumper for banks? Well, there are two factors to consider. First, let's talk about RBI has delivered around 100 basis point of rate cut, and second is that when you look at the system loan growth, that has come down to 9.6% versus what it was at 20% just a year ago. So, considering all these factors, when we look at the risk, there are two risks for banks in this quarter specifically. First is that the slowdown in the loan growth, and second is that the slowdown in net interest margins. First, let's talk about the loan book growth. From the provisional updates so far we have seen this slowdown was quite evident with from large sector and mid-segment bank. We have seen banks like Kotak Mahindra Bank, Karur Vysya Bank, Bank of Maharashtra actually outpacing. But on the other hand, we also had IndusInd Bank, Union Bank, who reported very weak set of numbers. When we look at Small Finance Bank, the same trend was evident, except for AU Small Finance Bank. All the other Small Finance Bank who reported their provisional numbers actually reported a very weak set of numbers if we compare it with its overall growth for the last few quarters. In fact, when we talk about some banks like CSB, we have seen good numbers because of the gold portfolio, but in terms of the asset quality also, we saw some risk rising. For an instance, Equitas Small Finance Bank actually reported sharp spike in the fresh slippages. So considering all these factors, when we look at the overall loan book growth expectations, we are not expecting any kind of big number or any big changes from that. In fact, we're expecting around 8 to 12% growth for the banks who have not reported provisional numbers so far. When we talk about asset quality, there also we may see a little bit of concerns, because when we talk about the overall slippages, in Q1, slippages are usually heavy for the banks, and that is the reason there are a few banks which are on our radar in the likes of ICICI Bank, HDFC Bank, SBI, where we will be watching out on slippages. In terms of credit costs also, as we mentioned earlier, there are some banks who are shifting their focus more on the secured segment, and these are the banks where we may see some changes in the credit cost, and credit cost is likely to remain higher in the likes of Bandhan Bank, RBL Bank, even in IndusInd Bank. And talking about all these factors, if we talk about net interest margins now, we may see some pressure building up in net interest margins as well. In fact, we're estimating 8 to 30 basis point of impact on net interest margins across the segment. There are a few banks to highlight. So we, in the likes of SBI, Bank of Baroda, Axis Bank, we may see this net interest margin impact of around 10 basis point. For the larger banks like HDFC, ICICI, and also like mid-sized banks like Federal Bank, we may see this impact somewhere in the range of 15 to 20 basis point. And for the banks where we are seeing higher unsecured mix, because these banks are shifting more towards a secured mix, we may see this impact going as high as 20 to 30 basis point. In fact, when we talk about IndusInd Bank, there was a one-off impact, and that is the reason why in this quarter specifically, we will see some kind of increase in the net interest margins of 70 to 80 basis point. But again, if we compare it with its all-year average, it will be lower. Lastly, when we talk about overall earnings, so there also we are not expecting any kind of big jump. When we talk about PSU banks, we may see a healthy number on a year-on-year basis in terms of EPS growth. But for the larger banks like HDFC and ICICI Bank, we may see this number somewhere remaining in the single digit. In fact, when we talk about some banks with higher exposure in unsecured, like Bandhan Bank, RBL, we may see this fall as high as 20%. And for IndusInd Bank, again, we will be seeing this fall somewhere in the range of 40 to 50 basis point in terms of EPS. But does that mean that banking sector and banking stocks is losing its shine? Well, not likely, because what now analysts believe is that this pain is going to remain only for first or second quarter. From second quarter onwards, we will see some pickup in net interest margins. In fact, Macquarie in its recent note also highlighted that in FY27, we will see margin recovery, and at the same time, private sector banks' EPS can grow at around 15% over the next 3 years. So definitely Q1 is going to be painful as per expectations. But from here on, there are multiple tailwinds, and on back of this, we will be watching out on this sector.
Thank you. Very comprehensive. So banks could see some short-term pain. For IT, the question is, there is pain, no doubt, in Q1. We saw that in the case of TCS with a more than 3% drop in the top line. And for HCL Tech as well, which reports numbers post-market, we are expecting a drop of more than 1% in the company's constant currency revenue growth. When there is no top line, margins get compressed, so margins are likely to decline. Now, the question is on their guidance, because TCS doesn't give you a guidance. HCL Tech does. HCL Tech's guidance stood at 2 to 5%. Can they raise the guidance? Some analysts believe at least the lower end of the guidance can be revised higher, but that's unlikely to be a positive signal. It could be ignored by the guidance. So 3 to 5% guidance from 2 to 5 is unlikely to move the needle too much. But what the company says on discretionary demand, spending, outlook, hiring will be tracked very closely. But again, Q1 is expected to be weak.
All the more reason to keep an eye out on HCL Tech's numbers, particularly after what TCS delivered. But what about Tata Tech, Reema? That too comes out with numbers today.
And you know, this stock has seen such a fall, 30% down in the last 1 year. It's, I think, closer to 700 rupees. So the issue price was 500. But if you remember day one and the immediate aftermath, it was such a blockbuster listing. Issue price was 500. It listed at 1200. It went to 1400. And since then, this entire weakness in the the auto industry, which is feeding into the auto companies, like IT companies catering to the auto industry, whether it's a Tata Tech or even a KPIT Tech, it's been hurting them. So this time, revenues are expected to decline 6.5%. We need to edit that. It's a minus 6.5% drop in the company's revenues this time. And the problem is that even some of their main anchor clients, whether it's Tamo, JLR, they are hurting. Sales are getting impacted, and plus there is the tariff issue. Now, the only thing is, when we spoke to the management post the prior quarter's numbers, they're still aspiring for a double-digit revenue growth. But it's such a weak start to Q1, so is that even possible? They also told us that they're bullish about Q2 and a strong H2. They acknowledged Q1 is going to be weak, but they were confident about things improving, but the uncertainty is still lingering on. So, I think we're going to quiz them on that guidance, right? What you shared last time, the optimism that you held out 2 months back.
Will that continue?
Where does that stand right now?
We'll watch out for that one for sure. Tata Tech, an important number that will be on our radar today. But with that, we've completely run out of time on this edition of Trading Hour. But do stay tuned. Halftime report is up next.
US President Donald Trump spooks the street by announcing a 30% tariff on EU and Mexico. Over the weekend, IT and financials drag while utilities and healthcare eke out gains.
Market regulator SEBI says it is examining a request by Jane Street to lift certain restrictions imposed in its interim order. This follows Jane Street's depositing over rupees 4,800 crores in an escrow account favoring SEBI as required by the order.
MSN wins a patent litigation against Novartis in a US court, paving the way for launch of a generic for cardiac drug Entresto. The consequent dip in drug prices is seen hurting Divi's, which supplies the ingredients.
And after multiple SPE and Sacheti brothers to take up 32% stake in VIP Industries, followed by an open offer, promoters Dilip Piramal tell CNBC-TV18 an ownership change was needed to put the business on track and that he will trim his residual holding from 20% to 8% in 5 years.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala, and we will have Manglam with us soon as well. Well, we do have the WPI data on your screen. It is a deflation which has come through for the month of June, minus 0.13% versus 0.39% on a month-on-month basis. And we have fuel and power, which is in deflation as well by around 2.65%. To get us more details in terms of what this means and whether this deflation was expected or not, we have Lata joining in to take us through the numbers. Lata, over to you.
The market was not expecting a deflation at all. The average I got from about, say, 10 economists was 0.8%, which would be actually higher than what the inflation was in the month of May at 0.39. The expectation was 0.8. So this is going to be a big surprise for the market. And more importantly, what this can mean is there can be an impact on the CPI as well. We don't know. There are not too many overlapping elements, but that can happen. And the fact that fuel and power contributed is perhaps not a surprise, because we did see fuel prices year on year far lower. But I think manufactured products, this kind of a fall was not expected. It was always food that was year on year much lower, because vegetable prices last year had shot up, as had pulses. And now we are seeing a steep fall in the pulses prices. We saw that in the May CPI as well. And therefore a repeat was expected. But primary articles deflating by, minus 3.38% month on month was perhaps not on the cards. Food prices were at best expected to be flat year on year. This kind of a steep fall is largely because of cereals and pulses. There has been a robust harvest, and that's impacting food inflation, now gone into deflation at the wholesale level. Fuel and power year on year was expected to fall, but manufacturing also will come as a surprise that it is risen by only 1% compared to 2% month ago. 1.97% compared to 2%. So the extent of year-on-year growth has clearly slowed. This could be that, people are not able to sell to the United States or are fearing less sales, and therefore that's bringing down prices in the wholesale markets. It could be a whole host of reasons, but these are very important signals for the CPI number that will come later today, and for the CPI numbers in the coming months as well. That, core inflation, which was the only factor that was rising, will probably start falling in the coming months. But let me defer to the expert. Kanika Pasricha, Chief Economic Advisor at Union Bank, joins us. Kanika, nobody told me it will be a deflation. I know it's marginal. It's a small number, minus 1 point something compared to 0.8 plus that was expected. But nevertheless, your thoughts?
So let that 3 points. See, first and foremost, it looks like food has been a game changer here, because food was not expected to get into deflation. The numbers, as you have talked about, from 1.7% in May, food was expected around 0.6, 0.7% as per our estimates. It may have been lower, but a negative number on food, as you rightly said, it's not veggies now solely. It's also cereals and pulses, which probably have contributed to this number, and also gives a sneak peek into maybe some positive surprise on the CPI inflation as well, because food is a primary channel in terms of impacting WPI to CPI, because the other segments like fuel is not impacting CPI as much, because petrol, diesel prices are regulated, and even from core WPI to CPI, given that services inflation stays elevated, the impact is captured. So that's first. Food is the primary source of surprise in our view. Second, what we think is that, this is actually showing a positive inkling in terms of not just a good monsoon. So it's not just about what has happened till now, even going forward. If you look at some of the Kharif sowing numbers, so the harvest for food was good, but Kharif sowing is also up 11% YOY as per the data for 4th of July. So the outlook also matters now, where start to monsoon good. Now what happens in July and August, which contributes to 65 to 70% of rains and sowing, needs to be closely watched. That's important.
That's right.
Last but not the least, metals needs to be watched, because we thought that will impact core CPI significantly, primarily commodity-led. And this was a war-led month in the month of June, but that has not shown up as much as what we had thought. Thanks.
Okay. No, that point is taken. Food actually is the one that's surprised. Cereals index is down 0.2% on the month. Vegetable index is, of course, up on the month, but that is the normal seasonal factor. June prices are always higher because monsoon disrupts movement of vegetables. But manufactured products, again, it's not just cereals that are down 0.2% on the month. The manufactured products as well have come down by 0.1% on the month. So both, year on year is one thing, but even on the month, and edible oils is the other big factor that month on month has fallen by 2.2%. That's largely because of the change in the import tariffs. So all told, a very big fall. A quick last question to you, Kanika. The average I have got for the CPI poll from, I think, about 20 economists is 2.3% for the month of June, which will be announced at 4 p.m. Do you think a downside surprise to even 2.3 is possible?
So looks likely, Lata. Though in the past, whenever WPI has surprised on the downside, we have thought that CPI will show up as a similar number, like, some downward surprise will be seen. But it may not be a one-on-one correlation. However, 25% of WPI is food, 46% of CPI is food, and a number showing surprise from plus 0.6% to a deflation in WPI. It may show up, if it shows up in CPI,
a few basis points,
a sharp downward surprise likely. Given a high,
and very quickly, does that mean the bond market will start opening up expectations of another cut?
See, I would say there's only one thing. Maybe the bond market starts pricing in something. But what is very important is all of us and the MPC penciling in CPI average in this financial year at sub 4%, at 3.6, 3.7% range, is all contingent on food CPI, which has been sticky persistently for last 3 years in 6.5 to 7% range, suddenly crashing to 2 to 2.5% levels. That's highly dependent upon monsoon, climate being well behaved, which has not been so much, which not blessed us so much as well in last 3 years. So I would say it's important to watch out for monsoon and impact on food inflation before we become very optimistic of a live October or December meeting. Thanks.
Okay. Thanks for that, Kanika. Well, this is a downside surprise, as it is written all over the place in practically every number. The CPI number 2.3 is also a 6.5-year low, but it can be, say 2.2 or 2.1 because of food prices. It will clearly open up for the bond market hopes of a rate cut sometime in 2025. It is extremely unlikely that the Reserve Bank goes from accommodative to neutral in the June policy, and in the August policy comes and cuts. Though, neutral really means you can cut, you can pause, you can hike. But having gone from accommodative to neutral in just the next policy to cut looks like a bit far-fetched. But, a number which is so close to 2 can,
a possibility is there.
Yeah, I mean, you're data-driven ultimately. There's no ego about these numbers. So you can't rule out either. But clearly, later in the year, the markets are going to pencil in a rate cut. Maybe not August, maybe it will come in September, in October. But expectations will definitely start getting penciled in.
Okay, all right, Lata. Thanks very much for that. In fact, the CPI data would be the key one to watch out for now this evening at around 4 p.m., where it is expected to come in above 2%. But we need to take a short break. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m.
Welcome back to Halftime Report on CNBC TV18. Markets 25,000, just holding on to that mark as of now. Today's lowest point almost is what the Nifty is trading at. A lot of action that's happening in the capital market front. We're seeing all those capital market names buzzing. And other than that, we're seeing pharma names that are buzzing in trade as well today. So whether you look at something like a Newland Lab that's in focus, that's buzzing in trade. We have Sai Life Sciences, Laurus Labs, Piramal Pharma, Mankind Pharma, all these names are buzzing. But other than that, we have Divi's Labs that is under pressure today. Now, why is that so? What has happened on this front? Ekta, we have some court case that was going on, right, in the US for MSN and Novartis, and now that seems to be causing some bit of a pressure for Divi's.
Oh, well, yes. This is because of the, blockbuster heart failure drug Entresto, which Divi's has been supplying the API to Novartis for. So MSN has been in a patent litigation with regards to this particular drug, and now MSN has won the patent litigation with regards to the Novartis blockbuster drug Entresto. So what this means is that MSN can probably launch will be launching the generic version of this drug in July itself. Now, how does it impact Divi's? We have Entresto, the API, which is expected to be the largest product for Divi's custom synthesis business. It is estimated to contribute around 40% of the CS business and estimated to account around 20% of the overall revenue. IFL says over the next year, Divi's could see a potential 12 to 13% decline in the annual EBITDA. But the reason why you've seen the stock recover, and this is, the reason is that there's so much back and forth with regards to Entresto that maybe the street had already factored the worst in, and now they're looking ahead because there are opportunities such as GLP-1 and other CDMO opportunities which are coming up, and I think the street wants to look at that more positively. But to talk more about that, we have Alankar Garude, who from Kotak Institutional Equities, to talk about Divi's as well as a whole host of pharma stocks in focus on account of earnings. Alankar, thank you very much for taking the time out. Before we get to talking about what you estimate from earnings this quarter, wanted your thoughts on Divi's and the news with regards to Entresto.
Hi, Ekta. Thank you for having me here. So basically in our numbers, we were already factoring in a generic entry, specifically MSN's entry in mid-July. If you look at the pediatric exclusivity, it's ending tomorrow, 15th of July. So to that extent, in our numbers versus almost 1,100-1,200 crores of sales of Entresto reported by Divi's in FY25, we are expecting rather almost 850 crores in our numbers for FY26. The good thing, or rather the only solace, if you have to call it that way, for Divi's regarding Entresto is, unlike most other CSM molecules, in our view, the gross margins which Divi's enjoys for this molecule is much lower. In our view, Divi's makes somewhere around 45 to 50% gross margins at best for this molecule. So to that extent, the earnings impact is something which will not be in sync with the strong top-line contribution which we saw from this product for Divi's in FY25. So yes, there will be an impact, but at least in our numbers, we have already baked that in.
Okay. Alankar, good afternoon. This is Vinny joining in the conversation as well. Let's talk about Q1, right? While you have baked in all these points coming in for Divi's, what about overall Q1? What is expected to do well this time? One, do we expect CDMO players to perform better than other companies?
If we look at CDMO specifically, Q1 is a seasonally weaker quarter. And I'm talking about the sequential performance here. Still, if you look at some of the trends which we have picked up, companies like Sai Life Sciences, Blue Jet, are going to report relatively good performance. Even Laurus, we expect a pretty strong custom synthesis performance in this quarter. Having said that, there are a couple of CRDMO companies like Syngene and Piramal, which have already guided for a relatively muted FY26. So to that extent, we also expect first quarter for them to be relatively muted. The impact for both these companies is going to be transient in our view in FY26. So we do expect the sales numbers to pick up towards the end of FY26. So once this transient inventory destocking issue for their largest molecule passes through. So net-net, I think Q1 is going to be good for a few companies on the CRDMO space. But if you look at a couple of companies in our coverage, the whole of FY26 is going to be a bit weak. And those would be Syngene and Piramal.
All right. Whole of FY26 will not be particularly good for the companies that you track, Alankar. But, the buzzword of the last couple of years has been semaglutide. With that going off patent, there are a lot of Indian pharmaceutical companies that stand to, perhaps partake in that opportunity. How big do you think the Indian opportunity realistically could be here, and who could be the winners here?
So, Mangalam, if I look at the diabetes market today in India is roughly around 20,000 crore. There are some 10 crore people in India who suffer from diabetes. And there could be people who are obese but do not suffer from diabetes. So that would be on top of this 10 crore people which I mentioned. If you look at, say, US, currently less than 10% of the people who are diabetic really take GLP-1 drugs. That number is expected to increase once you see more generics entering the market, even in US and not just in US, even in other markets as well. We could see something similar happening in India as well. So depending on how things pan out, the size of the GLP-1 market in India can run into a few thousand crores. Can be closer to that 20,000 crore mark of the diabetes market currently in India, or even could be higher. Also in India, one interesting angle to consider here would be the combination between oral and injectable. Because of affordability, because of storage requirements, because of ease of administration, we might as well see a fairly decent penetration of the oral combination in India compared to the injectable. So, clearly an interesting opportunity. If you look at who are the key players in the diabetes market in India today, a whole bunch of all the larger players which we cover today have a big play on diabetes today. So players like Sun Pharma, Torrent, Cipla, Dr. Reddy's to an extent. So these are all relevant companies who have a very strong diabetes presence in India. And we expect some of these companies to be winners eventually when it comes to the GLP-1 opportunity, both on the diabetes side as well as on the obesity side.
Okay. Alankar, just wanted to understand if you had a look at Sun Pharma's Halol facility observations and what you made of them, as well as maybe the news that Glenmark has also received a warning letter for their Indore facility. So separately, just wanted your thoughts on the specific observations for Halol. What do you think of them? And two, the fact that a lot of these companies are now not reacting to observations or warning letters in an extreme fashion as compared to earlier.
I think that last point which you made is pretty interesting, right? So, if I talk about Sun specifically, Halol is not as relevant in their entire scheme of things as it used to be, say, 10 years back. Having said that, of course, it's one of Sun's largest facilities. It's very important to get it cleared. But if you look at the number of new launches lined up from that facility are not really very high. We don't have the details of the observations as yet, so I would reserve my comments on that. Also on Glenmark, they had already received an OAI in May. So to that extent, receiving a warning letter is more of a procedural thing. Glenmark is also one name which we don't have under our formal coverage at the moment. So would refrain from giving any views on that.
All right, take that point. Thank you so much for joining in. Glenmark, the stocks continuing to do well after a big rally that it saw on Friday as well. But mind you, it is in F&O band, so we'll keep an eye out on that. Alankar, thank you for joining in. We'll take a short break, come back on the other side, get you more on the markets and a lot of stock-specific action. Stay with us. Welcome back. Even if it is 100 points lower on the Nifty, a bunch of frontline index stocks are doing a lot better. So Eternal, for one, has moved to the high point of trade, up around 3%, and recovered in the last hour of trade on Friday as well. So the erstwhile Zomato stock doing extremely well. And pull up the Realty Index, Realty stocks as well. Over the last 10 minutes or so, we've seen a big jump in the Realty Index. The Realty Index has moved to the high point of trade. Ola continues to do well, up 13% right now, and that's on the back of management commentary post its first quarter numbers. More than the numbers, the fact that they will continue to focus on operational profitability. They've given a revenue guidance as well. The auto business will break even in the second quarter itself. Has the street excited? And given that excitement on Ola, a lot of these other new age companies as well buzzing around. So Eternal's done well. We spoke about that. Paytm is the other one, which too has surged to the high point of trade. So we'll just watch out for all of these stocks. Meanwhile, just keep an eye out on the FNO setup of this afternoon. We have the frontline indices. The Nifty is lower, but the Nifty Bank not so much. Even on Friday, the Nifty Bank supported the cause of the frontline index, and we have the mid caps which are doing a lot better. Two things that I'm watching out for going forward from here. One, the India VIX. Now it's back above that 12 mark. When it was below that 12, some on the street were saying that, it's perhaps factoring in some sort of complacency, and the market was range bound. Now that the market's declined on Friday and continues to be choppy today, VIX has moved higher, which is not necessarily a bad thing. The good part is that now options are getting priced in more realistically and complacency is getting out of the way. The second thing that I'm watching out for is the put-call ratio. Because the market has seen a big decline, the put-call ratio has normalized from over 0.9 to 0.75 in the previous trading session, and now has gone to sub 0.7 as well. So 0.65 to 0.7 is where the market becomes oversold. So support is fairly near. Where is that support? We've seen, the 25,000 put being extremely active. So today's low alongside the 24,950 sort of mark is extremely crucial to track, because the 25,050 put also has seen a lot of writing. Though on the way up, we need to cross past the 25,200 mark and the 25,265 mark, which is the 20-day moving average on the frontline index, to see further short covering on that index itself. But by and large, the market, while in a range, it's at the lower end of that range right now as it has moved lower. Let's see whether it can cross past the upper levels or not. Take a short break, come back. On the other side, we have Manisha Gupta joining in with all things commodities. Stay with us.
Welcome back, and joining us now on the show is Rajesh Agarwal. He's MD at Insecticides India Limited. Mr. Agarwal, hi, thank you so much for joining in. I mean, this is one sector that clearly has been growing, and agriculture has been in favor and conversation for some time now, especially as we look at that deal that India is doing with UK and Australia and, of course, US as well. But what is your sense on the numbers? Because we're looking at India's role rising within this segment. There are various reports also suggesting that the global numbers also would continue to gain up. There are various reports to that effect as well. But your sense on India's role within that?
There are two aspects. Actually, number one is the domestic aspect, because I believe that when in India more than 50% people are involved in agriculture, so there is a very good scope of expansion within the country, because the demand is rising as the awareness goes up, as the demand for food goes up, because the population is rising at such a scale. So with the awareness and the population, ultimately the demand for the all agri input is going to go up. Yes, India is one manufacturing country, because after China, India is the only solution which can provide the AIs to the world, which can provide the white labeling products to the world, and also take our brands to the international markets. All these FTAs and different agreements what India is going to sign with the other countries are going to give a big opportunity to all the manufacturers in India. It will take some time, because all the products have to get registered. So there might be certain registrations which are going on in these countries. They will get the immediate help. And for other companies, yes, there will be an opportunity to register from India. And when the people of those countries get the product tax-free or at the discounted tariffs, definitely will be very competitive supplier to those countries.
Mr. Agarwal, what is your sense, if you could help us with numbers really on India market size when it comes to agrochemicals and the kind of growth that we are seeing here?
Indian market size has been little stagnant for last 2-3 years with a very minimal growth. So we believe that India domestic market size is roughly 40,000 crores, and the export is little more than this, which had crossed 50,000 crores at one point of time. But at this moment, people say that the market is somewhere around $9 billion. So it is poised to go to 10 billions, but it will take one more year, I believe, to touch that number.
How would you look at India's competitiveness when it comes to the global markets? How would you also look at rules and regulations, policies, that is, because that really tells you on where we would move on, how fast we will move from here?
India cooperates a lot if we have to do the registration for exports. So we get the export registrations very, very fast. But sometimes many countries ask for the domestic registration, and there is a lot of data generation. So we have to do a lot of data generation here in India. And then all the bioefficacy trials are to be conducted again into the countries where you wish to sell. So overall, that's a tedious policy, which from country to country, 1 year to 5, 6, 7 years time is required. So many things are in process for most of the companies which are into international business. So things are always under process, and we have to plan for at least a decade, even for the domestic markets as well as the international markets. So always the R&D teams, the development teams are on toes, and they are regularly working in the development of the new products, new solutions for the farmer around the world, I would say. So India is well prepared, because when it comes to synthesis, as I told you before, after China, India is today in the leading position. And India is one area where you can manufacture 12 months a year and fulfill the demand of the markets.
Well, that's interesting to know, because that really was my next question on when you look at the global markets changing, Indian markets as well changing as well. As you said, India seems to be responding quite well to it. We have a capacity where we can run it for 12 months too. So when it comes to investments or capex within the sector, has that seen a growth too?
Yes, 2 decades were very, very lull. From 1995 to 2015, I didn't see any investments coming in the business. But in this decade, all the leading companies in the country have invested into backward integration. Some companies are very aggressive. They're investing in R&D, in setting up the plants for backward and forward integration. Insecticides India is one of them, actually. So, yes, we see a lot of investment coming in that trade, and there is a good opportunity, both in the domestic markets as well as the international market.
Mr. Agarwal, I'll also come in on the tariff point. You did touch it briefly initially in the conversation, but do you see an impact of that one? And the second thing is about sustainability, because that really seems high on cards too.
Yeah, definitely. Actually, you have to continuously work on innovation. bring the newer solutions. There is pressure over certain generic products, and ultimately the generics will be moving out and the new generation products will be coming in. So farmer need one-shot solution, immediate solution. So these are the demands of the farmer today. The biological products are also coming in, but that market is very, very small. So ultimately it appears that the chemical market is only going to rule for a few years. But yes, the biologicals will also see their entry. So we are working in both the direction. Overall, the opportunity in front of the industry is very good. And I would say that the growth will go up. These rains were very, very erratic in the past 2 years. This year, we are seeing going through. So far, everything is positive. The rains are good. The reservoirs are full. So we are seeing the growth at the moment. If that momentum continues for next 2 months, then yes, there will be a big growth actually in first half of this year.
Okay, interesting. If the rain continues, everything goes well, then we could see good growth coming in. Thank you so much, Mr. Agarwal, as well as Manisha, for joining in with us for this conversation. We'll be keeping an eye out on the sector as well. But on that note, we're going to slip into a very short break. When we come back, we'll be joined by Habil Khurakiwala, who is the chairman at Wockhardt, to discuss their exit from the US generic business and more about the company as well.
Welcome back. Well, for the markets, it's mixed at this point in time. Mid-cap index up around 0.5%. But let's focus on one particular company which is doing well today. It's Wockhardt. That stock is up around 4.5%. The company has decided to exit the US generics business entirely. And remember, that particular business has been making losses, posted a loss of around $8 million in FY25. The company's filed for voluntary liquidation under Chapter 7 of the US Bankruptcy Code. To understand this move and what the future holds and what they will be focusing on, antibiotics as well as insulin, we have with us Dr. Habib Kharakiwala, to answer and take some of our questions. Mr. Kharakiwala, thank you very much for joining in. Well, it's quite a landmark considering that Wockhardt has now exited the US business. But does that mean that you would not be selling via even third parties in the US? There's no presence whatsoever in the US now on?
Yes, you are right. Because as far as the pharma generic is concerned, we are exiting and we will not have even the third party presence. But however, as far as our new drug is concerned or biologicals are concerned, we would be definitely there in the US market in time to come.
Okay. What would an exit, and we'll get to the biologics and the new entities a little later, but just wanted to understand that what would the new business model mean without the US now in terms of revenue as well as margins especially?
The US, as far as the revenue is concerned, it was hardly 2-3% of our revenue. So it hardly makes any impact whatsoever. As far as the margins are concerned, I think our numbers will improve because we have been incurring losses for the last several years. In fact, we lost about $8 million last year. So partly it will be made up in this year because 4-5 months we have worked. So there will be some losses, but it will not be 8 million, it will be much lower. And from next year onwards, these losses will not be there.
Okay, so when you say there will be, say, it'll be, margin accretive or it'll be positive for margins, you did around 13% in terms of margins in FY25. What do you think it can go to now that you don't have these losses to incur?
It will make a small difference of a couple of percentage margin going forward.
Mr. Kharakiwala, you had joined us earlier in the year and you did say that over the next 3 years, you expect the sales of the company to double and you were targeting 20% margins by the end of this 3 year. Are we on track for that? And with the money that you get from the US business, what happens to your balance sheet?
See, we would be on the track because we are introducing our new drugs in the Indian market. And after initial first year, it would be significant margin improvement. Additionally, we would be focusing on our biogenerics, that is diabetic portfolio of insulin and newer insulins. And all these put together will certainly, we would achieve this kind of 18-20% market, margins over next few years.
Okay, 18-20% margins in the next few years. Good afternoon, sir. So also in terms of the antibiotic segment, where you have Zenic, that is there as well. Now, obviously, you've given us an update that, it's there with the Indian approval. You're waiting out for that in terms of regulator. The US side is where you're planning to go for approvals as well at the second half of the year. Any opportunities in terms of out-licensing also that you're looking out for here?
See, as far as our strategy is concerned, we will be filing for the US next month in August. And we already filed in India and we hope to receive approval sometime end of the year, early next year. As far as marketing in the US is concerned and other markets are concerned, some of the markets we would be certainly looking for out-licensing, and that will depend from market to market. And some markets we may decide to do it ourselves also.
Okay. Well, Dr. Kharakiwala, I just wanted to actually narrow down upon the out-licensing opportunity because we're having this conversation at a time when Glenmark has just about closed a very big out-licensing deal for themselves. So it seems as though the market seems to be hot and there is more confidence in Indian generic companies looking at innovation as well. What is your sense in terms of how big a deal you could get for out-licensing when it comes to Zenic?
It's very difficult to comment while the discussion are going on the size of the transaction possibility. But we will be evaluating both out-licensing option in addition to doing it ourselves because it is not a single product. Second, we have developed the product all the way and got the approval. And we have a number of products in the pipeline. So that is a decision we have not yet taken, but depending on the interests of the parties and the valuation we get, we'll take an appropriate call sometime later.
What about Zenec? You said you are expecting approvals in FY27?
Sorry, I didn't get your question.
The Zenec drug, you said
Yes.
you are expecting some approvals by FY27.
Yeah, of course. We will definitely get approval in India. We will get approval in the US also next year. So we are filing in August and we hope to get middle of next year approval in the US also.
Okay. Approval in the US also you're expecting by the next year. Mr. Kharakiwala, what I also want to know is, over the last couple of years, obviously, you've significantly reduced the debt for the company as well. Balance sheet has become much better. Newer opportunities, what you're talking about as well, especially coming in for nifurthromycin. So I want to understand in terms of investments there, more R&D, global expansion, what more now the focus is going to be on?
See, our focus is continue to remain on drug discovery research in antibiotics. We have the largest portfolio of new drugs available amongst the research product. US FDA has given 6 of us. No other company has received more than 1 or 2. And we want to maintain research leadership as far as the antibiotic is concerned. And over a period of time, we want to build up this leadership, translating this leadership into our business leadership also over a longer period of time.
Okay. You're also looking to grow your insulin biosimilar business, Dr. Kharakiwala. This comes at a time where the entire landscape of diabetes medication is changing. So tell us what you are actually projecting in terms of revenue, sales, and even investment when it comes to insulin biosimilars.
See, in biosimilars, we have taken a strategic position of focusing on insulin and newer insulins and anti-obesity drug because it is the same kind of manufacturing and the space is the same. Our new investment in fixed asset would be marginal because we already have manufacturing facilities of API and formulation. Our research organization is already there and they are working on it. We have already developed a few of these molecules. So we expect that all this will fructify in coming years and we will be focusing on this in all markets.
Okay, all right, Dr. Kharakiwala. Well, thank you very much for joining in and definitely the end of a long story. With Wockhardt actually exiting the US generics business finally. Thank you very much for taking the time out and speaking with us. That's Wockhardt. The stock is up around 4.5% at this point in time. We take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report. As of now, Nifty is where we started the show with as of now as well, right? 25,040 is what the Nifty is trading at, down almost 4/10 to 0.5% in today's trading session. Mid and small cap, that's managing to do well, holding on to gains even as of now. 0.5% of gain almost coming in for the mid cap. Small cap also seeing good gains in today's trading session. And in the broader end of the market, in the last 1 hour, what has picked up pace furthermore is Ola Electric. After its numbers, we're seeing it rise furthermore in the last 1 hour as well. We have Walkart, Glenmark Life that are managing to hold on to gains, while in terms of the losers in the last 1 hour that have seen a bit more decline coming in the last 1 hour, Tata Elxsi, that's the one that's seeing a bit more of a further decline in the last 1 hour, as well as First Source. That's something that we're watching out for. Today, IT is not managing to do well as of now as well. When you're looking at it, IT is down almost more than 1%, so 1.5, 1.7%. Day's lowest point is what the Nifty IT is trading at as of now. But we'll keep an eye out on HCL Tech today. Why? Because they're expected to report their numbers. Q1 earnings are expected, and the market is expecting a muted quarter coming in for the company. What more should we watch out for in terms of details? We have Reema joining in with us to give us those details. Good afternoon, Reema.
Hi. So just some key numbers. One on the top line, expect a revenue drop of about 1.1% in constant currency terms. This will be better than the 3.3% decline that TCS reported last week. Now, the pressure on the top line will will result in margin contraction. So margin seen down to 17.3%, profit seen lower by 3%. But the key is going to be the guidance. 2 to 5% is the current revenue guidance, 18 to 19% on the margin. Margin guidance is likely to remain unchanged. The revenue guidance could get tweaked. The lower end of the revenue band could get revised higher. So 2 to 5 may become 3 to 5. But unless the upper end of the band is changed, it's unlikely to be a meaningful boost in terms of a trigger for the stock. Deal wins are likely to remain healthy between $2 to $2.5 billion. But Q1 is going to be tough, and I think the street will want to know about what clients are doing now. Has this uncertainty increased? Is it persisting even in Q2? Is Q2 now going to be also impacted, given the weakness in the macro environment? So I think the outlook for Q2 and the second half of the year will be very crucial.
All right, we take that point. Reema, thank you so much for that. There is some news at the bottom of your screen on Karnataka Bank. We'll keep an eye out on that. Raghavendra Srinivas will now be CEO for the next 3 years. So it has gone ahead and appointed Raghavendra Srinivas as interim MD and CEO. This after a senior rung of leaderships of the company did put in their papers a couple of weeks ago. We have seen the stock recover a tad from that. The day the leadership issue happened, the stock had fallen about 4%.
All right.
Okay. We'll wrap up on this edition of Halftime Report. Business Lunch takes all the market action ahead. Thank you for watching.
US President Donald Trump spooks the street yet again by announcing a 30% tariff on the European Union and Mexico over the weekend. IT and financials are the big drags, while utilities and healthcare eke out some gains.
Market regulator SEBI says it is examining a request by Jane Street to lift certain restrictions imposed on its interim order. This follows Jane Street depositing over 4,800 crore rupees in an escrow account, favouring SEBI as required by the order.
MSN wins a patent litigation against Novartis in a US court, paving the way for the launch of a generic drug for cardiac Entresto. The consequent dip in drug prices is seen hurting Divi's Laboratories, which supplies the ingredient.
After multiples, PE and Sacheti brothers signed to pick a 32% stake in VIP Industries, followed by an open offer, promoter Dilip Piramal tells CNBC-TV18 an ownership change was needed to put the biz on track and that he'll trim his residual holding from 20% to 8% in 5 years.
You're with us here on Business Lunch. You're coming to live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Vatakia. With me is Vamakshi Thoria. Vamakshi, good afternoon. Well, almost a similar kind of session playing out from where we left off on Friday, but the bulls still trying tooth and nail to defend that 25,000 mark.
Well, absolutely, Hormaz. You know, it's quite an interesting looking screen today. And of course, the markets are feeling a bit of Monday blues coming in, especially for the benchmark indices. Take a look at the Nifty, that's down almost 0.4%. But when you look at the advanced decline ratio, it's largely in favor of the declines. Now, what's interesting is that the mid-cap end of the market, Hormaz, is doing so well. The mid-cap index is up almost 0.6%. The small cap index is doing even better than that. It's up almost 0.8%. So interesting moves out there. But as far as some specific sectors are concerned, most of them are in the green. The gains are largely being led by realty. When we look at some of the realty names like Brigade, Godrej Properties, all of them are up almost 2% in today's trading session. What's not doing too well, and this is similar as to what we saw in the previous week, is the IT pack. Keep in mind that, you know, the TCS had a week showing the stocks declined on Friday. It was, I mean, the worst performing sectoral index. And, you know, the index continues to not do too well today.
There's all the more reason, right, why you should keep an eye out for HCL Tech's results in later this evening. But the Nifty IT, well, the worst performing sector in today's session. Of course, there are a couple of other movers, though, in today's session that are surging, and how Ola Electric is one of them. 16% higher on that stock now after its first quarter results, and that is after its losses narrowed compared to the previous quarter, although they were wider on a year-on-year basis. And even on a sequential basis, there has been an improvement on the revenue and the volume front as well. And the stock is moving higher on very strong volumes, mind you. Almost 30 crore shares were already traded last checked, and that is way above the 20-day average of around 2.5 crore shares at the same time during the day. So stellar moves seen in Ola Electric. But the big story of the morning, though, was the confirmation of a CNBC-TV18 news break, where promoters of VIP Industries will be selling 32% stake to a consortium of multiples PE and Mithun Sacheti at 388 rupees a share. Now, the management also joined us earlier to discuss this stake sale. Mangalam is joining in to tell us more, and to what the management also told us exclusively. Mangalam.
Well, it was the deal of the day for sure. Promoters of VIP Industries decided to sell up to 32% of their stake to multiples private equity and a consortium of other investors as well. Initially, the stock opened lower because the deal price was 388 rupees per share. The stock had already seen a 75% rally from a 52-week low in the run-up to this deal. But more importantly, you know, all the excesses were out of the system once the news was in. But thereafter, the belief that maybe the new owners could turn this company around, a stock which has been an underperformer in the sector, could actually do a lot better going forward. The street is betting on that, and thereafter we saw that recovery from the lows on the counter itself. We spoke to Dilip Piramal, who joined us in our studios, and was fairly candid. He said that, you know, he had no option but to sell this business because there was a management crisis. More importantly, senior leadership wasn't performing, and at the same time, none of his family members were willing to take up managerial positions and run the company on a day-to-day basis as well. So left with no option and loss in market share as the business was not doing well over the last few years. he had to go ahead and sell to private equity. The choice for private equity was rather simple. He said private equity investors are usually, betting on improving the value of the company and increasing the valuation as well going forward and the profitability, and that was his best bet. He will hold 20% stake in the company, will have to pare it down to almost 8% in the next 3 to 5 years, for which he has a right of first refusal with multiples private equity as well. He says the company needs good management to get its old mojo back. Let's see how that performs. For now, the street is betting on the ability of multiples and the legacy of brand VIP to take it forward from here on. Let's hear out what Dilip Piramal had to say to us.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value. There is a clause that as 20%, I'm still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
Well, that was the management of VIP Industries. The stock has seen a very good recovery in today's trading session. But moving on, one stock that is doing well is Ola Electric after the company reported its first quarter numbers. Sudarshan gets us all of the details. Sudarshan?
So Ola Electric stock was at a 52-week low ahead of its Q1 FY26 earnings, down more than 50% in 2025, down more than 75% from the record high that stock had hit in August of 2024. But just as today morning stock, a company has released its earnings for Q1 FY26, the stock is now currently up almost 16%. And there are majorly two main reasons. First, earnings have improved on a sequential basis, that is QOQ, and company has given a very healthy guidance for FY26. So now first talking about the earnings, losses have narrowed on a sequential basis. In Q1 of FY26, company has reported loss of rupees 428 crore against rupees 870 crore that it had reported in Q4 of FY25. The similar trend was seen on revenue front as well. Revenue in Q1 FY26 was at rupees 828 crore, and that has increased from rupees 611 crore that company had reported in Q4 of FY25. The biggest positive is gross margin. In Q1 FY26, gross margin is 25.8%. That has seen a sharp improvement, not only sequentially, but also YOY. Now the positive part is company is saying by the end of FY26, it's saying gross margin improving to 35 to 40%. That would be an improvement of almost 1,500 basis points if company really achieves that. Now on the concern front, company, like all the other auto companies, has raised a concern regarding rare earth magnet. It's saying that in long term, if there is unavailability of rare earth magnet, it will be a concern, but for short term, company remains well covered. Also, it has given guidance for volume and revenue. On the volume front, in FY25, company has done total volume of 3.59 lakh units. Now in FY26, it's saying that it will do in the range of 3.25 to 3.75 lakh units. On revenue front, revenue growth is seen. It might decline up to 7%, or it may see a growth of almost 4%. So overall, after a sequential improvement in the earnings, main reason why the stock is rising is on the back of healthy guidance that company has given for FY26.
All right, Sudarshan, thanks a lot for that. Of course, Ola Electric, possibly the stock of the afternoon now, 16% higher on that stock. Now, the Maharashtra State Transport Department has flagged concerns over the operations of Ola Electric stores in the state, revealing that around 350 outlets are functioning without proper permissions or licenses. The commissioner told CNBC-TV18 about the complaints received on 350 Ola Electric stores operating without a proper permission and licenses. The officials confirmed that action has already been taken against some of these stores. The department has now directed Ola to apply for the necessary licenses and permissions required to continue operations. Now, operations at these stores will only be permitted once the company secures the relevant approvals, and authorities are expecting a formal report and response from Ola Electric by the end of the day. Vamakshi.
Well, moving on then, Jane Street has deposited 4,843 crore rupees with SEBI given a lien on that account. The SEBI order of July 3 said in para 62.22 that once the money was paid, the restrictions placed on Jane Street in para 62 would end. What are those restrictions? We now have Lata joining in with more details. Over to you, Lata.
Well, the entire punishment and restrictions are contained in para 62 of SEBI's order of July 3rd. 62.1 said that they have to pay 4,843 crore rupees in an escrow account and give SEBI a lien on it, which was done. And the next line says that places the restrictions until they pay that money. 62.12 or so says that all the restrictions will go once the money comes in. That is 62.1 is met. Now, what are the restrictions? It says that Jane Street cannot, the Jane Street Group entities cannot access the securities market, and others like banks, custodians and registrar transfer agents also cannot do any debits for Jane Street. Any credits, if they are paying in money, that of course would be allowed. Of course, Jane Street was allowed to meet obligations which were done prior to the July 3rd order. For that, they could use the bank accounts, but nothing thereafter was allowed. Now, according to this order 62, order number 62, they can, all these restrictions on banks, registrar and trading agents and Jane Street itself accessing will go away. In fact, Jane Street, while giving the money, had requested that these conditions be removed. And SEBI also in its press release says that the request from Jane Street is under examination. Sources tell me that they will pass a confirmatory order. Yes, money received and all these restrictions removed. However, I must invite you to the last point in this para 62 of the order, which says that the entities shall cease and desist from directly or indirectly engaging in any fraudulent, manipulative or unfair trade practices or undertaking any activity that may be in breach of the existing regulations. This is not part of what is removed. This is, a separate line in para 62. So it looks like even when they are allowed to access the markets, they will not be allowed to do what they were, what SEBI has accused them in the order. So their activities will automatically be restricted.
Interesting developments. We'll see how they unfold now as they have deposited that money. But Lata, stay with us because the bigger trigger for the evening is going to be the June headline CPI number, which is likely to dip further to 2.3%, hitting its lowest level since January of 2019. Tell us more on that front.
Well, the CPI is June CPI is expected, according to the CNBC-TV18 poll, to come in at 2.3%, which is lower than the 2.8 in May, and of course, much lower than the 5.08% that was a year ago in June. Now, this is important because this is a 6.5-year low, if it really comes as low as that, and the lowest point since January of 2019. Now, if you look at the food and the core sector, there again, cereals, pulses, fruit have all been bringing down the food inflation. So the expectation is that the food inflation will be something like, 0.1% only higher. That is according to the CNBC-TV18 poll. As you can see, 0.1% is the estimate compared to a 1% rise in May. So that much it falls. Core sector is expected to rise by 4.4%. In May, it was 4.2%, and a year ago, it was 3.1%. Now, I just want to invite you to the WPI numbers. The wholesale price index has come in negative, deflation, minus 0.13 for the month of May. Now, that is because food has fallen more than expected. So there's a chance that CPI comes in even below 2.3%. And even if it comes at 2.3, then the average for April-June quarter works out to 2.75. It can even be 2.7 if it comes below 2.3 in June. In that case, it is below the Reserve Bank's own forecast of 2.9 for this quarter, April, May, June. Then the bond market will start speculating that is there one more cut. Maybe it will not come in August because they have just moved from, neutral, accommodative to neutral, but the market will start pricing in a cut.
Thanks for that, Lata. Interesting data out there here on the CPI data. But let's take a short break then. More news and updates follow on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC-TV18. Let's take a look at the news now from the conflict in Ukraine. Even as peace between the two warring sides looks elusive, the US has announced that it will send Patriot air defense missiles to Ukraine. While Trump declined to say how many Patriots he plans to send to Ukraine, he added that the cost will be reimbursed by the European Union. Ukraine's President Volodymyr Zelensky has been asking for more defensive capabilities to fend off missile attacks from Russia. Listen in to what Trump had to say.
I haven't agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it, but we will send it. It'll be business for us, and we will send them Patriots, which they desperately need, because Putin really surprised a lot of people. He talks nice, and then he bombs everybody in the evening. So there's a little bit of a problem there. I don't like it.
Taking cue from that, all eyes will be on the President Donald Trump later this evening, as he had teased a major statement that he plans to make on Russia on Monday. So it'll be interesting to see what is the kind of statement that he makes. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now, BASF has cut its global guidance due to slower growth, led by some headwinds that the company is facing due to the Donald Trump-related tariffs. Sonal is joining in with more details on this. Sonal.
Oh, well, yes, BASF, it's a chemicals giant. So when they talk about any uncertainty, the industry has to listen. Now, the Germany player, they have come out with their results. This is for the quarter gone by, that is 30th June 2025. This is the second quarter of this calendar year for them. They say the revenues are down 2.1%, which is coming at 15.77 billion euros. Revenues declined due to negative currency effects and lower prices as well. The EBITDA is down around 10% on a YOY basis for the company at 1.77 billion euros. In their outlook specifically, they have spoken about weaker economic growth, geopolitical risk and strong product availability. They have cut their full year expectations of their EBITDA number. Now they have cut their EBITDA by 8% to 7.3 to 7.7 billion euros versus 8 to 8.5 billion euros earlier. They are looking at slower global growth due to the US tariff announced and the resulting uncertainties in the market. Now remember, they are one of the biggest players globally. So if they are talking about any uncertainties with respect to pricing, with respect to demand, this is something that the industry has to take seriously and something that we'll be watching out for in the chemicals results this time around for our own listed universe as well.
Thanks for that, Sonal. BASF Global has cut its guidance, but let's also get you some updates on the investigation into the Air India plane crash. Madhya is here with more details. Madhya?
Well, we are learning that the aviation regulator, the DGCA, is actively reviewing the safety design of the fuel control switches of the Boeing 787 Dreamliners. It is likely to pass an order in the coming days mandating inspections of the fuel switch locking mechanism across all Boeing 787 aircraft operated by Indian carriers. Foreign carriers like Etihad have already started this exercise by issuing internal advisories to replace the entire thrust console module of the Boeing 787s if the fuel switches move forward or backward without proper manual lift. Now, why fixing the fuel switches is important? Because the AAIB report revealed that both fuel switches on the ill-fated flight AI-171 moved from run to cutoff, effectively shutting off thrust to both engines during the climb. One pilot asked the other, did he cut off and why did he cut off? And the other pilot said he didn't. 10 seconds later, both switches were turned back to run, but it was too late and the second engine could not recover in time. The pilots issued a mayday distress call, but the aircraft crashed just beyond the airport perimeter. Now, what the preliminary report findings don't clarify is, did the pilots deliberately move the switches or did they shift due to a mechanical fault? Which pilot asked the question about cutoff, the one flying or the one monitoring pilot? Why was the landing gear never retracted during takeoff? Was it a pilot oversight or were they distracted by a system failure already underway? The preliminary report has opened a debate on how the switches moved, causing one of India's deadliest aviation disaster.
All right, Madhya, thank you for that update almost a month now after that disastrous air crash in Ahmedabad. But we take a leave on this edition of Business Lunch. From Amakshi, me and the team that put this show together, thank you for watching. We leave you with the Nifty down 100 points, mid-cap radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Good afternoon, Vivek. Well, it's a Monday where we are seeing cuts come through continuously. Friday, we went below that 25,200 mark. We are very close to the 25,000 mark right now. Across the board, it's a red, barring the mid-cap index.
That's right, and aptly named, it's mid-cap radar, so that particular index continues to hold out in the green. But we have a lot lined up on the show, an important management conversation as well. So let's start off with the top headlines. US President Donald Trump spooked the street by announcing a 30% tariff on EU and Mexico over the weekend. IT and financials drag, while realty, pharma and healthcare eke out gains. Mid-caps buck the trend.
After multiple SPE and Sacheti brothers signed to pick a 32% stake in VIP Industries, followed by an open offer, promoter Dilip Piramal tells CNBC-TV18 an ownership change was needed to put the business on track and that he'll trim his residual holding from 20% to 8% in 5 years.
Ola Electric surges as earnings improve sequentially. The loss-making company also gives a very strong guidance for FY26, and that boosts sentiment.
AUSFB under pressure after Kotak Institutional Equities downgrades stock to sell and raises target to 700 rupees a share. They say that if macro environment turns favorable, bank can deliver healthy business growth ahead of peer banks.
NCC gains after winning a near 2,300 crore rupees MMRDA contract. The company bags an order for rolling stock telecommunication systems of Mumbai Metro Line 6.
Okay, those are the top headlines for the markets. We've been pointing out it's very close to that 25,000 mark. We'll have to see whether that important level is broken today or not. Still have 2 hours to trade. The mid-caps doing well, 0.5% higher on that index. And there are pockets which are doing really well. The pharma space, for instance, has been consistently outperforming today. Be it something like a Newland Labs, which is up 12%. You have Alembic Pharma, which is up 5%. Laurus Labs, Granules, Wockhardt, you name it. And that pharma stock is surging. And how? Of course, we'll get more details in a bit from Hormuz as well, but we did speak to Wockhardt today. We did see a lot of news updates come by in the entire pharma space. So it's about deals, it's about results, it's about news flow, a very, very heavy and busy day.
And tariffs on top of that as well. That's right. If you could just pull up the stock of IFCI, you saw some important flashes on your screen. The company is looking at consolidating its business segments, and there's going to be a merger of all of the holding finance companies within itself. And on the back of that, that stock is up almost 7%. But Hormaz has been waiting patiently by the wall. This is our special segment, Mid-Cap Movers. He's going to take us through all of the mid-caps that are moving around in the session.
Well, if there is someone who needs patience right now, it's the bulls, considering the fall that we are seeing in the markets. But of course, the broader markets are doing fairly well for themselves, and that could provide some bit of comfort if you shift your focus away from the benchmark screens. But we'll start off with some of the gainers then in the broader markets, considering they are the outperformers today. Look at Newland Laboratories, 12% higher on that stock. Every single pharma name, as Sonal was highlighting, doing well in today's session. Anand Rathi Wealth, after its earnings gains on Friday, is building on those, 9% higher here as well. Piramal Enterprises, although Piramal Group stocks doing well today, and Godfrey Phillips too at the highest point of the day, 6.5% higher on that stock as well. And some of the newsmakers in today's session, of course, Ola Electric has been hogging the limelight over the last couple of hours, 15% higher on very strong volumes. Wockhardt, of course, after exiting the US generics business, BSE with all the developments with regards to Jane Street, and Lakshmi Dental firms mentioned here because of a very strong initiation note from Motilal Oswal. Pharma stocks, as I just mentioned, we just highlighted a couple of them, but there are, look at the others. Laurus Labs is at a record high. Mankind Pharma is building on those gains. Torrent Pharma at the highest point of the day. Granules too trading with gains of around 4%. So it's a very, very healthy day for a lot of these pharma companies. Stocks on the volumes front, India Mart is up 5%. VPRPL, well, has given up most of those gains, still holding on to a 4% advance, but on very strong volumes. Sai Life Sciences and Graphite too seeing a good move in today's session, and stocks that are at a 52-week high in today's session. Take a look at Control Print, up 8% today. Cyrocare is at the highest point of the day, a very sharp spike in the last few minutes. Suven Life and Cartrade Technologies, the most underperforming IPO or until last year, is now an outperformer, 3.5% higher at a 52-week high. Back to you guys.
Okay, all right. Interesting names. Control Print, there is Cartrade Tech, some names that should be on your radar. Thank you, Hormuz, for joining in as always. always, it's a good time to get a technical check on the markets. Ruchit Jain from Motilal Oswal is joining us just for that. Ruchit, good afternoon. Thank you for joining in. There's a wee bit recovery on the Nifty, but that's what we've been seeing, the recovery getting sold into. Do you think that is a trend that could continue? What is the important level on the Nifty right now?
Yeah, hi, very good afternoon. Well, in last 1.5 weeks, we have seen some correction from the highs in the index as well as the broader markets. Generally, when the corrections are there within an uptrend, we either see some time-wise correction or a price-wise correction phase. And 40-day exponential moving average usually acts as a good support in case if it's just a time-wise correction phase. Now, I think post this correction, we are trading right now near that average, which is in around 25,000 to 24,900. And along with that average, there is also a rising trendline support of the recent up move that we have seen. So we are seeing that 25,000 to 24,900 is a very crucial support zone. And if this remains intact, then probably market should resume the up move after some 2 or 3 days of consolidation around these levels only. But only if 24,900 is breached, then we will expect some more price-wise corrective phase. Otherwise, I think the risk-reward ratio is favorable to take some contra call over here on the index and keep a stop loss below 24,900 for an up move again towards 25,300 to 350.
Ruchit, any individual stocks for the day? Any buy or sell calls?
Yeah, a couple of names we are looking at. One is the pharma space. The Nifty Pharma Index has been one of the underperformers if you look at last 3 months of markets up move. But today the Nifty Pharma Index is showing a breakout from this entire consolidation phase. So we believe that the risk-reward ratio is favorable because this is one sector which has not yet shown any up move over last few months, and now it's giving a breakout. So within this basket, Biocon is one stock which technically is looking good. A gradual high top, high bottom structure has recently been formed. Price volume action is positive. So at current levels, short-term traders can go long on Biocon with stop loss below 367 or potential target somewhere around 400 to 405. And Ultratech Cement is another stock which we are quite positive on. It has recently given a breakout of after about 1 year of consolidation phase. So 12,200, 12,100 was acting as a resistance since last 1 year, which has been broken. And even in this falling market, now the stock prices are not correcting below that level. So clear signs that we should see a resumption of the positive trend from here on. So we can be keeping stock below 12,100. One can go long on Ultratech Cement as well for potential short-term targets around 13,200.
Okay, all right. Thank you so much, Ruchit, for joining in. So those are some technical picks coming in. With that, we'll slip into a break. But remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned in to Midcap Radar on CNBC TV 18. The hotel sector is in focus. Q1 did see some disruptions, but what's the outlook going forward? Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels, is joining us for a conversation. Mr. Keswani, good afternoon. Thank you so much for joining in. Before I speak to you about what happened in Q1 or what the outlook is going forward, can you talk to us about what's happening with the company? The stock has been buzzing lately. In the past, you've spoken of an alternate structure as well in terms of asset structure. Is something brewing? Are you looking at an alternate asset structure? Any change in corporate structures? Demerging any of your assets?
Good afternoon. Well, that is certainly one of the options we are looking at. What I think I have said in the past is that we are going to basically have, we already have an asset company in a joint venture with a Dutch pension fund, and our intent is to list it. Now, the way we list it is actually what is under discussion. Will it be an IPO, and in which form? That is something I cannot comment on right now, but it is under discussion, and we're very clear we want to do it as quickly as possible.
So is there a timeline to that? Do you think it'll happen in this calendar year or maybe this financial year?
No, I said it would be by the end of next year. So we are still sticking to that. It could happen earlier, but broadly in the next 18 to 21 months, this company should list, and I think it'll have a very successful listing.
Mr. Keswani.
Yeah, please.
Yeah. So I understand, you're talking about Fleur Hotels, where you've mentioned the possibility of an IPO. You expect to complete that particular transaction by the end of FY27. What's in it as far as the shareholders of Lemon Tree are concerned? What is the holding of Lemon Tree in that particular company? And what will be I believe, that particular transaction will be to reduce debt. So what will be the debt pre and post that particular IPO?
See, our debt is not so high now. It is... our debt to EBITDA is less than 2.5. And by next year, anyway, it will be less than 1.5, closer to 1. So the intent is not only to reduce debt, which will happen automatically. The intent is also to split the company into an asset-heavy side, which attracts a certain type of investor, and a high-growth management/brand/technology side, which is where Lemon Tree is. Why are we doing this? Is basically because return on capital obviously is enormously higher in the asset-light side of the business, but it needs large scale in order to be chunky. So we want to focus on ownership/development of assets in Fleur, and management and, as I said, brand in Lemon Tree. How will it benefit Lemon Tree shareholders? Well, depends on the structure of how we list Fleur. But as I have said before, we are certainly looking at a way to significantly reward shareholders of Lemon Tree in this, because we currently own about 60% of this joint venture, and we intend to become deconsolidated, which is our shareholding should drop below 50% in this company. And obviously, how we reward shareholders is also part of this entire discussion.
Got that point. So this is something which is developing. So once there is more finality or more agreements to whatever you're looking at doing with this asset structure, we'll have another conversation. Mr. Keswani, about the business right now, there is a note from Lara today. They spoke about some one-offs that Q1 saw because of a lot of geopolitical risks. Did Lemon Tree see disruptions because of that? What was the occupancy like? And also, because of disruptions, did we see any change in pricing?
As I've said, I'm pretty happy with how we performed in Q1. I don't want to comment more than that. It is very much in line with what we expected. Yes, there was a disruption because of the near war or war. There was a disruption because of COVID. There was a lot of news articles that COVID was coming back. So there have been multiple small disruptors. But overall, as I said, we've done as well as I was hoping we would do in Q1. There is, I think, going forward, we are waiting for really H2, which is when we significantly reprice. I read in your thing that Amritsar saw a contraction in hotel rates. Well, a lot of city saw a contraction in rates because of that temporary disruption. But I think things are coming back to normal, and Q2 should be as we expect, and H2 will be very, very good. That I think I can already sense.
Okay, so recovery in Q2 and H2 is expected to be strong. That's what we take away. The other important question is, going forward, how do you split growth? Number one, between the RevPAR, the management fees, as well as new openings, because that is something that the street wants to know.
See, we are growing very, very rapidly. So if you look at Q1, we signed 1,350 rooms, 15 hotels, most importantly in 6 new cities. We opened about 400 rooms with 5 hotels, and one of that was in a new city. In July alone, we will sign another 10 hotels, and in 8 new cities, 800 rooms. So the way I see it is, growth is in the asset-light business is not chunky in EBITDA, because basically every time you manage, say, 7 rooms, you really get, or 6 rooms, you really get the EBITDA of only 1 room. That is your share of the fees. So obviously, for it to be significant, you have to add a very large number of rooms when you compare it to an asset-heavy side of the business. For example, we will sign 800 rooms in July. That would be like, when these hotels operationalize, that would be like opening a 120-room hotel. Because that is our share of the EBITDA. What's our perspective? See, broadly, if you look at India's personal consumption expenditure, which is about 62% of GDP, about 40% is staples and 22% is discretionary. And most of that discretionary consumption occurs in the top 200 cities of India, which have a population of 5 lakhs or more. So we are very clear, we want to be in all these 200 cities. What we track most closely are which are the cities which are growing very fast, have better connectivity based on airports, airlines, roads, and Vande Bharat. And we want a presence there because it has an impact onto our entire network. And that's what we really track.
Okay. We take that point. Such insightful comments coming in from you and more understanding of the industry as well. We have completely run out of time, Mr. Keswani, but we'll have a conversation again after your Q1 numbers. You did speak about a blip in Q1, but Q2 will be strong. And you spoke about addition of keys and hotels as well. That's the word coming in from Lemon Tree Hotels. For now, we'll slip into a break. More on the markets on the other side. Stay tuned for that.
Welcome back to Mid-Cap Radar. Well, a very important development over the weekend. The government has gone ahead and eased FGD norms for power plants. What does it mean for the power sector, industrial companies and capital goods? Vamakshi joins in with more details.
Well, Vivek, important point coming in out there. What has actually happened is that the Union Ministry of Environment, Forest and Climate Change has issued a notification on July 12th. Now, largely what this notification says is that thermal power plants outside a 10-kilometer radius of cities with a population of 1 million plus would be exempted from installing FGD systems, which is the flue gas desulfurization system. Now, keep in mind that such plants which have been exempted account for almost 79% of the overall operational power plants in the country. So it's a huge number. But what about the remaining 11%? Well, the notification mandates that for plants that are within the 10-kilometer radius, the mandate will be looked at on a case-to-case basis. As far as plants in cities like NCR are concerned, cities with at least 1 million population, they need to comply with the mandate, and they will be required to install FGDs by December 2027. So this overall development has negative implications for some of the industrial players like HCL, Thermax, L&T through its arm L&T Power, ICEJEC Heavy Engineering, Techno Electric, GE Power, PowerMech. Of course, the impact on all of these various companies will vary depending on how involved they are. But it's a negative impact because number one, it leads to shrinkage in the addressable market, and number two, it raises questions on the execution of the current order backlog. Now, Thermax in the quarter four con call had also highlighted that they did have an FGD order book worth almost 467 crores, of which nearly 350 crores was expected to be liquidated in FY26. They have been highlighting the problems that the industry had been facing, and they have said that the FGD space has become messy, projects are not happening, and they had also said that FGD has been a bloodbath for everyone. As far as Techno Electric is concerned, their order backlog for FGDs stood at 1,450 crores, and they had highlighted in their earlier con call that they were targeting almost 500 crores of revenues from this particular segment as compared to the whole year guidance of almost 3,500 crores. This is overall for the company. So this is definitely a negative for some of these industrial stocks.
Oh yes, they had been talking about how big an opportunity this could be for these companies. Thank you so much, Vamakshi, for putting into perspective what this means and which companies would be impacted as well. But on that note, we'll do one thing. We'll take your leave on Mid-Cap Radar. When we come back, your stocks will be here with your queries.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, markets, broader end of the markets is doing well. Benchmark is not doing as well as we were expecting. So yes, what we're seeing in terms of the benchmark indices, Nifty is just managing to hold on to the 25,000 mark as of now. And like you can see at the top of the screen over there as well, we're seeing the mid cap that's managing to do well. Banks is also not managing to hold on to gains today, down 0.2%. While in terms of IT, that's also among the top sectoral loser today. So watch out for Nifty IT as well. Now, obviously, some of these individual stocks that I would just like to mark right now is IFCI. That is an important one that we're keeping an eye out on. There was a news flow that came in also in today's trading session as well, where the board has approved consolidation plan at group level, including some key subsidiaries as well. So because of that, we are seeing IFCI that is in focus as of now. In the last hour also specifically, we saw that spike up, then came off the day's highest point. Other than that, what we are watching out for in terms of top gainers, Ola Electric on the back of its numbers, Newland Labs, Mankind Pharma, Laurus Labs, Pharma, that's doing well. That's continuing to do well in the last few trading sessions as well, and that is what we are seeing today. So Pharma is among the top sectoral gainers, and other than that, we have a Realty that is a top sectoral gainer as well. And like I mentioned, IT banks, that's not managing to do well, and that's where we're seeing a bit of a fall coming in terms of the trading session. But yes, that's how the market setup is looking like. But this is a show where we solve all your stock related queries, and as always, we have our experts joining in with us. We have Gaurang Shah, Senior Vice President at Geojit Financial Services, joining in with us as of now. Gaurang, good afternoon. Thank you so much for joining in with us. You know, now earnings season is here, so we have a lot more news or a lot more moves that will be coming on the back of earnings. But let's start with the first query for today. This is actually an investment query that we have for today. Sandeep is writing to us from Bangalore. He has an investment query on power stocks and is asking, out of Adani Green Energy, Tata Power, Suzlon Energy, which of the stocks can give good returns? They've not mentioned a time period, so I'm going to be assuming it's an investment or long-term query. Power stocks, what should they be investing in, and which is looking as a better bet?
Thank you so much for having me on this program, Vinny. Good afternoon to you and to all the viewers of CNBC-TV18. A small disclosure before I go into details. All recommendations are a part of our research team views. Our company, Geojit, or we do not have any personal investments or any financial interest, nor there is any other kind of conflict of interest. But we give recommendations on similar lines to our clients. They might have their investment interest over there. Now, coming to the entire power sector. So, Vinny, I think the entire power universe or the power sector looks quite promising, given the government's policies and the new power generating capacities that is likely to come up in the next 3 to 5 years. A large part of that, more than 70-75%, is going to be clean and green, that is wind and solar. Along with that, this year in the budget, the Honorable Finance Minister also spoke about nuclear energy, which is going to be a major game changer as we go into the future. We like companies in power generation, we like companies in power distribution, and we like companies in power equipment manufacturing companies. Specifically about power generation, Tata Power, NTPC, Suzlon, which is, of course, green energy producer, wind energy. We're positive on JSW Energy and Torrent Power. These are the stocks that we are positive in. My sense, Vinny, is that every year the power consumption is going up. We need to have more power generating capacities coming up, which is likely to throw in a little bit of more positivity. And of course, you know, a couple of years back, when you remember, there used to be power theft. Now with smart meters replacing the old meters, that has also become a thing of the past. So power sector looks very promising.
Okay, power sector looks very promising. Keeping an eye out on those names you mentioned over there. We also have Ashish Kayal now joining in with us on the show. Ashish, good afternoon. And power sector, what's your view coming in? The viewer is asking specifically Tata Green Energy, Adani Green Energy, I beg your pardon, Tata Power, as well as Suzlon Energy. Which would be a better bet for them?
Hi, afternoon to you and all the viewers. If you look at the overall sector, I think the sector should outperform from here on. Very clearly, we can see that. Adani Green has unfortunately not shown any kind of a strong upside momentum over the past many months now. And if you look at Tata Power, that is much better placed. So Tata Power and Suzlon looks to be much better placed compared to Adani Green at this point of time. And Tata Power, we can expect a move on the upside towards the level of around 440, 450. On the downside, the support for the stock is around 375 levels. Suzlon has been consolidating over past few weeks, and I think the stock has shown a very strong rise from the lows of around 50, managed to make a high of around 74, consolidating now from there. And I think there is a possibility we should resume an upside journey in Suzlon as well. The target for Suzlon can be around 80 levels, and on the downside, one can maintain a stop loss for the stock at around 62.
Okay, keep an eye out on those levels over there, and which Ashish has mentioned right now. Let's move on to the next query for today. Electra Green Tech. Now, this is coming from Venish Gupta, who's writing to us from Jammu, holding 200 shares of Electra Green Tech. This is at a price of 1,200 rupees per share. So right now, also the stock is trading around that buy price. He's asking whether he should hold the stock or look to sell at the current levels and just get out of the stock. Electra Green Tech. Gaurang, what's your view?
First of all, the acquisition price is very attractive, 1,200. This company manufactures EVs, commercial EVs. As we all know, there was an issue with respect to China supply of rare earth minerals and magnets, which is a very crucial component which goes into manufacturing an EV. Government is working on resolving the issues. I think some representatives were in China for discussion, and we are also talking to the third country also for our requirements as far as rare earth minerals and magnets are concerned. If you're from a long-term point of view, I would first of all say our research team has an accumulate stance, so you can hold on to it. Your acquisition price is very attractive, and the resolution looks to be coming sooner rather than later as far as supply of rare earth minerals and magnets are concerned. So don't rush into any kind of hasty decisions, just in case if your investment in Electra Green Tech is from a long-term point.
Okay, that's a view coming in there on the fundamentals front. Don't rush into anything. Next, Ashish, actually on the technical front as well. Electra Green Tech, right? At one point of time, you had that in somewhere in 2023 to 2024 approximately. So that very, very sharp run up coming in for the stock, right? And then post that, some bit of that correction, consolidation, obviously merits it given that the run up was such a sharp run up. But now what should they be doing? They bought it at 1,200 currently. On the technical front, should they continue to hold?
Yes, Vinny, if you look at it, we clearly see the stock went all the way on the upside, made a high of around 2,200 levels. It's nearly 50% down from there, and it's now not showing any kind of momentum also. So I would suggest that if he is holding Electra Green Tech, you need to hold on for a bit longer period, maybe a year or more, because over short term there are no signs of positive momentum either. On the downside, the support for the stock is around 1,140 levels. And on the upside, the stock needs to break above that resistance of 1320. It has struggled miserably from there multiple times. So 1320 needs to be taken out. Once that is taken out, then we can expect a momentum towards the level of 1,400 or 1,500 on the upside. So as of now, hold on, extend your time horizon to at least a year, and let's see if 1320 gets taken out.
Okay, hold on. They shouldn't average or anything like that also right now, or add more, right?
Absolutely, absolutely. Avoid averaging, avoid buying more at these levels. We have.
Okay. Okay, so wait out for those levels over there that, Ashish is also mentioning. Let's move on to the next query for today. This is coming in from Ramakrishnan, who's writing to us from Bangalore, holding 80 shares of Eternal, previously known as Zomato, at a price of 200 rupees per share, making a profit on this one. Wants to know the outlook on the stock. Gaurang, your view for Eternal. What are we watching out for? Eternally buzzing away in trade is what we should be expecting now?
Eternal competition is on the horizon, Vinny. Yeah. Good for consumers like you and me, and of course my good friend Ashish, who normally views these platforms. But the fact still remains, Vinny, that this is one of the established players in the e-commerce sector. There are near-term headwinds. We all know about Zapto. IPO was lined up, then it was pulled back. There are news of 2 or 3 bigger known names coming into the e-commerce sector with competition. But established players like Eternal, that is Zomato and Swiggy, should not have much difficulty, Specifically with Eternal, our research team has a positive coverage from a long-term point of view. They are running towards opening up of 2,000 dark stores by the end of December 25, which was the target earlier was December 26. I think this dark store addition, along with penetration into areas where there is no visibility, will help them get larger client base and a larger pie of the market share.
Okay, that's interesting. So keep your investments in Eternal on the fundamental front. Technicals also, is that the view coming in, Ashish?
Yes, absolutely. We need one more interesting thing that I want to point out technically. From the 200 levels, the stock started moving up. And if you look at the weekly chart, for around 13 weeks, already it has not given a single weekly close below prior weekly low, which means the trend has been very good despite of everything that we have seen in the markets. But this stock has protected prior weekly low on closing basis. So that keeps the trend intact. I think the stock should be headed towards on the upside near 320 levels. And even today, it's up nearly more than 3% already. So the momentum is there. It's picking up. It has given, again, a fresh breakout. We can expect 320 as the target on the upside. On the downside, the immediate support for the stock is at 250.
Okay, so we're seeing good returns coming in as of now as well, and expected to see a run-up coming in. Interesting data point coming in over there from Ashish as well. So keep an eye on those levels over there for Zomato or Eternal as we know it. Next query for today, Ashish, we have Neil Deshpande who's writing to us from Mumbai. 300 shares of SJVN and price is 150 rupees, and 200 shares of Finolex Industries price is 296 rupees per share. So for SJVN, they are making a loss, and even on Finolex Industries, they're making a loss. Ashish, what should they be doing? Should they continue to hold, sell, average? What's the bet on both these stocks?
If you look at SJVN, the stock has underperformed, definitely. But right now, I think there is a possibility of a upside breakout to come in. If you look at past 6-7 days of movement, it is moving in a very narrow range. Looks like the volumes have dried out. So it's looking for some kind of a trigger. And I think that should be on the positive side. So I'm continue to hold on with SJVN. The buy price is pretty high. But as of now, I think the stock can move towards the level of 115 on the upside. On the downside, the support for the stock is around 93, which is very crucial support. So hold on SJVN. As far as Finolex industry is concerned, I think the stock is quoting somewhere around 204 levels as of now. And from here, we can expect a positive traction to come in also into this stock. Overall, the support for the stock on the downside as per price action is 190. So as long as 190 is intact, there is a positive possibilities, and we can see the stock again towards the level of 240. So hold on to Finolex Industries as well right now.
Okay, hold on to both these stocks right now. That's the view coming in there. But on that note, we're going to sip into a very short break. But here's a reminder for your viewers. Tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, as well as economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC TV18. We still have our experts with us, Ashish Kayal as well as Gaurang Shah. Let's move on to the next query, gentlemen. This is coming from Ritesh Kapoor, who's writing to us from New Delhi. He's holding 70 shares of Tata Motors. Is at a price of 400 rupees per share. He's asking whether to remain invested. And he adds if there is any threat from Tesla entering India as well. That's the new one that is coming in here in terms of competition. But Gaurang, your view coming in for Tata Motors. What is the view? What should they be doing? They're making a profit on this one.
Well, definitely making profit, Vinny. And if I'm not mistaken, I stand to be corrected if I'm wrong over here. If he's bought it at 400, I'm sure he would have seen a price of 1100 also. I think that's what Tata Motor made somewhere around all-time new high. And then from those levels, it has retraced 50%. Having said that, our research team has a whole recommendation. Competition is a good thing because that will keep companies on their knees and will make them deliver better products. Tesla competition, well, I think Indian counterparts have made decent products with respect to EV, PV, passenger vehicle, EV passenger vehicles. Enough market share. Tesla needs to prove its worth. And as we all know, Indian consumers with respect to passenger vehicles, whether it is conventional ICE driven engine or whether it is the new age electric vehicle or whether it is going to be a futuristic green hydrogen vehicle, they are very sensitive with respect to the cost economics. And my sense is that will take a while. So as of now, we don't see any great threat. Continue holding Tata Motors. Your investment is as a very safe zone at rupees 400. I think risk reward is favorable.
This reward is favorable. And just, a few days back, those JLR Q1 update reports had also come in, where sales numbers also look decent. Even Morgan Stanley had highlighted a strong mix is something that is helping the company as well. So, they are making strides even in those EV side as well. Ashish, on the technical front as well, right? Even Gaurang highlighted it. The viewers holding it from 400 has seen those 1100 levels. Now it's back to 600. So what are they watching out for here now? Are we expecting a run up in the recent times or it's going to be slow and steady up move?
See, if you look at the chart patterns on Tata Motors over the past entire 2025, it has formed an inverted head and shoulder pattern. That's more like an accumulation pattern, a bottoming pattern, and it should give a breakout on the upside. The neckline is placed around 740, but I think the overall undertone should be on the buy side. So continue to hold on. I don't see any kind of headwinds here. The stock has been doing well over the past few months. And we can expect a breakout on the upside above that 740 levels. And the stock can even head back to 900 and possibly to 1100 levels. Having said that, we do have holding on Tata Motors. So I would want it to see the 1100 levels again on the stock. The overall undertone is positive as long as on the downside, the support for the stock, which is at 600, continues to hold.
Okay, keep an eye out on those levels over there for Tata Motors. Next query for today, this is coming from KS Rao, who is writing to us from Andhra Pradesh, holding 55 shares of Go Digit General Insurance. This is at a price of 270 rupees per share. Overall, wants to understand the prospects of the company. He is making a profit. Ashish, what's your view here?
Go Digit, which is currently quoting at around 350. If you look at it, the stock formed a higher high, higher low. As per Dow theory, the overall tone has turned on the positive side. And on the downside, the support for the stock is going to be around 330 levels. So as long as 330 is intact, we can expect the stock to reach towards the level of 375, 380 on the upside. Having said that, the volumes have been little erratic and the candle formations have been with spikes. So trade cautiously with the target of 380 and maintain a strict stop loss of around 330 levels.
Okay, keeping an eye on that. Just marking the flashes at the bottom of your screen as well. BSNL and MTNL asset monetization, something on that front has come in, where we're seeing that the government has actually opened non-auction route for central government organizations to acquire MTNL, BSNL assets at market rate. And that is something that will be decided on certain factors that are mentioned over there as well. Now, the committee of secretaries headed by the cabinet secretary have cleared the transfer of MTNL, BSNL as well as ITI assets to central government or central government organizations as well. So on that note, let's just keep an eye out on MTNL, BSNL, ITI. These companies are something that we'll watch out for, given this is coming as an announcement right now. Next query for today, let's move on to that then. We have Alan, who's writing to us from Kerala. He's holding 70 shares of Hindustan Zinc. This is at an average price of 493 rupees per share. He wants to know the outlook of the stock, considering there are trade tensions that are going on, India, US. How should one be viewing the stock? Gaurang, your view coming in for Hindustan Zinc.
So, Vinny, we have a whole recommendation on Hindustan Zinc, but just to give a little bit of more clarity to Alan, have a little bit of longish time horizon, because the entire metal pack is going through a little bit of rough patch in terms of global news flow, whether it is to do with tariff from US or whether it is to do with the economic situation in China. And China news flows is more, it creates a more volatility on the entire metal pack. But given the domestic outlook, consumption, we expect the consumptions in the domestic market to stay very, very robust. If you're a long-term investor, you need to hold on to it. Just in case if you have investable amount, then not at current levels, but at lower levels, since your current investment is at a little bit elevated zone. If you get lower levels, I believe Ashish might be able to help. Somewhere close to about 400, it will be a zone to accumulate more to bring down your acquisition price.
Okay. Let's watch out for that levels over there as well. Can accumulate at lower levels right now. That is also a possibility, but hold it for some bit of a time. Don't be in a rush to sell it. That's a word coming in from Gaurang as well. Ashish, your view on the technical front, what are the levels that one could watch out for? Maybe an accumulate level also, if you could give us.
See, the levels that Gaurang mentioned is bang on, because 400 is the level from where the stock has managed to bounce back multiple times in the past also. So 410 can be the zone where he can look forward to accumulate more of the stock. As of now, over short term, over past 3-4 days, it's showing some kind of a recovery on the upside. Maybe we can head towards the level of around 460, 470 over the near term. But yes, the time horizon has to be extended for a bigger, longer term upside move. And any kind of dip towards 400, 410, use that as an accumulation. On the downside, it should not break below 375 levels, because that's a very important support. So 375 can be the stop loss. On the upside, the stock can head towards 475 levels.
Okay, 375 is the stop loss. 400 is maybe something that you could look at that level, maybe to average out as well, given that your buying price is higher. So that is the query coming in on Hindustan Zinc, and that was the last query. So Ashish as well as Gaurang, thank you so much for joining in with us as always and helping our viewers solve all their stock-related doubts. And viewers, thank you so much for tuning in. As always, keep sending us your queries. You have the email ID flashing at the top of your screens for you all as well. But the last 1 hour of trade is still left, and to take you through all of that, you have closing bell up next.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Japanese markets for now are down almost 0.4%.
The 40-day exponential moving average, which is 25,018. So 25,150 on the Nifty, 82,500 on the Sensex.
The main thing is for investors to have very moderate expectations from equities.
Historically, we have grown at a CAGR of about 24%.
It lists at a bit of a premium in comparison to what the IPO price is.
Bank Nifty is down, but not as much as Nifty is currently.
Revenue front, it's seeing a decline of 7% or growth of 4%.
The last 2 years, the share price has been going down. So now I was very insecure that we are a downward vertical spiral, you know.
The market was not expecting a deflation at all.
It's very close to that 25,000 mark. We'll have to see whether that important level is broken today or not.
Okay, that is the day so far, and it has been sideways from the word go. No real bounce or anything of that sort. From the lows, yeah, maybe a little bit, but otherwise, it's been down. Broader market is another story entirely. Mid and small cap indices are up between 0.5% and 0.6, 0.7%. So divergent kind of screen out there. Lots to talk about in the next 60 minutes. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, afternoon.
Hi, we would have been a little better if it wasn't for the continued decline in IT stocks. The Nifty IT index is down 1.5%. Other than that, there are no big losers.
Well, that's right. You know, I think we're down close to around 80 to 100 points of majority of the trading session. But you will not still be too worried, you know, the lower levels to protect out. And as you all said, there are plenty of themes that are playing out here. VIP is higher. You have, various other stocks. Zee Entertainment is higher. Polycab is higher. So there are a lot of stocks actually that would be making your portfolio look quite good, though the Nifty is down 100 points.
Oh, absolutely. And, even the breadth of the market, I don't think it's that bad. I mean, 1,300 up and almost there. I mean, so not very bad. It's just the IT, as Reema said, the IT index is down for the second day running. Infi, TCS are down 1.5%, 2% respectively, and that's basically the Nifty look a little bad. But just a couple of points sideways since morning. The pockets which are doing well, and I mean, you've got to count them. Real estate is doing well. I looked at pharma, but also healthcare. Hospital companies are doing well. Capital markets is another area which seems to be doing quite nicely. So, we'll talk about each of these, some of them as we go along. IT, a loser for the second day in a row. And of course, straight away supports Nifty 25,018. I think we're almost there. We're trading just over it. That's the 40-day exponential moving average level we put out in the morning as well. The Nifty Bank is the 40-day for the Nifty Bank is 56,097. As it trades right now, the Nifty Bank is around or just under the 20-day moving average. Remember, the Nifty broke the 20-day on Friday. The Mag Nifty did not, but I think it is doing that today. It's not down a lot or anything. It's just down about 0.25%, but that's doing it for the Nifty in terms of the that important sort of short-term moving average.
Well, just a quick run-through of the price action in large cap IT. 1.5%, 2% gone on most of the heavyweights. So TCS, Infosys, HCL Tech, Wipro, and Tech Mahindra all down more than 1% at LTI Mindtree. If you look at the ER&D companies, especially the ones which cater to, say, sectors like automotive, which have been hit, the question is, have they perhaps bottomed out in the near term? Look at the price action in Tata Elxsi or even at Tata Tech. Tata Tech reports numbers today. Tata Elxsi reported very weak numbers last week towards the end of the week, but those stocks are actually higher in trade. Tata Elxsi is now up close to about 1.5%, and Tata Tech too is managing a green tick. But in the mid-cap space, lots of big movers. You spoke about a few, but I think the stock of the day clearly is Ola Electric, 14% up.
Well, that's right. That's the big mover today. And even VIP, actually, the deal was announced at a sharp discount. The stock was down 5%. Now it's up 5% from the low. So that's seen a big recovery, actually. But let's focus on that name first up itself. In a confirmed news break, promoters of VIP Industries will sell 32% stake to consortium of Multiples PE and Mithun Sancheti at around 388 rupees a share. The management also joined us earlier today to discuss the sale. Mangalam joins in first up to tell us more about this deal. Mangalam.
Well, in the morning I had said that because there is a discount to the current market price for VIP, the stock would open lower, but thereafter the street would start looking at possible turnaround. Yes, the stock had rallied about 75% in the preceding 3 months, suspecting a deal like this. But now that the deal has happened, those initial, sell-on news moves have happened. Now the street is betting on the longer-term perspective where over the last 5 years or so, if you look at VIP and look at some of the other competitors, VIP has massively underperformed. So with the prospect of the business turning around, can there be better days ahead or not is what the street seems to be betting on right now. The promoters of VIP sold 32% stake to multiples private equity and a clutch of other investors who include the likes of Mithun Sacheti, etc. And apart from that, because of this deal, there has been a mandatory open offer at 388 rupees per share as well for another 26%. Remember, we spoke with Dilip Piramal and he said that it was imminent that he had to sell this company to a private equity player because there was a management crisis in the company over the last 5 years. At the same time, the second generation was not interested in professionally running the business. More importantly, a private equity player would come in and focus on scale, creating value and profitability at a time when there has been a loss of market share and the overall competitive scenario has changed a fair amount, and the stock too from its peak is about 40% away. So he thought, why not now than another time later? At the same time, he owns about 20% in the company with the decision to pare it down to 8% over the next few years. And he offhand also did say that Multiples intends to hold this business for the next 5 to 7 years, and typically PEs are looking for a multiple of investment anywhere between 2 to 3 times. So he's laid out threadbare what Multiples intends to do and what VIP needs to do to change and relive its old glory days.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value. There is a clause that as 20%, I'm still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
All right, that was Mr. Piramal then, giving us a rationale behind selling it and his plans as well with the stake going ahead. But let's get a technical check first on the stock and then, in fact, we'll get a fundamental view. Mitesh Thakkar is back with us. Mitesh, before we talk about the Nifty, what's the view on VIP? A stock that was 750 rupees or thereabouts, say a couple of years ago, 2 years ago, and then it went down to 250. At around 480, how's it looking?
So I think, Nigel, one, on the long-term charts, the correction is over. And getting past 460, 440 zone is a very positive sign. The first target is around 520. What I expect, what I'm looking at eventually is 560, 570 zones. So in the short to medium term, the trend is on the upside. So my idea is if somebody is holding the stock, just hold on. I think the stock is likely to head higher.
Okay. What about stocks and the index trade from here on?
See, on the index, I said that we've got into some kind of put spread, so there's vested interest. But yeah, the belief is that the view is slightly on the negative side. We might test about 24, 800, 850, 860 zones, and with that, shorting should be done on a pullback closer to about 25, 200, or make some put spreads, which is what could be a good trading strategy. On stock specific basis, I have one buy and one sell. Macrotech Developers in Lora is a buy with the stock at about 1390. Look for a target of around 1360 here. And a sell on Mazgaon Dock with a stop at about 3160 for targets of 3040.
Got that. We'll come back to you, Mitesh, to get in some more trading ideas. For now, let's turn our attention to the big story that we're tracking, the BSNL and MTNL asset monetization drive. Ashmit is joining in with the details. Ashmit?
Well, we're beginning to get glimpses of what this asset monetization drive may look like. To begin with, a committee of secretaries had been formed. It was headed by the cabinet secretary. What we understand is that they've opened up a non-auction route for other government ministries, government departments, and government agencies to acquire this land of BSNL, MTNL at market rates. This is the non-option route that has been contemplated. Under this route, interested departments, interested government organizations can express their interest on properties that they feel are lucrative for them, and then they can do so by going ahead and making a 2% earnest money deposit. But one thing is clear, that the decision that has been made makes it clear that this entire transaction, even if it happens will happen at arm's length between two government agencies. It'll happen at the market rate. The market rate this decision was arrived at was very clear. How will this market rate be determined? Well, for assets below 10 crores, it'll be MTNL, BSNL themselves who will assign a market value. For assets above 10 crore rupees, it'll be the CPWD that will arrive at the market value. And for assets north of 100 crore rupees, in those cases, the National Land Monetization Corp will be the one deciding the market rate, and this will be the rate at which the transaction will be done. Again, interested government parties can move ahead. They can make a 2% earnest money deposit of this market value and then can proceed with this transaction. What is important, however, is that there's a caveat. The caveat is that there is only a 90-day window within which the government agencies will have a right of first refusal. If there is no response coming in from the central government agencies, then after the completion of that 90-day period, those assets will be available for even non-government entities to participate. So that is something that MTNL, BSNL will have to look at. A two-stage process. First stage, the central government agencies will have the ROFR, will have the first cut at the pie. Back to you.
Thank you very much for that. Stocks are excited. Pull up that MTNL up 7%. ITI, monetization of their land infrastructure will help them raise money, cut their losses, bring down their debt. So looking up for the stocks. Dipan Mehta is now joining in. Dipan, any thoughts on this monetization roadmap? First, it's going to be the central bank entities which will be given an option to buy the infrastructure and the surplus land that many of these telcos are sitting on. Should they have directly opened up to private sector? I mean, I'm sure these stocks like MTNL and IT are not on the buying radar, which is why I'm not directly asking you on that. But your thoughts on the process followed. And is this prequel to a potential entire sale, a privatization?
Yeah, good afternoon, Nima, and thank you for having me on your show. I think it's a good move, and it's a non-controversial move because the minute you start selling assets to the private sector, whichever route you apply is going to cause controversy in our country. So I think let them try this particular route. I think it's the first time that the government is trying to, set up some process like this. And if it is successful, I think there are a lot of other public sector enterprises sitting on very rich real estate and other assets which can be monetized or used by other government departments or other PSUs. And only one needs to understand what is the real scope of value unlocking over here for MTNL and BSNL, and is it going to be significant? And also another aspect I think for MTNL should also consider is there going to be a merger with BSNL as well, because that would make the entity more viable, and certainly the funds that they can get from there, they can invest in the business. And whatever happens, I think BSNL or a third player or a fourth player from the government side is always going to be a reality in the telecom industry.
Rima, you remember you had an MTNL connection? A phone?
Yes.
Yeah.
Remember your number?
I remember. 26406161. Discontinued.
Good old days, right? I mean, Deepan, what about you?
Yeah, I remember all my telephone numbers, office, home.
You still have one? You still have a connection?
Yeah, of course. We all have connections at home and office. It's still required.
MTNL one?
MTNL, yes. But it's tough to get it fixed if it gets spoiled. But, we need to have these MTNL lines because sometimes the range doesn't get picked up in the office or at home.
Yeah. Do you remember the famous Jasbal Bhatti, back in the days used to come, right? There was a phone line flop show. with the lineman, the father trying to get his daughter married to a line to a MTNL employee, I think the phone department employee. And I try to show it to my kids, and they had no idea because they've never seen landlines, and that's the entire generation gap, right?
Not only that, Prashant, they don't know what it was to get a landline in the house. I mean, I grew up in the 70s, 80s, where landlines were a rarity. And it took a lot to get a landline. There was waiting of 5-10 years also. So to go from there to getting a SIM in your house or office is like a long, long way from where we were.
Absolutely. It used to be PCOs, and I mean, all that has disappeared, right? I mean, technology marches on.
And I'll tell you one thing, Prashant, while we are at this thing, that in our office and me personally, we are using so much of AI that I don't know where it's all going to lead to 5 years from now. We may think the internet and browsing and a whole host of activities which we are doing just now may just become completely redundant. So that's one big change happening, a big disruption happening in the entire workspace. I won't say technology, but the way people are working and interacting and getting their tasks done. So I don't know who's going to benefit from it big time, apart from NVIDIA, of course, but certainly it's going to add a lot of efficiency to organizations.
So you don't need as many people, perhaps, and you're hearing that, right? I mean, anecdotally, instances, etc., across industries, and you're absolutely right, Deepan. When we talk about if it's going to change, increase productivity levels massively across the board, I mean, AI, etc. Have you thought about where it kind of shows up in a big way as far as listed companies go here in India? IT is one, but that's, we spoke with TCS, for example, on Friday. They said productivity goes up, but they don't think pricing will get impacted. So they think they're not saying AI is deflationary. But anywhere else, you think it'll show up in a big way?
See, Prashant, I compare AI to what happened when internet suddenly started picking up, and we had so much of online transactions, online maintenance of accounts, online services, and we couldn't find a single winner over there per se, but all the companies benefited through improved productivity. And I think something similar is going to happen in AI. All that we can say is that the companies setting up data centers and manufacturing these servers, I think they're going to be the big winners over there. And one company, of course, we've spoken about E2E network, in which L&T has taken a stake, is bang in the middle of this particular investment theme. And of course, it's very expensive per se. But other than that, I think, if you want to buy a solid company bang in the middle of this AI investment theme, listed on the Bombay Stock Exchange or NSE, I think that's very difficult. Of course, there are bits and pieces being done by a lot of players, but no real single company like they have in US like NVIDIA, which is a complete play on AI.
But since AI is helping everyone across sectors do more with less, hiring is going to get impacted, whether it's for finance companies or even FMCG, etc. So is there a risk to, say, a company like InfoEdge, the Naukri business, or any of the staffing business at the lower end?
See, I don't think so. I think, empirically, we are seeing in our business, and when I speak to other entrepreneurs, there's a huge shortage of labor, in fact. I mean, look at what L&T is saying, what Kalpataru is saying, KEC is saying. There's a huge demand for skilled labor. Point number one. Point number two also, other than that also, I think across the board, whether it is in sales, marketing, or manufacturing, in back office jobs, there's a lot of demand in India. Companies are expanding. So I'm not too much concerned about job losses in India, because on the whole, the economy is expanding and the companies are expanding. There are so many startups also taking place within India. And so I'm not too much concerned about job losses at any particular corporate level. I think in India, who has announced job cuts because of AI? Nobody. And nobody had announced job cuts ever in the past in India on any count per se. So I'm not too much worried about job cuts in the Indian context. And I'm not too much worried about that impacting InfoEdge business as well. So I would rule that out.
Okay.
All right. Got that. Well, let's talk about not job losses, but a company that's been reporting losses, but promising better times ahead. Ola Electric. The numbers were announced some time back, but guidance was very, very strong. Sudarshan joins in to break it down for us. Sud.
So it's an electric move that shares of Ola Electric are seeing. So ahead of the earnings, stock was at 52-week low, down 53% in 2025 and down more than 75% from the record high that stock had hit in August of 2024. So what has worked for the company? First, earnings on a sequential basis have seen an improvement. And second, guidance that company has provided for FY26 is looking healthy if you take a look for the first time. But first, talking about the numbers, losses have narrowed. If you look at a sequential basis in Q1 FY26, net loss has come in at rupees 428 crore against rupees 870 crore loss that company had reported in Q4 of FY25. Similar trend was seen in revenue. It has seen an improvement on a sequential basis. In Q1 of FY26, revenue has come in at rupees 828 crore against rupees 611 crore. But the biggest positive that was seen was in gross margin. In Q1 of FY26, gross margin has come in at 25.8% and it has improved from 13.7% Q4 of FY25. And now, by the end of FY26, company is saying that it might see gross margin including PLI benefits in the range of 35 to 40%. If it really achieves, it would be an improvement up to 1,500 basis points by the end of FY26. Some of the concerns that company has raised, like all the other auto OEMs, it's regarding rare earth magnet. It's saying that in the long term, if there is an issue regarding availability of rare earth magnet, it might create an issue, but in the short term, company remains well covered. Lastly, talk about the guidance on the revenue front. Company is saying that in FY26, revenue is likely to be in the range of rupees 4,200 to 4,700 crore. That would be decline up to 7% or growth of more than 4%. On the volume front, it's saying that in FY26, volumes may be in the range of 3.25 to 3.75 lakh units, and that would be against 3.59 lakh units that company had reported in FY25. Apart from these guidance, company has also said that from Q2, auto segment business will turn EBITDA positive. So more than earnings, what has worked for the stock is the guidance that company has provided for FY26.
Okay, all right, sir. Thanks a lot for that. 15% higher. A stock that, post-listing, I remember dancing away to 140 rupees. At 40 rupees, it's seen a bounce. Dipan, will you buy the stock on this promise that things are going to turn around, growth is going to come back, profitability is going to be the focus at around this 45 rupees? All the bad news in the price, or you rather stay away?
No, I think, Nigel, I would rather stay away because, we have a conservative approach to investing per se. And, look at the volume growth, that's the most disappointing part. I think company like Ola Electric, you expect 15-20% type of volume growth, but that's not coming through. And competition also is intensifying. It has lost its market share as well. Of course, it has done great work on cutting down its expenses. But for the company to grow and for us to get interested, you need that 15-20% type of volume growth. And I don't know whether that's going to really happen in the near future. So sure, I think the management certainly has given a very positive commentary and that's taken the stock price higher. But apart from that, I think, let's just wait and watch how this year plays out. And most important indicator to watch is market share and volume growth.
Okay, so what would you buy then from autos if you had to buy a stock?
You always ask me this question and there's only one answer. Eicher Motors, I think, and I think it'll benefit from monsoon as well. And the second company is Mahindra and Mahindra. I think these are the two companies which are gaining market share, which have got a kind of Eicher Motors not impacted by EV per se, and M&M has a very solid EV strategy. So these are the two companies we are riding on as far as auto sector is concerned. Usual disclosure, we and our clients are invested.
Got it. Okay, all right. Was just wondering whether you're still loyal to the Royal Enfield and you're confirming that. So Eicher and Mahindra. Got that.
There was also an article in the paper that some of the smaller EV players have been wiped down because they have violated some of the FAME 2 subsidies. So we're talking about names like Okinawa Autotech, Greaves Electric. So I guess that is also helping consolidate market share with some of the larger players like TVS, Bajaj and Ola in terms of volumes.
All right. Interesting point out there. Let's shift focus then to the pharma pack. Ekta joins us to tell us why some of these stocks are buzzing today. Ekta?
Thanks. I'll start with Divi's, which is in focus because MSN, the pharma company, has won a patent litigation with regards to Novartis's cardiac drug Entresto, which clears the path for a generic launch of this particular drug in the US market in this month itself. Now, Entresto API is expected to be the largest product in Divi's innovator custom synthesis portfolio and estimated to contribute as much as 40% of their CS revenue and 20% of the overall company revenue. Sun Pharma, Morgan Stanley has written on Sun, overweight, target price of 1960. It's their preferred pick. Strength in the specialty pipeline and chronic-focused India business is something they like, and a robust balance sheet. Wockhardt has exited the US generics business. They will now focus on the new antibiotic drug discovery segment and biologics portfolio in insulin. Glenmark has received a warning letter from the US FDA for its Indore facility, which was inspected in Feb, and they have an OAI status, official action indicated status, since May of this year. Global Health, there was a petition filed before the Delhi High Court by the Greater Kailash Residents Associations and others. This seeks a stay on the construction of a proposed 400-bed multi-speciality hospital in New Delhi, and it was being developed by Global Health as well as DLF. It was a joint venture. The court, however, has not granted us any stay or interim relief with respect to the construction activities.
Thank you very much for that. Earlier today, we spoke with the chairman of the company, Habil Khorakiwala, after the company, as Ekta said, announced its exit from the US generics business. Listen in.
As far as the pharma generic is concerned, we are exiting and we will not have even the third party presence. But however, as far as our new drug is concerned, or biologicals are concerned, we would be definitely there in the US market in time to come. US, as far as the revenue is concerned, it was hardly 2-3% of our revenue. So it hardly makes any impact whatsoever. As far as the margins are concerned, I think our numbers will improve because we have been incurring losses for the last several years. In fact, we lost about $8 million last year. So partly it will be made up in this year. We would be on the track because we are introducing our new drugs in Indian market. And after initial first year, it would be significant margin improvement. Additionally, we would be focusing on our biogenerics, that is diabetic portfolio of insulin and newer insulins. And all these put together will certainly, we would achieve this kind of 18-20% market, margins over next few years. As far as marketing in the US is concerned and other markets are concerned, some of the markets we would be certainly looking for out-licensing, and that will depend from market to market.
Let's go across to Deepan. Deepan, what do you like from the pharma pack?
Yeah, I think that, of course, we have this threat about tariffs by Trump, but the entire CDMO space is where we are focused on. Again, disclosures over here. Companies like OneSource, there is Cohance, which was earlier Suven merged with another company. And then there is Dishman, I think DuJet also. I think these are the companies, I think, which have great potential. And whatever the outcome of the Trump tariffs, I don't think the CDMO business is going to get impacted. The China Plus One strategy is clearly playing out extremely well over here. And all of these companies are seeing a sharp increase in RFQs. So very positive on the entire space. And yes, Newland Lab also you can add to the list. These are the companies I think that we need to focus on. And Divi's Lab especially, I think, whenever there's bad news and you buy a decline, a few years later, 2-3 years later, you find the stock has again created a new high and recovered lost ground. So I wouldn't be too bearish on Divi's Lab just on account of this one particular development.
Okay, all right, Deepan, thanks a lot for joining in and giving us those views. By the way, as we're having that chat, take a look at the Nifty. It's cut its losses, was down 120 points. It's the 40-50 point recovery that we've seen. Grasim, HDFC Life, SBI Life, they have seen a good recovery. Throw in there even IndusInd Bank. Solid recovery was what we're seeing on that one. And in fact, from the broader markets, one stock that's catching an eye is Tata Tech. Remember, it's been a bit of an underperformer. I think results are due. And that one from the day's low has suddenly seen a sharp spike up on Tata Tech. Well, we'll slip into a short break. On the other side, we have Jitendra Gohel from Kotak Alternate Managers. He's waiting for us.
Welcome back. Jitendra Gohil is now joining us. He's Chief Investment Strategist at Kotak Alternate Managers. Markets, as Nigel pointed out, recovering from the day's low. And we are at about almost 25,100. Jitendra, welcome to the program. Thanks for joining us. Last you were on the program, Jitendra, you were talking about low-cost housing as an idea, Jitendra. Because financials broadly is still one pick because RBI is wants to spur growth, kickstart another credit cycle, etc. Lots of NBFCs have done quite well, beaten down NBFCs have done quite well. Housing finance and low-cost housing finance, not so much. First of all, are you talking about real estate companies or finance companies in this segment, low-cost housing?
Yeah, hi. Thank you for inviting me on your show. See, what we think about low-cost housing, first is the valuation is reasonable as of now. And what we feel is that the interest rates are going to fall further in India. And most of these NBFCs are in a much, much better place. Even some of these small finance banks who are catering to low-cost housing, probably there the growth rate is going to remain robust. And that's what we feel that the segment is looking attractive from a 2 to 3 year perspective. Also, we have to understand the rural recovery, right? So, although the sowing season has been pretty good so far, 16% YOY growth, monsoon has been pretty solid. So, from interest rates perspective, from rural recovery perspective, and we are also bullish on tier 2, tier 3 cities, the kind of growth that these cities are experiencing. So, overall, if I see the landscape, I feel that from a financial market, we are overall bullish. And within the financials, we think that the NBFCs and small finance banks, which are catering to the low-cost housing space, will do much better in the next 2 to 3 years.
Jitendra, what have you been adding to your portfolio right now?
Unfortunately, we cannot disclose the names, but from a sector perspective, I think all these leading, good quality small finance banks and NBFCs that we are looking at to add.
Okay. Other than that, in this bucket in the financial space, anything else that you all have been liking of late?
Yeah, so we continue to like entire financial space. We are overweight currently. So mostly some of the mid-tier banks that we discussed last time as well, that we like mid-tier banks, we like housing finance, small finance banks. And also we have to look at the liability and the, the loan franchise. For example, the banks and NBFCs where their lending is mostly fixed rate based while the borrowings are floating. So I think those kind of banks and NBFCs we prefer at this point of time. And we feel that interest rates are going to fall further. They are going to come out with a capital raise also. So the health of the banking system is very, very strong. So we think that this is a very sweet spot right now we are sitting on, where we think the loan growth has been pretty volatile, but it's been slowing down. From going forward in the second half, we think there could be a good chance that we see some pickup in loan growth, because CRR cut will start from September onwards and interest rate will fall further. So all these triggers are giving us very confident view on the sector.
Okay, all right. Hi, Jitendra, good to see you. When, tech, that seems to be in a bit of a tizzy. We had TCS's numbers that came out and they're very uninspiring. So we need to keep in mind that the global backdrop itself is very uncertain. And some of these are very, very well-run, good quality, clean balance sheet companies that could throw up a lot of cash. And, then the cash flow as a percentage of the market cap looks very, very good. What's your view on it? Some of these stocks, case in point being a TCS, has pulled back 20% from the recent peak. How are you positioned on tech? What do you like, large caps or the mid cap names?
Nigel, see, here we are a little bit cautious, and clearly we are mentioning that we like pharma or IT in the defensive space. Large cap IT, I think balance sheet is strong, margin profile is very good, but valuation obviously is stretched, and we think that there is ample opportunity outside this tech space. Some of the mid cap IT companies which have been beaten down, from a value perspective, we are buying a bit, but overall sector-wise, we think that one should remain a little bit underweight here, especially on the large cap IT names. Some exposure is warranted. Obviously, these companies are bellwethers and once the global economy starts to recover, and large part of the slowdown is already priced in. So it's not that we are experiencing a very sharp correction or anything, but we think that the sector might go in consolidation, probably might underperform the Nifty because banking underweight on IT, that's the call that we are taking from a house view perspective.
Point taken, Jitendra. We'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. We'll take a quick commercial break here. We'll come back and get you, some more opinion. Short-term trading ideas coming up as well. What to buy or sell today for a reverse trade tomorrow. Stay with us.
Welcome back. You're watching Closing Bell. About 30 minutes or less than 30 minutes to go now. It's been a subdued trading session for the benchmark indices. The Nifty is down 70 points, but off from the session lows, particularly in the last 20 minutes. There has been a pullback, 2580 on the Nifty midcaps, continuing to gain traction, 400 points up now. Mitesh is back with us for a few BTST calls for a reverse trade tomorrow. Mitesh?
There's some recovery in the index from lower levels, but I'm still not convinced about taking a long trade on the index. So we'll maintain that relative bias with put option spreads. On the stock side, though, Oil India and ONGC look good, so I've chosen ONGC as a BTST kind of a trade. Keep a stop below levels of 242 here. Look for a target of around 247.5 to 48 for tomorrow. And the other stock, which I have. The other stock which I have on radar, that's Policy Bazaar, which I would recommend taking a BTST with the stop below 1820 for targets of 1850.
Okay, Policy Bazaar, 1850 targets, stop at about 1820 or so. Thank you very much, Mitesh, for that. Now, cable and wire sector is in focus post JM Financial note. Upasana is here with what JM is saying. Upasana, take us through it.
Well, JM Financial is bullish on cables and wires players. Now, it projects that the sector is projected to continue its upward trajectory with a CAGR estimated at 12% over FY25 to FY28 is what the brokerage has highlighted. It expects exports to be a key growth driver for these players going ahead, and it believes that the India's share in global cables and wires exports has inched up significantly. Now, Indian players are augmenting their capacities and capabilities and has improved their global positioning in terms of their sectors. Now, lastly, it believes that unlike paints, the entry of new entrants is unlikely to disrupt given the lower capex and also a fragmented setup. It has also highlighted that it expects new entrants to have a greater impact on smaller, unorganized industry players as compared to the industry leaders. Hence, on the back of this, it has initiated a coverage on KEI Industries with a target price of around 4,500 per share, and it has also re-initiated coverage on RR Kabul with a target price of nearly about 1,640 per share. And we can see both these stocks surging in trade today on the back of this positive news.
Thank you very much for that. But back to talking about IT. So, this week we've got 10 Nifty companies reporting numbers. Out of that, 3 of them are the IT majors. HCL Tech today, Tech Mahindra on Wednesday, and Wipro will be Thursday post-market hours. TCS already reported their numbers last week. It was a disappointing set. Minus 3.3% was the revenue drop. And Infosys is next week, the 23rd. Now, for all the 3 companies reporting numbers this time, we are expecting this would be the second consecutive quarter of a revenue decline. For HCL Tech, minus 1.1, Tech Mahindra, minus 0.7, Wipro would be approximately minus 2%. So the question is that since this would be the second consecutive quarter of a revenue drop, how deep is the demand pain? Does it extend into Q2? Can there be even a modest recovery in the second half of the year? TCS already said that on a consolidated basis, it's difficult for FY26 growth to be better than FY25. Though if you strip out the BSNL deal, they do expect FY26 to be better. But look at HCL Tech's guidance. They're talking about a 2 to 5% revenue growth for this year, unless revised higher later in the evening. 2 to 5% would compare with 4.7% last year. Now, already Q1 it's been a weak start, especially for TCS. It was worse than expected. So we're going to watch that, whether the pain is running deeper than what was earlier anticipated, and how long does it extend. Now, stocks are about 20 to 30% away from their 52-week highs. TCS down 30. For Infosys, HCL Tech and Wipro, it's a correction of about 20-odd% from the recent highs.
Okay, all right. Thanks a lot for that, Reema. Well, let's get in Sudeep Bandyopadhyay, Group Chairman, IndiTrade Capital. Hi, Sudeep. Good to see you, Ben. What's your view on a couple of these Tata Group names that actually have been big underperformers and will be delivering their numbers? Tata Technologies, Tejas Networks, both of them come out with their numbers. We know these companies are good. However, in the near term, there are some headwinds, and they've come off considerably from the top. Your view?
Well, Nigel, I think you are absolutely right. The headwinds are pretty strong. And look what's happening in the automobile industry. There is significant set of challenges which these companies are facing due to the slowdown in the automobile industry. So as far as, particularly these companies are concerned, at this stage, I would say it's better to kind of hold back, not try to, kind of buy at levels where it have reached. It is significantly corrected, but look, they're still not cheap. If you look at the multiples and all that, they're still, aggressively positioned. So some more correction is possible, and it will have to wait for recovery in the related industry before they can show signs of recovery. So my advice will be to wait and watch.
All right, that's on Tata Tech. On Tejas Network, any view?
Well, I think, there are interesting things happening and there are opportunities, but I think the completion of the existing contract or exhaustion of the existing contracts, domestic contract, has led to a bit of a challenge as far as the order book is concerned. So I will again here also wait a bit and see how things move going forward in terms of their order.
Any view on the newly listed company, TFS, that listed today, Travel Food Services? The company looks pretty solid, in terms of growth, 20%, 25% to 30% growth. Margins are pretty okay. And profit margin, which the management has reportedly, said that 20 to 22% is what they're looking at. It trades at less than 30 times if we look at it on a forward basis. What is your view on the company? The fear is that, a dream folks kind of situation can play out. So the management told us that they are partnering with Adani and GMR. So they don't believe that that's going to be possible. Your take?
I think the entire issue got to an extent overshadowed by the Dreamfolks episode, and there were a lot of concerns regarding what happened to Dreamfolks wouldn't happen to them, and I think market is also waiting for that to be displayed over the next few months and quarters. So that's probably the reason why it didn't get a premium, didn't get the kind of excitement it would have otherwise deserved. So yes, I agree with you. It's a strong business, and they're expanding. The opportunities are significant with two new airports coming in the outskirts of Mumbai and Delhi. I think F&B is a good business to be in, and if they can continue working in partnership with the major airport operators, there should not be any risk to their business. So I generally kind of veering towards the view that probably it's worthwhile looking at, considering the multiples are not too high. But yes, the Dreamfolks related uncertainty still hangs over this entire sector.
Sudeep, what about a Safari? Now, Safari has been gaining market share at the expense of VIP for a while now. In fact, for many, many years now. The 10-year revenue growth rate for Safari was 24%, 3 times that of VIP, the 10-year revenue CAGR. Look at the stock price. In 10 years, Safari is up more than 1,000%, while a VIP is up 80%. But now there is a change of guard at VIP. So, and plus, we know the increasing competitive intensity due to these D2C players like a Mokobara, etc. And there's so many others. Do you think Safari's dominance could be challenged, and people would look at VIP where valuations are a little more attractive vis-a-vis a Safari, which has had a fantastic run so far?
Absolutely, Rima. I think I do agree with that logic, and I think it's time to look at VIP. What they lacked was the management and the promoter commitment. Promoter wanted to exit for quite some time, and that was getting reflected in the performance of the company. The potential for VIP is significant. Look, the Bangladesh plant, when they set it up and the way it had come up was a absolutely fantastic opportunity for them to get into the international market and do great revenue from international market, where the margins are also more attractive. Unfortunately, because of the local challenges and promoter and management related uncertainties, they couldn't capitalize on the Bangladesh factory. But I think with the new management, new promoter coming in, and the focus being back in the business, they should start doing very well. And yes, absolutely, that's probably the reason we see VIP price going up today in the market. The market will like to believe in VIP once again. And of course, Safari is at a very, very high multiple. So comparatively, and looking at the scenario as it prevails today, I think VIP will be a better buy.
Interesting times, actually, get that point valuation wise. If you look at it on a price, to sales to price as well, market cap to sales, definitely VIP is better placed on that front because Safari's got very expensive. But just one view in terms of the feedback that I've got is that there was a lot of price cutting, a lot of discounts that were given. So with a new promoter coming in for VIP, then hopefully that stops. That could be actually a positive for the industry on the whole. But let's see how that goes. For the time being, VIP seen a sharp recovery, and it has outperformed Safari, at least in the last 6 months. Over a longer term, obviously, Safari has done much better. Well, stay with us, Sudeep. For the time being, let's get in some market opinion. Earlier today, we spoke to Rahul Chadda, founder and chief investment officer at Shikara Investment Management. Asked him about his view on tariffs, the change in Fed governor, and also whether he sees value in the Indian markets. Let's take that break. And while we do that, hear out Rahul.
Yeah, so our beliefs mean tariffs are going to settle somewhere between 15 to 20%. There is going to be a lot of rhetoric around it, a lot of noise around it. The idea here is to induce, from a US perspective, other trading partners to agree to some of these conditions of better access for US companies and US products, etc. So markets seen this in the past, and which is why they're very calm about it. I think there may be a correction or a significant pullback in markets if actually such high levels, 30-35% of tariffs get implemented and US starts collecting it. That is the risk, if you ask me, that the yields kind of go out of control and touch 5%. If you ask me the risk for the markets, that's the risk of the market. See, right now what we've had is We've had the Treasury Secretary, Scott Bessent, who's played the role of a mature adult here and calmed the markets on that. But look, if the government or the administration here takes a whimsical way to change the guard or the chairman at Fed, I think that would be taken negatively by the bond markets, and obviously equity markets would also react to that. As the economy kind of bottoms and grows from here, banks are the best proxies. We've played it through the large cap banks, which are steady compounding machines. At the same time, we would like something like a AU Bank, etc., which has done well over the last 6 months. So select mid-cap banks. So we're not against cap banks, so it's select mid-cap banks, which are good franchises, good risk management, etc., something one has liked. This quarter may be a bit soft for banks as some of these rate cuts impact the NIMs on the, more importantly, impacting the asset yields, etc. But from a medium-term perspective, look, banks are the best way to play the economic recovery.
Welcome back. About 7 minutes left to wrap up today's trading session. Some of the big mid-cap movers, since the broader markets have been outperforming, Ola Electric has further moved up now. Now it's up close to about 20-odd%. And then you've got a Jayaprakash Associate, Jaiswal, Neko, some of these stocks, a BSC, Paytm, a Bank of Maharashtra also has turned back into the green. And Kryzac, which had a fantastic listing last week, today has moderated a tad bit. That said, the stock is still significantly above its issue price. In conversation with Sudeep, Ola Electric still off from its issue price. It's almost 50% lower, compared to its recent 52-week highs. But is it a buy now, given the guidance and the improvement that we're seeing sequentially?
Not really. I think there are still too many issues which is plaguing the company as well as the industry. So I'll wait and watch. They also have in the process of this entire new battery plant, which consumes huge amount of capital, and there is a drag on the overall performance because of that. At one point of time, that probably would have made tremendous sense, but today, the way the prices have come down globally, I'm not sure whether it does make sense, at least in the short to medium term. One doesn't know what's going to happen in the long term. That's one. And the other point is they have still too many issues in terms of servicing and after sales issues which they need to resolve. They have definitely lost the market leadership. They are number 3. And the numbers which they're selling on a monthly basis is nothing great at this stage. There will be a bit more consolidation because the smaller players are losing out the FAME subsidy, and they are, they are going out of business. So some amount of market share, some amount of numbers at least will come back to Ola. Probably they will show a little bit of improved turnover and turnover for next few quarters. But I think to say that the company is out of woods and one can go and buy, I think it's a little too premature. So wait and watch would be the right strategy here.
All right, Sudeep, I'm not sure whether you track these other names in the broader markets. Genus Spa, the stock has just moved up. We know that smart meters has a big potential. The other one is Orient Pro as well. I'm just looking at a couple of these names. In the last 30 minutes, both of them have moved up. Now, just some of these stocks have corrected 30-35% and then pulled back. So they're still a far cry away from the highs that we saw in the month of December around that time. Any view on either of these two names?
Well, Genus Power smart meter is something which is going to happen. It's a matter of time before the entire country gets covered by smart meters. So the companies which are into that space will definitely have significant opportunities. So Genus Power is one of those, and I'm sure they will have the opportunities. Of course, at current level also the valuation is not cheap. It is reasonably valued. So if somebody has a slightly long-term horizon in mind, at least a year, I think they can look at Genus Power at current levels.
This Landmark Cars, have you looked at the company? Today there is a BNK initiation on the report, and I think they're talking about significant upside from here on, close to about a 60% upside from current levels. And the key rationale is that the company's revenue growth rate, pro forma, over the last 2 years was 11%, which is 2x that of the Indian passenger vehicle sales, where the CAGR was about 5%. And that stock is up nearly 7-8%. Is this a stock that you like or you've tracked?
Well, I think, we have been looking at this stock for quite some time, but somehow we have refrained from recommending this. I think overall the sector is under pressure, that is the automobile sector, particularly passenger vehicles. And we believe that some of that pressure will eventually come to these, these companies which retail passenger vehicles. So we, at this stage, considering what's happening in the overall automobile scenario, we will probably wait. Honestly, I have not seen this report, so I won't be able to comment on the specifics of the report.
Okay, all right. Sudeep, any view on some of these metal-related names? Hindalco, it was higher in the morning. That's lost its way a little bit. Vedanta, I think you were fairly positive on the prospects. We had that Viceroy report that came last week. And actually, those that bought on that dip are making money because the stock has outperformed from there. Your view on any of these names from the Ferris pack, silver play as well, Hindustan Zinc is out there. That's holding firm after seeing a very sharp correction from the peak. Your take?
Well, I'm positive on both Hindustan Zinc and Vedanta, and you're absolutely right. Vedanta have been positive for some time. There are a whole lot of allegations before even Viceroy, and there were a lot of stuff being talked about. But if leave aside that, the facts on ground are very strong now. As far as Vedanta is concerned, pretty much all its verticals are doing very well. The demand for metals, particularly the commodities it is involved in, globally is good. And of course, on top of that, the demerger is a reality. Whether it happens in September or December, we can keep debating, but the fact is it's going to happen, which definitely going forward will unlock significant value. At some point of time, there will be, one of the companies may get sold, and which again will unlock value. So Vedanta, even at current level, does look good. Hindustan Zinc, obvious reasons, fantastic performance. The demand for zinc going up. They are putting up incremental capacity, and silver is an icing on the cake, which is in great demand today. And the valuation and price of silver is continuously going up. The expansion which Hindustan Zinc is doing currently is also going to definitely help them going forward from a long-term perspective. So Hindustan Zinc definitely can be looked at. So can Vedanta.
Got it. Okay. All right. Thanks for that, Sudeep. Stay with us. One stock that in the last few minutes has perked up is Bharti Airtel. If you pull up the intraday chart, it was in the red, I recall, and managing to end in the green, but the intraday chart will tell you suddenly we got a bit of a spike towards the end.
Last week, Bharti Airtel underperformed, and there was a UBS note. I think you can just pull up last week's chart. UBS downgraded Bharti, and Bharti was a consensus buy across, most of the brokerages. There you have it. In the last 7 days, it's corrected, and the key reason is they said, one, it's possibly priced to perfection, and two, everyone's watching out for tariff hikes. That's going to be the trigger. But don't rule out the possibility that this tariff hike could be delayed.
Yeah.
It's not so easy to hike tariffs in a country like India. So that's why UBS had downgraded it. So I think the stock is just reversing last week's underperformance.
Okay, all right. Well, time to wind down the markets then. In today's trading session, you had Eternal, that was one of the top gainers on the Nifty. Big move is what we saw out there. But otherwise, you had stocks like Hindalco that are a little bit under the weather from the Nifty pack. The Nifty goes home with a cut of around 60 points. The good news was that the Nifty Bank managed to fight back. That ended around the even-Stevens line. And the big outperformance came in from the broader market. Stock of the day was VIP. That big announcement was that was long awaited. The deal got done. Mr. Piramal finally sold 32% stake in the company. The street believes the way ahead is going to be far better. So that stock was up close to around 5.5% in today's trading session.
Okay, IT firmly lower ahead of big numbers later this week. So Tech Mahindra, Wipro, Infosys, HCL Tech, all down between 1.5% to 1%. Bajaj Finance, Asian Paints, L&T, Eicher Motors, Tata Motors. These were some of the notable drags in today's trading session. One other big mover outside of the index was Ola Electric. By the end of it, locked in an upper circuit of about 20%. Good close for the mid-cap index and the small-cap index, which was up nearly 1%. Don't go anywhere. We're calling time on closing bell, but on the other side is Markets Forward. We'll prep you up for tomorrow. Dalal Street ends mixed. The Nifty and the Sensex fall 0.25%, but the Nifty manages to hold on to 25,000. Mid-cap sprint, the index soars nearly 1%. IT stocks fall the most.
Market regulator SEBI says it is examining a request by Jane Street to lift certain restrictions imposed in its interim order. This follows Jane Street depositing over 4,800 crores in an escrow account favouring SEBI as required by the order.
Ola Electric surges as earnings improve sequentially. The loss narrows to 428 crore rupees. A strong guidance for FY26 also boosts sentiment. Stocks of VIP Industries gains after multiples PE and Sancheti Brothers signed to pick up a 32% stake, followed by an open offer. Promoter Dilip Piramal tells CNBC-TV18 an ownership change was needed to put the business on track and that he will trim his residual holding from 20% to 8% in the next 5 years.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Ekta Batra and with me is Reema Tendulkar. Well, Reema, what a session. It was mixed. We started off with the week with at least the broader markets outperforming.
You know, all in all, not bad. So while you have a minor cut of close to about 0.25% on the benchmark indices, the Nifty ending down 67 points at 25,082. Look at the broader markets. The mid-cap index was up nearly 0.7%. The small-cap index was up close to about 1%. The advanced decline ratio was even keel. I think if it wasn't for IT, the performance would have been a lot better because the Nifty IT index was down more than about 1%, and many other sectors, whether it's capital markets, real estate, etc., all did pretty well.
Well, yes, absolutely. We had the mid-caps, which went home with a gain of around 0.7%. The advanced decline ratio even keel at around 1:1. And the Nifty just about a little bit of a negative bias today, so down around 67 odd points. A lot of stocks in focus. Divi's, VIP, HCL Tech, Newland Labs. That saw a good run towards the close of trade. So we have a lot to talk about in the next 30 odd minutes. But here's a lineup of what we have in store for you. In fact, we'll start the show with the top movers and shakers of the day with Vivek. We'll also put the spotlight on Ola Electric, which surged by nearly 15% in trade despite weak Q1 numbers, while Divi's Labs did see some amount of red after facing a legal setback. Also in focus was VIP Industries. Last but not least, we delve into the key market events to watch out for in tomorrow's trading session. All right, but on to our first segment of the day. Vivek now joins in from the big wall with the top movers and shakers today. Vivek, over to you.
Well, thank you so much for that. Well, quite a bit of a topsy-turvy session, but like you mentioned, the market breadth was quite favorable, especially for the broader end of the markets. Well, quite a few movers and shakers. First on the list of gainers, of course, was first one, of course, was Eternal, the top Nifty gainer. Good volumes today. A lot of the new age companies did quite well in the session, and that brings us to the second name, which was Ola Electric. Q1 quite muted, but again, a sequential improvement. Again, a very strong FY26 guidance is what kept the stock high in the session, almost perched at the upper circuit when we ended the trade. Pharma stocks, again, one particular set of stocks that did quite well in the session. There were a few laggards, of course, but overall, the entire pharma pack today did quite a bit of buying activity. Names like Sun Pharma, Loris. We also saw Newland Labs, that ended the session at the 20% upper circuit limit. Some names from the broader end of the markets, India Mart, the top gainer as far as the mid-cap index was concerned. That particular stock on good volumes ended at the upper circuit. And capital marketplace today, especially a name like BSE, some positive news flow, especially when it came to the Jane Street going ahead and depositing the money in the escrow account. On the back of that, BSE did see bounce back in the session, up almost 4%. Quite a few laggards as well. Divi's Labs, key amongst them, one of the top laggards even on the Nifty, recouped quite a bit of its losses, but its key client Novartis is likely to see pricing pressure in one of its cardio drugs. AU Small Finance Bank, that stock was under pressure throughout the trading session, a double downgrade coming in from Kotak Institutional Equities. The Nifty IT pack, that pack, most of the stocks there were under pressure. Names like Wipro, names like TechM, all of them ended the session over 1% lower in the. And lastly, DMart, expectations going into this particular results were quite muted, disappointed the street. Even on that front, stock ended low by over 1% today.
Thank you very much for that. Those were the top stock movers. Let's now go across to our guest. Sudeep Bandopadhyay, Group Chairman at IndiTrade Capital, is still with us. Jay Thakkar from ICICI Securities joins in. Gentlemen, thank you. Jay, let me start with you. All in all, we managed to recover quite a bit from the day's low. The day's low today was 25,002, so about an 80-point recovery. What does that tell you, and what's the setup for tomorrow?
Good afternoon to you, Rima. Well, see, Nifty, since a couple of trading sessions, we have been seeing that, it's trading with a negative bias, and so is Bank Nifty. But then Bank Nifty managed to, hold on quite well today. Relatively, it outperformed the Nifty. And that is one of the reason, Rima, why Nifty bounced back. And we have two major results in this week, as far as, Nifty private sector banks are concerned, HDFC, ICICI, and then we have HCL Tech as well, from the IT pack. So, result season has started now. So far, it has been okay, or maybe below expectations, and hence Nifty has given up most of its gains, which it actually got post the breakout from 25,200, 300 range, which was earlier acting as a resistance. Now it's back within those levels. So I think that 25,300 now going forward will act as a resistance, and unless we are not seeing a close above those levels. The trend for Nifty, Rima, would be a bit of sideways to negative. The volatility is expected to rise from here on. The India Wix had fallen to 11, and the IVs in fact had gone down as much as 10 and 11 on Nifty and Bank Nifty respectively. And if you look further into the IVs, then the implied volatility percentile for both Nifty and Bank Nifty had fallen until 3.2 and 1.2 respectively, which is the lowest reading, I would say. It is at the extremes, indicating that IVs are likely to rise coming days, which will definitely weigh some pressure on Nifty on the upside. Generally, 70 to 75% of the time when IVs are rising, markets fall. So 25,300 Rima, until those levels aren't taken off on a closing basis, the trend will be sideways to negative. On a downside, 24,800 is a very critical support. So the range for this week is 24,800 to 25,300.
Okay, 24,800 to 25,800. Well, now let's get to a CNBC-TV18 news break, which is confirmed. Promoters of luggage manufacturer VIP Industries will sell 32% stake to multiples PE and Mithun Sancheti. The promoter, Dilip Piramal, tells CNBC-TV18 an ownership change was needed to put the business on track. Mangla Malu is here to tell us more. Mangla.
Well, it was the deal of the day for sure. Promoters of VIP Industries decided to sell up to 32% of their stake to multiples private equity and a consortium of other investors as well. Initially, the stock opened lower because the deal price was 388 rupees per share. The stock had already seen a 75% rally from its 52-week low in the run-up to this deal. But more importantly, all the excesses were out of the system once the news was in. But thereafter, the belief that maybe the new owners could turn this company around, a stock which has been an underperformer in the sector, could actually do a lot better going forward. The street is betting on that, and thereafter we saw that recovery from the lows on the counter itself. We spoke to Dilip Piramal, who joined us in our studios, and was fairly candid. He said that, he had no option but to sell this business because there was a management crisis. More importantly, senior leadership wasn't performing, and at the same time, none of his family members were willing to take up managerial positions and run the company on a day-to-day basis as well. So left with no option and loss in market share as the business was not doing well over the last few years, he had to go ahead and sell to private equity. The choice for private equity was rather simple. He said private equity investors are usually, betting on improving the value of the company and increasing the valuation as well going forward and the profitability, and that was his best bet. He will hold 20% stake in the company, will have to pare it down to almost 8% in the next 3 to 5 years, for which he has a right of first refusal with multiples private equity as well. He says the company needs good management to get its old mojo back. Let's see how that performs. For now, the street is betting on the ability of multiples and the legacy of brand VIP to take it forward from here on. Let's hear out what Dilip Piramal had to say to us.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value. There is a clause that as 20%, I am still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
So we discussed, you're saying VIP is now, potentially attractive, and maybe it could even do better than a Safari with the management change. So if someone buys right now, what should they expect from, VIP Limited?
Well, I think, as I was mentioning, they have a unutilized asset in terms of the huge Bangladesh plant, which can give them a significant leverage in the global markets. And the global market margins are higher. Potential for VIP to generate significant revenue from international market is there. So yeah, it can be taken to a different level altogether. And VIP has the potential. They have products in all the segments, and they can really take on the global majors. They used to do that in India. I mean, they have been market leaders in India for decades, and they can probably try to replicate the same model in multiple geographies around the world. And with multiples and a focused investor being there who wishes to maximize value, I think that definitely is possible. So buying at around 470, 80 levels, and going to the earlier high, I think it touched around 700. At some point of time over the next couple of years, that kind of valuation definitely is possible, provided the company is run well.
Okay, well, Jay, any thoughts on VIP technically?
Sure. I mean, Ita, I would say that it has been rising, as you rightly mentioned, since the announcement of this deal, and since the talks were going on since a couple of weeks, and it has bounced back from 320 now until 480. So there has been a good rally, but then still the momentum is quite in favor. I would say the volumes are back into the stock. It's been increasing. So I believe that 415 is a very critical support positionally. Until these levels are held, I think VIP has no further resistance until 550 on an immediate basis, and positionally up to the levels of 660. So it's looking good. If at all there is any dips in Reliance with the stop loss of 415 in the short term, one can definitely buy this, targeting 550 to 660.
Got that. Let's talk about the big mover of the day, and that's Ola Electric. The final tick on Ola was up about 20%, and I think post-adjustment, the stock closed with a gain of about 18%, 47 rupees. In Q1, the company reported a loss, but on a quarter-on-quarter basis, the losses have narrowed. Sudarshan now joins in to explain this kind of up move that we've seen in the stock. Sudarshan?
Ola Electric today has surged up to 20%, but ahead of the earnings, stock was at a 52-week low, down 53% in 2025 and down more than 75% from the record high that stock had seen in August of 2024. So what has worked for the company in 2025, or say Q1 of FY26? First, earnings have improved on a sequential basis, and second, the guidance that company has provided for FY26 is looking healthy. So first, talking about the earnings, losses have narrowed on a sequential basis. In Q1 FY26, net loss was at rupees 428 crore against loss of rupees 870 crore that company reported in Q4 FY25. Similar trend was seen in revenue. Revenue has seen an increase on a sequential basis. In Q1 FY26, revenue was rupees 828 crore against rupees 611 crore the same quarter. Now, the biggest improvement that company has seen was in gross margin. In Q1 of FY26, gross margin has come in at 25.8%, and that has improved from 13.7% that company saw in Q4 FY25. And now, by the end of FY26, company is saying that gross margin, including PLI benefits, can improve in the range of 35 to 40%. Now, apart from this, company is saying that from Q2, auto EBITDA is going to turn positive. And on the volume front, by the end of FY26, company is saying that volume is likely to be in the range of 3.25 to 3.75 lakh units against 3.59 lakh units that it saw in FY25. On the revenue front, the growth in FY26 is expected. It may decline by 7% or it may see a growth of up to 4%. And revenue may be in the range of 4,200 crore to 4,700 crore. So apart from the earnings of Q1 FY26, what has worked for the company is the healthy guidance that it has provided for FY26. And on the back of that, it saw a big move of 20%.
Okay, all right, Sudeep, what would your thoughts be on that? And thanks, Sudarshan, for taking us through that news. But Ola, would that be a stock that you like, Sudeep?
Well, no, I have not been liking it. And in fact, I have been recommending sell for quite some time. Yes, these Q1 earnings were better than what was expected and definitely better than last quarter numbers. I think what's happening in this entire space is a lot of these smaller players are moving out and they have multiple challenges, including the flame subsidy related challenges. So volume is getting consolidated in the top end, which is the Bajaj, TVS and Ola. In these three companies, so their volumes are going up. So the volume which is coming from these smaller players is helping them increase revenue and increase, maybe in some margin improvement is also happening because of some amount of cost cutting and this incremental revenue, because the larger amount of fixed costs get spread. But having said that, I think Ola has too many challenges even now. They have lost market share definitely, and their after sales and after sales services are still a lot to be desired there. Their battery plant, which is being set up, is definitely a drag on the P&L, and in the short to medium term, one is not sure whether that's going to help them. Long term, one doesn't really know. So too many moving parts, and at this stage is definitely not recommended a buy.
The Ola, stock closed at 47. The issue price was 76, and the all-time high was 157. That's the kind of fall it's moved. That's the kind of fall from it today. It's moved up 18%.
Okay, well, there's one stock which wasn't that impacted by negative news, and that's Divi's Labs, because the news, however, is definitely negative, but it did recover from the day's low. That's the news is that MSN, a pharma company, has won the patent litigation related to Novartis's blockbuster cardiac drug Entresto, and that basically clears the path for a generic launch of this particular drug in July for MSN. Why is Divi's impacted? Because Entresto, the API, is expected to be one of the largest products for Divi's in their custom synthesis portfolio. So they basically supply that drug to Novartis, estimated to contribute as much as 40% of their custom synthesis revenue and as much as 20% of the overall revenue. So there is concern that now that generic competition is going to enter the market, we are going to see the business for Divi's Labs probably fall, because the overall generic competition is going to increase. But Sudeep, would you have a view on Divi's?
Well, I think, repeatedly we have seen a lot of these news flows come, the price comes down, but again, Divi's recover. So I think the company has inherent strength of overcoming these kind of challenges and bouncing back. So I won't, rush to sell Divi's. If it's a question of buying, maybe I'll wait for a couple of days, see how things move and then take a call. But definitely, I won't be a seller based on this news flow.
Jay, in all the pharma stocks, which has the best chart?
Let's see, it's Laurus Labs, definitely, Rima. Glenmark too had rallied quite a lot. In the last trading session, the recent acquisition, as well as, the kind of entrance in the oncology and all, is definitely positive for Glenmark. But then Laurus is one stock which has been steadily moving up. It has a good increase in the open interest as well on the long side. So good long build up, good technical breakout, all-time highs, good momentum. Positionally, I think this is one of the best stock. And if you have to basically, Rima, sequence it out, so first would be Laurus, followed by Glenmark, followed by, I would say, Divi's Lab. That's how things are out there in Nifty Pharma stocks. And I think these are the three stocks which have been doing good.
Okay. In the same family pharmaceutical, Sudeep, do you look at Newland? That's seen a strong run today.
We do, and we like that stock, and we've been liking it for quite some time. And if somebody has a slightly long-term horizon, I think Newland is a good buy. Look, overall, pharma, we have been positive for some time, and we believe that this entire tariff-related challenge, which was looming, is to an extent has been relegated to the background. And I think at some point of time, it is going to be forgotten also. So we should focus on fundamentals. We should focus on what we used to focus before this entire tariff thing came. So considering that, I think this company can be looked at.
Gentlemen, it's been great chatting with you today. Thank you very much for joining in. Need to get into a short break. On the other side, we'll get you the top corporate voices and the key market events to watch tomorrow. Stay tuned.
Welcome back. Well, let's now go across to the key corporate voices that we had today. First up is Wockhardt. The management on its US exit says that it will not even have third-party presence in the US. This move will not have any material impact on revenue, but guides for improvement in margins. Post this exit, adds next year onwards, there will be no losses and it's on track to achieve profitability goals. Further, it expects to achieve 18 to 20% margins in the next few years. On the product front, the company is looking at certain markets for out-licensing and have a number of products in the pipeline. That's not all. It's confident about getting approvals for Xenic, an antibiotic that they have in their portfolio in India and the US.
Next up, it's Lemon Tree. Patanjali Keswani, chairman and MD of Lemon Tree Hotels, said that the return on capital was higher in the asset-light segment of the business. He added that the firm would take up a new corporate structure over the next 18 to 20 months. The company had seen disruptions in Q1, but is now confident of a recovery in the second quarter. The management also added that 1,350 rooms were added in Q1, and they would sign 10 new hotels in July.
Okay, and next up is Travel Food Services. The stock slipped after a tepid listing. The management was on our channel earlier and they were optimistic about growth. Expects profit after tax to grow in the range of 20 to 25%. Adds profit margin will be stable at 20% and that is expected to continue.
And as we wrap the show, let's bring you the key market events to watch out for tomorrow. Gaurav is standing by.
Well, yes. From the global front, let's first talk about OPEC monthly oil market data. That is something that we'll be getting tomorrow. Other than that, from the US market, we will get June CPI data. Now, let's not forget that between the talks happening and the commentary from Mr. Trump, this data is going to be a key thing to watch out for. From European market, we also have another update. Now, French Prime Minister is going to unveil the major public finance recovery plan. So that is also something that we will be watching out for. Other than that, from the Indian market, a much awaited launch is going to happen tomorrow. Tesla will come up with their first showroom in BKC, which is situated in Mumbai. Other than that, from the board meetings point of view, there are few companies are on radar. First is Centrum Capital. Board meeting is going to happen tomorrow where company may consider fundraising via equity issue. And Jetech India is also in focus because there will be board meeting to consider fundraising via rights issue. Other than that, there are few counters which will come up with their Q1 numbers. And the key ones are HDFC Life, ICICI Lombard, ICICI Pru, HDB Financial Services who got recently listed, Bank of Maharashtra, and other than that, there are companies like Himadri, Special Chemical and General Insurance companies. So all these companies are going to be on our radar on the back of the Q1 numbers.
Okay, all right, Gaurav. Thanks very much for that. On that note, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Indian equities begin the week with losses as silence over a trade deal with USA adds to uncertainty over tariffs. Sensex and Nifty dropped nearly 0.5% each as persistent weakness in tech stocks also weighs, but mid-cap stocks manage a show of strength. Market regulator SEBI says Jane Street has complied with the directive to deposit over 4,800 crore rupees in an escrow account. Adds that it is examining Jane Street's request that the conditional restrictions imposed under SEBI's interim order last week be lifted.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years, and our market shares are going down. And the younger generation is not interested in the management.
A day after VIP Industries promoter announces selling up to 32% in the company to a consortium by PE fund multiples, Chairman Dilip Piramal says a management and ownership change was needed. Adds he will not be part of the new board, but has been offered the position of Chairman Emeritus. EU trade ministers meet in Brussels for urgent talks after US President Trump threatens to impose 30% tariffs on the bloc. French President Macron calls for the EU to defend its interests resolutely, while Germany's Merz and Italy's Meloni call for calm. Major European benchmark indices trade with losses. The Aircraft Accident Investigation Bureau's preliminary probe report into the Air India plane crash says the fuel control switches had transitioned from run to cut off position seconds before the aircraft went down. Recommends no action against Boeing or GE at this stage. Sources say the aviation regulator may soon order an inspection of the fuel switch locking mechanism of all 787s. Air India CEO Campbell Wilson says that the preliminary report on the Ahmedabad plane crash had found no mechanical or maintenance issues, with the aircraft or engines. In a statement addressed to Air India staff, Wilson says that the report highlights that there was no issue with the quality of fuel. Ola Electric stays in the red in the first quarter of FY26, but the EV maker's performance improves on a quarterly basis and helps stock surge 20%. And in another update for the company, Maharashtra Transport Commissioner tells CNBC-TV18 that they have received multiple complaints of 350 Ola stores operating without proper permissions or licenses. Yannick Sinner becomes the first Italian player to win a Wimbledon singles title. The 23-year-old beat French Open winner Carlos Alcaraz in 4 sets. He is now a 4-time Grand Slam champion. All right, the big update that we are tracking at this hour, June retail inflation numbers are out. Let's go to Lata Venkatesh. Lata, over to you.
Well, actually, it's quite a pleasant surprise for the market, or shocker, depending on where you stand. The retail inflation is coming 2.1. The CNBC forecast was for 2.3. Actually, it was going towards 2.35, my average. There was one 2.2. It was SBI, which had a 2.21%. They were the lowest, but this has even beaten their forecast. And you can see the market was smelling that 2.35 will be beaten to the downside, because we got the wholesale price index numbers at noon today, and the wholesale price index indicated a deflation in the food prices. People were prepared for a 1% fall. You know, food prices were the worry of the market, so to speak, up until, say, 4-5 months back, and now they have been falling consistently. But now the expectation is that, the food prices will fall very low. No one was expecting a deflation, but that deflation of about -1% has reflected in the CPI as well. Food index has come in by -1.06% for the month of June versus June of year ago. The CNBC-TV18 poll had indicated flat, 0.1% rise. Many of them had zero rise, flat from June numbers. This is not flat from June 24. This is a fall by 1.06%. My sense is that the core index would be more or less the same. It was expected to be, by most analysts, at about 4.4%, between 4.3 and 4.4. Maybe it's 4.35. That at least was the CNBC-TV18 average. I think going by the kind of index numbers I'm seeing in front of me, that's a calculated number. But why has food fallen so much? The two big elements that have led to the fall are cereals and pulses. And mind you, cereals and pulses are very heavy in terms of their weightage in the index. They have seen a month-on-month and a year-on-year fall. People don't expect that from May to June, the prices will fall so much for cereals and pulses. Like I told you, they're weighty items, and that's dragged the food inflation down. Vegetable prices always rise. In the wholesale price index, the year-on-year rise was 18%. Now, this month, the consumer price index also indicates a 7% rise in June over May. That happens because of rains. There is dislocation, some vegetables rot away. So you do expect a seasonal price rise in June over May. But look at the year-on-year. You have to compare it seasonally comparable, right? June over June. June over June, vegetable prices have fallen by 19%, for God's sake. And pulses, of course, the one I already referred to, down by 11%. Cereals up by just 3.7% year-on-year. And finally, the important element, oils and fats, edible oils, because of the cut in the duties, have also been falling. This for the month of June, they are almost flat with the May numbers. That would have been a negative in year-on-year terms. The prices are higher, but it's negated if you look at it month on month. So all told, it is food that is the huge surprise. It's almost deflation territory. And if it is 2.1 in June, there is every chance that it is going to be less than 2% in July if the current food and vegetable prices continue. So, I mean, the Reserve Bank's average, April, May, June, they had given us an expected average of 2.9%. Now the number is coming at 2.65%. I mean, sizably lower than what the Reserve Bank said. It's not just 5 basis points. It's a good 25 basis points below what the Reserve Bank forecast for the first quarter. Now chances are for the full year, the Reserve Bank said 3.7. Almost everyone is going to come down to 3.5 or 3.4. So then the question will arise, is there space for another rate cut? More on that later.
All right. Thank you, Lata, for that comprehensive update. All right. Shifting focus to the day's market action. Sensex and Nifty ended the day in the red, with the broader markets outperforming the benchmarks. Nifty held on to levels above the 25,000 mark. IT stocks remained a drag for the Nifty, with the IT index being the biggest laggard today. Prashant Nair joins us now with the day's market action. Prashant.
A sideways day from the word go, and it didn't change over the many hours that the market traded and into close as well. It was not down large, but it was sideways, and there was little attempt at a recovery. I think you can put the blame squarely at the feet of what the IT index did. It was down and down over 1% for the second day running. TCS numbers Thursday evening, sort of taking the IT space, softening it up a little bit on Friday, and that continued today as well. But apart from that, you look at what the mid and small cap indices are showing up on your screen, it didn't look bad at all. Actually, even the Nifty Bank was absolutely flat. So mid cap index 3/4, small cap index almost about 0.75% higher. You look at lots of sectors. Real estate did well, pharma, healthcare, capital markets. So the entire pack holding out quite well. I'll just start with the Nifty for what it was worth. Jio Finance was down about 2%. It was the only 2% plus loser today on the Nifty. Bajaj Finance down about 1.7. And then comes the IT that I was talking about. Tech Mahindra, Infosys, Wipro, TCS. These were all down uniformly about 1.5% apiece today. What was higher? Zomato was up about almost 3%, so 271 on Zomato. Titan was up about 1.33%. That's it. I mean, two names with gains in excess of 1% in terms of what we had on the index. Now we come to the broader market, which of course is an entirely different story. So market breadth was almost 1:1. I'll start with what was up because, really long list of volume-led gains. Ola Electric, almost 20%, number one NSE volume-led gainer today. JP Power, I think, was up 20% on Friday. It's up another 15 today. From 15 to almost 27, 28 rupees very quickly on this one. Second largest volume-led gainer today. Newland was at number 3, 20% here, huge volumes. Anand Rathi, big mover on Friday, big mover today, 16% on Anand Rathi. There was Piramal Enterprises up 6%. VIP Industries ended about 5.5% higher. Godfrey Phillips was up 7.5% today. MTNL, we of course reported on an exclusive story. India Mart was up 5%. Prime Focus, Limit up 10%. Again, very large volumes in this one. Tega Enterprises ended up about 5% or so. There was AB, the distillery company, 10% on ABDL. And I could go on. Blue Jet, Thyrocare, Everready was up about 5% or so. So, I mean, pretty vibrant list if you look at the broader market space. On the downside, you had Garden Reach, which was down 5% today. Something like a Techno Electric was down about 3.5%. Hubtown lost about 4% today.
Right, thank you, Prashant, for that. Moving on, market regulator SEBI has confirmed that Jane Street has deposited more than 4,800 crore rupees in an escrow account, complying with its interim order of July 3rd. The company also requested SEBI to lift certain conditional restrictions, which the regulator is currently examining. Now, earlier this month, SEBI had banned the American trading firm from accessing the Indian securities market for allegedly manipulating the market and unlawfully gaining over 4,800 crore rupees. All right, on to the crypto markets. Bitcoin has hit a record high of over $122,000. Optimism about growing institutional adoption supported prices of the digital currency. Bitcoin prices have been on the rise in the last week, fueled by strong ETF inflows and rising expectations of more crypto-friendly regulation in the US. Meanwhile, the price of silver has reached its highest level in over 13 years. The metals prices have risen 7% this month and 27% in the last year as robust industrial use drove demand higher. We told you first, and now it's official. VIP Industries Promoters has agreed to sell up to a 32% stake in the company. Mangalam Malu joins us now with the details. Mangalam, take us through the contours of this deal.
Well, it was the deal of the day for sure. Promoters of VIP Industries decided to sell up to 32% of their stake to Multiples Private Equity and a consortium of other investors as well. Initially, the stock opened lower because the deal price was 388 rupees per share. The stock had already seen a 75% rally from its 52-week low in the run-up to this deal. But more importantly, all the excesses were out of the system once the news was in. But thereafter, the belief that maybe the new owners could turn this company around, a stock which has been an underperformer in the sector, could actually do a lot better going forward. The street is betting on that, and thereafter we saw that recovery from the lows on the counter itself. We spoke to Dilip Piramal, who joined us in our studios, and was fairly candid. He said that he had no option but to sell this business because there was a management crisis. More importantly, senior leadership wasn't performing, and at the same time, none of his family members were willing to take up managerial positions and run the company on a day-to-day basis as well. So left with no option and loss in market share as the business was not doing well over the last few years, he had to go ahead and sell to private equity. The choice for private equity was rather simple. He said private equity investors are usually, betting on improving the value of the company and increasing the valuation as well going forward and the profitability, and that was his best bet. He will hold 20% stake in the company, will have to pare it down to almost 8% in the next 3 to 5 years, for which he has a right of first refusal with Multiples Private Equity as well. He says the company needs good management to get its old mojo back. Let's see how that performs. For now, the street is betting on the ability of Multiples and the legacy of brand VIP to take it forward from here on. Let's hear out what Dilip Piramal had to say to us.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value. There is a clause that as 20%, I am still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
EU trade ministers are meeting in Brussels for urgent talks after US President Trump threatens to impose 30% tariffs on the bloc. French President Macron has called for the EU to defend its interests resolutely, while Germany's Merz and Italy's Meloni called for calm. The US president said that tariffs were imposed on EU because of a trade imbalance. Remember, the tariffs on the European bloc are steeper than the 20% tax that Trump unveiled in April. European Commission President said the EU is prepared to take the necessary steps to safeguard its interests. However, the bloc delayed its retaliatory tariffs on the US exports, which were due to start on Tuesday.
We're dealing with other countries and certain countries that would rather have a deal than a regular tariff. And we're willing, if they're willing to open up. These are countries that have been shut to us, but we've been open to them. In other words, they wouldn't let us do business there, but they would do business in our country. Not a fair deal. So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country.
All right, it's time for a short break. Coming up next, the Aircraft Accident Investigation Bureau's preliminary probe report into the Air India plane crash says the fuel control switches had transitioned from run to cut-off position seconds after the aircraft went down. Details when we return. Welcome back. The Aircraft Accident Investigation Bureau released its preliminary probe report into the June 12 Air India Ahmedabad plane crash over the weekend. The report has highlighted that the fuel control switches transitioned from run to cut-off position within a second of each other, moments after lift-off. The report says that one of the pilots can be heard on the cockpit voice recorder asking the other why he cut off the fuel, to which the other pilot responded by saying that he did not. The full transcript of the cockpit audio has not been released. The report has also recommended no action against GE or Boeing at this stage. Air India CEO Campbell Wilson has said that the preliminary report had found no mechanical or maintenance issues with the aircraft or engines. In a statement addressed to Air India staff, Wilson said that the report highlighted that there was no issue with the quality of fuel. Meanwhile, sources have said that the aviation regulator may soon order an inspection of the fuel switch locking mechanism of all 787s. Madiha Mujawar, who's been very closely tracking these developments, joins us on the broadcast. Madiha, what are these fuel switches and how do they work?
Well, the fuel control switches on the Boeing 787 are now at the heart of this investigation of the AI-171 crash. The AIB's preliminary report reveals that the fuel supply to both engines was cut just seconds after takeoff. Why? Because both fuel switches were moved from run to cut off, essentially killing power to the engines. I obtained this video that you will watch on your screen from a 787 engineer showing how these switches behave. You can see they are built not to move on their own. You can see that these aren't your ordinary toggle switches. Each fuel switch on the 787 is protected by a spring-loaded V-shaped locking mechanism. Think of it like a mechanical guard sitting firmly between two positions. Run when the fuel flows to the engines, cut off when the fuel supply stops. To move them, you have to pull them out, as you can see in the video, then move them up or down depending on when you're using them. The V-lock has a job. It blocks the switch from sliding unless it is intentionally lifted. In other words, you can't just bump these switches with your hand, elbow, clipboard, or even turbulence and expect them to move. The lock was designed to prevent exactly these situations. But back in 2018, the US FAA flagged cases where these switch locks disengaged unexpectedly and recommended inspections of the locking mechanism and replacement if the locks disengaged, something that was not done by Air India. The AIB says that both switches moved within 1 second, but it is still unclear who moved them or why one pilot is heard asking the other, why did you cut off? And the other replied he didn't. That line alone points to uncertainty in the cockpit, suggesting that even the crew was surprised by what had occurred. So could the switches have moved unintentionally despite the locking design is one question. Or is there a deeper mechanical or electrical issue where the switch state remained in run position physically, but internally the system interpreted it as cutoff? Now, what we do know is this. Moments after the cutoff, the switches were turned back on, restarting both the engines. So there's another possibility, given the pilot's exchange, is if it was deliberately moved to cut off by one pilot and he lied to the other pilot that he didn't do it, and then the switches were turned to run. That is one possibility. Another important factor was that the landing gears not retracting, as we watched in the video as well, and the AIB report also talks about it, that the landing gears were not retracted after takeoff. That has also raised questions if there was a bigger system failure that we are not aware of. Now, switches are the crucial part of this investigation for now. They are small, but the implications are massive, not just for one flight, but for an entire fleet of aircraft worldwide flying every day around the world at different airlines.
All right. Thank you, Madiha, for that update. Moving on, shares of Ola Electric surged after its first quarter net losses halved sequentially. The company's margins also doubled compared to last month. Sudarshan now joins us with Ola Electric's earnings snapshot. Sudarshan.
Ola Electric stock has today jumped up to 20% on the back of Q1 FY26 earnings. Ahead of the earnings, stock was at a 52-week low, down more than 53% in 2025 and down more than 75% from record high that stock had seen in August of 2024. So what has worked for the company in Q1 of FY26? First, earnings have improved on a sequential basis, and second, the guidance that company has provided for FY26 is looking healthy. So now first talking about the earnings, losses have narrowed on a sequential basis and similar trend was seen on revenue front. It has seen an improvement on a sequential basis, but the biggest positive was gross margin. In Q1 of FY26, gross margin has come at 25.8%, sharp improvement that company saw from 13.8% that it reported in Q4 of FY25. Now going ahead, company is saying that by the end of FY26, gross margin including PLI benefits may be in the range of 35 to 40%. If it manages to achieve that, it would be an improvement up to 1500 basis points from the current level. Now on the volume front, company is saying that by the end of FY26, it's expected to be in the range of 3.25 to 3.75 lakh units, and that would be against 3.59 lakh units that it saw in FY25. On the revenue front, it's saying that it will be in the range of rupees 4,200 to 4,700 crore, and that means that it might be a decline of 7%, or on the upside, it may be of growth up to 4%. So overall, more than the earnings of Q1 FY26, what has helped the company stock basically surge 20% was the guidance that it has given for FY26.
Thank you, Sudarshan, for that. And speaking of Ola Electric, the Maharashtra State Transport Department has flagged concerns over the operations of Ola Electric stores in the state. The State Transport Commissioner told CNBC-TV18 that around 350 outlets are functioning without proper permissions or licenses. The Commissioner also confirmed action has already been taken against some of these stores. The department has now directed Ola to apply for the necessary licenses and permissions required to continue operations. Authorities are expecting a formal report and response from Ola Electric by the end of the day. And the Finance Ministry has held interministerial talks on proposals to cut GST rates on various items. Sources have said that the government will also meet with states to discuss rate rationalization and merging of GST slabs ahead of the GST Council meeting. Tim Zee Jaipuria joins us now with more. Tim Zee, what are your sources telling you?
Well, the talks have picked up pace yet again and getting heated day by day as we await to see when the GST Council meets. Meanwhile, what sources are indicating to us is the fact that the Finance Ministry officials have held interministerial talks on GST rate rationalization ahead of the Council meeting. The officials have sought inputs on rate rationalization from Department of Commerce, Home Ministry, Department of Pharmaceuticals, Health Ministry, Department of Agriculture, Department of Fertilizers, Heavy Industry, Rail Ministry, and all those key departments where the items falling under 12% slab are actually the line ministries, to take a view that what should be their understanding, whether the item should move up at 18% or to be reduced at 5%. So these are the discussions that are happening at the level of centre. Finance Ministry officials have also briefed top PMO officials on these proposals regarding rate rationalization and slab reduction. Also, the top government, we understand from sources, is likely to discuss GST rate rationalization and slab tweaks proposals with the states before the council meet to have a smoother decision when the council actually meets. Meanwhile, when we sent a query to Finance Ministry on these interministerial talks, we await a response right now. And just to remind our viewers, on the agenda for the upcoming council could be to do away with 12% slab, moving the items of these 12% slab to other rates. It could be 5%, could be 12%, could be 18%. And the GST Council is likely to take up these decisions when they meet up next. Let's see what happens, whether the decision is actually taken or not, something that we'll have to wait and watch for.
All right, thank you, Tim Zee, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Hello and welcome to this special edition of State of the Economy. I'm Lata Venkatesh and we are discussing the June consumer price inflation number that has just hit the stands. The number indicates a 2.1%, the lowest since, I think, February of 2019. The inflation of 2.1%, and it is lowest okay, it's not February, it's lowest since January 2019. The fall is sharper than expected by the CNBC-TV18 poll, which threw up a number of 2.3%. Now, the important point is that inflation has been dragged down primarily by food prices. Food inflation would be a misnomer, actually. Food inflation is at a deflation. It is at a 6.5-year low, and as you can see, at minus 1.06. So that's the reason why the inflation number has shocked to the downside. Now, the core inflation number, which is everything other than food and fuel, is called core, largely personal services, which cannot be imported. Medical services, education services, those would come under core, and that has risen by about 4.4%. Now, to discuss these numbers more, we are joined by Rajni Sinha, the chief economist from CareEdge Ratings, Anubhuti Sahai, the head of India Economic Research at Standard Chartered Bank, Sameer Narang, the head of Economics Research Group at ICICI Bank. In a bit, we are also going to be joined by Kaustubh Gupta, co-head of Fixed Income at Aditya Birla Sun Life AMC. Ladies and gentlemen, thank you very much indeed for your time. Sameer, to you first. This is a shocker, this 2.1%. What is your sense about the future course? Are we going to go below the RBI annual number of 3.7% by a wide margin?
So, Lata, on the RBI trajectory, which is at 3.7, we are at 3.3 for the year, with most of the undershoot happening in Q1, Q2, and Q3. Q1 undershoot is not much. RBI is at 2.9. It's in Q2 and Q3 where the undershoot will be the maximum compared to RBI's trajectory. And you rightly said that it's largely driven by food prices. And within food, it's the vegetable price index, which is driving it, because vegetable prices last year rose by 20%. And this year in Q1, you've looked at a number around 14% decline or deflation that you spoke about. So those are the factors. But within food, there is a lot more broad-based trend that is playing out because of a good monsoon last year and plentiful rainfall this year as well. So cereals, pulses, all of them are showing a decline, and that is expected to continue this year. But unfortunately, too much of a good thing this year will result in a low base. And because of that, led by vegetables, food prices ideally on a low base will be higher next year. So next year, we are pretty much in line with RBI's trajectory of 4.5%. But this year, we are 40 basis points lower than RBI, largely driven by inflation drop up to December. In March quarter, number will be close at 4.5, 4.6.
Okay. Well, Anubhuti, would you agree with what Sameer is saying? There are numbers on the street that July is going to be below 2%. Considering that, June numbers have come so much below consensus expectations, a good 25 basis point below. Consensus was 2.35. So, it's a 25 basis point lower than consensus. So are we staring at a sub 2%? And what's your annual number?
For monthly inflation prints, Lata, I think it's a very high probability scenario that we'll get at least a couple of prints of below sub 2%. So next month's print, at least based on data published till now, we are seeing a sub 2% number. Probably September might again see a sub 2% number. But I think if we just zoom out and look at the medium-term target of 4%, I think edging above 4% is likely to take some time. It won't come before the first quarter of 2026, and probably there might be some downside surprises there too, on a host of factors. One, global commodity prices remain very, very well contained at this point in time, and if we look at the tariff tensions, they are escalating rather than de-escalating at this point in time. Secondly, food prices, as we all know, have been moving lower. Monsoon, we are still in the middle of the season, so I don't want to take too much of a comfort. But all said and done, the reservoir levels, even in the regions where rainfall is deficient, looks absolutely healthy and fine. So there is a possibility that we might see it trending lower. And from MPC's forecast perspective, clearly there is a downside risk. Our forecast is 3.5%. And I think based on today's number, again, let me emphasize, based on today's number and the trend on prices till now, I would say there is a downside risk of at least 30 to 40 basis points even to our annual forecast.
Okay, 30 to 40. So what would your approximate number be, you said?
Our annual forecast is at 3.5%. The tracking number...
There could be a downside.
There could be a downside based on today's print and whatever food prices we are seeing on the ground till date.
So you're looking at 3.3 or 3.4 for the full year?
3.5 with a downside.
No, I mean with a downside.
Yeah, yes.
Okay, before I come to the other economist, Rajni, let me get the bond dealer, the bond expert in. What is shocking about the whole thing, the yields don't seem to have moved much. I would have thought that the yields will at least show some kind of interest and move down. It's standing at 6.3. What are we missing here, Kaustubh? Shouldn't the market be expecting another rate cut?
Clearly, the global headwinds on the bond yields in the developed market is playing on the minds of the market as well. As you know, that for this week, we are going to see a lot of data on the US economy side, both on inflation, retail sales, and there are a line of Fed speakers which are planning to give their views for this week, which is why markets are more or less flat. Despite that, on the Friday, US yields jumped from about 7 to 8 basis points. In that context, we are fairly, I would say, stabilized. The second thing on your point is markets. Of course, these numbers are better than market anticipation. But given that RBI has already preempted a lot of rate cuts in its last monetary policy, and the consensus for the market is that probably RBI will wait for a couple of policies to make further next move. So market for now, they are looking more on what's happening at the global level rather than focusing on local inflation print alone.
Mm-hmm. Okay, got your point that, probably after going from neutral, going from accommodative to neutral just in the June policy, it may be difficult for Reserve Bank to sound accommodative anytime soon and even give a rate cut after you have gone to neutral just in the previous policy. So maybe they will wait and watch. But Rajni Sinha, on that point, do you expect that the Reserve Bank will move because inflation is likely to be, as Samir and Anubhuti are guessing, maybe 3.3, 3.4 this year? Or will they wait for weak growth signs and won't be satisfied with just inflation numbers because the base effect can take it away next year?
So Lata, when RBI last time had cut rate by 50 basis points, it was more than expected. And that was mainly on the expectations that inflation is going to moderate further going forward. And that's how inflation data is playing out. So I think RBI had already factored in that inflation is going to go down forward. So now if they cut rates, that will really be dependent on how growth data pans out. So if we look at the growth expectations now, RBI's expectation of around 6.5% for this year, ours is though a little lower at around 6.2%. But I would say around 6.5%, if we go with RBI's projection, that's pretty decent. And that doesn't warrant a rate cut immediately. I think RBI will go for a rate cut only if growth falters further. If the global scenario, I think this window open because if the global scenario worsens, there are too many uncertainties on the global front, specifically with the US trade policy uncertainties. So if we get, some very bad news on that front that hits our growth, in such a scenario, RBI would look at further rate cut. But otherwise, I think with inflation, they had already factored that and hence cut rate by higher than what the market was expecting. So I think they'll cut rate only if growth falters from here.
Well, let me take a quick poll from the four of you. How many of you expect a rate cut in 2025? I'm not asking for just August. Samir?
Well, our base case is no rate cut, but 125 is a possibility. So I would say...
And so do I count you as yes or no, yaar? I'm going to count you as a yes. Okay, Anubhuti?
Rate cut, that's our baseline.
Sorry?
No rate cut. That's
No
our
rate cut.
baseline.
Okay. Oh, you guys have this printed report. You can't swerve from your printed report. But I'm guessing that the next printed report is going to say yes for a rate cut. Rajni?
No rate cut if growth is okay. I mean, if it's around this range, 6.2.
I want your poll. We want monosyllabic answers. So no rate cut. Okay. Kaustav?
We do think that by end of this year, probably there is a window for one more rate cut. So we are in that camp. One more rate cut maybe by December policy.
Okay, so there are two guys. The guys are, kind of leaning towards the possibility of a rate cut, and CARE and Stan Chart have not yet written their report, so they're not going to give us a rate cut vote just yet. Okay, let me look at the growth numbers actually. Samir, look at okay, who was looking at the growth numbers? Rajni. See, the core growth number, 8 sectors, core sector number, came in at a miserable 0.7% for the month of May. For April, it was 1%. And likewise, if you look at the IIP numbers, again, the IIP numbers indicated something like, 2.6 for April and 1.2 for May. You couldn't call this growth. The numbers we are getting in the second quarter, I mean, we've only got IT numbers just yet. We don't have a sizable amount of consumer goods results just yet. But it is looking like, a little under the weather. The Q1 numbers are not expected to be, coming all guns blazing. So do you think that the Reserve Bank has enough disappointment on growth, Rajni?
Compared to last year, or I would say compared to the very good number of 7% plus that we saw in the fourth quarter of FY25, definitely there is going to be moderation in FY26. For the first quarter, we are expecting growth of around 6.4% or so. But I would say while, overall, we are expecting growth to moderate in FY26. Like I said earlier, we are expecting around 6.2% growth. But some points that we have to take into account is that right now there are some good positives for the economy. One, the monsoon has been good. So that is going to be supportive of rural demand. Second, the lower income tax burden that we are going to have for this year. Third, inflation has been going down. And fourth, most importantly, I would say that while on the global front, there are a lot of concerns, but still at this point in time, things don't look as bad as what we were fearing, say, 2-3 months back. Now, at least there's still not clarity on reciprocal tariff as to what's going to happen on that front. But probably it would turn out better than what was being feared, say, 2-3 months back. So even on the external front, the concerns I would have kind of abated. So overall, I would say that even if the economy records a growth of 6.2% or so, and I think there is probability of now it being higher because our concerns on the global...
Okay, Rajni, let me stop you there and take a quick poll. What are you all expecting by way of growth? Rajni, can you give me your Q1 number and your full year number? And likewise, Anubhuti and Samir. But first, I'll start with you, Rajni. What are you working with for Q1 and for the full year?
Q1, 6.4%. Full year, 6.2%. But like I said, there is an upward bias now because global concerns have somewhat abated.
Okay. Anubhuti?
Yeah, so for full year, we are looking at a growth rate of 6.6% and Q1 at close to closer to 6.8%.
Okay, so that's not really weak growth. Samir?
Well, as per the information available as of now, around 6.3, 6.4 is what you get in Q1, largely driven by spending by the center and the states. As you are, HFIs, you're right, are quite weak as of now. And for the full year, we are around 6.4 because H2, given the stimulus given by the government and RBI, ideally things should pick up in H2.
Okay. So we are looking at an average of about 6.4 if I take all the three of you, which is only a tad lower than what Reserve Bank is working with, 6.5. But it's clearly a downside bias to what Reserve Bank is forecasting. So it could have reasons to rethink its growth number. Quick break. We are coming back with more questions. Welcome back. You're watching a special edition of State of the Economy, and we have been discussing the June CPI numbers, which have come in at 2.1%, far lower than the 2.35, which the CNBC-TV18 poll threw up, a good 25 basis point lower than the CNBC-TV18 poll. The numbers have been dragged down largely by food inflation, which can't even be called inflation. There is a deflation of prices. The CPI has fallen by 1.06% from year-ago levels, and that's largely because of cereals and pulses prices falling and vegetable prices not rising as much as previous June. That's the story of the CPI number. We've been discussing with Rajni Sinha of CARE, Anubhuti Sahai of StanChart, Sameer Narang of ICICI Bank, and Kaustubh Gupta of Aditya Birla AMC. Ladies and gentlemen, thank you for your time. Let me come to the inflation numbers and what impact it can have on growth. Sameer, would you worry that, when numbers go to deflationary levels, and, the inflation is expected to be like a sub 3% for a better part of 2025, won't that have a negative impact on growth? Manufacturers manufacture with the expectation of a bit of a margin. If that's kind of getting denied, can there be a growth impact?
So, Lata, it will have an impact more on nominal GDP than anything else. The center also was looking at nominal GDP growth upwards of 10%. So it's very likely that you'll have a nominal GDP growth which is around 9% rather than 10% because of very low CPI, and even WPI print was in deflation that we saw earlier in the day. So all of that put together will have more of an implication for nominal GDP. For real GDP, the volume indicators, as you've already pointed out, some of them are turning weak. Though one of the few good things is that rural demand is holding up very well, be it for auto sales, be it for FMCG. And exports to the US are growing in double digits. They were up 20 or 21% in the first 2 months of the year. So there are a few bright spots despite whatever challenges that we see. But in aggregate, yes, there are a number of indicators pointing towards even the volume growth being slightly soft. But we do believe that the stimulus given by both the center as well as by RBI will start working through into H2. And that should lead to some pickup in, domestic demand as well.
Okay. Well, there are a set of bankers, at least, who believe that, or economists who believe that the fall in cost of credit is not reason enough for people to increase credit growth, to borrow more. You don't borrow more because the interest rate is low. You borrow when you're sure you have a job and you're able to repay the money. And that perhaps may not be a sentiment which is widespread at this point in time. I mean, we remember in the last cycle, up until 2004, credit growth was not picking up. But 2005 onwards, when interest rates started rising, credit growth went to 25 to 30%. So history does not always give you evidence that a fall in rates leads to a rise in credit growth. The more important question, Kaustubh, is how will Reserve Bank behave when it sees this number? Do you think that it may even stay off the VRRRs because growth seems to need more support, or at least inflation is giving them more comfort? Do you expect liquidity policy to be somewhat easier than the already easy policy?
Is that the question to me?
Yes.
Yeah,
the question to you is, do you expect Reserve Bank to keep liquidity even easier?
So, look, the point is we are living in the world of uncertain in terms of growth clouds are concerned. And clearly, India doesn't have any fiscal space, and which is why RBI is using its monetary space to support growth. And in that backdrop, they are not only cutting rates, but they are also making sure that the liquidity is accommodative. And which is why we do think that RBI will make sure that liquidity in the system is very, very comfortable. And it remains more than 1% of NDTL for the enabling of a better monetary policy transmission. VRR is just to make sure, VRRR is just to make sure that overnight rates, they don't fall below the RBI policy corridor, so that there is a sanity of RBI policy rates. And despite the VRRRs, as you can see, even in last 15 days, the overnight rates have trended between 5/4 and 5/2, which is where RBI wanted to be. This is the likely to steady state for next 1 year, at least at minimum.
Okay, fair enough. They have definitely kept it way below the 5.5% mark. That is way below the repo rate. Anubhuti, are you expecting any changes in the liquidity policy? Will the Reserve Bank be a little kinder and may not have to do too many VRRs?
I mean, look, on liquidity, I think I would completely agree with what Costa mentioned. RBI has been, kinder than what any one of us expected, in terms of announcing 100 basis point CRR cut in H2. VRR, they will have to continue doing to ensure that rate remains anchored to the weighted average call rate, and also to ensure that excess liquidity doesn't lead to any kind of a fraud. I mean, our data analysis shows that whenever liquidity is in excess of, or becomes closer to 2.5 or 3% of NDTL, that can lead to risk of froth bin in certain unproductive sectors. So from that perspective, VRR fine-tuning will continue, but RBI is likely to continue with its liquidity policy of keeping ample liquidity available for flow of credit to the right sectors in the economy.
Okay. Very quickly, Rajni, what are you all expecting in July itself? The dipstick survey I did indicated that you're definitely going to get an inflation below 2%. People were expecting it to fall from 2.35 to about 2.1, 2.2. Now that the June inflation itself is 2.1, there are quite a few people who have told me that they're expecting a sub 2% number. 1.8, I think, was SBI's number. Maybe it's going to be revised lower now after seeing the CPI. What about you? Are you expecting a sub 2 number in July?
Lata, we were expecting around 2%, but given that this number, the June number has come lower than what we were expecting, it's quite possible that in the next month we could get a number lower than 2%.
Okay. Samir, just a final question. What do you expect the governor might say in the August policy? Anything different to expect? Do you expect an easier tone? What would you have him? What would you want to ask him?
So I think, Lata, if you see the tone and the tenor was more about how the inflation trajectory is panning out in March and the next year. If the governor actually also emphasizes on the growth and the inflation outlook for this year, I think that will change people's thinking on where the RBI is heading in terms of its policy making. And on the liquidity bit as well, it's already been talked about. But here as well, what is the extent of liquidity that the RBI would be comfortable at keeping would also be important. Because for every 1 lakh crore of incremental liquidity, the WCACR actually is 3 basis points below the repo. So where they are ideally comfortable with the overall liquidity will give a sense to the markets in terms of pricing the money markets, and the entire yield curve gets priced off that. So I think...
Also, would you therefore say that the Reserve Bank is likely to stick to this 5/4 as the call rate for a little longer than the market fears?
I think may not be at 5/4, but maybe 5.35, 5.40, somewhere it settles, because the collateralized rates will be slightly, slightly lower. So I think the weighted average would come around the number you're saying. But yeah, pretty much that's where it is settled.
All right, we'll leave it at that. Samir, Kaustubh, Anubhuti and Rajni, thank you very much for joining us in this conversation. The sense we are getting from economists is that the door has certainly opened for another rate cut. It may not come as early as August. Perhaps the Reserve Bank will want to watch the growth numbers, and we will get them on August 31st. The April, May, June GDP numbers will be announced on August 31st. So the Reserve Bank will be in a slightly better position in September, or maybe I think October is the next policy, to cut rates if it wants to. As well, by then you would also know the first round of crop arrivals after the Kharif season. And therefore, maybe October would be in a better position. But it does look that the door opens for at least one more rate cut from the Reserve Bank, and allowing the call rate, the overnight rate, to remain below the repo rate, because the danger from inflation or the danger of prices rising because too much money is chasing fewer goods in the economy is not there at all. We are in a near deflationary situation when it comes to food prices. So that's it on this edition of the State of the Economy. Thank you for watching. More news and updates are lined up for you.
Hello and welcome to News Center. I'm Parikshit Luthra. The Aircraft Accident Investigation Bureau released its preliminary report into the June 12th Air India Ahmedabad plane crash over the weekend. The report has highlighted that the fuel control switches transitioned from run to cut-off position within a second of each other, moments after liftoff. The preliminary report states that one of the pilots can be heard on the cockpit voice recorder asking the other why he cut off the fuel, to which the other pilot responded by saying that he did not. The fuel transcript of the cockpit audio has not been released. The report has also recommended no action against GE or Boeing at this stage. Air India CEO Campbell Wilson has said that the preliminary report had found no mechanical or maintenance issue with the aircraft or engines. In a statement addressed to Air India staff, Wilson said that the report highlighted that there was no issue with the quality of fuel. Meanwhile, sources said the aviation regulator may soon order an inspection of the fuel switch locking mechanism of all 787s. Madiha Mujawar joins us now with the latest. Madiha, the fuel cutoff switches are at the center of the cash probe. For the benefit of our viewers, tell us how they work and also take us through the issues that the preliminary report doesn't clarify on.
Well, the fuel control switches on the Boeing 787 are now at the heart of this investigation of the AI-171 crash. The AIB's preliminary report reveals that the fuel supply to both engines was cut just seconds after takeoff. Why? Because both fuel switches were moved from run to cut off, essentially killing power to the engines. I obtained this video that you will watch on your screen from a 787 engineer showing how these switches behave. You can see they are built not to move on their own. You can see that these aren't your ordinary toggle switches. Each fuel switch on the 787 is protected by a spring-loaded V-shaped locking mechanism. Think of it like a mechanical guard sitting firmly between two positions. Run when the fuel flows to the engines, cut off when the fuel supply stops. To move them, you have to pull them out, as you can see in the video, then move them up or down depending on when you're using them. The V-lock has a job. It blocks the switch from sliding unless it is intentionally lifted. In other words, you can't just bump these switches with your hand, elbow, clipboard, or even turbulence and expect them to move. The lock was designed to prevent exactly these situations. But back in 2018, the US FAA flagged cases where these switch locks disengaged unexpectedly and recommended inspections of the locking mechanism and replacement if the locks disengaged, something that was not done by Air India. The AIB says that both switches moved within 1 second, but it is still unclear who moved them or why one pilot is heard asking the other, why did you cut off? And the other replied he didn't. That line alone points to uncertainty in the cockpit, suggesting that even the crew was surprised by what had occurred. So could the switches have moved unintentionally despite the locking design is one question. Or is there a deeper mechanical or electrical issue where the switch state remained in run position physically, but internally the system interpreted it as cutoff? Now, what we do know is this: moments after the cutoff, the switches were turned back on, restarting both the engines. So there's another possibility, given the pilot's exchange, is if it was deliberately moved to cut off by one pilot and he lied to the other pilot that he didn't do it, and then the switches were turned to run. That is one possibility. Another important factor was that the landing gears not retracting, as we watched in the video as well, and the AIB report also talks about it, that the landing gears were not retracted after takeoff. That has also raised questions if there was a bigger system failure that we are not aware of. Now, switches are the crucial part of this investigation for now. They are small, but the implications are massive, not just for one flight, but for an entire fleet of aircraft worldwide flying every day around the world at different airlines.
We will get you the latest from the Air India crash, but before that, let's take a look at one of the top stories today. VIP Industries promoters has agreed to sell up to 32% stake in the company. Mangla Malu joins us now with more details. Manglu, take us through the contours of this deal.
Well, it was the deal of the day for sure. Promoters of VIP Industries decided to sell up to 32% of their stake to Multiples Private Equity and a consortium of other investors as well. Initially, the stock opened lower because the deal price was 388 rupees per share. The stock had already seen a 75% rally from its 52-week low in the run-up to this deal. But more importantly, all the excesses were out of the system once the news was in. But thereafter, the belief that maybe the new owners could turn this company around, a stock which has been an underperformer in the sector, could actually do a lot better going forward. The street is betting on that, and thereafter we saw that recovery from the lows on the counter itself. We spoke to Dilip Piramal, who joined us in our studios, and was fairly candid. He said that he had no option but to sell this business because there was a management crisis. More importantly, senior leadership wasn't performing, and at the same time, none of his family members were willing to take up managerial positions and run the company on a day-to-day basis as well. So left with no option and loss in market share as the business was not doing well over the last few years. He had to go ahead and sell to private equity. The choice for private equity was rather simple. He said private equity investors are usually, betting on improving the value of the company and increasing the valuation as well going forward and the profitability, and that was his best bet. He will hold 20% stake in the company, will have to pare it down to almost 8% in the next 3 to 5 years, for which he has a right of first refusal with Multiples Private Equity as well. He says the company needs good management to get its old mojo back. Let's see how that performs. For now, the street is betting on the ability of Multiples and the legacy of brand VIP to take it forward from here on. Let's hear out what Dilip Piramal had to say to us.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years, and our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership.
Moving on to the big story we are tracking here. Global EV giant Tesla is all set to officially drive into India at 10:30 a.m. on Tuesday, the 15th of July. Tesla will formally launch its showroom in Maker Maxcity Mall in BKC, Mumbai. The EV major is likely to showcase 3 cars in India, the Model 3, the Model Y, which are sedans, the Model X, the SUV. The company will also announce dates when bookings will begin and the delivery timelines as well. Sources tell us that Tesla will initially import cars from Shanghai but may start imports from Berlin once the India-EU FTA is signed. Entry-level prices of Tesla cars are likely to be anywhere between 50 to 55 lakhs to even 60 lakh rupees, and prices could go up to 1.5 crore rupees for the Model X, which is the SUV. Now, deliveries of Tesla cars could happen in Q4 of 2025. Duties on imported cars make Tesla more expensive for Indian customers than they are in the US. However, Tesla is banking on duty reductions in India. Let me now go across to our guests. We're joined by Hemal Thakkar, Associate Director at Crystal Research, Arun Bhatt, founder of the Tesla Club India. They're joining us on the program. Thank you very much for being with us. Arun, you at Tesla Club India, you've been asking Elon Musk to bring Tesla cars for many, many years now. You were one of the first people to even go ahead and book a car as well. How do you feel today with Tesla finally getting ready to open its showroom?
Yeah, it's been a long 10-year wait for us who have reserved our car since 2016. Back then, it was the Model 3 that was available. And now, of course, we think Model Y is going to come into the picture, and let's see how things progress.
Right. Could you also give me a sense of what's happened with the reservations? How many people in India would have those bookings for Tesla already?
We know tens of people who have the reservation, but the ultimate number only Tesla would know. But there's quite a few number of people publicly who have said that they have reservations, and many still continue to have the reservations.
Okay. What do you think is the main reason for Tesla to come into India right now? In fact, they had been toying with the idea for a very long time. Their sales in China are down. They're having some stress in Europe as well. So what makes India more important for them today?
I think the Tesla compact low-cost model is expected in the second half of this year. That may be a reason why this time has been chosen, because Model Y has been there in the market for the last 3 to 4 years. But this may be the right time because they would like to test the waters with the Model Y and just set up the initial charging network and showroom and service network, so that once the compact car comes in, they have the entire setup ready.
Right. I wonder if we can go across to Hemal Thakkar as well. All right. We're getting Hemal also on the phone line. But just to ask you, Arun, this is an important time, and we're seeing a lot of competition for electric vehicles now, especially to 50 lakhs to 65 lakh space. Do you think Tesla will have a smooth run in India, or there is going to be a lot of competition and really nothing is given when it comes to the India market for Elon Musk?
One can argue both ways, but they probably have lost the first entrant advantage that they've given up to other players in the market. They're quite maybe 2-3 years late on that front. But maybe back then it didn't make sense because Model Y volumes in India would likely be very low. For example, in China, they sell 15,000 cars a week, whereas at the given price point, Model Y in India would be hardly 8 to 10,000 a year, max. So that may be the reason why they would have delayed the launch. Hopefully, Model Y will test the waters and we'll see how how the numbers stack up.
Right. Hemal, what do you feel about Tesla's India launch now? What kind of numbers do you expect them to get initially? Will they pose a strong and stiff competition for local EV makers?
The price point at which Tesla may be catering when they come to India will largely be comparable to the luxury car makers that we have in India. Merc, BMW, Audi. If you put them in that league, because the price points that they have will be largely in the range of about say 50 lakh plus. Okay, and last year the industry was somewhere about 6,500 to 7,000 odd units for such kind of vehicles. So now you are not looking at a very big industry size as of now. But yes, the proportion is definitely increasing. Year on year, it has grown by almost like close to 75% plus, over the last year. So from that perspective, going forward, even if you see that the industry size is going to be closer to 8 to 10,000, and Tesla has to make a mark in it, it's not a very big industry per se, but yes, they will definitely make their presence felt in the industry at this point of time.
Right. Hemal, I would also like to understand from you, what will be important if Tesla has to be successful in India? What is going to be the recipe that's important?
So if you ask me, my sense is, they will have to come in the mass market space, at least be there in the space of about 25 to 30 lakhs if they have to see reasonable volumes shaping up. Today, their ticket size is 50 lakhs and above. And for that, they may have to, localize big time in India. And, they may have to set up local manufacturing here in India, and then they may be in a position to do so. But if they're going to go on an import-driven model, it's going to be really tough for them to bring global launches here in India and be price competitive at the same time.
All right. Thank you so much, Hemal, for joining us, and Arun Bhatt for joining us, literally giving us a sense of what we can expect with the Tesla launch. We're going to be there at the Tesla showroom at Maker Max City Mall to give you all the live updates. And I'm sure many Tesla fans would be queuing up. And I hope there is some clarity for people like Arun Bhatt who booked their cars long back, but they've not really got any clarity on what happens with that reservation. And hopefully, Elon Musk and Tesla will clear the air on that front as well. Thank you once again for both of you for joining us. Let's now move back to our top story. The Aircraft Accident Investigation Bureau releasing its preliminary probe report into the June 12 Air India Ahmedabad plane crash over the weekend. Joining us right now is BJP MP, former Civil Aviation Minister Rajiv Pratap Rudy, who's himself an honorary pilot, joining us. Sir, thank you very much. Whatever happened on June 12, extremely tragic. This report gives at least some sort of clarity to the families of those who lost their loved ones. It was a terrible tragedy. What are some of the things that come to your mind after you go through this report as a pilot, somebody who understands the aviation industry very closely? Sir, you're on mute, sir.
Hi, sorry about it. I've been going through the report which has been published by the government and the AAIB report, and we were all eagerly waiting for it. And it's been within a month, it was submitted to the people, to the nation, and thanks to the government and the agency which worked to see that it is published. Now, there are a few facts in this which have been mentioned in the report. And we have seen that the aircraft does take off. It has been put in the report. It achieves a speed of 118 knots. It has been put in the report. And thereafter, something happens. And that is what is most intriguing. Thereafter, there is an action initiated by the aircraft in emergency, which is done by the aircraft on its own, which happens only when both the engines, in particular in Boeing's, happen, and in particular in Dreamliner, which has happened. The RAT has deployed, which is a equipment for hydraulics and electrical, and the APU, which is the auxiliary power unit, which is switched off before takeoff, starts operations. Like it starts, it moves on. Now, when these two things happen, it only happens when both the engines stall or they shut off. And this is, if this single engine would have happened, possibly these two things would not have deployed, which actually did. So the report categorically states that the engine did stall or the engine did switch off. The spool, it came spooled down, or it lost power. So that's a fact. Then there is a mention in the report about the lever switch, which is the ignition switch, being relit in a particular period of time. And it's also been indicated that after a particular period of time, the action of a captain putting back that switch from cutoff to on, or cutoff to on, has been performed and the engine has gained power. Now, in the report, one thing is significantly not been mentioned, but that how did the aircraft close or shut down? So that thing has not been mentioned. It has been left open. So as per this report, it has not apportioned the blame on the captain or the airlines or Air India, or for that matter, Boeing. It has not said anything. It's just given evidence of the things which have happened inside the aircraft and the things which time-wise were the actions taken. So this is something very intriguing. And we still have to wait to find out what AAIB says, who is responsible for it. It has not been spoken.
Mr. Rudy, what caused the fuel switches to move? Because in a matter of 1 second, they tried to move it up and down. They tried to bring the engine back to life. With your experience, your flying experience, and whatever you may have heard from experts, and through your understanding, what do you think could have caused these switches to move?
So in this very report, there's something mentioned about an FAA report in 2018, which has said that the fuel switch does not have a lock-in system. It is mentioned in one of the reports, and this was an advisory, but no action was taken. So this is one report which has been mentioned in this report, that the lock-in mechanism does not exist in this kind of switches. So this is a part of the report which has also been given in this report. The second aspect which comes is, for this, what I have learned from the senior captains of 787 Dreamliners, that in case of an engine shutdown, the process of relighting the engine is switching off the fuel control switch and switching it on. And when this process happens, the FedEx or the computer communicates it to the engine, and the relevant fuel injection and the start procedure is initiated. So it only happens when you switch it off and you switch it on. Possibly there is a gap which does not mention at what point of time the previous switching off had taken place, because there is no mention in the report. So in absence of these finer details, it is very difficult to say what could be the possible. There is also one report across the world which says that in millions of cases, one action can happen, and that is the FedEx failure, which is an electronic failure, which is a computer failure. So That has also been discussed. Unless and until AAIB comes back and says, this has happened and this is the reason why it has happened. It has said that the engines have shut down, but it has not.
So, Mr. Rudy, would you say that this preliminary report actually does not indicate the cause of the engine shutdown?
Yes. If you look closely, it talks about everything, but it doesn't talk why. Which action resulted in the engine shutdown has not been explained. So there is an option 1 there, there's an option B there, option C there. You keep on trying to figure it out. And that is why these conversations are going on, that captain could be responsible, or B could be responsible, or FedEx failure could be there, or the locking device did not activate. So all these are there because the AAIB has not concluded that which action resulted in the shutdown of engines. So we are
do you feel, Mr. Rudy, that in the present form, we're actually being unfair to the pilots who lost their lives? You know, they were highly trained pilots, very experienced, who did their best at that
Mr.
time.
Sabrawal had good 8,500 hours. The young boy also had about 1,000 hours plus. And you see that when you are flying a plane, and especially a commercial one, and there's nothing called a co-pilot or a junior pilot. Both the capabilities of both the pilots as far as flying the plane is concerned is more or less the same. And it is the seniority or the experience which is there with the commander who is cleared to be in command after clearing certain examinations, certain professional requirements. So I think both were good enough. And this time the pilot flying was the first officer and the pilot monitoring was the commander. So he was very much hands-on to whatever was being displayed on the screen, the engine performance, the roll, the speed, the checks, the rotation speed, and possibly there is some communication in between about the switches being put to off. Now, all that is all awareness. And I would feel that the commander, and I believe it is the commander, had the presence of mind to relight the engine, which in case of a 787 Dreamliner is the process which is a memory item. We don't have anything written. It's memorized that if both the engines fail, immediately switch it off and switch it on.
Do you feel, Mr. Rudy, it's now very important, considering that you've put out in the accident report that there was a conversation between pilots. One of them said, why did you shut down the fuel? The other said, I have not done this. This is not conclusive. This is not conclusive. Do you feel that more details should be put out?
Even one doesn't know who. I think they should have put it in the report. The commander who was a pilot monitoring said this, or the first officer who was a pilot flying said this. None of them said this. So it's not been indicated in the report actually who said this. And that should have come. And the time when it was said is also not been indicated in the report. So all these things become critical as you can see, the levers which are being pushed up. So, and when you are taking off, you don't look at this because it is assumed that it is going to remain in that position. So you have to stretch it. I have not operated these flights. I've used, and this is the process by which you ignite the engines. In case of a Airbus, you put engine 1 on, you put the ignition on, and they put engine 1 on and engine 2 on. But here it's a different kind of a switch which starts the engine. So let us see. Let us see how it works out. So, but I would refrain, and I think everyone should refrain from pointing a finger to the captain or maybe X or maybe Y till the time a factual report comes.
You're absolutely right, sir, because clearly there was something that went wrong, and we need to get to the bottom of it. What is the kind of questions you think the government must be asking of the airline, of Boeing, of GE, so that this doesn't happen in future? And at least from this investigation, what do you expect now should actually come out so that, you know, someone is held...
I will not speculate anything. I would not speculate anything. I will not conjure anything. And I feel very slightly upset when I find people in isolation picking up situations. The facts are there with the AIB. And there are other regulatory agencies across the world who may be cross-checking, because it's not at this point of time there would be more than 800 787 Dreamliners in air, with thousands of passengers. So we cannot make a speculation that this should have been done. Of course, There are a lot of freelancers who come and speak, but we should refrain from giving a reason unless until. And I think it would be in the interest of the airlines and aviation per se, that as early as we come to know where was the fault, things could be, people would feel happy about it.
Right. And I'm assuming, sir, it'll take at least 2 years for us to get the full report?
I am not the authority to speak on that. I'm really not the authority to speak on that. And I wish it could be earlier. But there exist certain gaps in the preliminary report, which possibly could get addressed in future, Parikshit.
We hope so too, sir. Thank you so much for joining us with your responses, your views on the terrible tragedy and the preliminary report and the gaps also that you pointed out. That's all we have time for here on News Center. Thank you for watching. Goodbye.
Hello and welcome to the Medicine Box. I'm your host, Ekta Batra. Today we are addressing a deeply worrying and increasingly common trend, the rise in sudden cardiac events amongst young Indians. It's no longer rare to hear of someone in their 30s, 40s or early 50s seemingly healthy and active collapsing without warning. At the gym, at marathons, at concerts, at home and not getting back up. These aren't just statistics anymore. They're people we know. From Ranjan Das, the 42-year-old CEO of SAP India, to 39-year-old banker Amit Kasat, 40-year-old actor Siddharth Shukla, 41-year-old cardiologist Dr. Gaurav Gandhi, 50-year-old singer KK. From a 19-year-old in Ghaziabad, a 24-year-old constable in Hyderabad, to a 35-year-old gym goer in Himachal. And most recently in Karnataka's Hassan district, 23 people between the ages of 30 and 55 died of heart attacks in just 40 days. What's truly alarming is that in many of these cases, the heart attacks were silent, with little or no warning, no obvious symptoms, and often no prior medical history. Sometimes the collapse happens just weeks or months after a clean bill of health. So what's really going on? Is it chronic stress, lack of sleep, poor lifestyle habits, hidden genetic flaws, post-viral complications, or overexertion unmasking a silent underlying condition? And perhaps the most unsettling question, could this happen to any one of us? In this episode, we break it down. Why are these events happening? What role do supplements, sleep, stress, and unseen genetic vulnerabilities play? And what exactly needs to happen in those crucial seconds or minutes after someone collapses? Because in many cases, CPR and access to an AED can mean the difference between life and death. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Dr. Mehta as well as Dr. Seth, welcome to the show.
Thank you, Ekta.
Well, Dr. Mehta, let's start with you. What is your reading of events where young, seemingly healthy individuals collapse at gyms, marathons, or in environments where they seem to probably be pushed beyond their limits?
This is an enigmatic problem for cardiology fraternity also. The reason is when the coronary arteries get choked up by the deposits of fats and cholesterol and etc., till they are clogged up to 70%, no symptoms occur. So the patients or the normal person, I might say not even a patient, does not see a need to see a doctor. And even if I do his tests, they may turn out to be completely normal. What happens is when a non-flow limiting obstruction suddenly ruptures due to external or internal stress, the one which is 40% blocked, that block becomes almost 100% in a matter of few minutes or hours. And that produces sudden heart attack. And 33% of the people, sudden cardiac death is the first symptom of heart attack. They don't get a chance to even contact a doctor. That is very enigmatic. So people who put themselves to an exercise or a gym where they're exercising, suddenly the blood pressure and the pulse rate go up. And the rate of rise of pressure and the blood pressure, the combined product, puts so much of stress that the plaque ruptures, a soft plaque ruptures, and what is 40% becomes occlusive to 100% and produces heart attack. That is the problem.
Many of the times, or most of the cases that we hear about, is that the person is at the end of the marathon. The person is at a gym and it's been a very intense workout, or they've been at a concert and it's, a high intense environment also when at a concert. So give us a sense in terms of why exactly it happens towards the end of a certain event, rather than, at the start where the stress is not probably that much.
Exactly, to some extent, Dr. Mehta did explain that. These people do not know that they have blockages in the arteries of the heart. The blockages in the arteries of the heart do not cause any symptoms till they grow beyond 70%. But extremes of exercise, like heavy weightlifting, like severe running, like even marathon running, or in a constrained and very sweaty atmospheres, a performance to the extreme where the heart rate goes up and the blood pressure goes up will suddenly cause that blockage to rupture and a clot to form on the blockage, suddenly blocking the artery up and creating a heart attack. It's almost like a drain where there was a narrowing but still the water was flowing, and suddenly kachra got stuck on it, and suddenly the flow to our pipes stopped. And that is why that sudden, and when it comes suddenly from a 40-50% blockage to suddenly 100% blockage, then the chances of not just the heart attack does happen, but the chances of it presenting as a cardiac arrest are a lot more. And that is why we say that those who want to go to extreme exercise, to gymming, to long distance running, or to extreme sports, climbing, trekking up the mountains, should always get a checkup done prior to these extreme exercises or sports.
Like it did happen, Ashok and Ekta, both, that a 23-year-old girl who was performing a dance performance on the stage just collapsed and died. But that could be a serious and vigorous exercise.
Yeah.
But that, I think, is one should understand that exercise is meant for fitness. We are not competitive.
Yeah.
We should not be competitive. That's a different ball game. We should not indulge into that. And that, I think, is important. Because you do not know that you have blocks or you don't have. Your doctor does not know that you have blocks or you don't have blocks. So in that situation, one should play safe.
Okay. Well, Dr. Ashok, that's exactly the case. A lot of these marathoners, people who, there are doctors who've collapsed also while running a marathon. So they obviously have had their medical checks and their medical work done. These are CEOs that we're talking about as well. So they have gone through that medical check. But despite that, they've still had an issue in terms of sudden cardiac arrest. So what has gone wrong or what hasn't been picked up during that medical check, Dr. Ashok?
So here is what we presume that they've had their medical checks. Firstly, a lot of this happens in smokers. Clot formation is a problem which is very high in smokers, especially during severe exercise. And many of these always say, oh, but I've had a checkup, I'm healthy. It depends upon, and then they are smokers. Now, smoking itself is a known risk factor for creating that clotting during severe exercise. So that's my first point. Second, what is the checkup they've had and what's the quality of checkup? A checkup always has to involve not a blood pressure check. So it's not just an ECG, an echocardiogram, a sugar test, and a cholesterol test. If we actually have these are major risk factors on us. And we are then able to control these risk factors in a much better manner, especially if there's a family history of a heart problem in our family. So we must understand that checkups are not expensive checkups. These are common checkups, but we need to know our risk factors. And in that risk factors, we got to control our hypertension, sugars, cholesterol, especially if you've got a family history of sudden cardiac death. We need to have an echocardiogram, which is a simple, straightforward investigation, and an ECG. By the way, it's also more important to understand that smoking is a no-no. A lot of patients come to me and say, I lead a healthy life. I do exercise. I walk daily. I eat well. Look at me. I'm so, health conscious. And then you ask them, what about smoking? Yeah, but I smoke, but that's okay. So I think we've got to understand all this. Finally, I'll also have to say, just like we've talked about, that blockages cannot be picked up by any testing. We can pick up risk factors, but we cannot pick up pre-existing blockages. So those who have a family history of a heart attack, which means any parent having died or having had a heart attack or having sudden death before the age of 60, we emphasize on them more personalized testing, which could even mean doing a calcium score on a CT or even picking up early blockages on a CT angio to be sure that we can put in preventive factors for them at an early age between 20 and 40 so that they don't get into the same problem as their parents did.
There are a couple of people who have all these tests cleared, right? The ECG, the calcium score, but they still have these events after many years of an exercise regime, which they're still used to. So what happens in those cases? What have they missed there?
So the basic issue is the fundamental cause, irrespective of any amount of risk factors, be it diabetes, smoking, or stress, obesity, abnormal lipids, whatever it may be. The basic fundamental issue, A, presence of a plaque within the coronary artery and the rupture of the plaque suddenly. So the issue comes, can we pick up the plaque? Can we pick up the plaque? Do we know how to treat it? These are the fundamental issues. Now, to pick up the plaque, ordinary non-invasive methods are useless. They can tell you only the function. Are the plaques flow limiting or not flow limiting? Are they there or not there? Is inferred. We do not know. We don't see. There is no non-invasive except CT coronary angio, which to some extent can tell you, yes, there is calcium, there are plaques, be a little more attentive. And even if the CT detects the plaque, at this point of time, how do we treat asymptomatic individuals? The medical science still is not decided about it. Had there been a situation that doing a plasty or a bypass carries a 0% risk and 100% success and it's cured forever, I would do it for everybody.
Yeah.
But that is not the truth. The truth is that the procedures have their own inherent risk, that the disease will progress or not progress, also it's not known. I would say this way, that would like what Ashok said, that those individuals, we should weed them out. We should separate them out. That those who are at a high risk of developing coronary disease, acute heart attack and sudden cardiac death, they should be treated intensively.
Okay.
That's all the message that I can say.
Well, Dr. Ashok, there was a case of a CEO who actually collapsed and was a very regular runner and around early 40s and collapsed one day. But one of the things that stood out was just about 4 to 5 hours of sleep for that person. How critical is sleep for cardiac health and for fitness, or for those who focus on high fitness activities?
Firstly, I must emphasize there is no single factor. It is multifactorial and it is a combination. For example, this CEO, and let's not even talk about individuals, but let's take that example. That CEO, who I don't know as a person who you're talking about, may have been doing all this, but I'm not sure whether he was a smoker, not a smoker, or she was a smoker. Secondly, lack of sleep could be just one of the reflections of many other factors. For example, lack of sleep is an important factor, but also could cause hypertension. He could be under a lot of stress, trying to meet numerous deadlines all the time. So stress comes in as another risk factor. We don't know whether he was a diabetic or not a diabetic, but was there a family history, which none of us would know apart from he himself.
Yeah.
And therefore, yes, let us also add into the two other important things in the recent times, which added on to this multiplicity of risk factors. And that's viral infection, mostly COVID, and secondly, pollution. These two are the most recent factors over the last 6 years to 7 years. We've increased the incidence of heart attacks. Again, like we say, a multiplication factor. So we must understand that when we put a single risk factor, that's not the risk factor. That single risk factor is just a reflection of a person having multiple risk factors and the person was not able to identify those multiple risk factors, which led to a heart attack. By the way, I also want to emphasize that 10% of these sudden cardiac arrests could be a viral infection affecting the heart, which leads to weakening of the heart muscle, which leads to irregular heart beating. And those irregular heart beatings can suddenly present during exercise as well. So there are a 10% usually of other risk factors, say perhaps a young footballer suddenly having a cardiac arrest on the field could have a genetic disorder of a cardiomyopathy, which could have been picked up in an echocardiogram or genetic testing, but he just couldn't locate that and would have had that. So
Dr.
we must keep a lot of things in mind and not just one risk factor.
Would you recommend such individuals to exercise the way they do?
Healthy lifestyle should be the way of life. It's not a treatment. It has to be practiced in your day-to-day life as a routine. And I would say that the key point is moderation. I mean, nothing is wrong in taking alcohol. Nothing is wrong in taking sweets once in a while, as long as you are in moderation. And I think the checkup, the health checkup, having established risk factors and having treated them, we must also monitor, are we achieving the targets? Are we achieving the goals? So that I think is very important. My message to people, that those who are at a high risk or even otherwise should get regular checkup done. I would put now the age limit of 25 and above, and therefore control the risk factors. Absence of disease does not, absence of symptoms does not mean absence of disease. That I think is my message.
Okay. What about COVID-19 and cardiac events?
See, people are attributing it to vaccine. That I don't think so is the truth. It's not established. COVID-19 can present as a heart attack during COVID-19 time. There were many patients who came to the hospital exactly simulating heart attack, including ECG changes, turned out to have a normal coronary angiography. So they were not actually the heart attacks of the natural history that we see with the blocks and whatnot. And second thing, those who have an existing disease, it could get precipitated by COVID-19. It happened that way. So this is the way the COVID-19 played its role in posing the problem to heart patients.
Okay. Well, Dr. Seth, what we've noticed is that most of these cases take place with men and rarely with women. Why is that? Is that because they have the estrogen protection?
I would dispel that completely right now on in your messaging. Women, the biggest cause and the biggest killer in women is heart attacks, cardiovascular diseases, the same as men. It has changed completely. It is 6 times more than any cancer, all cancers put together. And we talk about cancers in women, we talk about breast cancer, we talk about ovarian cancers, take all the prevention, but we've not emphasized to women that the biggest cause at the moment is cardiovascular diseases. So firstly that, and let's dispel that myth around being protected, etc. And the risk factors, by the way, are the same, but there's clear understanding that women have more severe heart disease. When they have heart attacks, their symptoms, by the way, can be totally atypical. It could just be sweating, nausea, vomiting, ghabrahat, and may not be typical. We also know that the ECGs in women are not entirely the same as men. And we also know that women present later because they're more interested, they're really focused towards taking care of the men folk and the family at home. And even when they have heart disease, they tend to take a backward role in that to say, oh, but I'll get my investigations done later. It's just because the sacrifices that they make for the family all the time present later. They have smaller arteries and they don't respond to many treatments as well as men. So why are we emphasizing that? We're emphasizing that because women need to understand that any atypical symptoms in themselves also may present as coronary artery disease, and women need equal checkups as much as men to make sure that the risk factors are well understood and that well taken under control. I just want to emphasize 2 other important things or 3 other important things which are very clear. And this is going to be very simple for people to understand. Those who have a family history of heart attacks or sudden cardiac arrest in their parents, brothers, or sisters need to start getting every checkup done by the age of 20, which should also include an echocardiogram and a blood test. And this can be done by a cardiologist and is very cheap, inexpensive. Those who are men or women, excuse me, but have risk factors of diabetes or hypertension or raised cholesterol should actually get their checkups done regularly. Otherwise, if they don't have the risk factors, like just like Dr. Mehta said, by the age of 25 onwards, they can get it done every 5 years. One of the important things about those who go for running, there's nothing wrong with people running, cycling for a long duration. Running, fast walking, cycling, swimming are aerobic exercises. Heavy weightlifting, gymming are anaerobic and exercises which are bad for the heart. Those who go into these aerobic exercises anyway, and those who go to gymming should have checkups done by a cardiologist prior to going for extreme exercising in a detailed manner, which the cardiologist would advise related to the extent of their extreme sports. It is so important that they have it done prior by a cardiologist. And finally, women need to present themselves early and understand that they may have atypical symptoms and they are a reflection of coronary artery disease, which is still the biggest killer in women. And finally, even just simple exercise of 200 minutes of brisk walking, what does it transfer to? 5 times of 40 minutes walking can decrease our chances of heart attacks by 25%.
All right, Dr. Mehta, what is it that one needs to do if in case there is a cardiac event? Or let's backtrack a little bit. What are the symptoms that one needs to respond to immediately of their own body if they think that they're having a heart attack?
Well, quite contrary to the popular belief that the heart attack is often associated with severe unbearable chest pain, in reality, the symptoms are very often mild. Discomfort in the chest, heavy weight as though mountains are on my chest, or compression or a constriction of the chest as if there is a tight bandage across my chest, pain sometimes radiating to the jaw or to both the arms, shoulders are common symptoms. Occasionally, rarely, the symptoms could be very mild symptoms, like just simply pain in the jaw. My suggestion is that any unusual symptoms which has not occurred before in the trunk, be it from the jaw to the upper abdomen, should alarm an individual to seek medical help.
Okay. All right. Now, this sudden cardiac event that takes place, how important is CPR and AEDs at that point in time?
I would say that the family where the member has suffered a heart attack, every member of the family should learn CPR. Apart from that, I think CPR should be mandatorily taught in the schools and in the colleges also. And you never know when you will be required to use it on your bystander, in your family member, so on and so forth. So I think it's important. More importantly also, important for telephone numbers of ambulance, nearby ICU, family members, etc. should be handy. This I think is very, very, very important.
AEDs?
Yeah, at important public places like in movie houses, in public railway stations, etc. I think all public places AEDs should be available. And I think it also can be taught. In fact, in Bombay, in Mumbai, we had started, there was a move which was undertaking how to teach CPR and also AED.
Okay, all right, Dr. Seth as well as Dr. Mehta, it's been an absolute pleasure. Thank you very much for taking your time out and speaking to us about something that is so important in terms of a topic and something that we'll probably revisit as we go on. Thank you very much for taking the time out and speaking with us.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we are tracking this evening. Indian equities begin the week with losses as silence over a trade deal with USA adds to uncertainty over tariffs. Sensex and Nifty dropped nearly 0.5% each as persistent weakness in tech stocks also weighs, but mid-cap stocks manage a show of strength. Market regulator SEBI says Jane Street has complied with the directive to deposit over 4,800 crore rupees in an escrow account. Adds that it is examining Jane Street's request that the conditional restrictions imposed under SEBI's interim order last week be lifted.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management.
A day after VIP Industries promoter announces selling up to 32% in the company to a consortium by PE fund multiples, Chairman Dilip Piramal says a management and ownership change was needed. Adds he will not be part of the new board, but has been offered the position of Chairman Emeritus. EU trade ministers meet in Brussels for urgent talks after US President Trump threatens to impose 30% tariffs on the bloc. French President Macron calls for the EU to defend its interests resolutely, while Germany's Merz and Italy's Meloni call for calm. Major European benchmark indices trade with losses. The Aircraft Accident Investigation Bureau's preliminary probe report into the Air India plane crash says the fuel control switches had transitioned from run to cut off position seconds before the aircraft went down. Recommends no action against Boeing or GE at this stage. Sources say the aviation regulator may soon order an inspection of the fuel switch locking mechanism of all 787s. Air India CEO Campbell Wilson says that the preliminary report on the Ahmedabad plane crash had found no mechanical or maintenance issues with the aircraft or engines. In a statement addressed to Air India staff, Wilson says that the report highlights that there was no issue with the quality of fuel. Ola Electric stays in the red in the first quarter of FY26, but the EV maker's performance improves on a quarterly basis and helped stock surge 20%. And in another update for the company, Maharashtra Transport Commissioner tells CNBC-TV18 that they have received multiple complaints of 350 Ola stores operating without proper permissions or licenses. Yannick Sinner becomes the first Italian player to win a Wimbledon singles title. The 23-year-old beat French Open winner Carlos Alcaraz in 4 sets. He is now a 4-time Grand Slam champion. All right, the big update that we are tracking at this hour, June retail inflation numbers are out. Let's go to Lata Venkatesh. Lata, over to you.
Well, actually, it's quite a pleasant surprise for the market or a shocker, depending on where you stand. The retail inflation has come at 2.1. The CNBC forecast was for 2.3. Actually, it was going towards 2.35, my average. There was one 2.2. It was SBI, which had a 2.21%. They were the lowest, but this has even beaten their forecast. And you can see the market was smelling that 2.35 will be beaten to the downside because we got the wholesale price index numbers at noon today, and the wholesale price index indicated a deflation in the food prices. People were prepared for a 1% fall. You know, food prices were the worry of the market, so to speak, up until, say, 4-5 months back, and now they have been falling consistently. But now the expectation is that, the food prices will fall very low. No one was expecting a deflation, but that deflation of about -1% has reflected in the CPI as well. Food index has come in by -1.06% for the month of June versus June of year ago. The CNBC-TV18 poll had indicated flat, 0.1% rise. Many of them had zero rise, flat from June numbers. This is not flat from June 24. This is a fall by 1.06%. My sense is that the core index would be more or less the same. It was expected to be by most analysts at about 4.4%. between 4.3 and 4.4. Maybe it's 4.35. That at least was the CNBC-TV18 average. I think going by the kind of index numbers I'm seeing in front of me, that's a calculated number. But why has food fallen so much? The two big elements that have led to the fall are cereals and pulses. And mind you, cereals and pulses are very heavy in terms of their weightage in the index. They have seen a month-on-month and a year-on-year fall. People don't expect that from May to June, the prices will fall so much for cereals and pulses. Like I told you, they're weighty items, and that's dragged the food inflation down. Vegetable prices always rise. In the wholesale price index, the year-on-year rise was 18%. Now, this month, the consumer price index also indicates a 7% rise in June over May. That happens because of rains. There is dislocation, some vegetables rot away. So you do expect a seasonal price rise in June over May. But look at the year-on-year. You have to compare it seasonally comparable, right? June over June. June over June, vegetable prices have fallen by 19%, for God's sake. And pulses, of course, the one I already referred to, down by 11%. Cereals up by just 3.7% year-on-year. And finally, the important element, oils and fats, edible oils, because of the cut in the duties, have also been falling. This for the month of June, they are almost flat with the May numbers. That would have been a negative in year-on-year terms. The prices are higher, but it's negated if you look at it month on month. So all told, it is food that is the huge surprise. It's almost deflation territory. And if it is 2.1 in June, there is every chance that it is going to be less than 2% in July if the current food and vegetable prices continue. So, I mean, the Reserve Bank's average, April, May, June, they had given us an expected average of 2.9%. Now the number is coming at 2.65%. I mean, sizably lower than what the Reserve Bank said. It's not just 5 basis points. It's a good 25 basis points below what the Reserve Bank forecast for the first quarter. Now chances are for the full year, the Reserve Bank said 3.7. Almost everyone is going to come down to 3.5 or 3.4. So then the question will arise, is there space for another rate cut? More on that later.
All right. Thank you, Lata, for that comprehensive update. All right. Shifting focus to the day's market action. Sensex and Nifty ended the day in the red, with the broader markets outperforming the benchmarks. Nifty held on to levels above the 25,000 mark. IT stocks remained a drag for the Nifty, with the IT index being the biggest laggard today. Prashant Nair joins us now with the day's market action. Prashant.
A sideways day from the word go, and it didn't change over the many hours that the market traded and into close as well. It was not down large, but it was sideways, and there was little attempt at recovery. I think you can put the blame squarely at the feet of what the IT index did. It was down and down over 1% for the second day running. TCS numbers Thursday evening sort of taking the IT space, softening it up a little bit on Friday, and that continued today as well. But apart from that, you look at what the mid and small cap indices are showing up on your screen, it didn't look bad at all. Actually, even the Nifty Bank was absolutely flat. So mid cap index 3/4, small cap index almost about 0.75% higher. You look at lots of sectors. Real estate did well, pharma, healthcare, capital markets. So the entire pack holding out quite well. I'll just start with the Nifty for what it was worth. Jio Finance was down about 2%. It was the only 2% plus loser today on the Nifty. Bajaj Finance down about 1.7. And then comes the IT that we were talking about. Tech Mahindra, Infosys, Wipro, TCS. These were all down uniformly about 1.5% apiece today. What was higher? Zomato was up about almost 3%. So 271 on Zomato. Titan was up about 1.33%. That's it. I mean, two names with gains in excess of 1% in terms of what we had on the index. Now we come to the broader market, which of course is an entirely different story. So market breadth was almost 1:1. I'll start with what was up because, really long list of volume-led gains. Ola Electric, almost 20%, number one NSE volume-led gainer today. JP Power, I think, was up 20% on Friday. It's up another 15 today. From 15 to almost 27, 28 rupees very quickly on this one. Second largest volume-led gainer today. Newland was at number 3, 20% here, huge volumes. Anand Rathi, big mover on Friday, big mover today, 16% on Anand Rathi. There was Piramal Enterprises up 6%. VIP Industries ended about 5.5% higher. Godfrey Phillips was up 7.5% today. MTNL, we of course reported on an exclusive story. India Mart was up 5%. Prime Focus Limit up 10%. Again, very large volumes in this one. Tega Enterprises ended up about 5% or so. There was AB, the distillery company, 10% on ABDL. And I could go on. Blue Jet, Thyrocare, Everready was up about 5% or so. So, I mean, pretty vibrant list if you look at the broader market space. On the downside, you had Garden Reach, which was down 5% today. Something like a Techno Electric was down about 3.5%. Hubtown lost about 4% today.
Right, thank you, Prashant, for that. Moving on, market regulator SEBI has confirmed that Jane Street has deposited more than 4,800 crore rupees in an escrow account, complying with its interim order of July 3rd. The company also requested SEBI to lift certain conditional restrictions, which the regulator is currently examining. Now, earlier this month, SEBI had banned the American trading firm from accessing the Indian securities market for allegedly manipulating the market and unlawfully gaining over 4,800 crore rupees. All right, on to the crypto markets. Bitcoin has hit a record high of over $122,000. Optimism about growing institutional adoption supported prices of the digital currency. Bitcoin prices have been on the rise in the last week, fueled by strong ETF inflows and rising expectations of more crypto-friendly regulation in the US. Meanwhile, the price of silver has reached its highest level in over 13 years. The metals prices have risen 7% this month and 27% in the last year as robust industrial use drove demand higher. We told you first, and now it's official. VIP Industries Promoters has agreed to sell up to 32% stake in the company. Mangalam Malu joins us now with the details. Mangalam, take us through the contours of this deal.
Well, it was the deal of the day for sure. Promoters of VIP Industries decided to sell up to 32% of their stake to Multiples Private Equity and a consortium of other investors as well. Initially, the stock opened lower because the deal price was 388 rupees per share. The stock had already seen a 75% rally from its 52-week low in the run-up to this deal. But more importantly, all the excesses were out of the system once the news was in. But thereafter, the belief that maybe the new owners could turn this company around, a stock which has been an underperformer in the sector, could actually do a lot better going forward. The street is betting on that, and thereafter we saw that recovery from the lows on the counter itself. We spoke to Dilip Piramal, who joined us in our studios, and was fairly candid. He said that he had no option but to sell this business because there was a management crisis. More importantly, senior leadership wasn't performing, and at the same time, none of his family members were willing to take up managerial positions and run the company on a day-to-day basis as well. So left with no option and loss in market share as the business was not doing well over the last few years, he had to go ahead and sell to private equity. The choice for private equity was rather simple. He said private equity investors are usually, betting on improving the value of the company and increasing the valuation as well going forward and the profitability, and that was his best bet. He will hold 20% stake in the company, will have to pare it down to almost 8% in the next 3 to 5 years, for which he has a right of first refusal with Multiples Private Equity as well. He says the company needs good management to get its old mojo back. Let's see how that performs. For now, the street is betting on the ability of Multiples and the legacy of brand VIP to take it forward from here on. Let's hear out what Dilip Piramal had to say to us.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. Of course, in India, there are some exceptions where even the 7th generation is doing well. So there was an absolute need, in my case, to have a change of ownership and management. So it is for the interest of the shareholders. I think we needed a change of management with change of ownership. You see, change of ownership, the party has skin in the game. And why then, private, as we are doing with the private equity player, is that the only aim of the private equity is to increase value. There is a clause that as 20%, I'm still designated as a promoter of the company. So in a period of 5 years, not before 5 years, but after 5 years, I am required to bring down my stake to under 8%.
EU trade ministers are meeting in Brussels for urgent talks after US President Trump threatens to impose 30% tariffs on the bloc. French President Macron has called for the EU to defend its interests resolutely, while Germany's Merz and Italy's Meloni called for calm. The US president said that tariffs were imposed on EU because of a trade imbalance. Remember, the tariffs on the European bloc are steeper than the 20% tax that Trump unveiled in April. European Commission President said the EU is prepared to take the necessary steps to safeguard its interests. However, the bloc delayed its retaliatory tariffs on the US exports, which were due to start on Tuesday.
We're dealing with other countries and certain countries that would rather have a deal than a regular tariff. And we're willing, if they're willing to open up. These are countries that have been shut to us, but we've been open to them. In other words, they wouldn't let us do business there, but they would do business in our country. Not a fair deal. So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country.
All right, it's time for a short break. Coming up next, the Aircraft Accident Investigation Bureau's preliminary probe report into the Air India plane crash says the fuel control switches had transitioned from run to cut-off position seconds after the aircraft went down. Details when we return. Welcome back. The Aircraft Accident Investigation Bureau released its preliminary probe report into the June 12 Air India Ahmedabad plane crash over the weekend. The report has highlighted that the fuel control switches transitioned from run to cut-off position within a second of each other, moments after lift-off. The report says that one of the pilots can be heard on the cockpit voice recorder asking the other why he cut off the fuel, to which the other pilot responded by saying that he did not. The full transcript of the cockpit audio has not been released. The report has also recommended no action against GE or Boeing at this stage. Air India CEO Campbell Wilson has said that the preliminary report had found no mechanical or maintenance issues with the aircraft or engines. In a statement addressed to Air India staff, Wilson said that the report highlighted that there was no issue with the quality of fuel. Meanwhile, sources have said that the aviation regulator may soon order an inspection of the fuel switch locking mechanism of all 787s. Madiha Mujawar, who's been very closely tracking these developments, joins us on the broadcast. Madiha, what are these fuel switches and how do they work?
Well, the fuel control switches on the Boeing 787 are now at the heart of this investigation of the AI-171 crash. The AIB's preliminary report reveals that the fuel supply to both engines was cut just seconds after takeoff. Why? Because both fuel switches were moved from run to cut off, essentially killing power to the engines. I obtained this video that you will watch on your screen from a 787 engineer showing how these switches behave. You can see they are built not to move on their own. You can see that these aren't your ordinary toggle switches. Each fuel switch on the 787 is protected by a spring-loaded V-shaped locking mechanism. Think of it like a mechanical guard sitting firmly between two positions, run when the fuel flows to the engines, cut off when the fuel supply stops. To move them, you have to pull them out, as you can see in the video, then move them up or down depending on when you're using them. The V-lock has a job. It blocks the switch from sliding unless it is intentionally lifted. In other words, you can't just bump these switches with your hand, elbow, clipboard, or even turbulence and expect them to move. The lock was designed to prevent exactly these situations. But back in 2018, the US FAA flagged cases where these switch locks disengaged unexpectedly and recommended inspections of the locking mechanism and replacement if the locks disengaged, something that was not done by Air India. The AIB says that both switches moved within 1 second, but it is still unclear who moved them or why one pilot is heard asking the other, "Why did you cut off?" and the other replied, "He didn't." That line alone points to uncertainty in the cockpit, suggesting that even the crew was surprised by what had occurred. So could the switches have moved unintentionally despite the locking design is one question. Or is there a deeper mechanical or electrical issue where the switch state remained in run position physically, but internally the system interpreted it as cut off? Now, what we do know is this: moments after the cutoff, the switches were turned back on, restarting both the engines. So there's another possibility, given the pilot's exchange, is if it was deliberately moved to cut off by one pilot and he lied to the other pilot that he didn't do it, and then the switches were turned to run. That is one possibility. Another important factor was that the landing gears not retracting, as we watched in the video as well, and the AIB report also talks about it, that the landing gears were not retracted after takeoff. That has also raised questions if there was a bigger system failure that we are not aware of. Now, switches are the crucial part of this investigation for now. They are small, but the implications are massive, not just for one flight, but for an entire fleet of aircraft worldwide flying every day around the world at different airlines.
All right. Thank you, Badiha, for that update. Moving on, shares of Ola Electric surged after its first quarter net losses halved sequentially. The company's margins also doubled compared to last month. Sudarshan now joins us with Ola Electric's earnings snapshot. Sudarshan.
Ola Electric stock has today jumped up to 20% on the back of Q1 FY26 earnings. Ahead of the earnings, stock was at a 52-week low, down more than 53% in 2025 and down more than 75% from record high that stock had seen in August of 2024. So what has worked for the company in Q1 of FY26? First, earnings have improved on a sequential basis, and second, the guidance that company has provided for FY26 is looking healthy. So now first talking about the earnings, losses have narrowed on a sequential basis, and similar trend was seen on revenue front. It has seen an improvement on a sequential basis, but the biggest positive was gross margin. In Q1 of FY26, gross margin has come at 25.8%, sharp improvement that company saw from 13.8% that it reported in Q4 of FY25. Now going ahead, company is saying that by the end of FY26, gross margin including PLI benefits may be in the range of 35 to 40%. If it manages to achieve that, it would be an improvement up to 1500 basis points from the current level. Now on the volume front, company is saying that by the end of FY26, it's expected to be in the range of 3.25 to 3.75 lakh units, and that would be against 3.59 lakh units that it saw in FY25. On the revenue front, it's saying that it will be in the range of rupees 4,200 to 4,700 crore, and that means that it might be a decline of 7%, or on the upside, it may be of growth up to 4%. So overall, more than the earnings of Q1 FY26, what has helped the company stock basically surge 20% was the guidance that it has given for FY26.
Thank you, Sudarshan, for that. And speaking of Ola Electric, the Maharashtra State Transport Department has flagged concerns over the operations of Ola Electric stores in the state. The State Transport Commissioner told CNBC-TV18 that around 350 outlets are functioning without proper permissions or licenses. The Commissioner also confirmed action has already been taken against some of these stores. The department has now directed Ola to apply for the necessary licenses and permissions required to continue operations. Authorities are expecting a formal report and response from Ola Electric by the end of the day. And the Finance Ministry has held interministerial talks on proposals to cut GST rates on various items. Sources have said that the government will also meet with states to discuss rate rationalization and merging of GST slabs ahead of the GST Council meeting. Timsy Jaipuria joins us now with more. Timsy, what are your sources telling you?
Well, the talks have picked up pace yet again and getting heated day by day as we await to see when the GST Council meets. Meanwhile, what sources are indicating to us is the fact that the Finance Ministry officials have held interministerial talks on GST rate rationalization ahead of the Council meeting. The officials have sought inputs on rate rationalization from Department of Commerce, Home Ministry, Department of Pharmaceuticals, Health Ministry, Department of Agriculture, Department of Fertilizers, Heavy Industry, Rail Ministry, and all those key departments where the items falling under 12% slab are actually the line ministries, to take a view that what should be their understanding, whether the item should move up at 18% or to be reduced at 5%. So these are the discussions that are happening at the level of centre. Finance Ministry officials have also briefed top PMO officials on these proposals regarding rate rationalization and slab reduction. Also, the top government, we understand from sources, is likely to discuss GST rate rationalization and slab tweaks proposals with the states before the council meet to have a smoother decision when the council actually meets. Meanwhile, when we sent a query to Finance Ministry on these interministerial talks, we await a response right now. And just to remind our viewers, on the agenda for the upcoming council could be to do away with 12% slab, moving the items of these 12% slab to other rates. It could be 5%, could be 12%, could be 18%. And the GST Council is likely to take up these decisions when they meet up next. Let's see what happens, whether the decision is actually taken or not, something that we'll have to wait and watch for.
All right, thank you, Timsy, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
course, Temp Holdings, one of the world's largest investors with a net portfolio value of $324 billion, has steadily expanded its footprint in India, with more than $40 billion already deployed and a commitment to invest up to $10 billion more over the next 3 years. The India story is clearly central to its global strategy. Today, we speak with Ravi Lamba, the India head of Temp, to unpack their portfolio playbook, sectoral bets, and how they see India's role in a shifting global order. Ravi, always a pleasure to have you. Thank you so much for your time here today on CNBC-TV18. How is Temp view on India really evolving in the current global macroeconomic environment? The India book, we understand, last was about $40 billion, and of course, you propose to invest another $10 billion, but it's still only 8% of the global portfolio. How is this expected to increase overall in the next 5 years or so?
Sure. No, thank you for that. I think our exposure this year in March 25 in India on a mark-to-market basis is at $50 billion US, and it was $37 billion last year. So it's grown quite well. It's grown with of course, the value of the portfolio underneath it has grown that we own, and we've deployed more capital last year. And we started 2 years ago with a view that the India story was attractive. It was very well placed with the 4 themes that Temasek invests in globally. The 4 themes that include the future of consumption, longer lifespans, and sustainable living. So these are the themes that we've been focused on, and digitization as a 4th theme. And if you look at these 4 themes, they fit very well. India fits very well in them, and therefore we've had the conviction to go and put more capital in India. And what happened 2 years ago when we said, looking forward, we can see the potential to deploy $9 to $10 billion over the next 3 years, and we've been well on track on that. We deployed just under $3 billion in the first year, and we've deployed more than $3 billion last year. And this is not a number that we are so fixated on. It's a number which we are hoping to deploy. Going forward, we can deploy more than the $9 to $10 billion that we talked about. Depends on the opportunities we find. India fits very well in the themes. More importantly, we took the view a few years ago to accelerate our deployment in India because we saw certain themes working really well for us. And the macro, for example, has been very strong in India. The $4.3 trillion economy. Yeah. Almost equal to Japan on a PPP adjusted basis. The capital markets have deepened a lot. We can talk about that if you like. The fact that inflation is well under control, below 5%. The economy is growing at 7%. India continues to be amongst the fastest of the large economies in the world in terms of GDP growth. And the foreign exchange reserves position is very solid. Monetary policy, government policy is consistent. Certainty is there. So we feel that's a very favorable environment for us to keep expanding our portfolio in India.
Well, if you are so bullish, Ravi, when do you see India getting to a double-digit share in the portfolio? And more broadly, in a world where, global investors are increasingly talking about India as a strategic hedge to China, does Temasek also view India as part of, a rebalancing within Asia, or would these be separate strategies?
So we don't allocate capital to geographies or sectors. We are very bottom-up driven investors, and so wherever we see the bottom-up opportunity, we will invest capital. And again, the 8% that you quoted is the right number, but it's an outcome of our investment activity. It's not that we decided that we would be X percentage in India, X percent in China or the US for that matter. What we're doing now, looking forward, we see opportunities to deploy capital in the US and in many countries in Europe. India, we are starting to increase our exposure in Japan. And of course, China is still a very stable part of the portfolio. So our activity is totally bottom-up driven.
All right. So, in the current environment, let me come to the markets in India. Almost now back to the peak levels that we saw in September last year. How are you positioning Temasek Capital in the listed space? Where do you see pockets of value? Which sectors really stand out?
That's a good question. Look, we are agnostic to public and private markets. We are, in fact, I would say that we are increasing our exposure to public markets globally. In India, last year, we saw value and we invested. We increased our stake in HDFC Life Insurance, for example. We invested in Kotak Mahindra Bank. Another example, we put more capital into an existing portfolio in AU Small Finance Bank. So we are in public markets. We continue to see wherever we continue to see value, we will put capital to work, and especially in companies that we own, we will double down as well. So ultimately, valuation is a point in time exercise, and when we look at investing, we are long-term investors. We are not fazed by short-term volatility, and we do look at intrinsic value as our test, basic test to put capital to work. So whether it's public or private, the same tests apply.
But let me stick to public, Ravi, for a bit then, because, financial, of course, has been a big theme for you. Half your exposure in India is there. Banks, insurance, and now fintech as well. What specific pockets in BFSI do you see meaningful investment opportunities in, where you're talking about doubling down as well? Are we going to see any big ticket deals from Temasek in this space?
Well, I think it's two different points. I think, yes, we are positive on investing in the capital market, in the public market stocks in India. We are looking at opportunities all the time. In fact, we are, like I said, we are indexing to put more capital in public markets than we have before. So that at the top level, that's how we're looking at it. Now, financial services is a sector we've always been focused on. We've invested in the banks for a couple of decades now. We've invested in them. We truly see them as proxies for economic growth, and more importantly, as we see the sector expand, we are finding opportunities in insurance, which we have investments in both general and life insurance, in the listed space and in the unlisted space. We had a portfolio company, Niva Bhupa, go public last year, so that's another good example of an insurance company that's matured to go to the public markets. And going forward, we see new categories of investment in the financial services space. I mean, we see opportunities in life insurance and general insurance, and beyond that, we see wealth management and asset management as well as emerging categories where we will look to deploy capital.
All right, so both life and general insurance and the wealth management space as well. Let me quickly switch to Haldiram. That was one of your big investments this year, 10% for about $1 billion. And then, of course, two more investors followed suit. But given the current consumer spending softness that we're seeing, how resilient is the consumption thesis behind Haldiram's, and how soon, as one of the key investors, do you think the company could look at a public listing?
So it would not be fair for me to comment on any particular investment. But I would say, stepping back, I would say the consumption story in India is still very solid. There is a period of slowdown. But again, like, we are long-term investors, and we really do think long-term. And what do we like about the long-term in consumption? We find India is a domestic consumption economy. That is why it doesn't suffer the volatility of international events. It's relatively stable. We like that. We look at consumption in different ways. Haldiram is an example of consumption in the consumer and the food space. And it's a great brand. So we look at value emerging from, great companies with great brands and great market share. And it perfectly plays well into that particular position. So that's really what motivated our investment. Great management team, great brand, great potential, both in India and overseas. And we think we can be investors who can add value. And that's the thesis. And look, consumption, thematically, we've been playing consumption ever since we've started investing in India. And I think it's suiting us really well. And we see consumption across many different parts of the economy, whether as you talked about, Haldiram, which is more consumer and food. In healthcare, we see consumption. Healthcare is part of consumption. Technology is part of consumption. Financial services is part of the consumption theme of the economy. So thematically, consumption is where we are very, very singularly focused when putting capital to work.
All right. Let me quickly touch upon the companies that are looking to go public, because quite a few in your portfolio are taking steps towards that, whether that is ICICI Pru and Pine Labs just having filed papers, CureFit, Lenskart, Licious. They're also taking steps towards that. How many of Temasek's portfolio company do you expect to IPO in this financial year or next? And, what really does the exit pipeline look like for you?
So two different points. I think I won't wager a bet on how many will go public, but you're right. There are several who are planning to access the capital markets because capital markets are favorable. There's a great place for great companies to go public. Investors are focused. There's enough liquidity waiting to be put to work. And more importantly, I think the timing has to be right to go public. And each of these companies that are looking to go IPO are going with a particular strategy in mind, whether it's got to raise capital, whether they want to provide exits to investors, etc. So they're all different reasons. From our perspective, we see the IPO as one event in the company's timeline. We may not exit, we may not sell a portion, and we may buy. So I think all options are open to us as we think about a company going public. At this stage, we have not planned any large exits from any of our IPOs. We will support the business as we have before when it was private, and then we will decide at the right time whether we should exit or take some money off the table or even put some more capital to work. So this is a conversation for once the company's gone public, not right now.
Okay, but what about Manipal hospitals? I mean, as the majority stakeholder, I mean, they've been in the news recently with that Sahyadri acquisition. When do you anticipate they will be IPO ready, or do you think they still need to bulk up further before a listing is explored?
I think Manipal Hospitals has good scale now with over 12,000 beds and 49 hospitals, and it's a scale at which it can go public. And we will evaluate, like I said before, from all the all the points I made before about timing and strategy and the rationale to going public. At the right time, we will tap the markets. The Sahyadri acquisition is a welcome addition to the portfolio, and clearly gives us good scale in the West, which was missing. We have scale in the South and in the East, and this is part of the footprint development. Now, how much will we scale is a matter of looking forward. I think when the opportunity is right, Manipal hospitals will look at scaling more. But that does not mean that the IPO needs to happen, in advance or post that. IPO, as I said, is a separate decision, and the board and the shareholders will make that call.
Well, another interesting space has been the quick commerce space in India. Of course, you have Zomato in your portfolio. Now we have its rival Zepto looking at an IPO. Rapido has just entered this space. As a long-term investor, how are you assessing the sustainability of this valuation premium, especially in a highly competitive and margin-sensitive segment, like Blinkit for Zomato?
Yes, I won't comment on the names, including our own portfolio company. But all I would say to you is that if I look at the future of consumption, the future of consumption is changing rapidly. And, short of, the restaurants and the home delivery of food, the cloud kitchens are back. We invested in Rebel Foods last year. These are all playing to that same vertical, which is expanding very rapidly. So I see a lot of future here. The key question in all of these businesses, as you rightly point out, is to make sure you develop a business that's profitable and can stand on its own feet and does not constantly need equity capital to fund its growth. Because if that happens, then the burn rate can get to you. So you have to be careful about how you build these businesses. You have to calibrate the long term with the short term. And, from our perspective, we are very happy and comfortable with our position in Zomato. It's done really well for us as an investment, but more importantly, from an execution perspective as well. So we see the long term. Quick commerce is something here to stay. How you execute it, how much capital you burn, and how much value you create, I think is really dependent upon each company's own strategy, which would not be fair for me to comment on.
All right, but is Temasek happy, as you said, with its investment in Ola, for instance, Ola Electric? We've seen the shares continue the downward move. Profitability, which you highlighted, that has been elusive for them as well. There's been reports of regulatory scrutiny of sales figures. How confident are you in the valuation upside in the case of Ola Electric?
Yeah, again, I will not comment on any particular investment of ours because it's not fair. But I would again say to you, EV as a theme fits very well into our sort of energy transition and our sort of focus on sustainability. And we made two investments in this space. One is in Ola Electric, as you said, and the other one was in Mahindra Electric. And both are doing, from our perspective, executing on something that's still very early in its journey. It takes time. This is a transition of, you're truly making a transition for consumer consumption. You're making a transition on usage. You're making a transition on, what different experiences electric vehicles contribute to customers. It takes time. And we believe that wherever there's opportunity, it'll come with some challenges. And our whole focus with our portfolio is to work closely with our partners in the portfolio, our CEOs, our founders, and help them through times when we can add some value. And that's really what we're doing right now. Let's see. The future is it's a long path for electric vehicles. I think it's just started.
Well, we've spoken quite a bit about the public sector and these listed companies, but in the private space, where really do you see room for, investment? Where do you see biggest opportunities emerging?
I think, again, it comes back to my consumption comment. We see opportunities across the consumption of the entire economy. I mean, India as an economy is very well suited when you think about consumption. Now, obviously, consumption has slowed down, and there are cycles in consumption. Because we are long-term oriented, we can hold through the cycles. And more importantly, when cycles are down, it's a good time to actually invest. Because from a long-term basis, with a $4.3 trillion GDP, and at some point in time, the GDP is going to double, that entire value creation will come through consumption. Even infrastructure as an asset class, underlying it is consumption. So we are on the private space, we are looking at healthcare services, and healthcare life sciences as one sector. We're looking at financial services, looking at technology, consumer and consumer tech. And I would say these are the top sort of 4 sectors in which we're very focused on, with financial services obviously being the bedrock of what we've held for many, many years here. So that's kind of our focus area. And ultimately, all of this will play into the consumption theme as we think about it. So in the private space, we're looking at a few things. One is we're looking to do more mature investments in slightly more mature companies where we can put higher amounts of capital to work and concentrate that position a bit more than we did before. So that's a slight sort of evolution of our strategy, where if we can find investments where we can put larger capital to work, we would prefer that than doing many, many small investments. So that's one thing we will do. And we will likely focus at the slightly more mature end as against the very early stage end, because we feel that, you know, the ability to concentrate and have a more deeper portfolio is easier when you don't have a very long tail of portfolio assets, which is what the early growth, what otherwise contributing to our portfolio. So that's one directionally what we will do this going forward. So as an example of that, you've seen we invested in Haldiram, we invested in VFS Global. These are all large investments where, you know, we have taken larger concentrated bets in, even though they're minority positions, we're happy to go on down that path. And similarly, where there are opportunities like Manipal, where we can increase our stake and even take a majority position, we're happy to do that too. So we can concentrate again on fewer assets with more dollars to work.
Ravi, hold your thoughts. We have a lot more to talk to you about, but we have to take a very short break. Don't go anywhere. We're back in just a moment. Welcome back. We're in conversation with Ravi Lamba, the Temasek India head, on the PE Giants playbook. All right. While you're looking at large investments in more mature companies, a quick word on Indian startups as well. Are you seeing more discipline in spends, in cash burns coming down, a bit more focus on governance and profitability, more cleanup? Is that a space that, Temasek would look at?
Yes, indeed. I mean, we have been invested, as you know, as you've seen from our list of investments in startups and early stage companies for a long time. But if I step back, over the last 10 years, we've seen a lot of changes happen, right? Money was, generally quite free. Interest rates were low. That whole environment has now changed. Interest rates are high, and money is more expensive. So that means high growth, which was in favor before, and at any high growth at any cost, now no longer is the theme, and it has to be a profitable growth. And we're seeing that mind shift change, not just because people wanted to change it, because capital is not available for companies that are, in a high burn rate. So that has already happened. We see that continuing to be the discipline amongst many companies. The companies that are leading will attract the capital. The companies that are struggling will obviously will probably have a longer path before they can raise the capital they want. And that is just the nature of the way the market is today. From our perspective, I think we are still investing in early growth across globally, not just in India. We have an innovation team, we have an early technologies team very focused on deep tech investing. But beyond that, for the core portfolio minority growth, investing will be, the evolution is a little bit away from that early growth, but more towards the slightly more mature companies where we can see the ability to deploy more capital in lesser companies. And of course, we continue to manage the early growth portfolio that we have. We manage it as a portfolio, and the overall portfolio outcome has actually been very good for us. In India, for example, you talked about Zomato, which is an early growth investment for us about a decade ago. Policy Bazaar is another example, and there are several others too.
Yeah. Well, globally, Temasek has been investing in the AI value chain, of course, energy transition, digital assets, these kind of things. How do we view, India's readiness in this space, and are we likely to see more Temasek capital flow into this domain in the next 12 to 18 months?
Yes, I think thematically AI is something we're putting capital to work. You're right. We have a AI pod in Los Angeles, for example, focusing on building capabilities in AI, etc. So AI as a space is front and center. In India, we're seeing a lot of AI-led activity in our portfolio companies, and there's a lot of improvement. There are two things happening in AI. One is you got to manage, the disruption that AI can create and affect your businesses. And the other one is what value AI can create. So we're looking at both. We are working with our portfolio very closely to determine where they should invest, in which certain applications, in certain, models, etc., across enterprise as well as consumer, so they can improve their outcome when it comes to an AI-specific impact. That's the main focus in India for our portfolio companies. We're not yet seeing, deep tech AI investment opportunities like we see in the US or we see in China or elsewhere. As and when that happens, we'll stay close to it, and we will look at deploying capital in those selectively as well. There are some, for sure, very promising, but we're focusing on that and looking at it more closely. Yeah, you said about renewables too, right, globally. I think renewables as well, sustainability is a big theme for us, and we are putting capital to work in energy transition, as well as in sort of areas where we can actually go and create platforms like O2 Energy, which we did in India with EQT. So that theme will continue.
All right, Ravi, just to sum up this conversation that we've had, quickly in the next year or so, how much more could you invest apart from that $3 billion that's been earmarked, and top sectors for fresh investments for Temasek?
Okay, I see. So, by the way, $3 billion has not been earmarked. What we said was we would invest $9 to $10 billion. We would target $9 to $10 billion in the next three years or so, is what we said 2 years ago. And like I said earlier, if we can find opportunities to put more than $3 billion, if they make sense, we will. Because we are bottom-up driven. We don't allocate to geography or sector. That's just a notional number. So having said that, I think the new sectors, there are no new sectors, if I can put it that way. Everything is around what I've already said, which is around our consumption theme, healthcare, financial services, consumer, technology, and are sort of places where we will focus.
All right. And in terms of exits, what are the sectors where you're seeing opportunities, and what kind of exits can we expect from Temasek? I asked you in the context of IPOs before, but you said IPOs are not necessarily for exits. You could even look to double down on these companies. So in terms of exits specifically, what's lined up? What are the top sectors where you may do so?
So again, we're not managing our portfolio exposure by sector in India. We're really managing it bottom up. So when I talk about an exit will happen if our intrinsic value test tells us that the thesis has played out and there's no more upside here to hold, as an example. Or we may exit to rebalance because we may feel that even though the intrinsic value test indicates we should hold, the position has become large and therefore we should rebalance just for risk purposes. So those are the reasons typically we would use to exit, partially or fully. In the last year, we exited our stake in Tata Sky, which is a very long-term holding for us. And that has been, as an example, O2 was exited because, the fund life that EQT had invested in was coming close to the end of its fund life, and therefore we exited that along with them. So exits are really opportunistic and dependent upon those situations. We have not planned any exits this year. Once the companies that we talked about in our portfolio, if they list, then we will think about at that point in time where the valuation is and how we want to rebalance our portfolio. So this is a conversation, is an ongoing conversation. There's there's no pre-mediated sort of exit plan.
All right, we'll leave it at that. Ravi, thank you so much for your time here today and for speaking to CNBC TV18. It was a pleasure speaking with you. Thanks very much.
Thank you. Thanks for having me. Bye-bye.
All right, on that note, we're going to wrap up this special conversation. Thanks very much for tuning in, but stay with CNBC TV18. More news and updates will continue on the other side.
Welcome to Indianomics. The threat of tariffs has been larger than the actual tariffs. President Trump has announced 25 to 50% tariffs on about 15 countries this week, but via letters, not executive orders. His executive order has actually pushed the effective date of higher tariffs to August 1, as we know. Now, that explains why markets have not reacted very badly to these very large tariffs that he has announced via letters. And then there is this threat to the BRICS countries that they'll be hit by 10%. There's also a threat for those buying crude from Russia. There is threat on pharmaceuticals. As of now, it appears that the world may have to live with 10% tariffs for all imports into the US, 50% tariffs on steel and aluminium, and a whole lot of threats. Now, what's going to be the upshot for EM economies, for the US itself, and for rates and currency markets? I have with me Chetan Ahya, the Chief Asia Economist at Morgan Stanley, Louis Squeeze, Chief Economist, Asia Pacific at S&P Global Ratings, and Sameer Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Gentlemen, thank you very much indeed for your time for what must be very busy days for all of you. Louis, let me start with you. If this is the status quo that we should get used to, about 10% to 15% imports and a whole lot of threats, what will it mean for the Asia-Pacific region? Should we be prepared for even lower growth?
Well, I think it's clear that both the elevated level of the US tariffs, but also the uncertainty around it that you indicated, is not helpful if you're thinking about where to expand, where to build factories, where to export to. So we expect this to weigh over the region, especially the more export-oriented economies, of which there are quite a number, of course, in the APAC region.
Yes, the uncertainty and therefore the problem with investments, problem for investors. Sameer, what about the impact on the US itself? the latest numbers we saw didn't look all that bad. I mean, even if you looked at inflation, it was not way higher, it was higher enough for the markets to remove the expectation of any cut anytime soon. Do you think the tariffs are going to show by way of higher inflation in the US sometime soon and therefore prevent the Fed from any rate cuts at all this year?
Hi, morning, Lata. Indeed, I think one of the interesting facts about data has been the US economy has proven to be a lot more resilient, even to all this level of unpredictability and the threat of higher tariffs. Now, part of the story could well be front loading. I mean, everybody is fearing those tariffs to go up and therefore exporting rather rapidly to the US. I think it's keeping up sort of general activity levels a lot better. But it is true. I think this high uncertainty around the tariff policy, we suspect will bear down on growth in the second half. Part of the equation has also been how easy financial conditions have been. Financial conditions in the US are right now easier than they have been since sort of early 22, and which has probably been part of why this resilience come about. The consumer balance sheets fairly clean, firm capex plans. Yes, I think sentiment has been weakening, but nowhere near about as large as one would have expected, given how big a shock to the global trade order the last few months have actually proven to be. Still, it's on watch. I suspect second half there will be payback to that front loading in a lot of trade activity. Our view in the House is that growth will slow down. I think we will avoid recession, but growth will slow down in the US. Now, as far as the Fed is concerned, our view is they'll probably only be cutting rates by December of this year. Risks are maybe more two-sided, but I'd argue it will require probably a lot weaker labor markets for the Fed to trigger rate cuts earlier than that.
Okay, then let me just finish the Indian or the Asian situation. We have never seen this kind of rate differential between India and the US. What does that mean for the Indian currency? Do you think that there could be appreciation bias on Asian currencies in general and India?
So I think there's a little bit of a difference. I think India has a bit of a unique position within Asia. So like you said, there's a common factor, which is the rate differential. And absolutely, the rate differential argues a lot more in favor of the US at the moment. I mean, the differential is fairly wide. And on top of it, given how low inflation is in bulk of Asia, including India, the bias should be for, in a way, that differential to at least sustain at these levels, maybe even widen, depending upon how quickly central banks in Asia actually cut rates. The other factor, though, besides rate differential, which is driving, in my view, the currency markets, is, of course, this sort of lessening appeal, the safe haven appeal, if you might, of the dollar, or the willingness of the rest of the world to be able to invest in US assets or recalibrate the exposure they have towards the dollar. And that's something which I think is far more better looked at from the metric of net international investment position. Now, that's where India differs a lot. A lot of Asia is surplus on its NIIP. India isn't necessarily, so it doesn't necessarily benefit from the same factors. But for a lot of the rest of Asia, I'd say the fact that the investment community is not willing to necessarily at least incrementally add to its dollar exposure and probably willing to convert a larger part of its dollar stock holdings into local currency itself lends more of an appreciation bias. I think India is a bit of an exception on that front, but certainly for rest of Asia currencies, our bias is to think for more strength in the second half of the year. Okay,
more strength for other Asian currencies. Rupee perhaps will move both ways. I'll come to your view on the dollar itself in just a minute. Chetan has joined in. Welcome to the show, Chetan. Well, I wanted to begin at the beginning. You know, as we explained at the start, we are living with 10% import tariffs for the US and 50% for steel and aluminium. But the rest is a whole lot of threats. Nothing has been implemented just yet. What does this mean for EMs? Does it mean that you can actually push up your growth forecasts or no?
Well, not really. I think, Lata, I think not only this the new announcement, but the ones which were announced earlier are also still not yet reflected in the growth data points that we are watching across the region. The reason why there is a lag is because when you think about the tariff impact, So the tariff impact has also been delayed because stuff that gets imported into the US, if it is shipped on a particular date, which is right before the tariff is imposed, it does not attract that tariff on the US shores. And so that is, if you look at the US customs data, weighted average tariff in the US has increased to approximately 10%. But when we do the actual math of what is the weighted average tariff rate based on what were the import values last year, and then what is the tariff imposed on different countries, and that number is 13.5%. So tariff itself has got delayed in terms of actual collection because of the way the accounting is done. Plus, you have the other challenge, which is that, corporate sector has taken a decision not to invest in future projects, or if they have taken the decision not to invest in the future projects, that impact also takes time to come through in the numbers, because right now we are still implementing the projects which were announced earlier. And so the investor base has suddenly got that sort of sense that, oh, tariff doesn't impact US inflation, tariff doesn't impact corporate margins, tariff is not going to be an issue as far as the CapEx decision is concerned. We don't agree with that. We think all of this impact is in the pipeline, and we're going to begin to see that from the third quarter of this year. And for Asia specifically, we are saying that, the CapEx numbers for July, August, which we will be measuring very clearly from the capital goods imports data, which is a high frequency number. And that's what will actually come through. So, and the new announcements are only going to make this whole downtrend that we are building in either more confirmed, or you'll probably see more downside out of additional tariffs.
Okay. Well, I have a lot of questions on then EM growth for you. But, specifically with respect to India, Chetan, see, the big expectation is that we will not be taxed as much as, say, Vietnam or Bangladesh, that we would be, taxed less. Probably we already have a 10%, maybe it would become 15 or 20. Will your forecast of India's growth be very different from what it is now? If it is indeed 15 or 20, let's work with those numbers.
Look, I think the biggest impact that we have been referring to is the point on global trade and global CapEx, and consequently also India's CapEx trajectory. And that part of the impact is more connected to this uncertainty that has been created on account of tariffs, which is going to remain. I mean, if the global trajectory gets affected more because of the new tariffs, and therefore India's exports, or also Indian corporations' confidence on their export demand outlook, that part is sort of independent of what tariff specifically is imposed on India. I think if that higher tariff is imposed on India, then it takes away that offsetting demand which we would have expected India to get through, because India's tariff is less, other Asian trade partners' tariff is higher, then you could have said that the exporters in India would benefit and they would have market share. So that's the only bit which will be sort of taken away if India's tariff rate is similar to other regional players. Like we've heard Vietnam's number at 20, and if India's number is 15, then that gap narrows and it reduces that market share gain potential that Indian exporters would have had.
So what you're saying is that it's a very small needle that moves if India is indeed able to strike a deal at 15, because in any case, the rest of the world will slow because of the uncertainty and, the higher tariffs that the others are suffering, correct?
Yeah, if I may summarize it better, it's a global beta effect, and there is also an alpha story, right?
Yeah.
So that alpha story is a small proportion. I think the beta is a bigger, important story. If there's a global slowdown, global exports slow, then it will be hard for India to avoid that downturn.
Okay. Louis, a similar question to you, actually. Where are you all in terms of, pitching the growth story in Asia in general, but more particularly for me, India? Will the deal make a very big difference to your estimate of Indian growth?
Well, so these are almost two different stories, right? The general EM Asia story and the India story.
Okay.
Our India story is also, of course, picking up the fact that after a soft patch last year, the recent data on India has been better, so we have become a bit more optimistic on the domestic side. And in an economy like India that is so large and where the domestic side is so important, that really matters. And so I would say, I think if I recollect correctly, our latest change to the India forecast was moving up because of that better domestic momentum. That having said that, more generally, our story on EM Asia, and that kind of includes India, has from the start been like we should not underestimate the impact of those US tariffs and all that uncertainty that my fellow speakers have also talked about, how that is weighing on investment decisions and economic activity. And so we've generally been a little bit less optimistic, if I use the word. I've heard quite a few economists talking in recent years about looking who are going to be the winners in Asia, the countries that will benefit as supply chains are shifting. We have been a bit cautious on that. We have felt that given all that uncertainty, and if your neighbor's tariff is 20% and yours is 15%, is that really going to drive an investment decision that is based on many other factors as well? So we've been quite careful, and we've also been noticing that actually, if you look since the first Trump administration of quite a while ago, overall FDI into Asia in US dollar terms has come down rather than up. And so I think the general story is not really a good one. And trying to find relative winners is, I think, not the most important or not the most worthwhile effort. Generally speaking,
I get your point. You're basically saying what Chetan put it as, the global beta is more important and the alpha is for India will be, lower. I take your point.
But I would say, Lata, like the global story is important, but Asia is a relatively trade-dependent part of the world, right? And so that's why we have become particularly less bullish on the smaller open economies, be they Thailand, South Korea, these types of places.
Fair point. And maybe that's the blessing for India. But Samir, I want to get to the dollar. You brought a very important point to the table that large parts, many countries in Asia are not interested anymore in, buying US assets, especially US treasuries. Now, where do you see the dollar, therefore? There is the big, beautiful bill, and there is the demand side as well. Supply also is against US yields. There'll be too much of it. And there is less demand. So your trajectory for dollar and US yields?
Lata, from my perspective, I think it's very hard to be bullish on the dollar at this point in time, right? I mean, first and foremost, the twin deficits are bearing down on the dollar fairly significantly. We are probably running a current account in the US is, I would argue, probably close to 4 to 5%. This tariff policy hasn't really made much of a difference, though obviously there is a front-loading impact and we need to see payback to that. But at these levels of the current account in the past, the dollar has been materially weaker over a 1 to 2 year period. The other way to look at it is, of course, increasing pressure on the Fed to also ease policy, which could ultimately also take away that rate differential support, which you were earlier speaking about. But probably what is most critical, I'd say, is the fact that ultimately the global appetite to invest in the dollar is just a mirror image of the trade gap the dollar runs with, the US runs with the rest of the world. And to that extent, a shock to the global trade order will eventually also result, as it has been for the last couple of months, on the rest of the world's appetite to own US assets and to be able to fund that US deficit. Now, the US is sitting on a net international investment position which is negative to about 80-90% of GDP. Even if that were to try and revert back to some level of historical norm of about, let's say, 60%, that would still require potentially material dollar weakness from here. Now, the dollar obviously has that safe haven exceptionalism, so it's hard to be able to look at just historical trends to see how much that correction would be. But it's not obvious to me at all that, particularly with the current set of policies, that the global appetite for the safe haven appeal of the dollar is necessarily going to lend to the same level of financing.
Samir, let me just stop you there. I have to take a commercial break. But after the break, I want from all of you some specific numbers on how much of dollar depreciation you see and how much of growth may be impacted by this overall global slowdown that Chetan just spoke about. Back in a minute. Welcome back. We've also been discussing the tariff uncertainty and the tariff threats with Chetan Ahya of Morgan Stanley, Louis Quees of S&P Global Ratings, and Sameer Goel of Deutsche Bank. Gentlemen, thank you very much for your patience. Sameer, I know you're running into a wall in terms of the time limit. So a final question to you. Can you tell us what you're looking at? You argued that there are reasons for a further dollar fall. What are we looking at? Are we looking at a dollar index of 90, even below 90, 89 types? And what does it mean for dollar rupee?
Lata, we don't have formal targets on DXY, but I argue that moving below 95 over the next 6 months, very possible. Once the Fed cycles really underway over an 18-month period, can we actually be looking at something closer to 90? Not entirely impossible, depending, of course, upon how we land on various sort of US policies.
Okay. And the dollar rupee?
So, like I said, I think it's hard for the rupee to completely sort of be able to move against that trend. I'd still probably put dollar rupee higher than where we are right now, then lower, probably towards closer to the forwards of 86.5 in the next sort of 6 months. But that would still mean the rupee is sort of underperforming what rest of Asia currencies would.
Which is what you argued. Thank you very much, Sameer, for your time. I know you're running too many appointments. Chetan, I wanted to ask you about, therefore, what do you look at as the Indian growth? You said the alpha is not enough. So do you think the Reserve Bank's 6.5 is very tough? Do you think we could be in a rate lowering, in a downgrade trend come second half when people realize the impact?
That's right, Lata. So we are expecting growth to slow in India, and the fourth quarter of this year, calendar year, we're expecting growth to slow to 5.9%. So we are expecting it to get to that, below 6%, just below 6% kind of numbers. And that's because of the reason that I mentioned in the first half of our discussion today, that there is going to be that global downtrend that will weigh on India's exports. And we do think that the corporate sector in India is also conscious of these trade tensions. And another point which I didn't mention earlier is that to the extent to which China has been going through this deflation challenge, and we know that when the trade downturn comes in, there will be even bigger deflationary pressures from China to the rest of the region, including India. And that is also making the Indian corporate sector conscious of not going ahead with aggressive capacity expansion because, you know that there is a pricing power problem. You know that there is a competition from China. And so, I think India is going to find it difficult to continue to keep maintaining its growth rates while you have this global trade slowdown and global capex slowdown.
Okay, I want to come to the inflation issue as well. Let me put that first to Louis. Louis, would there be a big deflationary pressure from Asia and from the world in general because of not being able to sell to the big market? India is almost heading towards 2.5% CPI for the next few months. Can the pressure of disinflation mount?
Yeah, so I think when we look at our inflation forecast, there are other drivers than the China or the overcapacity story that are putting downward pressure on inflation. We have had commodity prices, we've had energy prices, but I do think that the wave of industrial products that will be looking for a market now that those US tariffs have gone up and now that we've had a divergence between prices in the US and everywhere else, I think that these pressures will amplify and are going to put more downward pressure on inflation and also, of course, on corporate profits in the region.
Chetan, your view, also the inflation trajectory in India because of the global or Asian disinflationary pressures as well, therefore, is this the last of the rate cuts we saw, or will the Reserve Bank be forced to do more because of growth, if not inflation?
So, Lata, I mentioned my growth forecasts, and those are not very good in the sense that India will still outperform rest of the region, and those numbers which I mentioned are respectable. But there is going to be a slowdown, and already inflation has reached low point. You're going to have deflationary pressures on account of tariff. Tariffs are inflationary for the US, but deflationary for the rest of the world, particularly Asia. And as Louis mentioned, we've got this commodity price decline that is adding on to it. So we think all the factors, domestic capacity utilization suffering with growth slowdown, the international factors like trade, as well as commodity prices, inflation will remain pretty much in control unless you have some supply shocks on account of food. But I think at this point of time, rainfall is looking like it's going to be on track. Area under coverage is up. So yeah, we are highlighting the point that the central banks in the region, including India, will probably end up doing more than what the markets are pricing in right now. And we, in our base case, have one more rate cut. But we are also highlighting the risk that the central banks may end up doing more because of the way the inflation trajectory is going to be across the region. Oh, and sorry, one more point to add, that this currency movement and the dollar weakness is also adding to some kind of disinflationary trajectory. So yeah, it's an additional factor, and it's also an important factor because when the central banks are looking at their domestic growth inflation dynamics and taking a decision to cut their rates, they are not being held back by what's happening to the dollar. Because in the early last year, if you remember, we still had the concern on, what are the currencies going to do if you cut rates ahead of time. But now, with the way the dollar is going, that's another factor that will help central banks, if need be, to cut rates more.
Okay. Well, thank you very much for an extremely enriching discussion, Louis and Chetan. The key takeaway that we may have a small alpha if our tariff rates are lower than, say, Vietnam or Bangladesh, but the bigger beta of global slowdown will take away that advantage. More rate cuts coming, but not for a good reason. They will come because growth is going to disappoint. That's not a very pleasant situation to be in, but that's the way things are panning out. Thank you very much for watching this special edition of Indianomics.
FY24 wasn't all that great for India's insurance sector. The insurance penetration declined to 3.7% from 4%, though the silver lining was that the insurance density marginally increased to $95 from $92. But the industry now has been entrusted with a new vision, Insurance for All by 2047. The vision goes beyond concepts like penetration as well as density. A lot of steps have already been taken towards this aspiration of Insurance for All by 2047. Many more steps yet to be taken. On this Insurance Awareness Day, to discuss all the steps which have been taken and also the ones which are planned, we are joined by Mr. Anup Bagchi, Chair, FICCI Insurance Committee and MD and CEO, ICICI Prudential Life Insurance, Mr. Mayank Bathwal, Co-Chair, FICCI Insurance Committee and CEO, Aditya Birla Health Insurance, Mr. Parag Raja, Member, FICCI Insurance Committee and MD and CEO, Bharti AXA Life Insurance. Mr. Bagchi, to start this discussion with you, the life insurance sector has had a barrage of reforms in the last 1 year. Do you think these reforms have helped the industry to take insurance to policyholders in a much better way than what used to be earlier, or did we somewhere miss the diamond in search for gold? We were too occupied with all these reforms and changes, and somewhere the purpose got lost.
No, I think the reforms that happened in the last few years are very progressive, very customer focused, and really building the foundation for big growth. I'd only add, yes, that we should, when we are looking at penetration, we should not just look at retail penetration. India is a low per capita country. And so on the retail protection side, we should also add the credit